Hello everyone, my name is Mohammad Zain. I'm a chartered accountant and welcome to the revision of accounting, which is your paper 1 of CA Foundation. So before we start, this is a quick revision video. So how we'll do it, we'll go through each and every concept, we'll cover all the chapters and we'll do one or two questions from the material, or we'll discuss examples for each concept. So before we start, let me tell you what flow we'll be following, the flow of chapters that we'll be following for the revision video. We'll start with accounting process, which is your journal, ledger, trial balance, subsidiary books, etc. After that, we'll move on to the concepts of inventory and depreciation. After that, we'll move on to BRS, and then we'll directly go to final accounts. So we'll be following the process of accounting itself. First, we'll learn what is the process. We'll discuss few topics which will be relevant in your final accounts, and we'll move on to final accounts. After that, we'll do the important chapters of NPO, company accounts, and partnership. After that, we'll do the rest of the topics, which is your special transactions and theoretical framework. All right. So theoretical framework, whatever theory is relevant while we are discussing the other topics, we'll discuss it there itself, whatever concepts are relevant, and the rest of the chapter, the whole chapter, we'll go through it in the end. So these 4 chapters, if you see, are the most important and the most which contains more weightage. So on an average, so your accounts paper is for 100 marks, right? So you have to answer 5 questions of 20 marks each, and they'll give you 6 questions, out of the 6 you have to answer 5. So your paper is for 120 marks, out of which you have to answer for 100 marks. So out of these 120 marks, these 4 chapters alone, final accounts, NPO, company accounts, and partnership, comes to around 50 to 60 marks, which is high weightage. More than almost half of the paper contains of these 4 chapters. These 3 combined will be around 30 marks, and the rest will be for the remaining marks. So you can see it contains more weightage. So we'll be following this process. We'll be following this flow when we are discussing the chapters. So first chapter we'll be discussing is accounting process. Let's start with it. Accounting process. What is the accounting process? You know the accounting definition. What is the definition of accounting? Accounting is the process of recording, classifying, and summarizing, right? Accounting is the process of recording, classifying, and summarizing what? Events and transactions. After they record, classify, and summarize, they'll get something. So whatever results they get, they have to communicate to the users, which is nothing but your financial statements. So accounting is the process of recording, classifying, and summarizing. So it's a flow. Flow that we have to follow: recording, classifying, and summarizing events and transactions. And then whatever results they get, they have to communicate the results to the users. All right. So here we'll discuss this. They'll be recording, classifying, and summarizing. We have to follow this flow. First, we'll see recording, classifying, and then summarizing. But what are they recording? Events and transactions. So first, we'll discuss the meaning of transactions and events. What are transactions? Transactions are nothing but performance of business activity. What do you mean by business activity? Sale, purchase of fixed asset, expenses made, or payments made to the lenders, like payments received from the debtors, whatever transactions, whatever business activity happens, those are called transaction. And events is consequence of the transaction. Consequence of the transaction means after all the business activities have happened and we have recorded them, there will be consequence. Means for example, company for example, closing stock. So after the company purchases goods, sold goods, so there will be some stock remaining at the year end, which is a consequence of the transaction, or the balance of debtors at the year end. So these are the events. These are not activities. These are the events that are happening as a consequence of the transaction that has taken place. So this is the meaning of transactions and events. So these transactions and events, what we'll be doing? We'll be recording, classifying, and then summarizing. So we'll start with recording here. Recording. You have to record the events and transactions. How will we record? We record it using something called journal entries, right? Journal entries. For this, we follow a system called double entry bookkeeping system. Double entry bookkeeping system. So this system assumes that there is this system says that there are always, whenever a transaction or event takes place, there are two aspects to it. One is debit and one is credit. Two aspects, debit and credit. We have heard this when we are passing the journal entry. How is this? How is it telling two aspects? Anything you take. For example, we purchase goods. How is it telling two aspects? Because when we purchase goods, the goods are coming into the company. You are getting the asset. You are like spending amount. You are getting the inventory into the company, but you have to pay to the creditor. Whoever is supplying the goods, you have to pay to them. So there are like two aspects of it. That's what it means, that the goods are coming in, but you have to pay the cash. So cash is going out. So that's what is meant by double entry bookkeeping system. So so double entry bookkeeping system means that every transaction that you record, there are two aspects, and both the aspects should be recorded in the financial statements. There are certain advantages to it. Which is given in your books. First is profit or loss. Profit or loss can be calculated using it. Second one, financial position. What's financial position? After the profit and loss is ascertained for the year, at the year end, there will be what is the position of the company, what are the assets, what are the liabilities lying in the books. That is financial position. So that can be ascertained when we follow double entry bookkeeping system. Third, so whenever double entry bookkeeping system and the financials are prepared every year, it enables us to compare the results and position. Compare the results and position with the previous year. Or previous years. So it enables us to compare the results and position. And fourth one is accuracy. It says that it is more accurate when we follow double entry bookkeeping system. So the main thing is there are two aspects, and both the aspects should be recorded, both debit and credit. So we'll be doing that using the journal entry, right? So for journal entry, there are two approaches that can be followed. One is traditional and one is modern, which is your accounting equation approach. Let's discuss traditional first. So traditional, you would have heard, right? Golden rules. So the classification of accounts is done in traditional. One is personal accounts. Second one is real accounts. Third is nominal accounts. So what is personal accounts? Again, it's divided into three: natural person accounts, artificial personal accounts, and representative personal accounts. So what is personal? Personal is nothing but human beings. So natural natural personal accounts nothing but it's human beings. For example, Ram sold goods to Sham. So Ram and Sham both are natural persons. So when Ram becomes a debtor or creditor in the books, so that is considered as natural personal account. What is artificial personal accounts? It's nothing but companies, firms, trusts, etc. So it's like a person, like a natural person is not there, but a registered artificial person is there. It can be company, firm, etc. What is representative? Representative nothing but, for example, there is something called, for example, prepaid expenses. Prepaid expenses, there are some expenses that we have spent and we have paid in advance, so that's an asset in our books, but we have paid it to a person. So paid it to a person. It can be natural or artificial. When it's sitting in our books, it's called a representative personal account. It can, the examples are prepaid expense or outstanding expense, or even something like capital and drawings. Capital, whatever owner brings in, so the capital account whatever is there, it's a representative personal account. So when we say capital, it's neither a natural person or an artificial person. It's not an entity. It's a representative personal account. Then what is real account? Real account is nothing but the assets of the company. Assets of the company, cash, fixed assets, etc. But excluding debtors. Because debtors are personal accounts, right? So when we say natural persons, that will come under that natural or artificial. But all the other assets, including cash, excluding debtors, are real accounts. And what is nominal account? Nominal account is nothing but your expenses, income, losses, and gains. So whatever comes in your P&L is your nominal accounts. Clear till here? So this is the classification in your traditional approach which is followed. And what are the rules? What are the rules to be followed to pass the journal entry? In case of personal accounts, debit the receiver and credit the giver, right? In case of real accounts, debit what comes in and credit what goes out. And third, nominal account, what will be the what will be the rule? Debit all expenses and losses and credit all incomes and gains. So these are called the golden rules that this should be followed. So for example, one or two examples we'll take. Purchase of goods. So for example, cash is paid and we have purchased the goods. So what is purchase? First of all, purchase is an expense. You are spending on the expense. What is the rule for? So it's an expense. So it's a nominal account. So they are telling that debit the expenses and losses. So we'll be doing purchase account debit. So along with, so this is the debit aspect of the transaction. What is the credit aspect? The cash is going out. What is cash? Cash is a real account. Real account, the rule is debit what comes in and credit what goes out. Cash is going out here, so will be to cash account. So purchase account debit to cash account will do whatever amount, for example 1000 rupees. Clear? So this is how the rules of traditional approach are. There's one more approach which is accounting equation approach, which is the modern approach. So what is the accounting equation? We'll do it here. So accounting equation approach. What is the accounting equation? They say that assets minus liabilities. So what are assets you own minus, if you remove the liabilities, it's nothing but capital. What's capital? Whatever owner's equity is there, or owner's equity you can write. So they're telling that whatever assets you own minus, if you remove the liabilities, it is capital. We'll break down this equation further. So assets minus liabilities, it is fine. Liabilities. What is capital? So capital, if you know, capital is what is the amount invested. So whatever amount invested by the owner, that is capital, plus we'll add the profits earned by the company during the year. What are profits? Profit is nothing but income minus loss. Correct? Income minus expenses. Income minus, sorry about this, income minus expenses. Correct? And from this we'll remove drawings. So whatever amount is taken out by the owner, that will be drawings. So if we break down the main equation is this that assets minus liabilities is equal to equity. We break down further, we are getting this. What is capital? Capital is nothing but whatever owner has got minus we'll remove whatever owner has taken out, which is drawings, plus we'll add the profit during the year. This is nothing but profit, your profit or loss, profit or loss. So plus income minus expense we do. So this is the breakdown of the equation. So here, so in classification of accounts, previously in traditional approach, classification was done as personal account, real account and nominal accounts. Here the classification is very simple. So whatever are there in this equation is what is the classification. We have assets, we have liabilities, we have capital, which is nothing but the what is owner is getting. We have drawings, what the owner is taking out of the company, and there is income or revenue and expenses. So this is the classification in classification accounts in the modern approach or accounting equation approach. So here what they say is, these 6 accounts are there. The rules are like, they have given the nature of every account. So they are telling that assets is a debit natured account, liabilities credit, capital credit, drawings debit, income or revenue same as what we follow for nominal accounts in golden rules. Income or revenue will be credit and expenses or losses will be debit. So this is the nature of the accounts. So rule, what they say is, they'll check whether the account is increasing or decreasing. Now for example assets, they'll take whether it is increasing or decreasing. If it is increasing, we'll debit it because it is debit natured. Clear? Change this. Right. So rules, what they say is, they'll check whether there is increase or decrease in that particular account. For example, there is an asset, the asset is increasing, we'll debit it because it is debit natured account. And if there is decrease in the asset, we'll credit it, which is the opposite. Now same thing, take liabilities. Liabilities, if there is increase, you will credit it because it's a credit natured account. And same, if there is decrease, we'll debit the account. The same method is followed for the rest of the accounts. Capital, because it is credit natured, increase will credit it, decrease will debit it. Drawings, because it is debit, if there is increase in drawings, then will debit it. But if there is decrease in drawings, then will credit it. Income or revenue, it's a credit natured account. If there is increase in revenue, sale has been made, will credit it. And if there is decrease, then will debit it. Expenses, same, increase will debit and decrease will credit. Far simpler than the traditional approach. So here you can, the classification is 6, which will be following in the financial statements as well. You have assets, liabilities, capital and drawings, which will be coming in your balance sheet, and you have income and expenses, which will be coming in your P&L. So for all these 6 accounts, they have given the nature. Assets will be debit accounts, liabilities will be credit accounts, capital credit, drawings debit, income is credit, and expenses debit. So if there is increase, you should do whatever the nature is. If it is a debit natured account, debit it. If it is a credit natured account, credit it. If there is decrease, do the opposite. Clear till here? So this is the classification is in modern rule. We can do one question in the journal, but before we do, we'll discuss one more topic, which is from theoretical framework chapter, which is capital or revenue expenditure. This will be useful when you are capital versus revenue expenditure. Capital versus revenue expenditure. This will be useful when you are passing the journal entries. You have to identify whether it's a asset or liability or an expense, right? So one of the topic which will be useful is capital versus revenue expenditure. Now what is this capital versus revenue? What capital means is that whatever expenditure we are making, the benefit from that expenditure comes for more than a year, greater than 1 year. So this is relevant because we follow accounting period concept, right? Because we prepare financial statements for a particular year. Because of that, this concept becomes relevant. So capital expenditure, we are telling that when we are spending it, the benefits which we are getting out of it is for more than 1 year. And revenue, it is benefit is for less than 1 year. Less than 1 year. So how is it relevant? Now, for example, machinery purchased. Machinery will be used for the next 5 years. Now, it's an expenditure. Yes, it is an expenditure. You are spending, you are paying the amount to the lender, whoever is supplying that machinery, you are getting that machinery. It is an expenditure. But if we record that expenditure in the profit and loss account, it won't give us a clear picture. The profit or loss that we'll get won't give us a clear picture because the machine can be used for 5 years. If we put the whole expenditure in the P&L itself, in the current year itself, it won't give us the right profit or loss. So whenever the benefits that we are getting from that expenditure comes for more than 1 year, it is called a capital expenditure, and this is recorded in balance sheet. And whenever benefit is for less than 1 year, it is recorded in profit and loss account. Clear? So this helps in identifying whether you should record it as an expense which comes in P&L or record it as an asset which comes in the balance sheet. Clear? There are few differences that you have to that we can discuss here. Now, excuse me. Now, on what basis will we decide whether it's a capital or revenue expenditure? First is nature of business. Nature of business. How nature of business? For example, there's a laptop. We use laptops, right? There is a laptop. And for example, the institute bought a laptop for the recording of classes and like editing videos, etc. So the institute bought a laptop. It's a capital expenditure or revenue expenditure. It's a capital expenditure because it can be used for more than a year. So what is the nature of business of the institute? It's giving education to the students. So the laptop becomes an asset because the benefit is accruing for more than 1 year. But for example, Reliance Digital, the store, the Reliance Digital buys a laptop. They get some 10 laptops for the resale purpose. Is that an asset? No, it's a revenue expenditure because they'll record it as purchases. But if the institute is buying, they'll record it as an asset. So it depends on the nature of business. For example, a furniture guy, there are benches in the classroom. So when it's in the classroom, the nature of the business of the institute is not to sell furniture. So they'll record it as an asset. But those same benches, if they are in the IKEA store, that's an inventory for them. That's a purchase. So that becomes a revenue expenditure. So this is nature of expenditure. The second one is recurring nature. Recurring nature. So they say that capital expenditure will be non-recurring in nature and revenue expenditure will be recurring in nature. How? For example, same thing. The benefit is for more than 1 year. If they purchase an asset, they won't be purchasing the same machinery again and again every year, right? Because that can be used for the 5 years. But for example, annual maintenance is there for that same machinery. That has to be done every year. It's annual maintenance. So the purchase of machinery becomes a capital expenditure. But whatever we are spending for maintenance of it becomes which is recurring in nature, but that becomes a revenue expenditure. Third point is purpose. Purpose of the expense. If it is for like routine everyday operations, for example, salary is paid. Salary will be paid every year, right? So if it is routine expenditure, which is like done like now and then frequently, that is revenue expenditure. But if it is done for anything like production capacity or anything, now the same machinery example we can take. Now machinery example, what did we discuss? That the maintenance is recurring in nature and purchase is non-recurring in nature. On that basis we'll calculate. Now for example, purpose. So annual maintenance, it is a revenue expenditure. We discussed that. For example, after some 2 years, the company decides that same machinery, whatever we purchase, the same machinery, we decide that we'll add one more component to it. And because of that, the production of goods will go up by 10%. So if they were able to produce 100 units per month now, they'll be able to produce 110 units tomorrow. So whenever there is increase in the capacity of the asset, then that will be capital expenditure. Increase in the production capacity, etc. But if there is no increase, it is annual maintenance. So there is annual maintenance, or take even repairs. For example, some repair happened, they are calling one technician and getting it repaired. So that is not increasing so whenever they have spent the amount, that is not increasing the production capacity of that asset. So that will be revenue in nature. So if there is any expenditure which is spent which increases the production capacity, that will be capital in nature. And if the same expenditure is made but it doesn't increase any production capacity, it is like normal maintenance, that will be revenue in nature. Clear? So fourth will be materiality of the amount. Capital expenditure are generally of higher value. Capital expenditure is generally of higher value, and revenue expenditure is generally of smaller value. It can't be applied like in general, but like most of the cases, the materiality of amount, the amount value will be higher in case of capital expenditure and lower in case of revenue expenditure, because in case of capital expenditure the benefits are for more than 1 year. And fifth one is revenue earning capacity. Earning capacity just means that, so in case of capital expenditure, the revenue earning capacity will be for more than a year, greater than 1 year. And in case of revenue expenditure, the revenue earning capacity will be less than 1 year. Correct? So if the revenue earning capacity of an expenditure is for more than 1 year, we'll conclude that as capital expenditure and we'll record it in balance sheet itself. So this is the summary of revenue versus capital expenditure. So 5 points you should remember is, one is nature of business. If the nature of business is to sell or buy those items, that will be revenue in nature. But the nature of business is different and that asset is used for more than 1 year, then it will be capital in nature. Next, recurring. If it is non-recurring, capital. If it is recurring, revenue. Then purpose. If it increases production capacity of the asset, then it will be capital in nature. If that doesn't make any change to the capacity of the asset, that will be revenue in nature. Materiality of the amount, capital, higher value, revenue, smaller value. And revenue earning capacity will be more than 1 year in case of capital expenditure, less than 1 year in case of revenue expenditure. Clear? So this is one concept which is there in the theoretical framework, which will be using in our journal entries. Now for example, if there is purchase of machinery, it will be an asset account. Machinery will be an asset account. Or if they say purchase of goods, then it will be expenditure. So to identify that, this concept will be useful. Now let's get back to our journal entries. Journal entries. So how the way they can ask their the question is, they'll give you the transaction details, purchased goods, sold goods, rent paid, salary paid, etc. And you have to record it in double entry bookkeeping system. You have to record both the aspects, debit and credit. Clear? Now for journal, whenever we are passing journal entries, there is a format that we have to follow. Date, on what date the transaction has taken place. Particulars, here we'll be writing the account names, which is debited and which is credited. There is something called ledger folio number. This in normally you can leave it blank because they wouldn't have given the ledger folio numbers. You can leave it blank. Then there is debit amount, debit in rupees, and credit in rupees. So this will be the format that you will be following whenever they are asking for journal entries. We have discussed both the approaches, traditional approach and modern approach. We'll solve one question for journal entries now. Come to journal entries, question number 6 in the ArivuPro study book. This question, same question is there in ICA material as well. You can refer that if you want. We'll solve the question quickly. Now they have given transactions of Ramesh for April are given below. So April month transactions they have given. First transaction is Ramesh started a business with 10 lakh rupees. What do they mean? That it is a the owner. So Ramesh is the owner. The owner is getting the capital into the business. How much? 10 lakhs. We'll record this. We'll record this here. So the format I already told you. We'll write journal entries journal entries in books of Ramesh, right? In books of Ramesh. Format will be date, particulars, ledger folio number, debit in rupees. They've given in rupees only, right? Have they given? They've not given the denomination. Normally they'll give rupees, and credit in rupees. Now, what's the first transaction they're telling? That on April 1st, Ramesh started a business with 10 lakh rupees. On 1st April, here they have not given, here this is 2020. On 1st April 2020, Ramesh started a business with 10 lakh rupees. So he started a business with 10 lakh rupees, which means that he's getting that 10 lakh rupees into the business. Cash is coming in, correct? And capital will come in because owner is getting the amount. So the two aspects are, one is cash, which is coming in, and one is capital balance of the owner, which is increasing because he's getting the amount of 10 lakh rupees. Now what will you debit and what will you credit? What is the cash? In the classification of accounts, cash is a asset, and asset is increasing now because the owner is getting the capital. The cash is increasing in the books, so we'll do cash account debit. So you'll be writing the entry like this: cash account debit to capital account. Why capital account is crediting? Capital account is normally a credit natured account. So capital balance is also increasing because the owner has got capital. So we'll be doing cash account debit to capital account. No need to record anything in the LF number. Debit rupees 10 lakhs and credit rupees 10 lakh. So this is how you record the entry. After recording the entry, you will record a narration as well. Being cash bought in by the owner, right? The wordings can be simple, just whatever, or you can use the wordings given in the transaction as well. Being Ramesh started business with cash, right? 10 lakh rupees. So this will be the entry. This is how you will be recording. We'll go through the solution for each entry and we'll close it. First entry, what is it? We told cash account debit to capital account. In question, normally, so this is normally, if they have not given anything, it's better you use it as bank rather than cash, because if we see the next transaction, he has told that bought goods per check, which is bank transaction. So it's better will be bank account debit to capital account. So this you can see the format. They have given date, particulars, LF number, debit amount and credit amount. On April 1st, they recorded bank account debit to capital account 10 lakh rupees. Then let's go to second transaction. What are they saying? Bought goods per check. Bought goods, which means what? Revenue expenditure or capital expenditure? Revenue expenditure, which is because it is purchase of goods. If they had told asset, then it would have been different. So bought goods for check. So what is happening? Bank amount is reducing because you are purchasing goods. The bank balance will go down, right? And goods will come in. So purchase, which is an expense for us, is increasing. Now, if we go back to our rules, what is it? Bank is an asset account. It is decreasing. So we will credit it. And purchase is an expense. It is increasing. So we will debit it. What will be the entry? Purchase account debit. Purchase account debit to bank account. Right? So on April 3rd, purchase account debit, purchase balance. So the purchase account, the expense is increasing. So we'll debit it and to bank account. Bank is an asset, but the bank balance is an asset and which is decreasing. So credit will do bank account. We'll write the amount 50,000 and 50,000. Clear? Next entry, if we see, what are they telling? Drew cash from the bank. Whenever they're telling drew cash from the bank, will it be drawings? Will it be drawings? No, because if they tell drawings, they will give that word specifically that it is drawings, which is a reduction from capital of the partner. Whenever they just tell drew from the cash, it means that they got the cash in the company. They have bank balance, right? He got the capital in bank, 10 lakh rupees, then they spent 50,000. The balance amount is there in bank, but they'll need cash in the business. They'll need the physical cash as well. So whenever they say drew cash from bank, we have to consider it as they're withdrawing the cash from the bank for the business purpose. So what will be the entry? Cash is coming in, which is an asset. Cash is coming, so asset is increasing, but bank, which is also an asset, is decreasing. So we discuss the rule is whenever it is an asset account, if there is increase, we'll debit it, decrease, will credit it. So there are both the aspects here. Cash, it is increasing, we'll do debit, cash account debit. Bank is reducing because the amount is withdrawn from the bank account, bank is reducing. So cash account debit to bank account. Cash account debit to bank account. How much? 10,000. 10,000. Recorded here. Being cash withdrawn from the bank. This is not drawings. This is not the drawings made by the owner. For his, if he has taken the amount for his personal purpose, then it will be drawings. Whenever they say that cash drawn from bank, it just means that cash has been physical cash has been bought into the business for the use in the business itself. So it will be cash account debit to bank account. Done with the third entry. Fourth entry, they're telling that on 13th of April 2020, sold goods to Krishna on credit. So they have sold to Krishna goods on credit. On credit, what do they mean? That whenever they are selling the goods to Krishna, Krishna is not paying the amount right away. They are selling him on credit, that he can pay on a later date. At that time, what happens? So Krishna, when he owes the amount, he becomes a debtor. When we sold the goods, he becomes a debtor and his debtor balance increases. Whenever his debtor balance increases, debtor is an asset, something that we have to receive. So it's an asset and it is increasing. So we will debit it. The debtor balance is increasing, right? So we will debit it. What to credit? Sales. Sales is what? Sales is revenue or income, which is a credit natured account. Sales is increasing, so we will credit the sales. So sales is increasing, which is a income, so we will credit it. Debtor is a asset, debit natured account, which is increasing, will debit the debtor. What will be the entry? Debtor account debit to sales account. How much? 1,50,000, which you can see the entry here. Who is the debtor here? Krishna account debit 1,50,000 to sales account 50,000. Clear till here? Right? So the fourth entry also we have passed. Krishna account debit to sales account. Done till here. Now next, we are done with sold to Krishna, goods on credit. Next, bought from Sham, goods on credit. Same, on credit we have bought, but are we paying right away? If we are purchasing, if Ramesh is purchasing the goods, he has to pay the amount, but he is buying on credit, so he doesn't have to pay right away. So but he has to pay on a later date. So Sham, what he becomes is a creditor, which is a liability that we are not paying him today, but sometime we will have to pay him. So he becomes a creditor in our books, which is a liability account, which is a credit natured account. So creditor balance is increasing, which is a liability, which is a credit natured account. Whenever it is increasing, we will credit it. So we'll credit the creditor. Who is a creditor? Sham account. Sham account will credit to Sham account. To Sham account, how much? 2,25,000. What will we debit? Will debit the expense. They are telling bought goods, which means it is purchases. Purchases is nothing but expense, and expense is a debit natured account and it is increasing. So purchase account debit to Sham account 2,25,000. Yeah, you can see the entry here. Purchase account debit to Sham account 2,25,000, being goods bought from Sham on credit. Right? Clear till here? Yeah. Next. We are done till here, 20th. So 24th April, what is happening? Received from Krishna. What received? They received the amount from Krishna through cash or bank. Whenever they have not given, assume that it is bank. Then received from Krishna. So bank balance is increasing. Correct? Bank balance is increasing. And whenever we received from Krishna, Krishna is a debtor in our books right now. When we receive the amount from Krishna, he doesn't remain a debtor anymore because he is already paid. So debtor Krishna is decreasing. So the asset of bank is increasing because we are receiving the amount, but the asset of debtor is decreasing because he is paying the amount. He no longer owes us any amount. So what will be the entry? Bank account debit, because bank balance is increasing, to debtor account. Who's debtor here? Krishna account. How much? 1,45,000. How much did he owe to the company? 1,50,000. 1,50,000 he had to pay. How much is he paying? 1,45,000. You can see the next transaction. We are telling that allowed him discount. Who allowed the discount? Ramesh, the owner, allowed him discount of 5,000. Telling that, okay, you pay me 1,45,000, 5,000 is discount. Discount we have to record. Whenever we are allowing the discount, what is it? Expense or income? It's an expense because it's a loss to us, right? We had to receive how much? 1,50,000. We are receiving only 1,45,000. So 5,000 is an expense to us, and expense we should always debit when it is increasing. So here discount is debit. So here how we'll record it? We'll record something called compound entry. Normally there is debit and credit. We'll debit something, credit something. There can be two debits or two credits sometime as well. Like in this case, they are receiving how much? Bank account debit. Asset is increasing, 1,45,000. There is an expense which is discount. Discount allowed. Account debit. It's an expense, right? We'll debit it, 5,000. So we are debiting two accounts to Krishna account, because he is paying 1,45,000 and he is getting 5,000 discount. Means he doesn't owe us anything right now. So it becomes 1,50,000 credit. Clear? You can see the entry here. Bank account debit, how much? 1,45,000. Discount account, which is nothing but discount allowed, which is an expense, 5,000 to Krishna account, because the debtor balance is decreasing. Clear with this entry? This is nothing but compound entry, that there are more than two accounts, like more than two debit, more than one debit or more than one credit. Clear? Now next, they've told that on April 28, paid Sham. So who was Sham? Sham, from Sham we bought goods. Sham is the creditor. So we paid Sham. When we pay Sham, first of all, they're telling that they paid cash. They're specifically telling that they paid cash. So cash, what happens? Cash balance reduces, and they're telling how much is paid to Sham. 2,15,000 is paid, but discount is allowed 10,000. We owed him 2,25,000. He allowed discount. Who allowed discount? Sham allowed discount to Ramesh. How much? 10,000. It's an income or expense. We are receiving the discount. Who allowed the discount? Sham allowed the discount. Ramesh is receiving the discount. So discount received is always income. So cash is reducing 2,15,000. Income is increasing. Income is increasing by 10,000. And one more is creditor is becoming 0. Who is creditor? Sham. Correct. Creditor is a credit account. Whenever that is decreasing, we have to debit the creditor account. So we have to debit the creditor account. Cash is going down, so we have to credit it. Income is going up. Income is a credit account, so we have to credit this as well. So what will be the entry? Sham account debit. How much? Total amount 2,25,000 to cash account. How much? 2,15,000 to discount received. They have told that discount allowed, but the discount allowed is by Sham. Correct? So discount received is how much? 10,000. You can see the entry here. Sham account debit. Sham account debit. They have told bank account. You can assume it as cash account itself because they have specifically given it as cash, and to discount account. The amounts 2,25,000, 2,15,000 and 10,000. Done with this entry. Next, what is the transaction? Cash sales for the month. Cash sales for the month. Cash sales, what does it mean? Sale is made and cash is received. It's not credit sale, it is cash sale. Whenever this happens, cash is coming in. Whenever we make sale, we receive the cash. So cash is increasing, asset is increasing, we'll debit it. And income is increasing, we are making the sales. Income is increasing, we'll credit it. Simple entry. Bank account debit. Sorry, cash account debit. They're telling cash sale specifically. So cash account debit to sales account. They've told bank, but you can tell, it's a mistake here. You can write cash. Cash account debit to sales account. The narration will be being sold goods for cash. Amount is 8 lakhs. Clear? Next. There are 2 more entries there. Paid rent. Paid rent for the month. How much? 50,000. Paid salary for the month. 1 lakh. So both are expenses. Expense is increasing. Expense is a debit account. So rent account debit, which is expense, will debit it. So paid rent. So we would have paid using cash or bank. Nothing is given, so we'll assume it as bank. So bank balance is reducing to bank account. How much? 50,000. 50,000. So same entry for salary. What will be the entry? Salary account debit to bank account. So you can see the entry here. They have given one single entry, compound entry, because it doesn't make any difference. You can give it separately also, once also. They have told rent account debit 50,000, salaries account debit 1 lakh, and the bank account is getting reduced by the total amount. So you can record this separately also, or like this compound entry as well. It doesn't make a difference. Clear? Clear? One question is enough for journal entry. We'll move to the next topic, which is ledger. Ledger. Just a minute. Right, we'll continue with the ledger topic now. We are done with journal. So what did we discuss in journal? Double entry bookkeeping system, then two approaches, traditional approach and accounting equation approach. Then we discussed capital versus revenue expenditure as well, and then we did one question. Now let's come back to ledger. So what is the accounting definition? Accounting is the process of recording, classifying and summarizing the transaction in events. So we are done with recording. In the question that we did just now, we recorded using journal entries. Now next process is classifying. That whatever account, that every account that we have recorded in journal entry, we have to open a ledger account for that, and we have to record like for that particular account what all has been debited, what all has been credited. That is nothing but called posting. So what is a ledger? Ledger is also called principal books of accounts. That, for example, what was our first entry? Bank account and capital account, right? So in the same example we'll take, and we'll try to make the ledger accounts. Now first entry was what? Bank account debit to capital account. Now for both bank account and capital account, there should be a ledger. For every account that is prepared, a ledger should be prepared. For every account that has been recorded, there should be a ledger that should be prepared. Now let's take the same example and draw ledger accounts. We'll just prepare bank account. The same way all the ledgers should be prepared. So let's prepare bank account. So there is a format that we have to follow for ledger: debit and credit. So you have date, you have particulars, you have journal folio number. Same like ledger folio, journal folio number is there. In exams you don't have to write anything, you can leave it blank. Date, particulars, journal folio and amount. Right, so debit side, so left side is always debit and right side is always credit. So this is the format of the ledger account. Now let's prepare bank account. How will we post it is what we have to see here. What is the first entry that has taken place? Bank account debit to capital account. So we are preparing the ledger of bank account, right? So when we are preparing bank account, we have to see what, like whether bank account has been debited or credited. So here what has been done? It has been debited with 10 lakh rupees. So here also on debit side you have to record the 10 lakh rupees. So amount will be 10 lakhs. Amount will be 10 lakhs. But what will you be writing? Date we have 1st April 2020. But what we'll be writing here is with what account it has been debited. Bank account has been debited using capital account. Correct? So we'll write capital account, and we'll always write on the debit side using 2 capital account, and on the credit side we'll always use by. Clear? So first entry, what we recorded is bank account debit to capital account. What is happening there? Ramesh is getting the capital into the company. When we are preparing the ledger of bank account, we have to post, because bank account is getting debited, we have to post on the debit side itself. But what we'll be writing is with what account it has been debited. So here it is capital account. So to capital account 10 lakh rupees. Now for the same entry there is one more account there, correct? Capital account. Now if we prepare a ledger for capital account the same way, right? So if we prepare the ledger in the same way, date, particulars, journal folio number, amount, date, particulars, journal folio number and amount. Now, what will be the posting here? What is happening to capital account? Capital account is being credited. So we have to record on the credit side how much? 10 lakh rupees. But how will you post? On credit side always by bank account, because we are crediting the capital account using bank account. So always by bank 10 lakhs on 1st April 2020. Clear? So we'll continue with the bank account itself and close the ledger. So this whatever however we record this in the ledger account, this process is called posting. So whatever you have recorded as journal entries, you will be posting it in the ledger. So first posting is done. So the first entry is completed. What is the second entry? Purchase account debit to bank. So again bank is involved, but bank is being credited here with 50,000. So we should also credit on the credit side, we should post in the ledger with what? Purchase. So by purchase account on what date? 3rd April. By purchase account how much? 50,000. Clear? Was the third entry. Cash account debit to bank account. Again bank is involved. Again bank is being credited. Correct? So we'll have to post it on the credit side of the ledger using cash account. So again by cash account how much? 10,000. Then what date is it? 5th April. Done. Third entry we have posted. Was the fourth entry? Krishna account debit to sales account. Now we are preparing the bank account, right? The ledger we are preparing in bank account. Is bank involved in this transaction on 13th April? No, nothing is involved, right? So we won't post it. Next entry, purchase account debit to Sham. Bank is not there, so we won't be posting that in the bank account. Next, here it's there, right? Bank account is being debited, bank account balance is increasing, so we have to post that on the debit side of the ledger using what? Using Krishna account. How much? Only 1,45,000, not 1,50,000, because 5,000 is discount. So how much are they receiving? 1,45,000. So to who's the person? Krishna. To Krishna account how much? 1,45,000. And what date did he receive that? Krishna? 24th. 24/4. Krishna account 1,45,000. This will be the posting. Next entry, Sham account debit to bank to discount account. Bank account is involved here. Yes, bank account is involved. What will be the posting? Bank account is being credited here. So we have to record it on credit side of the ledger using what? Sham account. So by Sham account, how much? How much are we paying him? We are not paying him 2,25,000. We are paying him only 2,15,000. So whatever bank account column is there, that amount you should post, which is 2,15,000. Clear? Next, bank account debit to sales account. So it is for cash. So we'll ignore this because it is cash. It is cash account debit to sales account, so we won't be recording there. Next is bank transaction. Bank is credited here. We have to post it on the credit side of the ledger using rent account and salaries account separately. 50,000 and 1 lakh. How will we record that? On credit side, by rent account, by salary account. 50,000 and 1 lakh. Yes. Now we have to close the ledger. Let's discuss the process of closing the ledger. How we close the ledger is, so whatever is the higher side, higher amount, will record that. What will be the higher amount, higher side here? Here 10 lakhs amount is there, so debit side it will be excess. How much? 10 lakh plus 1 lakh 45,000, 11 lakh 45,000. So first we'll get the total of the side which is higher, then we'll try to balance it. So even this should be 11 lakh 45,000, same as this side. So if it should be 11 lakh 45,000, there should be some balance, that we write it as by balance carry down. By balance carry down. So debit side we have excess. So if we have debit side excess and we are getting balance in on the credit side, it is always called debit balance. Debit balance. So if the debit is excess, then even if the balance is coming on the credit side, it is debit balance. If credit side it was excess and it was coming on the debit side, it will be called credit balance. So debit balance, how much is there? We should calculate that. We should calculate that. So 11 lakh 45,000 minus 1 lakh minus 50,000 minus 2 lakh 15,000 minus 10,000 minus 50,000 be 7 lakh 20,000. 7 lakh 20,000 balance carried down. Now ledger. So this is for April month. So this will be on 30th April. I think even this was 30th April. So on the closing date of the month, the ledger is closed. Now next month, when the ledger is opened, it will be 1st May. When the ledger is opened, if you have balance on the credit side in the last month, you should bring that balance in the next month on the opposite side. You have the balance on the credit side here. We'll write it as to balance brought down. So whatever balance we recorded there, that we carried forward and bought it on the opposite side, because that's debit balance anyway, correct? This is a debit balance because debit was excess. We'll get it on the debit side. How much? Same amount, 7 lakh 20,000. And here the next month transaction, whatever May month transactions will take place, that will be recorded in here. Clear with ledger, right? Just remember the format. Once you are clear with journal entries, you can take the journal entry and post it. One trick to even get it easily is, for example, what account were we preparing here is bank account, right? So whenever bank account is being debited to capital account, because here automatically you are getting to capital account, record it as to capital account. 2 on debit side we record, so on debit side to capital account. Next, it's purchases to bank account. It is, we are preparing the bank account ledger, so whenever it is purchases, record it as by purchase account on the credit side. Clear? Now we are done with the ledger as well. So what will you do? You will post the whatever journal entries you have recorded, you will post them in the bank account. You will close it. You will close you'll close it by first getting the total of the side where the amount is higher and balancing it and taking it as by balance, by or to balance carried down, and getting the and recording the difference amount, which whatever you are carry forward, you will be carrying forward to the next month. There you will be recording balance brought down. Clear? Now we'll move to the next topic. So we are done with the ledger. We did the question as well for the same journal, whatever question we did, for that only ledger we recorded. Next is trial balance. So Trial balance is nothing but summary of our ledger accounts. Ledger accounts. So we'll prepare. So as we discussed, ledger accounts will prepare for each and every account. So when we prepare the ledger, at the end there will be a balance that will come. So whatever balances are there, so that balance ka summary is trial balance. So it's a statement which contains the debit and credit balances of the ledger accounts. All right. Accounting definition: it is a process of recording, classifying and summarizing phase. This is the third phase. This is the summary phase. Whatever journals, so we'll prepare ledgers for all the accounts that we have recorded, and whatever balances we get in those ledger accounts, we'll summarize it in trial balance, and it should tally. It should tally. Tally means what? It should match both the sides. The debit and credit sides should match. Why? Because we are following double entry bookkeeping system. Whenever we are recording an entry, for each and every debit amount, equal effect we are giving to credit as well. So because of that, whatever balances we get, debit and credit, both should be same. If not same, there will be some error. Whenever the debit side and credit side of the trial balance is not matching, a temporary account called suspense account is prepared. Suspense account is prepared, and later errors are rectified, and that suspense account is closed. All right. So what is the format? Generally, this is the format of the trial balance. So there will be serial number. There won't be date here because it's a summary of the balances. So serial number, here account name. What is the account name? What is the ledger folio number? And then what is the debit amount? We'll get debit balances. Debit balances and credit balances. Right? There is serial number. Account means ledger account name, and we'll have debit balance and credit balance, and whatever balances we get in the end, both the sides should tally. If it doesn't tally, we'll open something called suspense account in the end, and whatever in whatever column there is a shortage, we'll record that amount. Whatever is the difference, we'll record in that column and tally it. We'll tally it for the time being, but later we will find out what are the errors have happened and close this suspense account by rectifying those errors. Clear? Why do we prepare this trial balance? The objectives. Why do we prepare? First is to check arithmetical accuracy. What do you mean? If you have recorded all the journals properly, means for every debit effect you should have given a credit effect, and you posted it properly in the ledgers, then it should tally, correct? So if it's not tallying, then you have a problem. So to check that accuracy, whether we have properly recorded and classified the accounts, we have to prepare trial balance before we prepare the financial statements. Second one is for financial statement preparation. When trial balance is there, it becomes very easy because you have a summary of balances. You know that, okay, what are the expenses, what are the assets, what are the liabilities. You have the balances directly rather than the innumerable ledger accounts in your books. So whenever a summary is there, the financial statement preparation becomes easy. And as we said, trial balance is a summary of all the ledger accounts. There are few limitations as well. Limitations of trial balance. That even if arithmetical accuracy is found out, it is not a conclusive proof that it is accurate, because for example, uh, take your revenue versus capital expenditure rule, right? So for example, you purchased a machinery, but by mistake you recorded it as purchase expense, which is purchase of goods. So you had to record machinery account, you recorded purchase account. So whether there will be a difference in your trial balance is no, because rather than having asset balance, it will have expense balance and the trial balance will tally. But is that right? Are the books right? No. So the limitation is that it's not a conclusive proof that the books are fine. So these kind of errors, there are many errors that can't be traced only by preparing trial balance. So even after preparing, there will be few errors which will be missed out because it will be tallied. It will tally, but it's not that the books are totally accurate. So for that, we'll discuss in the rectification of errors chapter. But the limitation is that all the errors can't be deducted. All the errors cannot be detected. Clear? So we discussed the format here, right? So we know on debit balance what all will come. What are our classifications? So the asset balances should come on debit side. The expense balances should come on debit side. What else? The drawings, whatever are there, should come on debit side. And on the credit side, liabilities should come. Liabilities should come. Should your income should come on the credit side, and the capital balance of the owner should come on the credit side. Yes, clear with this? Next, now we'll take the question. We'll just see how it will come for this question itself. Now we prepared the we prepared bank account here, right? We just prepared. So for this trial balance, if we are recording, we'll see how it comes. So serial number, account name, ledger folio number, debit balances, credit balances. So what did we prepare? Bank. We prepared bank account. What is the balance? Balance is 7,20,000. Debit balance or credit balance? We already discussed. If the debit side is excess, then it is called debit balance. Also, we can say that because it is bank, we are getting a debit balance. Bank is an asset, right? Debit balance of 7,20,000 you are getting. Don't tally it like journal. Debit also 7,20,000, credit also 7,20,000. Credit, no balance will come. So bank balance will come on the debit side, 7,20,000. Similarly, we opened the capital account, right? Capital account, is there any other transaction? No, there is only one capital account. So capital account ledger, when we prepared, what was the posting? What was the posting? On 1st April on credit side, right? Because capital is being credited here. So on 1st of April by bank account. By bank account, how much? 10 lakh rupees. Capital account. Yes, 10 lakh rupees. There's no other entry passed for capital account. We can close this. So on 30th April, we can close this. How much? So if you balance, only one transaction is there. Credit is excess. Credit is excess. So you will do 2 balance carry down. How much? 10 lakh rupees. Both the sides are tallying. 10 lakh and 10 lakh. To balance carry down, 10 lakh rupees. This, if we have to summarize in the trial balance, then we'll write capital. What balance? Debit balance or credit balance? It is coming on the debit side, but excess is credit. So we'll write 10 lakhs on credit column. So like this, we have to summarize the balances of each and every ledger that we have prepared. So in the end, everything should tally. Yes, clear? It will tally. Here it's not tallying because we have not recorded all the ledgers. Once we record all the ledgers, it will tally. Now one more concept in trial balance that we have to discuss is methods of preparing TB. Now one method is nothing but what format to use. Now one is, as we discussed, there will be serial number, name of the ledger account, ledger folio number, and there will be debit balance, and there will be credit balance. This is a way. This is called balance method. This is called balance method, that whatever balance you are getting ultimately, you record it. This is the way generally they'll give you. So in final accounts, they'll give you trial balance in the question itself. In general, they'll give you only balances. They won't use any other method. There are two more methods. One is total method. Total method. Now the format will remain the same. Serial number, name, ledger folio number. But here we won't be taking the balances. We'll take debit total and credit total. What do you mean by total? Now in this ledgers that we discussed, now we prepared bank account ledger, right? We'll take only the totals of the ledgers excluding the balance. So balancing whatever we have done, we'll exclude that. Here it was what? 11,45,000. So one bank name is bank. So debit total of bank was how much? How much? 11,45,000. So debit total 11,45,000, and credit total will be, we have to calculate 50,000 plus 10,000. So 1 lakh, 2 lakh, 3 lakh, 15,000, 3 lakh 25,000. 3 lakh 25,000 on credit total. Clear? Simple. So second capital will be what? Capital. We prepared the ledger here. There is, so if we exclude the balance, there is no debit total at all. There is only credit total. How much? 10 lakh rupees. So debit total is 0, credit total is 10 lakh rupees. So this is called total method. This is called total method. There's one more, third one is total and balance method. Total and balance method. It's nothing. There will be serial number, there will be name of the ledger, there will be ledger folio number. Then you will have both totals and balances. You will have debit total, you will have credit total, and you will have debit balance, and you will have credit balance. Clear? Nothing different. Clear with trial balance? So that's all about trial balance. It's just whatever ledgers. So for now, the flow will discuss again. First, journal entries you will prepare in journal. So whatever journal entries you prepare, for each and every account, you have to prepare something called ledger. So this is the stage of recording. This is the stage of classifying. So after all the ledgers are prepared and closed, because you should have the balance. After all the ledgers are closed, we'll prepare something called trial balance. And in trial balance, you will show all the balances of ledgers. If the debit side is excess, it's called debit balance, which will come on the credit side. Correct? So all the debit balance and credit balance are prepared, are summarized in the trial balance. This is the summarizing phase. Summarizing phase of accounting. There is like more in summarizing phase, which will be your financial statements. You will prepare P&L account, trading account, and balance sheet. Even that is summarizing phase. Now let's go to the next topic. We are done with journal, ledger and trial balance. Next topic is subsidiary books. Subsidiary books. So subsidiary books. So already we discussed ledger is also called principal books of accounts, right? So these are subsidiary books, which is also called book of original entry or prime entry. But it's the first stage. First, when the transaction happens, it's recorded. So what stage of accounting is it? It's in the recording phase itself. Recording. So we discussed the journal entries, right? Whenever purchase happens, we'll record the entry. Purchase account to bank account or creditor account. But like to save the time, rather than recording one single entry for each and every purchase, there are certain books that can be managed. So for purchases, it will be one thing called purchase book. Similar way, there is sales book, purchase returns book, sales return book. Then we have cash book. We have bills receivable book, bills payable book, and the last one is journal proper. So these are the 8 books that are prepared at the initial stage. Book of what did we say? It's a book of original entry. So when the transaction takes place originally itself, it's the transactions are recorded in these books. So how do we do that? Now, for example, cash book is there. Cash book is nothing but all the cash receipts and payments, whatever are there, whether sales, purchase, etc. All cash transactions should be recorded in the cash book. That we'll discuss in detail in the next topic, cash book. In purchase book, what we do is we record all credit purchases. And sales book will record all credit sales. Why not cash purchases and cash sales? Because that's coming in the cash book itself. You don't have to record it there. Next, all here it's not about credit or cash in case of returns. All purchase return transactions will be recorded in purchase returns books. All the sales return transactions will be recorded in the sales returns book. Clear? Bills receivable book and bills payable book, we'll discuss it later when we do the bill of exchange chapter. Journal proper is all entries not recorded in the above 7 books. So all the entries which are not recorded in the above 7 books, will record it in journal proper. Yes. Now what will be the format of these books? Purchase book, sales book, purchase return book and sales return book. The general format is simple. What will that be? It will be date of transaction. There will be particulars, that from whom we bought, what are the details of like what we bought, etc. There can be details of calculation, like what have we bought and what is the amount, etc. And there will be amount. So there is like nothing complicated there. It's normal books that are maintained in which the transactions are recorded. Now, for example, there are purchases taken place on certain date, 1st April 2020. A purchase has taken place from Krishna. So we'll just write Krishna, no to or by. It's not a journal entry. These are books where we are recording the transactions. This is a purchase book, let's say. So we'll do Krishna. For example, we bought X product 10 goods into 200 rupees each, and Y good 20 goods into 100 rupees each. The details will be 2000 here, right? And here also 2000 plus 2000, 4000 will be recorded in the amount column. Like this, there will be some other creditors from whom we purchased goods. We'll record all that. We'll get the total, and this total will be directly posted in the ledgers. So this won't like for this again entry won't be passed. This will be automatically posted in the ledger. So this is the format for all the 4 books: purchase book, sales book, purchase return book, sales return book. Cash book we'll discuss later. The next topic, bills receivable and bills payable book, we'll discuss when we do the bill of exchange chapter. And journal proper is nothing but all the entries that are not recorded in those 7 books are recorded in the journal proper. It can be anything: asset purchase, anything else that is not coming in that book. Credit expenses, let's say cash expenses will come in the cash book. Credit expenses will record. Not that important chapter, but still we'll do one question. This is the question number 2 in the ICI study book. The same question might be there in I think it is there in the ICI material as well. Now let's start. We'll solve this one question. Now read the question carefully. Enter the following transaction in purchase book. So they are asking us to prepare purchase book and post them into ledger. So they want us to prepare a purchase book and they want us to post them in the ledger. They have given transaction April 4th 2020, purchased from Ajay Enterprises, Delhi. So they have purchased from Ajay Enterprises, Delhi. That we have to write in the particulars column, correct? Then what is happening? What have they purchased? 10 dozens of Rexona Hawaii chappal at 120 per dozen. So they have got how many dozens? 100 dozens. 100 dozens into 120 per dozen. So how much did it cost? 12,000. Yes. Next, 200 dozens of Palki leather chappal at 300 per dozen. So 200 in quantity into 300 rupees per dozen. It will be 60,000. Yes. Then they are telling less trade discount at 10% and freight charged 150 rupees. Now what will we do to trade discount? Trade discount, you should reduce it. How much is the total amount here? 72,000 is the total amount here. Minus trade discount will do. Trade discount, how much? At 10%. 10% of 72,000 will be 7,200. Right? You should reduce it. How much will it be? 7,000 will be 65, 64,800. Correct? 64,800. Right? And we have to record the freight as well. Freight will be added or deducted. It will be added because it's an expense. Purchase is an expense. So freight, whatever he's paying, it's an expense to the purchaser. So we will add freight. How much? 150. So adding this, it will be 64,950. This we should record in purchase book. We discussed the format of the purchase book. It was very simple. Date, particulars, the details and the amount. Sometimes whenever this trade discount and freight is there, the columns might increase, but the format remains the same. Now here there are three things that has to be recorded. What is the purchase cost? Then what is the discount that we are giving? Discount that we are giving or getting? Discount that we are getting, because it is purchase. Discount that we are getting, and freight, right? So you can look at the purchase book here. Purchase book, they have recorded on April 4th, Ajay Enterprises, how much? 100 dozen chappal at 120 per dozen, 12,000, and 200 dozen Palki leather chappal at 300, which is 60,000. Less trade discount. They have recorded the amount here. What is the gross amount? 72,000. Trade discount is 7,200. Net price they have taken 72,000 minus 7,200, which is 64,800. Then to that 64,800 they have added 150. Yes, so they have got 64,950. They have put 5 columns: gross amount, trade discount, what is the net price after trade discount, on that add freight, and we are getting the total amount at the end. Same way there are 2 more transactions, similar way, from Balaji Traders and who is that, Tripti Industries. So those transactions will be recorded in the same way, and will get the total of gross amount, total of trade discount, total of net amount, total of freight, and the ultimate, like total purchase. So how we should, so this is the purchase book. So they wanted what? They wanted purchase book, and they wanted to know how we'll post it in the ledger. So purchase book we have got it, right? Purchase book we have got it. These are credit purchases recorded in the purchase book. This we have to post it in the ledger. So what all ledgers will be relevant here? What are the expenses that we are recording here? One is purchase, one is purchase expense we are recording, right? Freight expense we are recording. Discount we are getting, right? Discount we are getting, which is an income. What else is there? These are the nominal accounts. One more is, because we are preparing the recording the credit purchases, we'll have a creditor here to whom we'll have to pay. These are purchases, we'll have to pay the amount ultimately, to Ajay Enterprises. So there is Ajay Enterprise account as well. Ajay Enterprise account. Similar way, for the next 2 transactions, there will be Balaji Traders as well as Tripti Industries as well. So there will be 6 ledgers that we have to prepare. Now let's see how they prepared it. One, first is purchase account. So I told you the ledger posting, right? Ledger posting. How will we do it? If in an entry the account is being debited, we have to record it on the debit side of the books. Here purchase entry is not recorded, purchase book is created, but you know purchase what kind of account is there, what natured account is there. It's a debit natured account. So what would have been the entry? Purchase account debit, purchase account debit to creditor account, which is Ajay Enterprise account. But we are preparing the subsidiary books here, so we are debiting only, but we'll take the total amount. So on the debit side of the purchase book, you will record to amount as per purchase book, to amount as per purchase book. Which amount will you take? You will take the total net purchase amount. Clear? Yes. So here what is happening is, they are not recording discount separately. So either, for example, here what you can do is, the entry I'll tell you. First entry, one is you can record it as purchase account to net to Ajay Enterprises, the net amount, which is 64,800. Or you can record it as purchase account debit, the gross amount. What is the gross amount? 72,000. To Ajay Enterprise not 72,000, because we have to pay him how much? Only 64,800, right? We are getting a discount, which is an income to discount received account, 7,200. So even this could be the entry, even this could be the entry. They have assumed that they are recording the net amount as purchases. So to amount as per purchase book, 1,26,000 you are recording in purchase book. Freight account, so freight is an expense. How much is the total freight? 450 rupees. Again expense on the debit side you will get. So in the ledger, to amount as per purchase book itself, 450 rupees you will record in the freight account. Now next is Ajay Enterprise account. Ajay Enterprise account, you will open that ledger. Ajay Enterprise is a creditor, you have to record on the credit side. So you will write by purchase account. You won't write as per purchase book, because the entry would have been purchase account debit to Ajay Enterprise. So by purchase account, the net amount of only Ajay, not the total amount, 64,800. 64,800. Freight has been paid by Ajay, so we have to pay him that as well. So by freight account, 150. Only what is related to Ajay Enterprise, we'll record that and we'll close the ledger. How will you close the ledger? To balance, carry down the total amount, 64,800 plus 150, 64,950. Clear? So the same way Balaji Traders account and Tripti Industries account will be prepared. So this is how subsidiary books are prepared and how it is posted in the ledger accounts. Clear? Now, so this is how all these 4 books are prepared. Purchase book, only credit purchases. Sales book, only credit sales. Purchase returns book and sales returns books, whatever returns are taken place, those will record. Cash book will discuss. In cash book, all cash transactions, but there are various ways in that they can be recorded. We'll discuss that. Bills receivable and payable will discuss later. Journal proper is like all entries that are not recorded in the above 7 books are recorded in the journal proper. So this is about subsidiary books. What is the objective of preparing subsidiary books? Because it saves time. It saves whose time? It saves the accountant's time also, because otherwise he has to prepare an individual entry for each and every purchase transaction. So it saves time of the accountant. Yes. Also, all the purchases and all the sales are recorded at one place. So even that's an advantage. So we are done with subsidiary books here. But one of the subsidiary books we'll discuss in detail, which is cash book. Cash book, they have given it as a separate topic. So we'll start with cash book. So cash book, we call the cash book subsidiary book. It's a subsidiary book. It's one of the 8 books, right? Subsidiary book as well as principal book. Sorry about that. As well as principal book. Why? You will get to know once you see the format. So the format of cash book is very simple. It's similar to ledger. All the receipts are recorded on left side and all the payments are recorded on the right side. So in cash book, one thing is all cash transactions is there. All cash as well as bank. Cash or bank transactions are recorded. Right? So in cash book, all cash or bank transactions are recorded. So the format of cash book is this. Simple cash book. The format is this. The receipts are recorded on the left side and payments are recorded on the right side. Now normal ledger also, if you take, we prepared one ledger right here. In the first question that we did, we prepared a ledger of bank account. Here also, if you see, all the receipts were recorded on the left side, debited. All the payments were recorded on the right side. right? So it's the same. So ledger we are telling it's a principal book, but cash book we are telling it's a subsidiary book. So cash book is called both a subsidiary as well as principal book. Means once we prepare cash book, we don't have to post it to ledger again, because that itself is the ledger. So from that we can directly take the balance and post it in and summarize it in trial balance. All right. So cash book, I already told you all the cash and bank balances should be recorded. Yes, all the receipts will be recorded on the left side. Right. Amount. Right. All the receipts will be recorded on the left side. All the payments will be recorded on the right side. So there are three ways in which cash book can be prepared, types of cash book. So the first one is simple cash book. Simple cash book is nothing but this. We will record all the transactions and amount, single column. It will be single column and will record only the cash transactions. Second one is two column cash book. Two column. In two column cash book, what happens is there will be two columns of amounts. So same ledger account will be prepared, but two amount columns will be there. What are those two columns? One is cash. One is cash. So on the left side receipts, on the right side payments. That doesn't change. One more amount will be discount on both the sides. What will be the discount? On receipt, whatever we are receiving, if it is a discount, what will that be? It will be an expense. So it will be discount allowed, that we have allowed when we are receiving the payment. And on the right side, on the payment side, if discount is there, what will it be? It will be allowed by the creditor, right? It will be discount received. Right, two column cash book. Now for example, we'll see in the question itself how will it be posted. So in the same question, the same journal question that we prepared, right, there was one thing where discount was there. These entries, these two entries, if we see these two entries, if we see, what is the first entry? Bank account debit 1,45,000, discount account debit 5,000 to Krishna account. In ledger, in simple cash book, which is bank account, what did we prepare? We put only 1,45,000, which is received, net amount, right? So in two column cash book, what happens is you will record that 5,000 as well. You will record to Krishna. 5,000 is the discount. 1,45,000 is the cash receipt. So the cash column remains the same, just that in that additional column, discount column, will record that discount. All right. Now the same way, there was one more. This was discount allowed. There was one more discount received. Which one was that? Sham. 2,15,000 was paid and 10,000 was the discount. So 2,15,000 in cash column and 10,000 in discount column by Sham account. Now what if the transactions doesn't have a discount? You won't record anything here, that's all. You will just record in the cash column. At the end, when you are balancing, what you should do, you will balance the cash account. You will record it as by balance, carry it down, whatever balance you will get. Correct? Ledger account, same. So when you're balancing, just balance the cash column. Don't balance the discount column. Discount column, you should take just the total amount. Clear? Yes. So you should just make the totals. It need not tally because you are just taking totals. You are not balancing the amounts. Similar way, there is three column cash book. Three column cash book. There will be three columns for amounts. Right? There will be date as well. I'm not writing that, but okay. There will be date, particulars. There will be three columns for amounts. What will be the three columns? Same as above. One is discount On the left side it will be discount allowed, the right side will be discount received. The other two columns will be, one will be cash and one will be bank. So cash and bank transactions you will record separately in two different columns, and one will be for discount. Clear? Now here what happens, the same like above. Above was a bank receipt and bank payment, right? So that amount will go in the bank and cash will be 0. So it will be 1,45,000 here, 5,000 here, and cash will be 0. Balancing, what you should do? You should balance both cash and bank. So by balance carried down, you should balance both cash and bank. For discount, you shouldn't balance it. You should just take the totals. It need not match. You should leave it like that. Yes, clear? So this is cash book. It is similar to ledger, the cash ledger or bank ledger that we prepare. If they ask 3-column cash book, just that all the bank transactions, put it in the bank column. All the cash transactions, put it in the cash column. Balance it. If discount is there, record it in the discount column. Otherwise, leave it. Yes, clear? So one thing to be careful here is discount column should not be balanced. Only the total should be recorded. So this is cash book. There are 2-3 more concepts in cash book that we have to discuss. One is petty cash book. Petty cash book. Petty cash book is nothing but like a separate account is maintained for calculating all the small expenses of the business. Whatever like daily expenses is there, something has to be got every day, and so it's a small expense. Petty cash book is prepared. Why do we prepare petty cash expense? So that in the main cash book or bank book, cash book that you are preparing, 3-column cash book, small irrelevant amounts are not there. All right. So because of that, in most of the companies there is something called petty cash book, and it is maintained for small expenses. It is maintained to meet the small expenses, and it is maintained under something called impressed system. Impressed system. What is the impressed system? It's nothing but a fixed amount is transferred to petty account, telling that okay, like 10,000 for this month is the amount for petty expenses, for the small expenses. Out of that you spend, and next month the same amount will be again given to the petty cash book. So in your main cash book, what will be the entry? Only to petty cash book payment will be 10,000. In petty cash book, all small expenses will be recorded. So what is the advantages? Time will be saved, and you will have track of like small expenses separately, and your cash book will have all the material amounts and not like all these irrelevant small amounts. So these are advantages. They won't ask you to prepare cash book. Just like remember the concept. Not that important. Next is they've given a concept for credit card transactions, credit card or debit card transactions. We use the cards, right? Debit cards and credit cards. Debit card is nothing but if you have the bank balance, out of that you can spend it. You can use the card and spend it. Credit card is like you don't have that balance. That's a credit facility given by the bank, and you can use the card and spend. So normally for debit card transactions there will be no charges by the bank, but in case of credit card transaction, fees will be charged. Fees will be charged to whom? To the merchant, to the person who's using that machine. You would have seen that machine, right? POS machines, point of sale machines, where they'll swipe the card. So to the merchants who are using that, they will be charged a certain fee from the bank whenever a debit card is swiped. So for that fees at like normally 1 to 4% it will be, whatever will be there. If that fees is charged, what will be the entry? That's the only thing that is asked. So what will be the entry? First, sales entry will be normal. So if there is when credit card is used, bank sales directly, right? Entry will be bank account debit to sales account, right? Bank balance is increasing when you are selling, and sales is a credit natured account. You should credit it. So this should be the total sale amount. sorry. So whatever fees is charged, whatever commission is charged by the bank, it's the seller's expense. So the merchant is paying that fees. So it will be his expense. So we'll record it as his expense in his books. How expense? What do we do? Expense is a debit natured account. When expense is increasing, you should debit it. So expense account debit to, how will this be paid? This will be automatically taken by the bank. So expense is what? Commission, right? Commission account debit. Commission account debit to, it will be automatically deducted by the bank account. The bank account has control over your money, right? So whatever commission is there, they'll automatically take from your bank account. So the entry will be commission account debit to bank account. Bank account will come down by that particular amount. So this commission is charged at 1 to 4% of what? They'll normally give you of sales amount. So if they tell you sales is 10 lakhs, 10 lakh credit cards, and it is credit card sales, and commission is charged at 1%. So when you're recording the commission, you should take 1% of 10 lakh, which will be 10,000. Right? So that's about it. Cash book. There's one more topic in the accounting process, which is rectification of errors. So we'll start with that. Rectification of errors. Yes. What is errors? Error is unintentional mistakes. We just learned the accounting process. We have to start with journal or subsidiary books, then that we have to post in ledger, we have to close the ledger, balance the ledger, and then the balances will go to trial balance. In this long process, many kinds of human errors can happen. So those errors, how to rectify, is what is this chapter. So first, before saying how to rectify, first we'll see what are the types of errors. What are the types of errors? So mainly it can be divided into two. One is error of principle, and another is clerical errors. What do you mean by error of principle? Error of principle means that if there is a contravention of accounting principle, then how to correct that? How to correct that we'll see. So if there is a contravention of accounting principle, then it is called error of principle. For example, we learnt capital versus revenue expenditure. Now for example, a person purchased a machinery. What should have been the entry? Machinery account debit, asset balance is increasing to bank account, right? Now for example, an error happened. He didn't follow the capital versus revenue expenditure principle, and he did he considered it as a purchase, which will go to P&L. So he recorded as purchase account debit to bank account, right? It's an error. So that's what is error of principle. So error of principle is treating revenue expense as capital expenditure and vice versa, right? So when this is done, like this example which we discussed, if this is done, will the trial balance tally? Yes, right? Because on the debit balance, rather than asset amount, the purchase amount would be higher. So the trial balance will tally. Trial balance will match in case of error of principle. Even if error is there, the trial balances will tally. Now the other type of errors is clerical errors. It is again divided into three types. One is error of omission, error of commission, and Compensating errors. What is error of omission? As the word itself says, omission. That the entry itself is omitted. A transaction has happened, but the entry itself has omitted. In this, again, two types will come. Complete omission, full or complete omission. What is complete omission? That the entry itself is not passed. The whole entry itself is not passed. One is partial omission. There are two aspects, debit and credit. For example, entry is passed, but while posting, they posted the debit part in the ledger, but credit part they didn't. In that case, it will be partial omission. In case of complete omission, one entry itself is not passed. In that case, trial balance will tally, right? Trial balance will match. Why? Because the entry, the total debit and credit both have not been recorded, so it will match. But in case of partial omission, debit would have been recorded, credit would have been omitted. In that case, your trial balance won't match, right? Because the both sides have to be recorded equally, and even the posting should happen properly. So partial omission, trial balance will not tally. Got it? Now, error of commission. Now, these errors are like, it can be wrong amount, wrong posting, wrong side of the ledger has been posted, etc. Now, at each stage, this can be like this error can happen. For example, in case of journal entries itself, let's say, wrong amount can happen. Rather than putting the amount as 610, they recorded the amount as 160. Unintentional mistake, it's an error, wrong amount in the journal entry itself. For example, in subsidiary books, it can happen. The totaling error can happen in subsidiary books. Like while totaling, some of the purchase is missed in the purchase book, and because of that, an error has taken place. Even in ledger, error can happen. For example, we had to post it on the debit side, we posted on the credit side, or vice versa. Or wrong amount, journal entry, one amount was recorded, but different amount we recorded in ledger. Or wrong side we recorded, wrong amount we recorded. Or while balancing the ledger, we didn't balance it properly. All those. So at each stage, the error of commission can take place. So error of commission is like wrong amount, posting wrong amount, or recording wrong amount. It can be either journal or ledger. Posting on the wrong side. Rather than debit side, you rather than on the debit side, you posted on the credit side in ledger. That can happen. Third, totaling errors can happen. Right? Totaling errors can happen. Fourth, wrong balancing can happen. Right? Wrong balancing. So all these errors come under error of commission. How to deal with that? We'll see. Whether the trial balance will tally in this case, it depends. Right? For example, both the debit side and credit side, both the postings have been done wrong. With the same amount, trial balance will tally. But only one side, for example, from subsidiary books, we took the wrong amount to one ledger and right amount to another ledger. Then it will not tally trial balance. But if the error has happened with the same amount, both debit and credit, then it will tally. Yes. Next, compensating errors. In compensating errors, that itself says that it will compensate. So two errors have happened, but two errors are compensating each other, because of which trial balance will tally. Trial balance will tally. So what's happening there is two errors are happening, but two errors are somehow compensating each other. Alright. So in that way, for example, wrong amount only, let's say, wrong amount is happening, but the similar difference they have made an error on the other side also. Because of that, trial balance is matching. Alright. That is compensating error, trial balance will tally. So you have to think whenever an error is given, if they ask in MCQ whether trial balance will tally or not, you should think whether both the aspects, debit and credit, are being affected or not. If both are getting affected in the same way, then trial balance will agree. But if one side, only one side is getting affected and one side it is right, then the trial balance will not agree. All right. Next. No, so all these are the errors. And now we'll see how will we rectify the errors. Rectification of errors. All right. So rectification of errors, there are three stages. There are three stages in the where the rectification of errors can happen. One is before preparing the trial balance. What do you mean before preparing the trial balance? That the ledgers are not closed yet. Like errors have happened, but trial balance is not prepared. So the summary of accounts is not prepared. Because of that, what happens? The ledgers are still open. We can correct them there, which means ledgers are open. We have not closed the ledgers. Clear? This will be one. Second situation will be after preparing TB. After preparing trial balance. So trial balance ledgers have been closed, tallied, trial balance. After that, you identified some errors. How will we rectify them? That is one. And the third one is in the next accounting period, means after financial statements are prepared and issued. So once financial statements are prepared and issued, one accounting period is closed. For example, 2021, you issued the financials. Next year, sometime like 2021 end, you saw that there have some errors happened in the previous year. How will you rectify them in the current year is what is done in that step. So in three stages, rectification of errors can happen. Now, first we'll see in the first stage, how will it happen? So first we should see whether it's a one-sided error or two-sided error. Means what? One-sided error means only one account, one aspect of the entry is getting affected. Debit and credit, I told, right? Only debit or credit is getting affected. This is one-sided errors. This will deal with it in a different way. And second one is two-sided errors. That the debit and credit both are getting affected in the similar way, similar amount. It can be omission also, like fully omitted, partially omitted, wrong amount on both the sides. So both the debit and credit, if they are getting affected in with the similar amount, then that is two-sided errors. That will be recorded in a separate way. Before preparing trial balance means what? That the ledgers are still open. I told you the ledgers are still open. So trial balance is not prepared yet. So suspense account is not necessary. Suspense account is not necessary. We discussed this suspense account when we discussed trial balance. That if there is a difference in trial balance after summarizing all the balances, then we'll prepare suspense account. So in case we are rectifying the errors before preparing the trial balance, suspense account is not required. Yes. Yeah. Now let's do one question. Then come back to the other two stages. So come to question. It's question number 4 in the study book of ArivuPro. Read the question. Correct the following errors without opening a suspense account and opening a suspense account. Without opening a suspense account means what? That the trial balance is not prepared yet. TB not prepared yet. Right? So we'll see how to correct that errors. First, sales book has been totaled rupees 100 short. They're telling that sales book, which is a subsidiary book, correct, has been totaled rupees 100 short. Now, in ledger sales account, What would have been the posting after totaling the sales book, the subsidiary book, whatever is there? They would have totaled the amount, which is 100 short. What would be the posting? What would be the posting? Debit side or credit side? Sales. On credit side, what would be the posting? By total of sales book. They entered the amount which was 100 rupees shorter, right? Which is 100 rupees shorter compared to, which is the sales book is 100, was total 100 rupees short. So whatever has been posted in the ledgers also, so sales account ledger, when it was prepared, whatever amount was entered there also would be 100 rupees short, correct? So credit side is 100 rupees short, right? So we should add that 100 rupees now. The ledgers are still open, right? Trial balance is not prepared yet, remember that. So we can still pass that in the ledger itself. How will we pass it? By, we can write anything. So whatever they have given only we'll try to write. They have told that the sales book has been total 100 rupees short by total of sales book short by 100 rupees. So you will add 100 to that. So the answer, how will you have to write it is, you don't have to draw the ledger of sales account, but what you will be doing, you have to write. So you'll be posting that in the sales ledger. What will you be posting? That by total or by short total of sales book 100 rupees, on credit side you will be doing. So you have to write that as an answer. So first point, the sales book has been total 100 rupees short. Read the answer. Since sales book has been cast 100 rupees short, the sales account has been similarly credited rupees 100 rupees short, correct? That's what we discussed here, that it was 100 rupees short, whatever was entered earlier, posted earlier. So we have to post 100. So they're telling that the sales account has been similarly credited 100 rupees short. The correct entry is to credit the sales account by 100 rupees as by wrong totaling of the sales book. By wrong totaling of the sales book. That wordings, if that is different of what you are posting, that is fine. But the treatment should be correct. Clear with this? It's a one-sided error or two-sided error? One-sided error, right? So first rectification, you did it like that. Next, read what error has happened. Goods worth 1,50,000 returned by Green and Co. have not been recorded anywhere, right? Partial omission or full omission? Partial or complete omission? Complete omission, right? Goods worth 150 returned by Green and Co. have not been recorded anywhere. Goods returned, right? Goods returned by means what? It's a sales return. Sales return you had to record, you haven't recorded anywhere. How to rectify? The ledgers are still open, right? Record the entry, that's all. How will you record the entry? What is the entry for that? Sales return. Sales is credited. When sales return is happening, sales are reducing. When sale is a credit natured account. When sales are reducing, you should debit it. So sales returns account debit to the party. Who is the party? Green and Co is returning. He would have been a debtor. The Green and Co would be debtor in the books. Now his balance is coming down because he is giving back the goods. So debtor balance is reducing. So the asset balance is reducing. Asset is a debit natured account. Reducing, so we'll credit it to Green and Co account. How much? 150. Right? Rectifying the omission entry before preparing trial balance is just recording the entry, that's all. See the rectification. To rectify the omission, the return inwards account. Sales return is nothing but return inwards. Right? Return inwards. The goods are coming in. So return inwards. Purchase return will be return outward. We are sending back the goods. So return inwards account has to be debited and the account of Green and Co should be credited. They have passed the entry here, whatever we passed. Alright, you have to write the narration that you are returning these goods. Right? You have to write that it was previously omitted as well. Right? In your own words, but just like write the narration should be that what you are doing. So it was the omission, you are rectifying it. So write what you are doing. That's all. Third, goods purchased worth 250 rupees have been just a minute. So goods purchased worth 250 rupees have been posted to the debit of supplier Gupta. So they are not telling that the journal entry had any problem. So they are telling posting. While posting, what is happening? Goods purchased worth 250 have been posted to the debit side of supplier account. Now what would have been the entry originally? What would have been the entry? It's a purchase, right? So purchase from Gupta and Co. What would be the entry? Purchase account debit. Purchase account debit to Gupta and Co. 150. Oh, sorry, 250. I think 250. So they are not telling that the entry has any error. See, are they telling entry has an error? No. Goods purchased 250 have been posted to the debit of the supplier Gupta and Co. Right? So this should have been posted, right? The entry is fine. While posting in purchase account ledger, where will we post? On debit side to Gupta and Co. 250, and in Gupta and Co. ledger we'll post on the credit side by purchase account. How much? 250. Now what they are telling is posted in Gupta account is wrong. Purchase account they are not telling that was done wrong. So purchase account is fine, but Gupta account what's happening? Rather than doing it on the credit side, they have recorded it as to purchase account. How much? 250. So this we have to rectify. One-sided error or two-sided error? One-sided error, correct? Because the posting here has happened. Like this is fine. Purchase account, whatever posting has been done, that is fine. But in the creditor account, the posting is wrong. On debit side they had to do on, rather than doing it on debit side, they have recorded it on credit side. This we have to rectify. One-sided error. What to do? You have to post something here. You don't have to pass an entry separately because entry is fine. You have to do the posting right. That's all. What would be the right posting? By purchase account 250. Correct. So you should credit by 250, but also whatever you have already debited, you should reverse it. Right. So to reverse it, what should you do? You should debit. So it was debit. So to reverse, you should credit it. So original credit 250, but plus reversing the wrong treatment already 250. So 500 on credit side you should post. Right. You can tell by wrong posting. By wrong posting 500. So when you post 500 here, what happens? Here 250 you have already done. Here 500. So ultimately you will get 250 only balance. Right. The purchase will be, net purchase will be 250 only. But to rectify that error previously done, you have to double the amount. Read the answer. What does the answer say? Gupta and Co have been debited 250 instead of being credited. The account should now be credited by 500 to remove the wrong debit, one effect, and to give the correct debit. Sorry, correct credit. Can correct this. So it should be credit twice because one is wrong debit, you should reverse it, and correctly it should be credited. So to rectify the error, the entry will be on the credit side. Entry means posting. Posting in the ledger account will be on the credit side by errors in posting rupees 500. right? Clear? Next error. Furniture purchased from Gulab and Bros ₹1000 have been entered in purchase day book. Here, what's happening here? In purchase day book they have done. So what should have been the entry? What should have been the entry? It shouldn't have gone to any of the 7 subsidiary books, right? It should have been the journal entry in journal proper. What should have been the entry? Machinery account debit to bank. What kind of error is this? Error of principle. We discussed, right? Machinery account debit to bank. What is the amount? ₹1000. ₹1000. What they did? They passed it in the purchase day book. Purchase day book is only for credit purchases, right? So for example, let's assume that this was a credit purchase only. So machinery account debit to creditor account. Because they passed it to purchase book, let's assume that it's a credit purchase. So machinery account debit to creditor, the lender account, ₹1000. So what they did is they passed it in the purchase book where only credit purchase have to be passed. So because of that, what happens is from purchase book posting would have happened to purchase account and the creditor account. Whatever went to creditor account is fine, because what is the right entry that happened now here? Sorry, wrong entry. Purchase account debit to creditor account. That's what happened in purchase book, right? Ultimately, when the totaling is done and passed in the purchase book, this 1000 is included there. So whatever went to creditor account, 1000 is fine. We don't have to rectify that. That ledger is fine. Which ledger we have to correct? One, purchase ledger, we have to reduce the 1000 purchase, correct? And machinery account, we have to increase 1000 in the ledger. So if that has to be done, it's a single one-sided error or two-sided error? It's a two-sided error because same effect is happening. Machinery 1000 less is debited and purchase 1000 more is debited. Like it's compensating, right? Trial balance will agree. Because of this, we should pass an entry which is machinery should have been debited earlier, which was not debited. So debit it now. Machinery account debit, right? Machinery account you should have debited, you didn't debit it earlier, you debit it now. Creditor is fine, don't touch it because creditor had to be credited ₹1000. It has been done properly. Purchase account, what is happening? Purchase account is debited 1000 more. It's not actually purchase, it's a asset purchase, it's a capital expenditure. You have to reverse it. To reverse it, what should you do? Normally purchase is debited. To reduce it, we have to credit it to purchase account 1000. Clear? Come to the solution. By this error, purchase account has to be debited by 1000, whereas debit should have been to the furniture account. The correct entry will be furniture account debit to purchase account. Sorry, I think I did machinery. It's sorry, it's furniture. Okay, I assumed it's a machinery. All right. Furniture account debit to purchase account. Clear till here? Next, see what's happening. Discount received from red and black. Discount received, income or expense. Discount received, it's a income received from red and black 15 has not been entered in the discount column of the cash book. Discount column of the cash book. When does discount column comes in the cash book? 2 column cash book and 3 column cash book. So in the cash book, discount column has not been entered. The ledgers are still open. Cash book is ledger, right? Subsidiary book as well as principal book. It is still open. You pass it now, right? To a buy. It's a receipt. It's a receipt of payment. It's discount received. When do we receive discount? When payment is made. So on payment side, on credit side, you post it now. See, The discount of 15 received from red and black should have been entered on the credit side of the cash book, right? Had this been done, the discount account would have been credited through the total of discount column, and the red and black would be debited. The entry should be red and black account debit 15 to discount account. Clear? Discount account was not recorded earlier. Record it now. Discount account is an income which is increasing, so crediting. Red and black is what? Creditor. His balance is reducing because we have made the payment and he has given a discount. Because his balance is reducing, creditor balance is reducing, we should debit it. Clear? Next. Discount allowed to G. Mohan and Co. Rupees 18. Discount allowed, expense, right? Discount is allowed when receipt happens. Has not been entered in the discount column of the cash book. Same thing. Sorry. The account of G. Mohan and Co. has, however, been correctly posted. Sorry. So in the previous error, what happened is the whole thing was not recorded. The discount itself was not recorded. So two-sided error. But here they are telling that G. Mohan and Co. Whoever is the debtor here, debtor only, right? Because we'll allow the discount to debtor. So this debtor account has been posted correctly. Debtor account has been posted correctly. Only in cash book is not done, right? So we'll rectify that error in the cash book directly. All right. In this case, the account of customer has been correctly posted. The discount account has been debited 18 rupees short, since it has been omitted from the discount column on the debit side of the cash book along with the receipts. The discount column, the discount account should now be debited by the entry. The discount account should now be debited by the entry to omission of entry in the cash book. So in the cash book, you have to enter to omission of entry in the cash book account rupees 18. All right. Now next, so this is how we'll rectify errors in case of when the errors are identified before preparing the trial balance. For one-sided errors, you'll adjust in the ledgers itself. You'll adjust in the ledgers. And two-sided errors, because both the sides are getting affected, you will pass a rectification entry. Will pass a rectification entry. Clear? Now next is how will we rectify errors when trial balance is already prepared. Now the previous one was trial balance was not yet prepared, so all the ledgers were open. So we posted in the ledgers, we passed the entries closed. Now after preparing trial balance, the ledgers are closed, right? You've got the balances in the trial balance. Now you can't open the ledgers. You can only pass journal entries. Only pass journal entries, and whatever effect is there, debit and credit, you will add it to the balance in trial balance. Clear? So only pass journal entries. So in case of two-sided errors, like both the aspects have been affected, debit and credit, it is fine. The same way you will pass the journal entries. You will pass the journal entry like how we passed in the previous question and close it. But when one-sided errors are there, like only one aspect has been affected, first of all, because of this one-sided errors, difference will come in TB, right? Difference in TB will come. So whatever difference is there, of that amount, suspense account will be opened in TB, right? And so suspense account will be opened for that difference. So whatever difference is there, that is coming because of one-sided errors. So however, when you are rectifying these one-sided errors also, you should use suspense account only. Pass the journal entries using suspense account. So you will have to debit or credit something for the error. Whatever is the other effect, give it to suspense account. Ultimately, whatever is the difference in TB and whatever errors you have, both should match and suspense account should become 0. Alright, we have the same question we read, right? They wanted Where is that? Right here. They asked for two things. Correct the following errors without opening a suspense account, that we already did. They also want opening a suspense account. Which means trial balance is already prepared. There will be some difference that they have not told. We have to pass the rectification errors anyhow. Was the first error? We've already done it, right? In when suspense account is not open. Now what's the first error? The sales book has been total 100 rupees short, right? Previously what did we do? Sales book was 100 rupees short, so sales had to be credited 100 rupees more. We passed it in the sales account ledger, but now ledgers are closed, right? Because the ledgers are closed, we have to pass a journal entry only, how we discussed. What entry should you pass? What entry should you pass? One thing is for sure, sales should increase, correct? Sales is income, so income is a credit natured account, right? You should increase it. So to increase, you should credit the sales account, right? So to sales account 100. So you are crediting the sales account, that's for sure. The other effect I told you should be suspense. Suspense account debit to sales account 100. Clear? So you will be clear of one-sided error, whatever has happened, that you should know what treatment to be done. The other side, whatever is there, you use the suspense account to pass the entry. You pass this entry, suspense account debit to sales account. For the first error, you can see that error, the entry here. First entry is suspense account debit to sales account, because sales has to increase by 100 rupees. We will pass it to suspense account. Next error, what has happened? Goods worth 150 returned by Green and Co have not been recorded anywhere. Like error of omission. Omission error, what did we tell? You have earlier you didn't record, you record it now. How will you record it? Same like before. Now you don't have to use suspense account for this, because it's a two-sided error. Both debit and credit are getting affected. So what will be the entry? Sales return account debit to Green and Co account. It will remain the same. Third, goods purchased 250 have been posted to the debit of supplier Gupta account. This is again one-sided error, right? So we discussed this already. Purchase account and Gupta and Co account. What is happening? Per entry is fine. Entry they are not complaining. Entry is fine. They are telling that in ledger, Gupta and Co, what has happened? They had to credit it, correct? But they debited it 250. Now what we did was, in ledger itself we credited by 500. One, to remove the debit effect and to give the credit effect. Now when we are passing the entry after preparing TB, we can't pass anything in the ledger because ledger is already closed. But to give that effect, it will remain the same. 500 effect should be given. 500 effect should be given. 500 should be credited to Gupta and Co. Correct? So to Gupta and Co. 500 rupees. This doesn't change. It has to be credited. The other side of the entry will be suspense account. So suspense account debit to Gupta and Co account. You can see the answer. Second entry, you can see return inward to Green account will remain the same. Third is suspense account debit to Gupta account 500. We should be clear that the Gupta account should be credited by 500. The other side is suspense account always. Next error, fourth, furniture purchased from Kulab and Bros 1000 has been entered in purchase day book. This we pass the rectification entry. Furniture account debit to purchase account. Two-sided effect, the entry will remain the same. It doesn't change. Fifth, discount received from red and black 15 has not been entered in the discount column. This again, two-sided entry, correct? We passed the entry. What was the entry? It's discount received, so income. Red and black account debit to discount received, right? Clear? So the entry will remain the same as in the previous example. The last one, discount allowed to G Mohan and Co 18 not been entered in the discount column of the cash book. This is one-sided error. All the ledgers have been closed. You have to record the discount allowed no. G Mohan and Co account is fine. You don't have to touch that. You just have to record discount allowed, right? Discount allowed is an expense. You want to increase the expense, so you will debit it. So discount allowed account debit to suspense account. Whatever is the other side of the one-sided entry, it will be suspense account. You can see furniture account debit to purchase account will remain the same. Red and black to discount will remain the same. Whichever has two-sided error effect will remain the same. But this one, discount account debit to suspense account. This is discount received or allowed. This is discount allowed. It's an expense. Yes, clear? So this is how this is how errors are rectified when the errors are identified after preparing the trial balance. Now in this, if you see in the answer, they have given the suspense account. In suspense account, what all effect we are giving? First entry, 2 sales 100, we have debited the suspense account by 100. We have debited Gupta and Co, we credited and debited it suspense account by 500. We debited the discount account and credited the suspense account by 18 rupees. So this 582 balance that they've got, this should have been, this 582 should have been the difference in trial balance. So the suspense account becomes nil. There won't be any balance. So this will be the difference in trial balance. Alright. That's why suspense account is prepared, so that the errors are identified and the effect, ultimate effect will be nullified. Clear? Now, the last one, when after the financial statements are prepared. Now these two are okay. What trial balance is prepared or not, you will use the suspense account and close. Now, when after final accounts is prepared, in the next accounting period, for example, financial year 2021, we prepared the books, we issued the financials, we gave the financials that this is the profit, this is the position, balance sheet, P&L, etc. In financial year 21-22 sometime, they identified there are errors. There are many errors that they have to get to know. Now what they can do is the question. Because now, for example, last time, the last error, if you take just now the question that we did, discount was not recorded. We recorded using a suspense account. Now the same error, if it was identified in the next year, we can't pass the same entry. What was the entry? Discount account debit to suspense account. Now if we pass this entry in the next year, no, it's an expense of which year? The previous year. Now if we pass this entry, right? If we pass this entry, this year's profit will become wrong. Because this expense is not relating to this financial year, right? So because of that, the entries will be a bit different. How will it be? Whatever nominal accounts are there, means whatever affects P&L, whatever accounts affect P&L. Now for this example, we took discount, we had to receive, it affects P&L. Whichever account affects P&L, we have to use something called profit and loss adjustment account. Profit and loss adjustment account to previously it was suspense, now also it will be suspense account only. Alright, if some asset has to be recorded, then record the asset, bring the asset in the books, that is fine. Otherwise, P&L adjustment account debit to suspense account. You will pass these entries for all the errors. At the end, what you should do is both P&L adjustment account and suspense account, whatever balances you get, you will close it using creditor. You will close it using capital accounts. Clear? So first point, whenever errors are identified after final accounts are prepared, first thing is all P&L items, whatever accounts are there or P&L accounts are debited or credited using an account called P&L adjustment account. Clear? For others we'll use suspense account. And whatever suspense account balance and P&L adjustment balance are there, suspense account and P&L adjustment account, these balance will be transferred to capital account. Transferred to capital account. Yeah, we'll do one question. We'll understand. Question number. Mm, it's question number 8 in study book. Even in ICA material, this question will be there. Now, read the question. Mr. Roy was unable to agree the trial balance last year and wrote off the difference to the P&L account of that year. He was unable to pass a, unable to agree the trial balance. He closed the books in the last year itself. Next year, what did he do? He appointed a chartered accountant who examined the old books and found the following mistakes. Purchase of, so these are the errors. What do they want? Such as the necessary rectification entries. They've also given one more thing along with the errors is Mr. Roy used depreciation on vehicles at 10%. All right, why this point is given, we'll see. So this point why it's given, we'll see. We have to pass the entries. When do we have to pass the entries? In the next financial year, because previous financial year, whenever the errors have happened, that accounting period is already closed. So the next financial year, we have to pass the rectification entries. Look at the first entry carefully. First entry. Purchase of a scooter was debited to conveyance account 3000 rupees. This error has taken place in the previous year. Now, what should have been the entry? It's a purchase of a scooter. So, scooter is an asset and asset is a debit balance. So, scooter account debit to let's say creditor account. Creditor account or bank account. Yes, that's the right entry. That's the right entry that should have been passed in the previous year. But what did they pass in the previous year? Conveyance. They recorded it as conveyance expense. Conveyance expense account debit to creditor or bank account. Bank account. So error what has happened is this. What has been debited. This is fine. This is fine because ultimately it went to creditor account only. That is fine. We don't have to check that. So the error that has happened is scooter account should have been debited and conveyance shouldn't have been debited. Correct? It's an expense. So what is affecting P&L in this? Conveyance affects P&L. Correct? And scooter account should have come in balance sheet which didn't come. Right? So now if this error was identified in the previous year itself, it was identified, what would be the rectification entry? Scooter account has to be debited. So if identified earlier, what would be the entry? One is scooter account should have been debited, that didn't get debited. Scooter account debit to conveyance shouldn't have been debited but has been debited. You reverse it now to conveyance account. How much? How much is the error? 3000. But it's an asset. We have something called depreciation. They have given a point relating to depreciation also. That depreciation is charged at 10%. Now previous year, if scooter was recorded, depreciation also would have been recorded. But because they recorded it as conveyance, depreciation wouldn't have been recorded. Right? So along with the rectification entry, one more entry would have been passed last year, which was depreciation account debit. Depreciation account debit to scooter account. How much? 10% of 3000. 300. Right? 10% of 3000 rupees. 300 depreciation would have been charged. What would have been the scooter's balance at the year end? 2700. Right? What would have been the effect on P&L? 300. Right? P&L effect would have been 300. Balance sheet effect would have been 2700. But what actually happened? P&L effect was 3000. Correct? P&L effect was 3000. And balance sheet effect? Balance sheet nothing came only, no? Right? Balance sheet became 0. This is what happened last year. Now we have to pass a rectification entry. Now I said whatever P&L items are there, that if you want to record, then use P&L adjustment account. So now P&L related, what should I do? Conveyance account was recorded in the previous year, which shouldn't have been recorded, right? I should credit it this time, right? So to P&L adjustment account, how much? 3000. 3000 is the conveyance which was recorded. But one thing in P&L that should have been recorded is depreciation, which was not recorded. So 3000, which has to be reversed, but 300 should have been there in P&L. So 2700 should be credited to P&L adjustment account, right? What will you debit? You have to get a asset in the book, right? Scooter was not recorded in the previous year. You have to record it now. So scooter account debit. How much? 2700 only. How? Because depreciation is charged. After depreciation, the scooter's value becomes 2700 only, right? Correct. Balance sheet 2700. So now the entry in the current year will be this. You can see the solution. The first one is scooter account, which is motor vehicles account. Motor vehicle account to motor vehicle account debit to P&L adjustment account 2700. Read the narration. Purchase of scooter wrongly debited to conveyance account, now rectified. Capitalization, that is capitalization of 2700, that is 3000 less 10% of depreciation. So you are reversing 3000 conveyance but recording 300 depreciation. So net effect of P&L should have been 2700, that you will record in P&L adjustment account. Clear? Next error. Purchase account was overcast by 10,000. What's happening? Purchase were over recorded by 10,000. Should have been some amount, but 10,000 excess was recorded, right? Purchase debited excess, right? Because if it is extra, debit extra had happened 10,000. Now to reverse that, you should reduce purchases. So it should have been to purchase account, but purchase is a P&L item. So I said whenever P&L item comes, instead of using that P&L item, use P&L adjustment account. So purchase has to be credited. So credit the P&L adjustment account, which is to P&L adjustment account. How much? 10,000. Now it's a one-sided error, right? It's a one-sided error. So use suspense account. Similar way. Suspense account debit. So they are telling only in the purchase balance error has happened. The creditor or bank was recorded properly. So only one-sided error. So record suspense account debit 10,000. Come to the answer. See, suspense account debit to P&L adjustment account. Purchase account over cost in the previous year. Error now rectified 10,000. Clear? Next. Third error. A credit purchase of goods from Mr. P for 2000 entered as a sale. Focus on this clearly. What has happened? What has happened? Purchase has been recorded as sales, right? Purchase has been recorded as sales. A credit purchase from Mr. P for 2000 entered as a sale. What should have been the entry? What should have been the entry? Purchase account debit to purchase account debit to P, Mr. P account 2000 to Mr. P account 2000. This should have been the entry. But what is the entry they passed? They recorded it as sales. What is the sales, sir? Sales will be credited. No. So they recorded Mr. P account debit to sales account. 2000. This error happened in the previous year. Correct? Now you should reverse it. So previous year, if it was identified, we could have done it easily, because just reverse whatever entries are there, pass the right entry, done. Now rectification entry this year will become complicated. Now previous year, think what should be done. One, purchase should have been debited, right? Purchase should have been debited. So now we have to debit purchase 2000, right? Next, sales shouldn't have been credited, right? Sales shouldn't have been credited, but it was credited. To reverse that, you have to reverse that. So you have to debit sales. So sales also you have to debit how much? 2000. Yes. Mr. P, you should have credited 2000, right? So Mr. P, you should have credited 2000. That you have to pass. But Mr. P, what was done? It was debited 2000. To remove that effect, you should credit it. So Mr. P, you have to credit 2000. So this is what has to be done. So what will be the entry? Just think of this and what will be the entry. Purchase and sales can we record this year? No, because previous year error has happened. We can't, whatever P&L items are there, we can't record now. What should we pass? P&L adjustment account. P&L adjustment account. How much? 4000. Both 2 plus 2. Both P&L items. To Mr. P account. How much? Both the effects. First, reduce the effect given in the previous year. Then give the effect, credit effect this time. 4000. Clear? You can see the entry. P&L adjustment account debit to P's account. Credit purchase from P 2000 entered as sales last year. Now rectified. Clear? Next. Receipt of cash from Mr. A was posted to the account of Mr. B. 1000. This is easy. Receipt of cash from Mr. A was posted to the account of Mr. B. 1000. So what was the right entry? Cash was received. Cash account debit to. It was received from Mr. A. Right? Received from Mr. A, no? Right. Received from Mr. A. How much? Whatever amount. But it was passed as received from Mr. B. Now, this is the right entry. This is the wrong entry. Now, Mr. B has been credited simply. You should reverse the effect. You should debit it. Mr. B account, debit. Mr. A account should have been credited, which was not credited, to Mr. A account, whatever amount is there. Now in this entry, this rectification entry, are there any P&L items? No. We don't have to worry about P&L adjustment or suspense account. The entry will be Mr. B account debit to Mr. A account. B's account debit to A's account, 1000. Clear? Next. Receipt of cash from Mr. B was posted to the debit of his account, 500. It was not passed to some other person here, right? 500 due by Mr. Q, receipt of cash from Mr. C was posted to the debit of his account. What should have been the entry? What should have been the entry? Cash account debit to C account. To C account. And this should have been passed in the, they're talking about posting here, right? They're talking posted to the account of Mr. B. Sorry, posted to the debit of his account. So cash account, there is no problem. Cash account, there's no problem. Only C account, ledger, when they are preparing, they should have done what? C account is being credited. So, by cash account, whatever amount. But what did they do? To cash account. Right? Now, what do I have to do to C account? It should have been credited, which was not credited. Now we have to credit that amount. How much? 500. Right? We have to credit C account by 500 plus last year it was debited. You have to remove that effect. So again it was posted on debit side. To remove that effect, you should post it on credit side. Again credit C account by the same account. One to remove the effect of last year and one to give the effect this year. So total 1000 you should credit. What will you debit? It's a one-sided error. So suspense account, not P&L adjustment. P&L adjustment only when you have to pass P&L items. So suspense account debit to C's account. Yes, clear? Next question. 500 due by Mr. Q was omitted to be taken to the trial balance. What's happening? 500 due by Mr. Q, debtor or creditor? Creditor was omitted to be taken to the trial balance. So it's not that entry was omitted. It was just that whatever balance was there of the ledger of Q account was omitted. So it was omitted. Now you have to record. He's a creditor. So Mr. Q, you should credit. What will you debit? You will debit suspense account. Sorry. Due by Mr. Q, not due to Mr. Q. Due by Mr. Q means debtor. Mr. Q has to pay us. So it's debtor. So Mr. Q account should be debited and the other account should be suspense account. So trade receivables or Q account debit to suspense account. Clear? Next. Sale of goods to Mr. R 2000 was omitted to be recorded. It was omitted. Now you have to record. What is the entry that was omitted? R account debit to sales. Right? Sales can we record now? No. Sales is a P&L item. So sales, in place of sales, you have to record P&L adjustment. So R account debit to P&L adjustment account. R account debit P&L adjustment account. Next, the last entry. Amount of 2395 of purchase was wrongly posted as 2593. Now look at this error. What should have been the entry? It's a purchase, right? Purchase will be debited. Purchase debit, how much should have been done? Should have been debited 2395. But wrongly, how much did they debit? Posted. So how much did they post in ledger? 2593. So excess debit they did. Now you have to credit the difference, correct? Will you credit the purchase account? No, you will use P&L adjustment account. So you will credit P&L adjustment account of that difference 2593 minus 2395 and debit what? Suspense account. So suspense account debit to P&L adjustment account 198. Clear? Now after passing all these entries, whatever balances are there. So P&L adjustment account balance had a credit balance of 10,898 and suspense account had a debit balance of 10,698. Both these balances will be passed to capital account or ROI's capital account. Clear? This is it in rectification of entry topic. You have to see whether it is when is the error identified, and depending on that will pass the rectification entry. We have to see whether it is one-sided or two-sided entry, and whatever treatment we have discussed that you have to give to rectify the errors. Clear? Now we are done with accounting process chapter completely. Now we'll start with BRS next. Bank reconciliation statement. What reconciliation? What is the meaning by reconciliation statement? So it's a statement prepared to reconcile something. Right? What is that you'll be reconciling? Two things. One is passbook. What is passbook? With bank, whatever transactions we have, whatever activities takes place in bank, the bank gives a statement, right? Statement that is called passbook. So whatever transactions happen, your withdrawals and deposits are recorded in the passbook. So that passbook is there. And one more thing is our books. So in our books, where is bank transactions recorded? One is bank ledger, or we can call in cash book, right? Bank column of cash book, right? 3-column cash book we discussed. Bank column of cash book. So these two things we compare and reconcile, right? One is passbook given by the bank and one is bank column of the cash book. So passbook and cash book we say, but when we say cash book, it is always bank column of cash book. All right. When is reconciliation necessary? When there are differences. Correct. There should be differences for the need to reconcile, right? Differences should be there. What are those differences and how to reconcile is what is this chapter. Now, few basic things. Now, okay. All right. Few basic things. In bank is what? Bank is an asset. What kind of balance, what natured account is it? It's an asset. So in your books, it will have a debit balance or credit balance. It will always have a debit balance if there is bank balance in. If there is a bank balance, then you will have debit balance in the books. When you have debit balance in passbook, what will it be? Whenever there is debit balance in the cash book, if it is debit balance, in passbook if it will be credit balance. Why credit balance in passbook? Because for bank it's not an asset. For you it's an asset. It's your bank balance, you own that, so it's your asset. But in case of bank, it's not bank's asset, right? They are taking the money from you, but they will repay you. They are just holding that money. So it's a deposit. So it's a liability for them. So it will always have a credit balance in bank, right? What do you mean if cash book has credit balance? Credit asset always have debit balance. If in cash book bank column has credit balance, what does it mean? It means that it is something called overdraft. Overdraft means that bank gives this credit facility. It's like a similar to a loan where you can draw amount exceeding your balance. If you have, for example, 5,000 balance in the bank, but you have to make an urgent payment to 10,000, the bank says okay, you pay. So you can pay 10,000 payment. So 5,000 you already had balance. That excess 5,000 is the loan facility given by bank. When that excess 5,000 is taken from bank, your balance becomes credit. And in case of passbook, in bank's books, what happens? It will become debit. Now it's an asset for them. Now they have given you 5,000. They have the right to receive that. So it becomes an asset for the bank. So this how it is. Cash book will always have debit balance. If they have credit balance, it is overdraft. And the bank will always have the other balance. If you have debit, the bank will have credit. If you have credit, the bank will have debit. All right. Now, BRS when it is prepared. So I told you for reconciliation to be done, there has to be differences, right? There has to be differences. What kind of differences? Very easy chapter. It will come for at least 5 to 10 marks. Easy marks, you shouldn't leave it. Very easy. Just focus. Now, differences, there will be differences in case of passbook and cash book, bank balance of cash book. That's when reconciliation is required. Otherwise, there's no point of this topic itself. So what are the differences that are possible? One is timing differences. Timing differences. Next, transaction differences. And third is errors. So because of these reasons, there can be differences in passbook and bank column of cash book, right? We'll tell cash book, but remember that it's always bank column of cash book. Cash is nowhere, physical cash is nowhere involved here. So now, what is timing differences? What can be the situations there? Let's take an example. A sold goods to B. A made sales to B. What B has to do? B has to make the payment, right? B has to make the payment to A. Now B, what it does is, it says, I'll give you a check. You know what's check? Check is a negotiable instrument where it directs the bank. It tells the bank, so whoever is giving the check, he'll tell that, okay, I'm signing here. You can pay this person, this amount of money from my bank account. Your account details will be there. So it's a direction given by you to the bank. Okay, you can pay to this person. That's a check. Now, A made sales to B. B has to make the payment to A. He makes the payment through check. Now let's say sale happened on, what's the date today? 10th. Okay. Let's say the sale happened on 1st of June 23. Now B has to make the payment. B sent a check to A. B issued a check on 2/6/23. All right. 2/6/23. B issued a check. Right. Now A received the check. Maybe let's say A received the check on the same date. All right. He won't go on the same day to bank. Maybe it was a Sunday or he didn't feel like. He goes to bank on the next day, 3rd 23, and he deposits the checks. So here what is happening? B is issuing a check. Now A received the check. He is going to bank and depositing the check. Deposit. He is telling, okay, this check I have to receive this sum of money from this person. You pay me the amount. Now bank will tell, okay, you give me the check, I'll process it. So process will take some 3 days, let's say. Ultimately on 6th of June 23, what bank will do is, on 6th of June, they will clear the check. When we say clear the check, means that the check is fine and the transaction is accepted. When the transaction is accepted, what will happen? On 6th of June, B's bank balance will drop, right? And A's bank balance will increase. Correct? When is it happening? 6th of June. Now let's say, how does accounting happen here? On 1st of June, they recorded the sales. What is the entry? B account debit to sales in books of A. Correct? When he received a check on 2nd June, will A record the amount as received? No, he won't receive. When will he record it as received? A will record it as received when he deposits the checks. When will he deposit? 3rd. So on 3rd of 6/23, A will pass an entry. What? Bank account debit. Has he received that amount in bank? Not yet. But when he deposits the check, he'll pass this entry. Bank account debit to B account. B had to pay me the amount. He paid check. So I deposited the check. So I'll receive the amount sometime. So bank account debit to B account. But actually, when is the amount coming in his account? 6th of June. Actually, the amount is getting credited to his account on 6th of June. Hence, during this period from 3rd to 6th, there will be a difference in the passbook and your cash book. Correct? In passbook, there will be a balance which is 10, which won't include the in passbook, whatever you have recorded your bank account debit, that amount won't be included in passbook because the amount in bank, the check is getting cleared on 6th June, right? But here, as per your books, your bank account will be higher, correct? So this is what happens here. Now one more thing is, this is check deposited but not cleared. You have an asset in your hand, check, you deposited the check, you recorded the amount, but it has not been cleared. So that is one difference. One difference is check deposited into the bank but not cleared. This is one timing difference. The other one is, there is difference in timing, right? Because he deserves to receive the amount on 3rd itself, but the bank process takes so long that we have a difference. Now one more difference is, now B made the purchase. For B it's a purchase, right? Purchase he would have recorded on the same date when the sale happened. What would be the entry? Purchase account debit to A account. And when will he record the payment? Right? He is issuing the check when? On 2nd itself. After that, he won't know when A goes to bank, when bank will process the payment. B won't know. So B, what will he do? On 2nd of June itself, he'll record the entry. What? A account debit to bank. Right? He has recorded as if he has paid. Bank balance has reduced. But actually, when is it getting cleared? 6th of June. Correct? So in this period, there will be a difference. Correct? As per your cash book, the bank balance will be less, right? Because you already recorded it as a payment. But in your passbook, it will be more because ultimately it is getting cleared on 6th of June only. Clear? This is one more difference, which is called check issued but not yet deposited. Clear? These are the two types of timing differences, main differences. When they say that check deposited but not cleared, it is your receivable amount. Remember that. When they say check deposited but not cleared, it is always receivable. And when they say check issued but not yet deposited, it's always a payment. Payment, right? It is receipt, it is payment. Payable amount, it will be recorded as payment. Clear? This is timing difference. What is transaction difference? There are many transaction differences. Now, what is transaction differences? So what does bank do? Bank will take your deposits, will pay you interest. In savings bank, it pays you interest. And it gives you loans and it charges you interest. Even if loan is not there, there will be some bank charges. All those charges and interest, bank charges and interest paid or received, let's say interest income or expense for you. This bank charges and interest, will bank reach out to you telling that, okay, these are the charges you have to pay or interest that you are getting or that you have to pay? No, it will automatically put if it is charges, bank charges and interest payable, it will automatically reduce from your bank account. Correct? It will automatically debit from your bank account. Correct? From bank point of view, debiting means bank balance is reducing. Crediting means bank balance is increasing. And if it is interest paid by bank, interest income for us, then it will automatically credit. But when will you get to know if that is credited or not? When you see the statement, when you see the passbook. So because of that, there will be transaction differences that you have to reconcile. What else? There can be automatic payments. Correct? You can set that you can like instructing the bank to pay electric bill directly every month or pay an EMI automatically every month, etc. So those automatic payments will automatically happen, but you will record it when you see the statement. There can be direct deposits. Now in this case, B had to pay to A. Rather than paying check, he goes to bank, deposits in A's bank account directly. When will A get to know? When he goes to bank, right? Only when he goes to bank, he'll get to know. Because of that, there will be something called transaction differences. That in bank account it's happening, but you are getting to know only when you are seeing the books. Errors. Errors is nothing but we've already discussed, right? Wrong, you have cash book, maybe you have done wrong totaling, or you have missed one amount, or you have wrongly credited one amount, etc. Errors can be from customer's point of view as well as bank's point of view. Clear? So both you should reconcile. Customer's point of view, errors, you know, like totaling errors, casting errors, wrong amounts, wrong accounts, etc., etc. Bank, they can also, like, wrong debit or wrong credit, sometimes bank can do, even that should be reconciled. Clear? Now how is BRS prepared? Now these are the types of errors that we discussed. Three: timing differences, transaction differences, and errors. Now how is BRS prepared? BRS, there is no specific format as such. You can just put particulars amount. What you should do is, first, for example, in the question, how they can ask is, they can give four things. They'll give something, they'll give a balance given. They can give four things. One, favorable balance they can give. Favorable balance they can give, or unfavorable balance they can give. What do you mean by favorable balance? Means that the customer has that amount, has the bank balance. Unfavorable means loan or overdraft. Overdraft. Favorable balance means it has a bank balance. Unfavorable balance is it is always overdraft. So given, they can give you either passbook balance, favorable balance as per passbook they can give, or favorable balance as per cash book they can give, or unfavorable balance as per passbook they can give, or cash book they can give. Now if they give those balances, will it be debit or credit? Think. If it is favorable balance in cash book, what will it be? Favorable means you have the bank balance, it's an asset, so it will be always debit. If it is debit in your books, in bank books, it will always be credit balance. Unfavorable balance, if the in cash book it will be credit, it's a liability. So passbook it will always be debit, it will be an asset for the bank. Clear? So they can give you like this as well, like in passbook the credit balance is this much, or in passbook the debit balance is this much, or cash book credit balance is this much, etc. You have to find out whether it is favorable, unfavorable, etc. If it is favorable, always remember that you have the customer has the bank balance. Unfavorable balance always means that it's a loan, like it's a overdraft. Clear? So they can give that. So whatever they give, you should record it here. For example, they gave favorable balance as per cash book they give, as per cash book. Debit or credit? Favorable, always debit in cash book. You have some amount, they will give you in the question itself. Now what you should do is, what is the balance in passbook? So if they're given your cash book, you should find out what is the balance in passbook. You have to find out by, so they'll give you differences. All those differences you should do plus or minus. What to plus, what to minus, that we'll see. But you have to do that. You have to reconcile and get what will be the balance in passbook. Clear? I told you already, they can ask in four different ways. Now let's take few examples and discuss how will we do this. Okay, let's take one by one example and see how we can do this. Now let's take first error. I told you timing difference, right? First error. Let's take check issued, but not deposited. What do you mean by check issued? that you have issued the check. Whoever is preparing the BRS, that company has issued a check, means they've made the payment, correct? Correct. So what has happened is they've made the payment, they've recorded the payment, but because it's not deposited, their bank balance has not reduced it. Clear? That's the difference that is coming, right? So when they give you, let's say we'll start with this. We'll start with cash book balance. So for example, they have given you that you have favorable balance as per cash book. So you have balance of cash book, correct? So always use your arms when you are doing BRS. So one is cash book, one is passbook. Now let's say they have given you what? Cash book. They have told you favorable balance. Now when check issued but not deposited, what is happening? You have recorded the payment, correct? You have recorded the payment. In your cash book, the bank balance has gone down, correct? In your cash book, the bank balance has gone down, right? So this is the difference. As per your passbook it is more, as per your cash book is less. Now you have to reconcile, you have to adjust. What will you adjust? You should always adjust what is given. All right, what is given there? Cash book is given, so you will adjust cash book only. So cash book has reduced because you have already recorded the payment, but the check is not deposited. Now cash book is given, cash book only you should adjust. So what will you do? You will bring it to the passbook level, so you will add. Clear? Clear? Just see what is happening first and then record it. Now let's say passbook is given. They have given you, as per passbook you have credit balance of this much, so favorable balance, you have bank balance. Now what is happening? Because of the same difference, what is happening? Let's see, you have passbook, you have cash book. So what is happening? Your cash book is getting reduced, correct? Your cash book is getting reduced because you have already recorded the payment in books, but actually bank account, that payment has not been done, so bank account is more. Now you should reconcile. You should always reconcile what is given. They have given what? Passbook, correct? So you should, to reconcile, to get it to the same level, you should always adjust what is given. Given is passbook, you are starting with the passbook, that only you should adjust. So to bring it to the same level, you have to minus. Clear? Now let's take the other way. This is interesting. See, now you have a bank balance, you did this, all right. What if you have overdraft? Whenever you are doing overdraft, same method you follow, but think from a point that it is a loan, all right. Now what is happening? You have passbook, you have cash book, you issued a check, but it is not deposited. You recorded it in your books. When you record it in your books, if you have favorable balance, your bank balance will come down, but you have unfavorable balance, means it's a loan, correct? It's a loan. So when payment is made, what will happen to loan amount? The loan amount will go up, right? So your cash book, what is happening is the loan amount has gone up, correct? In cash book, what is happening is you have recorded the payment, because of that the loan amount is going up. But passbook, what is happening? Passbook, nothing is happening, because the payment actually is not done yet. Only once he deposits, the check will be cleared. Clear? So the loan amount is, cash book is increasing. Now you have to reconcile, bring both of them into same level. Now if passbook is given, whatever is given only you should adjust. So if passbook is given, you'll add, correct? Passbook is given, you'll add. If cash book is given, you'll deduct. Clear? Clear? Always use this method. Just that if favorable balance, you should think that if it is a payment, your bank balance is coming down. If it is unfavorable balance, you should think of it as a loan and your balance is going up with every payment. With every receipt, your balance is coming down. Think of it like that. Clear? So one timing difference is this. So if they've given you BRS question, you will have these adjustments for sure. These two at least. One is check issued but not deposited. Second is check deposited but not cleared. What do you mean by this? Whenever they tell you that check is deposited, means you have to receive the amount. When you deposit the check, you would have recorded the receipt of amount, right? It's not payment. Whenever they say check issued, it is payment. Whenever they say check deposited, that means we have to receive the amount. Now we'll start 1 2 3 4. Now use your arms same way. Check deposited, you have passbook, you have cash book, correct? So what is happening? Check deposited but not cleared. When you deposited the check, what is happening? You would have recorded the receipt. When you record the receipt in your cash book, you have recorded, right? Passbook, nothing has changed. Passbook, only if it is cleared, it will change. In your cash book, what is happening? The bank balance would have gone up because you have already recorded the receipt, correct? It would go up. Yes. Now to reconcile, you have to see what is given. So this is the position. You have higher cash book balance, lower passbook balance. To reconcile, you should see which one is given. What is given first? Passbook balance is given. So only passbook you can adjust. Passbook, what to do? Passbook is this, cash book is this. To bring it to the same level, only passbook should be adjusted. So to bring to the same level, add back. Clear? Up is add, down is subtract. All right, add back. Clear? Same thing, think from a point of view of cash book. What's happening? You have passbook, you have cash book. Now because you recorded that receipt, your cash book has gone up. You have to reconcile now. You should always reconcile only the balance which is given. What is given? Cash book is given. Cash book itself is given. To bring to the same level, you have to adjust cash book only. So what will you do? You will bring this down. So minus. Minus. Now the same logic. Unfavorable balance. What will you think it of? It as loan. You will think of it as loan. So what happens? You have passbook, you have cash book. You recorded the receipt when you deposited the amount. It's a loan account, correct? It's unfavorable balance, so it's a loan account. When you recorded the receipt, the loan amount will go up or go down. The loan amount will reduce. So as per your cash book, your loan amount is reducing, correct? Your loan amount is reducing, but in passbook it is still intact because only after it is cleared they'll give you that balance. Now currently cash book has a lower loan balance than passbook. What is given? Passbook is given. Only that you should adjust. To bring it to the same level, you have to do minus. Clear? Next, same unfavorable balance. It's a loan, correct? When you deposited the check, you would have reduced the loan amount because it's a benefit to you. You would have reduced the loan amount. What is given? Cash book itself is given. Cash book is given. You have to bring to the same level. Cash book only you should adjust. Add back. Clear? Very easy, not that difficult. Use your arms. Decide what has happened first. Like what has gone up or what has gone down. In these both adjustments, cash book has moved first, whether it will increase or decrease. Now think what has been given. Only what has been given should be adjusted. If they have given cash book balance, adjust cash book. If they have given passbook balance, adjust passbook. Clear? Next. These are the timing differences. Next, we have transaction differences. Let's say charges or interest charged by bank. Let's say interest charged or bank charges. Now this is an income for bank, correct? This is an income for bank. For you it's an expense for the customer, correct? Now think of this now interest, whenever they charge interest or charge bank charges in your statement, they won't intimate you or they won't comment notify you that okay, we are doing this, they'll automatically reduce your bank balance and they'll charge the interest or bank charges. You will get to know when you get the statement. Now when you're doing BRS, what's happening is, for example, you have passbook, you have cash book, same logic. Now because that interest is charged, for example favorable balance, because that interest is charged or bank charges charged, what will happen to your passbook? Cash book, nothing is happening. Cash book you will record only when you get the statement. Passbook, something's happening. What is happening? The balance is reducing. Correct? The passbook balance is reducing. Now you have to reconcile. Now you will think what is given. Passbook is given first, right? Passbook is given. To bring to the same level, you should adjust passbook only. So add back. Add back. If cash book is given, so your bank balance is reduced, your cash balance is intact. If cash book is given, you should adjust only cash book. So bring down the cash balance. So minus. Next, passbook. Next, unfavorable balance. What happens when unfavorable balance is there? Now it's a loan, correct? On overdraft, obviously interest will be charged by the bank. What will happen to the loan amount? You have passbook, you have cash book. Cash book you will record only when you get the statement. Passbook, what will you do? Or passbook, what will bank do? It will automatically charge the interest. Now favorable balance, the bank balance will reduce. Now it's a loan, correct? Overdraft, unfavorable balance is a loan. So whenever it is charged directly, your loan amount will go up. So your difference will be like this. Your loan amount will go up. Now you think of whether what is given. If passbook is given, you should adjust passbook minus. If cash book is given, add back. Correct? If cash book is given, you should adjust only cash book. So add back. Minus and this plus. Clear with this? Fourth. Same transaction difference. Now for example, interest is received. Interest received or credited by the bank. If they say credited, it always means that your bank balance is increasing. Alright. Interest is credited by the bank, or direct payments are happening. Both are same rate. Direct payments from someone. Automatically they have deposited your amount. Sorry, not direct payments, direct deposits. Okay, direct deposits are happening. Both are same. Now let's think of it from interest point of view. Now first is passbook credit balance they've given, favorable balance. Now you have favorable balance, you have passbook, you have cash book. When interest is credited, you won't know in cash book. Passbook, what is happening? Passbook, your balance will go up, right? This is the difference. Now you have to adjust. What will you adjust? You will adjust what is given. Passbook is given, then minus. If cash book is given, plus. So it will be minus here and plus here. Direct deposits also same, right? Because when direct deposits is happening, your bank balance is going up. Then you should see what is given, then add or minus you should do. Even this will be same. Next, passbook or cash book. Now passbook, what will happen? Sorry, unfavorable balance. If you have unfavorable balance, you have passbook, you have cash book. Interest received. If interest is credited, what will happen to your loan account? In your cash book, nothing will happen. In passbook, when interest is automatically received, what is happening? Your loan amount will come down. Your loan amount will come down. Then you have to see that this is the reconciliation. This is the difference. To reconcile, you have to adjust what is given. If passbook is given plus, if cash book is given minus. The same logic will apply to direct deposits as well. Direct payments, automatic payments, direct payments, automatic payments. This is automatic payments. When they are happening, what is happening? You won't know until you see the statement. So cash book remains intact. Passbook, what will happen? The balance will come down if it is favorable balance. If you have, the balance will come down when automatic payments are happening. Now if passbook is given, add, cash book is given, minus. Minus. What if it's loan, unfavorable balance? Now when the automatic payments are happening, your loan amount will go up because payment is happening, your loan amount will go up. You should see what is given. If passbook is given minus, if cash book is given plus. Clear? Same logic you should apply for everything. Now these are few transaction differences. There can be others as well. These are few transaction differences. Now let's come to errors. Errors. What can be error? It can be error from bank point of view or customer's point of view. For example, in customer point of view, wrong debit happened. Wrong debit in cash book. In cash book, what is happening? Wrong debit. What do you mean by wrong debit in cash book? Debit in cash book is always receipt. Sorry. Debit in cash book is always receipt. What if they say debit in passbook? Debit in passbook is like payment, withdrawal. But debit in cash book means it's deposit, that your bank balance is increasing. Now what will happen is, if wrong debit has happened, means by mistake you have increased the, this is passbook, this is cash book, by mistake you have, by like with the wrong debit in cash book, by mistake you have done what? You have increased what? Cash book. You have increased the cash book. Bank book is same. It's a error. Difference is error. The treatment won't change. The treatment will be the same. Now this is the difference. Passbook is up. Sorry, cash book is up because you have wrongly debited in cash book. Passbook, it's remaining the same. Now you have to see what is given. If passbook is given, then add. If cash book is given, minus. Clear? Same logic. You just have to understand what they mean. Clear? Same in overdraft as well. You have cash book, you have passbook, you have cash book. Think of it as loan now, unfavorable balance. What is happening? Wrong debit happened. Wrong debit means what? Loan is coming down. Wrong debit means what? Loan is coming down. Loan should be credited normally. It is debiting, correct? Now wrong debit has happened. Loan amount has come down in cash book. Now you should see what is given. If passbook is given, minus. If cash book is given, plus. Minus, plus. Clear? Now if they say wrong credit in cash book, same logic you can apply and it will be ulta. This will be minus, plus, plus, minus. Clear? So in cash book, you should think of it like this. In passbook, if it is wrongly debit or wrongly credit. Now in passbook, if there is a wrong debit, the bank guy by mistake did what? He debited your passbook. He debited your passbook. What will happen when he debits your passbook? When bank credits, your bank balance will increase. When debits, the bank balance will reduce. For example, you have favorable balance. When he does a wrong debit, passbook balance, what is happening? Passbook balance is coming down. Correct? Now you should reconcile. If what is given, if passbook is given, you will add. Correct? Now, what is happening? You have passbook, you have cash book. What is happening here? Wrong debit in passbook. Wrong debit in passbook means what? The passbook balance has gone down. Correct? The passbook balance has gone down. Now you should reconcile. If you have, if what is given in passbook, then add back. If what is given is cash book, deduct. So add. Deduct. Clear? Now next is unfavorable balance. Think of from unfavorable balance. Wrong debit is done means what? Wrong debit done by bank means they have increased the loan amount. Correct? When they debit wrongly, loan amount has gone up in passbook. Correct? In cash book, what is happening? It's remaining intact. So this is the difference. Now you should see what is given. If passbook is given, reduce. If cash book is given, add. reduce, add. Same logic will apply, and if it is a wrong credit in passbook, will be ulta, minus plus plus minus. Clear? Same logic, just use your arms, see what is happening first. How is the difference coming? What is the difference coming, whether cash book is up or passbook is up, etc. Then think of what is given in question. If passbook balance is given, adjust that. If cash book balance is given, adjust that. Clear? So when you do this plus minus in that format, in this format, you will get the answer. There is no specific format you can follow. Just you be careful about the treatment, whether you are adding correctly or subtracting correctly. These are mostly the adjustments which are there. You can easily do it. You should understand whether what is the error happening, or what is the difference, what is the cause of the difference, what is happening to the balances first, how the difference is coming, then see what is given in the question, adjust that. Clear? We'll do a couple of questions in BRS now. Come to question number 7 in the study book. Same question will be there in ICA as well. Read the question. The cash book of Mr. Gadbadwala shows 8,36,000. Already we know what is given. We have cash book of Gadbadwala shows 8,36,400 as the balance as at bank as on 31st December. As on 31st, they have given balance. Favorable, unfavorable. When they have not given it as overdraft specifically or debit credit, it's always favorable. So favorable balance. Correct? Favorable balance as per cash book. Correct? Favorable means credit as per cash book. How much? 8,36,400. Right? So they have given, but you will find that it does not agree with the balance as per the bank passbook. On scrutiny, you find the following discrepancies. So as on 31st March, in cash book, they have a certain balance. How much? 8,36,400. But passbook doesn't match, because maybe because of various reasons. So that we have to find out. What are they asking in the end? Prepare a bank reconciliation statement. Prepare a bank reconciliation statement. So you have to find out what is the balance as per passbook. Now one by one read, see whether you will add it or subtract it. Now first thing, what is happening on 15 December 2019, in the last month, 15 December, what is happening? The payment side of the cash book was undercast by 10,000. What is happening? It's an error, right? What kind of difference it is? It's an error. What is happening? On 15 December, the payment side of the cash book was undercast by 10,000. Your cash book. We have our cash book, right? Cash book. We have bank column. Let's say it's bank column. On debit side, you will record receipts. On credit side, you will record payments. Correct? What is happening here? He is telling on 15 December, the payment side of the cash book was undercast, means less. Less was recorded. So 10,000 was less was casted on 15th of December on payment side. When less of payments are shown in cash book, what happens to the bank balance? You have passbook, cash book, right? Passbook, cash book. In your cash book, an error is happening. What error is happening? Payment side 10,000 undercast has shown, means less payments have been shown. When less payments are shown, your bank balance will go up. Correct? The difference will be that your bank balance will go up because payments less have been shown. If payments is less, bank balance is more. So payments have gone up. So difference is like this. You have passbook, but you have cash book. Because of an error, it is more. Right? You have to reconcile now. What is given? Cash book is given. They have given cash book only. To reconcile, what will you do? You will reduce. Clear? How much will you reduce? 10,000. You will reduce 10,000. See this. They have taken, see the solution. They have taken balance as per cash book and they have deducted wrong casting in cash book on 15th of December. They have done add and minus separately. It's fine if you are doing plus and minus like continuously. 1 plus 1 minus you are doing. It's good. It's like it's fine. It's not a problem. So first, what is being done? Minus. Minus. Correct. Next, what is happening? A check for 1,31,000 issued on 25th December was not taken in the bank column. What do they mean bank column? It's not passbook. When they say bank column, it means cash books bank column. What is happening? A check for 1,31,000 is issued on 25th December. When it is issued, what should have been done? The payment should have been recorded. Correct? The ideal way is when check is issued, the payment should have been recorded 1,31,000. But have they done that? They have not taken it in the bank account. So what is happening? You have passbook, you have cash book. So cash book, what is happening? Bank column, a payment has not been entered. A payment has not been entered. When payment is not entered in bank column, what will happen to bank balance? Payment is not entered. Bank balance will go up because payment is not entered. You have to reconcile. What should you adjust? What is given? Cash book is given. So reduce it. Bring it to the same level. Minus. You can see check issued but not entered in bank column 1,31,000. Two errors. Similar ones both. Payments have not been recorded. So your bank balance will go. Next. One deposit of 1,50,000 was recorded in cash book as if there is no bank column therein. So what is happening? One deposit of 1,50,000. A deposit has been made into the bank was recorded in cash book as if there was no column therein. Means like they didn't enter that deposit in the bank column. Now think of it only from bank columns perspective. Don't think of the whole error. From bank's perspective, you have passbook, you have cash book. In your cash book, an error has happened. What is happening? Your deposit is not recorded in the bank column. When your deposit is not recorded, when deposit happens, what will happen? The bank balance will go up, correct? Because the deposit has not been recorded, your bank balance is coming down, correct? Because the deposit is not recorded, your bank balance is down. To reconcile, you should adjust what? What is given? Cash book. You should adjust this only. So add back. How much? 1,50,000 deposit. You can see this 1,50,000 here in the solution. Deposit not recorded in the bank column. Clear? Next. On 18th December 2019, the debit balance of 15,260 as on the previous day was brought forward as credit balance. Very interesting adjustment. On 18 December, what is happening? Debit balance of 15,260. So it means that they are closing the ledger every day. Okay. So what is happening? Debit balance of 15,260 on the previous day. So they had a debit balance of 15,260. They should have brought forward it as debit balance. Correct. But what did they do? They took it as credit balance. Now think of what is happening. You have passbook, you have cash book. On 18th of December, what is happening in your cash book? A debit balance of 15,260 of the previous day has been brought forward as credit balance. First of all, debit balance should have been brought forward as debit balance. Means the bank balance would have been there. That was not done. First of all, because of that, your bank balance is coming down. How much? 15,260. Like over and above that, what have you done? You have not only not recorded the debit balance, you have also brought forward it as credit balance. You've reduced the bank balance further. Correct? 15,260 has been has come down because you have not brought forward the correct debit balance. The 15,260 didn't get into the debit balance, but you have taken it as debit balance because credit balance. Because of that, bank balance will further decrease. Correct? How much? 15,260 plus 15,260, 30,520. Correct? Now you should reconcile. This is the difference. Now when you reconcile, what will you reconcile? What is given? What is given? Cash book is given. So you should add back. Clear? See what has been done here. Mistake in bringing, sorry, mistake in bringing forward 15,260 debit balance as credit balance on 18 December. How much? 30,520, which is nothing but 15,260 plus 15,260. Two things are happening there in cash book. Clear? Next, 4 adjustments done. Next, of the total checks amounting to 11,514 drawn in last week, drawn means what? Drawn doesn't mean you have received and deposited. It's not it's not checks received, it's checks given. Checks issued. Checks drawn is checks issued. So 11,514 worth of checks have been issued in the last week, but out of that only 7,815 were encashed. Correct? So what is the difference here? Check issued but not deposited. Clear? Check issued but not deposited. How much? Not 11,514 or 7,815. 7,815 has been encashed out of 11,514. So you should take 11,514 minus 7,815. Whatever this difference is coming, you should adjust. Now think of what is happening. You have passbook, you have cash book. What is happening? You have issued checks. When you issue checks, what will happen? You have a favorable balance. Favorable balance of bank will come down. Will come down to what amount? Will come down by 11,514. Will come down by 11,514. Your cash book. Passbook, how much will come down? Only 7,815. So still difference is there. How much? Whatever difference that coming 3 to 4,000. Now what should you do? To adjust, you have to adjust only cash book because cash book is given. So add back. See what they have done. Check issued but not presented. Check issued but not presented 11,514 minus issued is 11,514, cashed 7,815. 3,699 you should add. Clear? Next, dividends of 25,000 collected by the bank and subscription of 1,000 paid by it were not recorded in the cash book. Two different things are there. Dividends have been collected by the bank directly and subscription has been paid by the bank directly, were not recorded in the cash book. Think passbook, cash book. Dividend, what is happening? Dividend bank has received, bank balance is going up. Now you should reconcile. You can adjust only what is given, cash book is given. So add back dividend amount. How much? Add back 25,000 here. Dividends directly collected by the bank but not yet entered in cash book. 25,000. Yes. Next, subscription they are telling 1,000 paid by it were not recorded in cash book. Subscription is paid 1,000. How? What is happening to bank balance? Bank balance is coming down by 1,000. You have to adjust. Now you can adjust only what is given. Given is cash book balance. So reduce it by 1,000. Reduce it by 1,000. See, subscription paid by the bank directly but not recorded in the cash book. Clear? Next, last adjustment. What is given? One outgoing check of 3,50,000 was recorded twice in cash book. Outgoing check means what? Outgoing check means you have issued. Correct. You have issued check of 3,50,000 was recorded twice in cash book. Correct. So what happens here? One outgoing check. So you have passbook, you have cash book. They have recorded 3,50,000 twice. Once is fine, but twice it has been done. So 3,50,000 is the difference. What change is happening? Cash book, it was recorded twice, so cash book has come down. Correct? It was recorded in cash book twice, so cash book has come down by 3,50,000 more than what it should have been. Now you have to adjust. What will you adjust? You can adjust only cash book because that is given. So add back 3,50,000. check recorded in twice in cash book, 3,50,000. Even that this week about. Clear? So after you add all these amounts and deduct these amounts, you will get the balance of passbook. This should be the correct answer. 125361. Clear? This is one question. We'll do one more which is relating to overdraft. Now what we did was favorable balance. Now let's do unfavorable balance. Let's see how they ask that. Yeah. Now take question number 10 in the study book. Read the question. What is happening? The bank column of cash book of Mukesh. The bank column of cash book of Mukesh was balanced on 31st March. It showed an overdraft of 5,000. So what have they given? Cash book balance only they have given. Bank column of cash book they have given, and they have got an overdraft of 5,000. So how will you record it? You will start with what? Overdraft balance or unfavorable balance as per cash book only. Cash book only they have given. Now this did not agree with the balance shown by bank statement of Mukesh. Obviously, that's why BRS is there. You are required to prepare a BRS taking the following into account. So we have to consider all this and record. Now, what is the first difference? Check issued but not presented for payment till 31st March 2019, 12 lakh rupees. Directly they have given. 12 lakh rupees is what? Check issued but not presented for payment. Check issued means what? It is a payment for you or receipt for you. It's a payment for you. You have issued the checks. Now, you have unfavorable balance. Think passbook, cash book, but loan. Alright. Sorry. You have passbook balance, cash book balance, but loan balance. What is happening? Check issued but not presented. When checks were issued, you would have recorded in cash book. Correct? When you recorded payment in cash book, what will happen to loan? It's a loan. What will happen to loan? The loan would have gone up. Correct? The loan would have gone up because you recorded the payment. But passbook wouldn't have gone up because those are not presented for payment yet. Now what will happen? Now this difference is there. You have to reconcile. What will you reconcile? What will you adjust? You can adjust only what is given. What is given? Cash book is given. So to get it to the same level, reduce. Minus check issued but not presented for payment, 12 lakhs you will minus. Next, check deposited but not collected by bank. Check has been deposited. These are receipts. 20 lakh. What will happen? You have passbook, bank book, but loan. So if when checks were deposited by you, what you did? You recorded in cash book. What happens to the loan amount? When you recorded receipt in cash book, the loan amount would have gone down. But in passbook, it wouldn't have because those are not cleared yet. Now, what should you do? You should adjust. What should you adjust? Cash book only because that is given. So, add back. Bring it to the same level. Add check deposited in bank but not cleared by bank till 31st March. Clear? Next. Interest on term loan 10 lakh debited by bank on 31st March 2019 but not accounted in Mukesh's book. What is happening? Interest on term loan 10 lakh debited by the bank. 10 lakh, what are they doing? They're debiting in the bank. Means they are increasing the loan amount. It's a payment, right? They're increasing the loan amount. You have passbook, you have cash book. When they're debiting your account, it means that the loan amount is going up. Interest is an expense there. So loan amount is going up. Cash book, it's remaining the same. Now what should you do? You should adjust only cash book because that is given. So add back. Bring it to the same level. Interest on term loan not accounted in books 10 lakhs, add back. Next, bank charges 2,500 was debited by bank during March 2009. Same bank charges similar to interest but accounted in books of Mukesh on 4th of April, means after the 31st March date, right? We are reconciling on 31st March. What is the difference? March there was some bank charges, but he recorded in April. Difference will be there. What is happening? Loan amount is passbook is going up because the charges are made. The loan amount is going up. Cash book only you should adjust. So add back. How much? 2,500 add back. Bank charges not accounted in books. 2,500. Next, an amount of 30,68,000 representing collection of Ramesh's checks. An amount of 30,68,000 representing collection of Ramesh's check was wrongly credited to the account of Mukesh by the bank in the bank state. Right? Bank has done this error. It's an error from bank side. What is happening? An amount of 30,68,000 representing collection of Ramesh's checks. Means what is that? He has to receive that amount. Correct. He had to receive that amount, but he didn't receive. Now what is happening? Was wrongly credited to the account of Mukesh. What is happening to bank account? They had to reduce the loan account of whom? Sorry. So whose BRS are we making? Mukesh's BRS we are making. Okay. Mukesh's BRS we are making. Correct. So there was some person called Ramesh whose checks were credited to the account of Mukesh by mistake. Now what is happening? Think that 30,68,000 it's not Mukesh's money, but they have been by mistake credited by the bank to Mukesh's account. What will happen to the loan account? It's loan account. Loan account will reduce by 30,68,000. Correct? But it shouldn't have been. Correct? This is the difference. Now what should you adjust? You can adjust only cash book because that is given. So minus erroneous credit by the bank to Mukesh's account 30,68,000. After you do this plus or minus, here one interesting thing is happening. Now we started with the positive figure. Correct? We started with the positive figure. After we did the reconciliation plus and minus, we are getting a negative figure. Now what happens here is always when you are starting with, always you will start with the positive figure only. When you are getting negative as a balance, then the balance will be, so if it was favorable earlier, it will be unfavorable here. If it was unfavorable earlier, it will be favorable here. Clear? So what is happening is, after all the adjustments, if the positive figure becomes negative, you have to change the nature. If it was favorable earlier when you started as per cash book, as per bank statement it will become unfavorable, and if it was unfavorable earlier it will become favorable. What is given here? It was given overdraft, so it was unfavorable balance earlier. Now when you are getting this negative balance in bank statement, what will be your balance? It will be favorable balance. You can write favorable balance as per bank statement 12,60,500. Now he is not writing bank overdraft, he is writing balance because it is favorable. Clear? If they had got a positive figure only here, it would have been an overdraft. But when it's changing, be careful there. It's always this thing will change. If it was favorable, it will become unfavorable. If it was unfavorable, it will become favorable. Clear? We've done 2 questions. I think we are good enough. There's one more small concept in BRS. So it is something like this. Let's discuss that. No need of question. There's something called adjusted cash book. Adjusted cash book. Now in this, what they say is, whatever errors have been done, what errors have been made by the customer, and whatever transaction differences are there, whatever transactions not recorded in bank column of cash book. So what they say is, they'll prepare something called, so when BRS we are doing, we'll prepare something called adjusted cash book, where we'll take the cash book balance as per the cash book. So to balance carried down will do, brought down. So whatever balance will be there, this is adjusted cash book. So from cash book, you'll take this balance, whatever is there. So these transactions, whatever errors have been made by the customer, and transactions which are there in the bank statement but not recorded, like what? Interest, bank charges, direct payments, automatic direct deposits, automatic payments, all these transactions which have already come in the statement but you have not recorded in books, all those transactions you will record it here. If it was payments will come here, all the receipts will come here, all the errors will be rectified in the same way how we do in BRS, and you will get a balance here by balance brought down. Is this the correct balance? Will this match with passbook? No, because there will be other differences as well. These are only transaction differences and errors made by the customer. What about timing differences and errors made by bank? For this, you will prepare a BRS. You will take balance as per cash book. You'll take this balance of the adjusted cash book. You'll take the timing differences. What will be timing differences? Check issued but not deposited, and check deposited but not cleared. You will take those two differences, and you will also take errors made by the bank, not the customer. Errors made by the bank, you won't adjust it in the cash book. You will prepare the BRS the same way. Clear? It's just that whatever cash book is there, whatever we can record as cash, which are the errors, we can correct them, and whatever transactions we have not recorded, we'll record it now. After we find out the adjusted balance, we'll prepare cash book where only few transactions will come. Those are timing differences and errors made by the bank. Clear? Done with BRS. Now we'll start with inventory and depreciation next. We'll continue with the topic of inventory valuation. What is inventory? Inventory is an asset. Categorized into three things. One is held for sale in the ordinary course of business. Right? So what is ordinary course of business? That what is the motive of his business? Like if a furniture selling is holding furniture as a stock, then it is inventory. If he has a laptop to manage accounts and stuff, that laptop is not his inventory. Even if he wants to sell that laptop now and buy a new one, that won't be his inventory, because selling laptops is not his ordinary course of business. Selling furniture is his ordinary course of business. So furniture will be inventory. So held for sale in the ordinary course of business and used in production. If production of such goods. So whatever you want to held for sale, if you are producing those goods and you are using some material in that production, this basically is raw material, right? If it is used in production of such goods, even those goods are inventory, right? The third is consumables, other consumables which are consumed in the production of goods. Something like packing materials, stores and spares, etc. All those goods which are consumed in the production as well are inventory. So inventory's basic definition is this: it's an asset either held for sale in the ordinary course of business, used in the production, or other consumables. Now, what will be the inventory normally in case of a trading company? If someone is a trading company, they're just buying and selling goods, the inventory they'll hold is traded goods, only those goods which they are buying and selling. If it is a manufacturing company, they'll have raw material, they'll have work in progress, they will have finished goods, and they will have consumables as well. Right? This is the types of goods that different entities hold. Now the concept is the topic that we are discussing is inventory valuation. Right? We discussed what is inventory. The topic is inventory valuation. That we have to value the inventory. Why should we value the inventory? Why valuation is required? Why valuation is required? One is to find out profit or loss of the company. Profit or loss of the company. How? We prepare trading account, right? We'll discuss this in detail in the coming chapter. When we prepare trading account, we take opening stock, purchases, and closing stock. That's when we record sales and we get gross profit. Why do we have to record opening stock and closing stock? Because you can't compare sales with purchase directly. For example, you purchase 10 units of a product at 10 rupees per product. Your total purchase was 100, right? Now you sold 6 of those products at 15 rupees, let's say. So this was purchase 100 units into 10 rupees per product. So 100 was your total purchases. Now sales, you sold 6 units at 15 rupees per product. So it is 90. So if you just compare purchase and sales, your purchase is 100, your sale is 100, you are incurring a loss of 10 rupees. This is not your actual loss, right? So there is a concept called matching concept. Matching concept. This is discussed in your theoretical framework chapter. This is very important concept applied throughout your accounts. It says that whatever revenue you have recorded, whatever sales you have recorded, your expenses should be relating to those sales only, right? Your purchases should match that sales. Now we have sold only 6 goods, so they are telling that even this should match. So even purchase you should take only for 6 goods. For 6 goods, what will be cost? 6 into 10, 60. So actually your profit will be 90 rupees your revenue, 60 rupees is expense, 30 rupees is your profit, right? To find out this, we do this opening stock plus purchases minus closing stock. It is called cost of goods sold. Cost of goods sold is opening stock plus purchases minus closing stock, right? You have to find out cost of goods sold, you need the value of inventory, and when you have only when you have cost of goods sold, you will be able to find out the profit of the company. So valuation of inventory is required to find out profit or loss of the company, also required to find out financial position of the company. Position. How financial position? At the year end you are holding some stock, it's your asset, so in your balance sheet that asset should be shown, right? Because of that inventory valuation becomes necessary. Now what is inventory valuation? How it is valued? Basis of valuation. Basis of valuation of inventory. They say that always when you are valuing inventory, take cost or net realizable value. Net realizable value, which is NRV. Take cost or NRV, whichever is less. Cost or NRV. You calculate cost, you calculate NRV, whichever is less should be your value of inventory. Now, what is cost and what is NRV? We'll see. What is cost? Cost is nothing but all the costs that you have incurred that to get that inventory. The cost is divided into 3. One is cost of purchase, cost of conversion, and other costs. Now, let's see what is cost of purchase. Cost of purchase is the purchase price that you have paid to get that inventory, right? Purchase price. Along with that purchase price, you might have paid some freight or something, freight or carriage, right? You might have received some discount, so reduce that discount, trade discount, right? You might have paid some taxes, so whatever you have paid, add it back, plus what, but whatever is your refundable taxes means the government will charge you tax, but it will ultimately refund you. So refundable taxes, you have to reduce it because that is coming back, that you are not actually incurring that. So this is cost of purchase. What is cost of conversion? This comes in case of manufacturing companies. They have to convert the goods, like to get the finished goods, they have to use raw material, work on it, right? And then you will get the finished goods. So the cost of conversion includes direct material, which is nothing but your raw material which is used, direct labor, whatever labor you have hired, whatever cost you have incurred, even that will form part of your cost of conversion. Third is overheads or direct expenses. In the manufacturing process, whatever expenses you have incurred to convert the raw material into finished goods, even those will come in the form part of cost. Other costs is nothing but any cost incurred to get the inventory to present condition or location. Like to make the goods saleable, whatever cost is incurred, that should also be included in the cost of conversion. So these three things, cost of purchase plus cost of conversion plus other costs, these form part of your cost. So these are the inclusions in cost. There are certain exclusions as well. Exclusions, let's see what are those. One is abnormal loss. If there is any loss of inventory which is abnormal, that you won't consider as a cost of inventory. Second, storage cost. You have taken a godown on rent. You are paying rent for a godown where you have stored all the raw material or finished goods. That won't form part of your cost of inventory. Third, admin cost. You are spending something for office expenses, or you hired an accountant, you are paying him salary. All those costs are admin costs. That won't form part of the cost of inventory that you are calculating. Fourth is selling expenses. So whatever inventory you are holding, if you have to incur some selling expenses, ultimately marketing, advertisement, etc. Those expenses won't form part of your cost of inventory. So this is about the cost of inventory. You have to get cost or NRV, whichever is less. This is cost. What is NRV? Net realizable value. The wordings itself says that net realizable, that whatever value you are realizing in net. If you sell the inventory today, what is the net value that you will be realizing? The formula for NRV is expected selling price. If you want to sell the good today, what is the expected selling price that you will be getting? From that you reduce the expected expenses that you will have to incur to make the sale. The expected expenses can be expected cost of conversion. That you have to spend some money first, make that into a saleable condition and then sell. You have to reduce that cost of conversion and reduce expected selling price. You have to selling expenses, that you have to incur some expenses, selling expenses, to make that sale happen. So reduce those expenses, and reduce the expenses from your selling price. That will be your net realizable value, right? So you have to calculate cost, you have to calculate NRV, cost or NRV, whichever is less will be the value of inventory. Why is this? Why whichever is less? There's one more concept, important concept, that is followed throughout the accounting process, which is conservatism concept. So conservatism concept says that expected losses should always be recognized, should always be recorded, expected losses. But expected profit cannot be recorded. Expected profit cannot be recorded. Profit can be recorded only when it is actually realized. But if any loss is expected, that is recorded instantly. Now here what is happening, if you see, you have purchased, you have spent some 100 rupees. But today you are seeing that the market price of that product has dropped and your NRV is coming to 90 rupees only. So on a particular date, you are expecting that you will incur a loss of 10 rupees, right? You are expecting this is not actual. You are expecting that you will incur a loss of 10 rupees. This 10 rupees you have to recognize in the books as loss, and your value of inventory will only be 90. But for example, the same product, if NRV was 110, you are expecting that when you sell the good, you are expecting that you will make a profit of 10 rupees. You are sure about it, but you won't be recording that profit today itself, because they say whenever loss is there, you record it instantly, but whenever profit is there, you cannot record, right? Whenever expected losses should be recorded, expected losses, and expected profit should not be recorded. It is the conservatism concept. Even this is discussed in your theoretical framework chapter. We'll go through the whole chapter at once. Here, this is the basis of valuation, cost or NRV, whichever is less. Now, there are some methods to determine cost. Methods to determine cost. Why is that required? We know what is the cost already, right? What is cost? Cost of purchase plus cost of conversion minus plus other costs minus all the exclusions that are there. But now, for example, for a year, the sale will happen throughout the year. Even the purchase will happen throughout the year. It will be very difficult to figure out like which product is sold on what date. For example, you purchase certain goods on 1st January. 1st January you purchase some 200 goods. On 5th of January you purchase some 100 goods. On 6th of January you sold some 200 goods. Now whatever sales you made here, 200, like which product is it relating to? Whether these 200 are from a purchase done on 1st of January or 5th of January, we won't know. But we have to know that, because on 1st of January you might have purchased at a higher price, maybe 10 rupees, but on 5th of Jan you purchased at a rate of 9 rupees. So we have to get to know whenever sale is made, which date that purchase was relating to those goods. So for that, to find out that, there are methods to determine the cost. What are those costs? We'll discuss here. The first one is specific identification method. Specific identification method. This is very easy. This method says that you can identify the cost of inventory individually. For example, there are like every unit of the product they can specifically identify. This is more suited in case when like huge products are manufactured or sold. For example, machineries are sold, let's say huge machineries. They'll be selling 2 to 3 units in a month. Then they'll be able to identify which product was manufactured when, and they'll be able to identify which product was sold first. So they'll be able to identify what is the cost of that inventory. For example, there are products X, Y and Z. They are able to identify that, okay, X manufactured in this month, sold in this month. They are able to identify that, and they are able to identify what is the cost of each and every product individually, right? This is one unit. So for example, cost is 100 here 200, here 150. So they are able to determine cost individually. Then it becomes very easy, right? Specific identification method. Now for example, they give NRV with the question. They tell that NRV is 120 here 200, and here it is 130. They'll ask you what is the value of inventory. Value of inventory, you know that, right? Basis of valuation 100 and 120, whichever is less. 100 cost. Why? 200 and 200, it's the same, so it doesn't matter. In case of Z, cost is 150, but you are able to realize only 130, correct? So it should be whichever is less, so 130. The total will be 430. This is the value of inventory. So they'll give you a question like this. It's very easy. So specific identification method, you should remember, it is suitable when products are not similar. Products are not similar and not interchangeable. That in case, like, rather than using this unit, use this unit, that is not possible, and they are different from each other, and each product can be specifically identified. Only in that case specific identification method will work. What if the products are similar and interchangeable? That's when there are like other methods, which are first in first out is the second method. There's one more called last in first out, simple average, and weighted average. Four methods are there when the products are similar and interchangeable. That rather than one unit, you can use the other unit. So these four methods, we'll take a question and discuss all these four methods. Come to question now. So in study book, come to question number 2. Read the question. A manufacturer has the following record of purchases of a condenser which he uses while manufacturing radio sets. So it's a raw material, correct? So he is using that in the manufacture. Even that is inventory, right? Used in the production. He has told that on December 4th, 900 units were purchased at 50 per unit. Like that, on 5 dates, 5 purchases have taken place, right? Then he's telling 1600 units were issued for production. 1600 units were issued for production during the month of December. He wants us to find out closing stock. He wants us to find out closing stock using FIFO method, first in first out method. What is first in first out method? First in first out method assumes that whichever product is purchased first is issued first or sold first. Whichever product is purchased first is issued first. Now here, how many products are issued? How many units are issued? 1600 units. So these will be issued from the date of initial purchases. Like first they'll use from December 4th. How many units? 900 units they'll use from what is purchased on December 4th. Then they'll use 400 from December 10th. How many done? 900 plus 400, 1300. They need 300 more units. So 300 they'll use from December 11th. Right? So 1600 units which they want to issue, they'll take it from these three purchases: December 4th, December 10th and December 11th. What will be our closing stock? You purchased 2600, you issued 1600, you should have 1000 units as your closing stock. Those 1000 units will be what is purchased on December 19th and December 28th, which is 200 units here, 800 units here at these prices, right? So see how they have calculated closing stock. They are telling that the closing inventory is 1000 units and would consist of 800 units received on 28 December this, and 200 units received on 19 December, right? So these two will be your closing stock. They have calculated the closing stock here: 800 units into 47, 200 into 60, right? whenever you are following first in first out, your closing stock will form part of the inventory which is purchased in the end, right? So purchased in the end is 200 plus 800, these two figures, right? So your closing stock is 49,600 under FIFO method, right? Easy, first in first out method. Now next method is last in first out. Now come to the next question, question number 3. They're telling that in the previous question, so using the same question, previous problem, assume that the following issues were made during the month of December. What were the issues made? 1600, right? So that 1600, he has told that these issues are made on different dates, December 5, December 20 and December 29. He is telling use LIFO method and find out closing stock. How will you do it? Now this is not as easy as FIFO. FIFO you can just take, okay, 1000 units are remaining, take the last two figures, you got the closing stock as per FIFO. But in case of LIFO, you have to be careful about dates, because now let's take for the first issue. On December 5th was the first issue. How many units? 500 units. So on December 5th, what was the inventory that the company was holding? On December 5th, what was the inventory? Before December 5th, only one purchase was made, which was 900 units. They are issuing 500 units, so they can use that. Correct? So out of 900, 500 will be used. So 400 will be remaining. Correct? Now next issue, when is it happening? On December 20, next issue is happening for 600. It is last in first out. So December 20th, before December 20th, how many purchases are there? December 20th. So here, December 20th is here, right? Before December 28th, these are the purchases. How many units? 600 units are issued. So when he takes on December 20, he'll take the inventory which is purchased last, the latest purchase. Before December 19, what are the purchases? 200 he'll take from here, totally 600. 200 he'll take from here, this will become 0. 300 he'll take from here, this will become 0. 500 done. 100 he'll take from here, this will become 300. Clear? So after two issues, you are left with 400 units of the inventory which was purchased on December 4th and 300 units of inventory which was purchased on December 10th. Next, see, next issue is on December 29th. 500 units were issued. Before December 29, let's see what was the latest stock. December 28 was purchased, so December 29 falls here. So before December 29, 800 units are here itself, purchased here. So he'll use the total 600 from here, right? 600 only, right? 500, sorry. So total 500 you'll use it from here. Out of 800, 500 is used. So 300 will be your balance stock here. So after issue of 1600 units, the inventory that you are holding is 400 units at 55, 300 units at 55 and 400 units at 50, 300 units at 55 and 300 units at 47. These are completely used. Right? Clear? Look at the presentation, how they have done. They have gone date wise. On December 4th, receipts, issues, quantity, rate, amount and balance inventory, quantity, rate, amount. On December 4th, what is happening? 900 quantity is purchased at 50 per unit and at the amount of 45,000. Issues, nothing on that date. So balance inventory is 900 into 50, the same thing, whatever was purchased. Now next, when it was purchased, 500 at the rate of 50, amount is 25,000. Next, it was purchased, again purchased on 11th, again purchased on 19th. Next issue is when? 20th. On before 20th, if you see, what is the inventory that they are holding? This was what was purchased initially. This was first purchased. This was second purchase. First purchase, or 400 units are remaining, right? 50. Right. This is the first purchase, second purchase, third purchase and fourth purchase. All the inventories are shown separately in the closing stock, right? Because whatever was purchased last will be used here, correct? On 20th December, they had to issue how many? 600 units. So when they're issuing, the last purchased was issued first 200 units, then the second last 300 units, then the from third last 100 units were issued, right? So this is the presentation that is shown, and in the end closing inventory, you can see after the last issue you have 400 units at 50 each, 300 units at 55 each, and 300 units at 47 each. The total cost of closing inventory is 50,600, which is nothing but the total of this. Yes, last in first out. We'll assume that whichever inventory is purchased last will be issued first. This is last in first out. What was the third method? Simple average. Simple average is very easy. You just have to take the prices here. What are the prices that they were purchased at? 50, 55, again 55, 60 plus 47. 5 purchases, right? At 5 prices they have taken, divided by 5. This you will get simple average. Simple average you will get a figure, right? Now you have to find out how much is the closing stock. 2600 minus 1000. 1000 units into that simple average price will be your closing stock. Clear? If you come to question number 4, in the same example of a manufacturer of radio sets given earlier, calculate the value of closing stock using average price method. What are they doing? Average price. First they are finding out simple average, the same thing, divided by 5. 53.4 is the average price at which the units have been purchased. So 1000 units which are outstanding will be valued at 53.4. 53,400 will be your closing stock. Very simple, right? The next is weighted average. Weighted average is a bit complicated and important. Weighted average method. So simple average is what we will take the prices and compare. Weighted average is not that simple. Now let's start. The format, follow this, or you can follow the textbook format as well. This is quite easy. Particulars, units, rate, value or amount. All right, so we'll start. We'll go date wise. All right, first what is happening date wise? If you go on December 4th, there's a purchase on December 4th, right? December 4th purchase. How many units? 900 units into 50. 900 units at the rate of 50. 45,000. Yes. Now next, after December 4th, what is happening? There is a issue December 5th. So whenever there is sale, you minus, because the stock will come down. Minus sale on 5th of December. How many? 500 units. What will be the rate? This is not selling price here. Cost. The cost will be what is there earlier. The earlier cost is 50 only. Right? 500 into 50, 25,000. You will reduce this. So you have balance of 400 units at 50 each, which is 45,000 minus 25,000, 20,000. Yes. What is happening next? 5th, December 10th, there is purchase plus purchase on December 10th. How many? 400 units at 55 each. 400 units at 55 each. 455 which is 22,000. Now what you do is 400 were there. Now you are adding purchase, so 800 units. Don't touch the rate. Calculate the total price here. 44,000 is the value of goods. Now what you will do is 44,000 is for 800 units. Do 44,000 divided by 800. You will find out the, sorry, 55 into 400, 22,000. Sorry, 42,000, right? Sorry. 42,000 divided by 800, which will be 52.5 here, right? Again, after 10th, what is happening? December 11th, again purchase 11th of December. How many units? 300 units at 55. 300 units at 55, which will be 16,500. Now do the total here, 1100, and here the total is 58,500. Now 58,500 is the value of 1100 units. So 58,500 divided by 1100 is equal to 53.181. So 18. So whenever a purchase is happening, your rate will change. Whenever sale is happening, it won't change. Whenever purchase is happening, your rate will change, and this will be weighted average price. All right. Next, what is happening after 11th? The next issue is on 20th. So before 20th, again one purchase has happened. Plus purchase 19th of December. How many units? 200 units at 60 rupees. 200 units at 60 rupees, which is 12,000. Get the total, 1300 units, 58,500, which is 70,500. 70,500 divided by 1,300 will be 54.23. 54.23. Next, what is happening? Sale is happening. Sale or issue, right? On what date? 20th of December. How many? 600 units. So 600 at same price will give 54.23. 54.23. Calculate 54.23 into 600. 32,538. You will reduce this. 700 units are left. The rate won't change because the rate changes only when purchase is happening. What will be the value? 37,962. Next, after 20th, what is happening? 29th, there is an issue. Before 29th, there is a purchase on December 28, 800 units at 47. Plus purchase 800 units at 47, which will be 37,600. Get the totals. 800 plus 700 will be 1500. 37,600 plus 37,962 will be 75,562. Now 75,562 divided by 1,500 will be your rate. 50.37. Next, again there's a, this purchase was on 28/12. Again there's a issue at 29/12. How many? 500. So 500 at 50.37. 25,185. This is your closing stock. Closing inventory will be this. All the transactions are done, right? Closing inventory will be 1000 units, that we know, at 50.37 only, because the sale doesn't change the price, only the purchase changes the price. What is the value? 50,377 is your closing inventory. This is the way weighted average price method is followed for calculation of cost. Clear? You can follow this, go date wise. Remember that whenever a purchase is happening, your rate will change. Yes, clear? Now Four methods are done. LIFO, FIFO, simple average and weighted average. Different value of closing stock will come in different methods. Clear with this? Now we have two more methods. So all these five methods, specific identification method. So all these five methods are based on historical data. Are based on historical cost data. That you know what is the cost of this product. So these five are based on historical cost data. There are two more methods which are non-historical cost method, which is adjusted selling price method. Adjusted selling price method. What is this method? This method is normally used by retail traders. Retail traders who doesn't maintain the cost records for the whole year. So at the year end, what they do is they'll know the selling price of the inventory, the closing inventory. They'll remove the profit component from it and they'll get the closing inventory. We'll do one question for this as well. You'll understand this. Question number 6. So this was the answer of the previous question. The format is a bit different. You can follow either ways. The answer remains the same. The closing stock is 50,377. Now next, question number 6. Now read the question carefully. Messrs. X, Y and Z are in retail business. Following information are obtained from their records. So from their records, they have only this much information. What do they have? Goods received from suppliers, which is nothing but purchases, correct? The purchases data, how much? Subject to trade discount, means before trade discount and taxes, they have 15,75,000 is the purchase. Trade discount they are telling is 3% and sales tax they are telling is 11%. We will get the purchases from there. They have given packaging and transportation charges 87,500. Even that will form part of like your purchases only, right? Cost. They have given sales during the year is 22,45,500 and sale price of closing inventory. We should find out what we need cost of closing inventory because we have to record it cost or NRV, whichever is less. They have given what sales price of closing inventory is 2,35,000, right? So from sales you have to determine cost. To determine cost from sales, what you have to do? You have to remove the profit element from it, correct? How will we do it? Let's calculate. Now first calculate the purchase data. What have they given? They have given that 15,75,000 is before trade discount and taxes, right? 15,75,000. It's the gross purchase. You have to find out the net purchase price. Trade discount, what will you do? Reduce or add? Trade discount you have to always reduce. How much will you reduce? 3%. 15,75,000 into 3% is 47,250. We'll get net purchases 15,27,750. Now the sales tax will be charged on this price, not on discount. On discount, whatever we reduced, on that sales tax won't be there. On net purchase, sales tax will be there and sales tax will be your expense. So you have to add sales tax at what? At 11%, right? At 11% of this value. 11% of this value. What will that be? 1,68,000. Sorry. 1,68,000. 053, 052.5, round it up to 053. You have to add this, correct? 15,27,750 plus 1,68,053. 16,95,803, right? To this you have to add transportation. Transportation, how much they have given transportation? 87,500. Clear? Have we done any mistake here? Okay. This was 15,75,500. All right. Small mistake. 15,75,500 minus 3%, which is 15,28,235. 15,75,500 it was. 75,500 into 3% is 47,265. You will reduce. Yes. What will be sales tax? At 11%, 15,28,235 into 11%, 1,67,996. You have to add, which will be 15,28,235 plus 11, 16,96,341 plus transportation. You add 87,500 plus 87,500, 17,83,841 is your total purchases. All right, total purchases 17,83,841. So you have total purchases, you have total sales during the year. What is that? 22 lakh 45,500. This is the total sales. Now if you compare this total sales and total purchase, will you get the profit? No, right? Because out of total purchases, some stock is still remaining, right? So to get the profit percentage, you have to compare the total sales and cost of goods sold. We don't have cost of goods sold here, but we have sale price of closing inventory, which is what? 2,35,000. Now to this total sales, if we add closing inventory at selling price, which is what? 2,35,000. 2,35,000, right? 2,35,000. If you add this, 22,45,500 plus 2,35,000. If you do this, it comes to 24,80,500. This is value of goods at selling price, value of all the goods, the sale as well as closing stock. Now this and this can be compared, correct? This is because here whatever total purchases are there, this is the selling price of total goods, total inventory, whichever is sold also, whichever is outstanding also. This and this can be calculated. So what will be the profit? What will be the profit? 24,80,500 minus 17,83,841. 6,96,659 is your profit. It's not your actual profit. When you are comparing selling price of total inventory and total purchases, you are getting profit of 6,96,000. From this you can calculate the percentage of profit. Percentage of profit on selling price we need, because we have selling price of closing inventory, right? So percentage of profit on selling price will be what? 6,96,659 is your total inventory. What is your total sale value? 24,80,500 into 100 divided by 24,80,500 into 100, which is 28.09%. This is your profit percentage on selling price. Now you have closing stock at selling price. right? Closing stock at selling price is how much? 2,35,000. From this, if you reduce profit, you will get the cost. Reduced profit element, profit at 28.09%. 2,35,000 into 28.09% will be 66,012. This is your cost of closing inventory. All right, which is 1,68,989. Clear? So in this way, you have to calculate the profit percentage, because in this question they have not given profit percentage. You have to calculate profit percentage in this way. In some questions they'll give the profit percentage, calculate the profit percentage, remove the profit element from the selling price, you will get the cost of closing inventory. 1,68,989. Clear? This is the solution. Clear with this method? So non-historical cost method, one is adjusted selling price method. We just saw one question how to do that. The last method is standard cost method. Standard cost method. There are no questions on this. Just remember one point. This is used when there are frequent changes. And there are frequent changes in the price. When there are frequent changes, a standard cost method is followed, and depending on that standard rate will value the inventory. Examples where it can be used is crude oil. Crude oil will be changing often rate. So in those cases, standard cost method is used. Clear? What else is there in inventory? Let me see if we are missing anything. Okay. There's one theory concept, inventory record system. Inventory record system. Like how will maintain the records of the inventory? There are two methods. Periodic inventory method, periodic inventory system, and perpetual inventory system. So in periodic inventory system, what happens is, to determine the closing stock at the year end, at the end of every month, or it's periodic, right? At the end of every month or every year, physical verification of closing stock is done. Based on physical verification of closing stock, they'll verify how many goods are left, right? They'll verify the closing stock value. They'll have the purchase data, opening stock data they'll have from last year, opening stock plus purchase minus closing stock, they'll find out the cost of goods sold. Clear? So physical verification, periodic inventory system, what they do is at the year end, they'll do physical verification of closing stock. They'll know what is closing stock. The balancing figure they'll take as cost of goods sold. Clear? In perpetual inventory system, what happens is they maintain records of each and every product, right? They maintain the books. In books, each and every product is recorded, and whenever sale happens, the respective cost of goods sold is also found out. Cost of goods sold is automatically found out. From purchases, they'll remove the cost of goods sold. They'll get the closing stock as balancing figure. So in physical verification, they'll find out the closing stock, and then balancing figure will be cost of goods sold. In books, they'll have records of cost of goods sold, and the balancing figure will be closing stock. All right. This is a simpler method. This is a simpler method. This is complex as well as costly. This is complex and costly, and this is simpler and cheaper method. All right. This is the inventory record system, periodic and perpetual inventory system. One more topic is there, which is inventory taking. Not that important. Inventory taking. So this physical verification, it normally happens at the year end as on the last date of the financial year, which is 31st March any year. For example, this year 2023, normally how inventory taking up takes place is they'll close the factory or shop on that date, value the inventory and record it. Sometimes it's not possible to close the factory on that date, or they're not able to physically verify. They might do it on a later date. For example, on 7th of April they did, let's say. When they do it on a later date, inventory taking, on they'll get the closing stock which is there on 7th of April. To that, they have to make some adjustment to figure out the inventory as on this date. What will they do? In this period, in these 7 days, whatever sales and purchase has happened, they have to adjust. Correct? How will they adjust? They'll do what? They'll take the closing stock as on 7th of April 2023. Sales, what will they do? They will add, because whatever has been sold would have been there on 31st March. Correct? And purchases they'll deduct, because purchase during the period is not the closing stock as on 31st March. They'll get the closing stock on as on 31st March 2023. Clear? Not that important, but this is also like one small topic in the inventory valuation chapter. So we are done with inventory. Yes. So the methods, remember, specific identification method is easy. Then FIFO, LIFO, simple average and weighted average. FIFO, LIFO and simple average is very easy. Weighted average, be a little careful when you are finding out rate. Remember that only when there is a purchase transaction, your rate will change. Then you have adjusted selling price method. There are two very good questions in study material. One we have done in the class. One more is there. Please practice that. Standard cost method, just like remember the theory about it. Clear? Now we'll start with the next chapter, which is depreciation. Depreciation. What is the meaning of depreciation? Depreciation is the systematic allocation of depreciable amount of the asset. Systematic allocation of depreciable amount of the asset over its useful life. Right? Read it. It's a systematic allocation. How it's systematic allocation? It depends on the method that we are following. We'll discuss the method. So they're telling that we'll systematically allocate what? Depreciable amount of the asset. What is depreciable amount? Depreciable amount is nothing but cost of the asset minus residual value. Residual value is nothing but your scrap value at the year end. It's also called salvage value, scrap value. So systematic allocation of depreciable amount. Why are we reducing residual value? Because we'll be recovering it later. So it's not technically not our expense. We are expecting that at the end of useful life, we are gonna receive a amount which is scrap value. So we won't be depreciating it. We'll depreciate only the cost of asset minus residual value, which is depreciable amount, over its useful life. Useful life will be given in the question. It's the expected life of the asset. All right. So three things which are important, three factors which are important while calculating depreciation is: one is cost of the asset, second is residual value, and third is useful life. Yes, clear? Why is depreciation necessary? Why is depreciation necessary? Because the asset value reduces, right? There will be drop in the asset value because of, it can be because of usage, it can be because of passage of time. So even if you are not using, even if the asset is idle, there can be drop in the value of the asset. One more is technological changes. Technological changes. There is rapid change in technology, right? Every day some or the other new thing will be coming up. So whatever like you're holding currently will become outdated, obsolete. So because of all those reasons, depreciation is necessary. What is the objective of, like, why do we have to prepare that? Why do we have to calculate that and record it in our books? Same reasons again. One is to calculate profit, correct? Profit objective, same reasons again. One is to calculate profit. Why? Because for example, you are using a machinery, you are using the machinery in the production of goods, let's say. So where we discussed the matching concept, right? That whatever revenue we are recognizing, the expenses relating to that revenue should be matched, correct? So if we are using some machinery, even that machinery cost is something we have to like record, right? We are using the machinery, we have spent something on it, even that we have to record. That we record in the form of depreciation, right? We record depreciation as an expense. That complies with the concept of matching concept, right? Second, again, financial position. Your asset value is dropping every year, so we have to show the correct value of the asset in the balance sheet so that our financial position is clear. So to find out financial position, we have to do. The third one is funds for replacement. Only when we calculate the correct value of the asset, we'll know that when the asset will become outdated and when we'll have to replace the asset. Even for that, depreciation is necessary. So why do we do it? These are the reasons. And what are the objectives? These three. Depreciation is actually a way of complying with matching concept. Yes, clear? Now, three factors are these necessary. When is depreciation done? When should it be done? For example, we purchased a machinery on 1st of April. 1st of April 2023, we purchased a machinery. It was installed on 5th of April 2023. It was installed. It was available for use. Then next, from 10th of April, we actually started using. We waited for some 5 days. Only on 10th of April, we started the usage of the machinery. Now, when it should be, from when depreciation should be charged? Depreciation should be charged from this date. How? Whenever the asset is available for use. Available for use. From that date, we should start recording the depreciation. Clear? So we discussed that the three things which are necessary is cost of the asset. Cost of the asset, what all it will include? Cost of the asset will include purchase price, similar to inventory. It will include purchase price plus installation expenses, if any, plus freight, plus any other expense incurred to bring the asset to current condition and location it is used. What won't be included? Inauguration expenses won't be included. Inauguration, this will be tested in your questions. Inauguration expenses, any other expenses incurred will not be included. Only the cost of the asset, which is purchase price, installation, freight, and any other expenses to bring the asset to its present condition and location. Clear? Residual value, they'll give in the question itself. Useful life, they will give in the question itself. Now, there are various methods of depreciation. We'll start one by one. Methods of depreciation. First method is straight line method. Straight line method. Meaning of straight line method is every year same amount of depreciation will be calculated. We'll assume that the machinery is used in equal, like in a same way every year, straight line. So what is the formula for depreciation here? Depreciation is equal to depreciable amount. What is depreciable amount? Cost of the asset, minus salvage value or scrap value or residual value divided by estimated useful life of the asset. So this will be the annual depreciation, and every year same amount of depreciation will be used. We'll take an example. Let's take cost of the asset is 1 lakh. Scrap value that you are expecting is 5,000, and estimated useful life is 10 years. Under SLM, depreciation will be cost of the asset 1 lakh minus scrap value 5,000 divided by number of years will be 10 years, which is minus 5,000, which will be 95,000 will be your depreciable amount divided by 10. 9,500 will be your annual depreciation. So every year 1 it will be 9,500, year 2 will be 9,500. Same way it will be depreciated for all the 10 years. Yes, this is called straight line method. Second one is diminishing value method. Diminishing value or diminishing balance method or written down value method, everything is same. WDV method also it's set. So diminishing value method, what do they assume? They assume that first year usage will be higher, the second year usage will be lower, and it will continue reducing. We'll tell that okay, first year it's new, so we'll use it more, then the actual like usage in terms of amount will reduce. How do we calculate it? Normally in the questions they will give a percentage that it is depreciated at 10% of the value. Alright, so we'll take the amount. For example, cost of the asset is 1 lakh. Cost is 1 lakh. They'll tell 10% is the depreciation rate. We'll tell depreciation is equal to 1 lakh into 10%, 10,000. So year 1 depreciation will be 10,000. Year 2, what will be the depreciation? We'll first find out diminishing value, diminishing balance. What will be written down value at the end of 1 year? End of year 1, written down value will be 1 lakh minus 10,000, 90,000. Written down value is 90,000. Year 2, when we are calculating depreciation, we'll do 90,000 into 10%, which will be 9,000. We'll be continuing in the same way. So in diminishing balance method, depreciation amount will be changing and depreciation amount will be reducing every year. Also, depreciation rate will be applied on the written down value, not on the cost of the asset every year. Clear? One thing you should be careful here is, in the question if they say depreciation is charged at 10%, assume it is written down value method, fine. If they tell depreciation is charged at 10% every year, you should directly go to SLM method. If they are telling that depreciation is charged at 10% of the cost of the asset every year, 10% of the cost of the asset every year, which means that it is straight line, right? 10% of the cost of asset is 10,000 every year, right? So we'll calculate that way. So read the question carefully. If they tell 10% and don't tell anything, it's fine. If they tell diminishing balance method, like even better, take diminishing balance method. But if they're telling depreciation is charged at 10% every year, 10% of the cost of the asset every year, it is SLM method, and follow SLM method for that. Third one is sum of years of digits method. see this formula. Depreciation is equal to, we'll take depreciable amount, which is nothing but cost of the asset minus residual value into remaining life of asset including current year. Be careful there. Divided by sum of digits of total useful life. Clear? The sum of digits of total useful life. Sum of digits. How can you calculate? You can do n into n plus 1 divided by 2. What is this method? Let's do one sum and understand what is it. Now, for example, same method will take 10 lakh is the cost of the asset. Let's take residual value is 0 and useful life is 5 years. What is the SLM method? The depreciation will be 20,000, right? 1 lakh minus 0 divided by 5. SLM method, easy, depreciation will be 20,000. The sum of years of digits method, how are we calculating? Formula is given, right? Depreciable amount is 1 lakh, right? Cost is 1 lakh. Residual value is 0 and life of the asset is 5 years. Expected useful life is 5 years. Now depreciable amount is 1 lakh, right? 1 lakh into remaining life of the asset including current year. Let's say depreciation for first year 1. How will they do? 1 lakh. What is the remaining life of the asset including current year? Including current year, remaining life is 5 years, right? It will be total life divided by sum of digits of total useful life. You can do n into n plus 1. N is nothing but useful life. So 5 into 5 plus 1 divided by 2, which will be 5 into 6, 30 by 2, 15. Or else, what is this? It's nothing but sum of all the digits. It's 5 years. So 5 plus 4 plus 3 plus 2 plus 1. Sum of all the digits, which is nothing but n into n plus 1, which is 15. So depreciation for year 1 will be 1 lakh into 5 divided by 15, which will be 33,333 for year 1. For depreciation for year 2, what will that be? 1 lakh into remaining useful life. How much now? Remaining useful life for year 2 including current year is 4 years divided by, this will remain same, 15. What will be the depreciation? 1 lakh into 4 divided by 15, 26,667 and so on. Clear? Just remember the formula. Remember that when you are calculating remaining life of the asset, it should include the current year as well. Clear? Sum of digits of total useful life is nothing but, if 10 years, 10 plus 9 plus 8 plus 7. For that, easy to calculate it easily, this formula can be used, n into n plus 1 divided by 2. Clear with this? There are few more methods. Machina method, Machinar method, production units method, and depletion method. So all these three methods, the depreciation calculation will be similar. Let's understand what these methods are. So in the previous three examples, how we did is, in diminishing value method, they'll give percentage. In the other two methods, they'll give the useful life in terms of years. Now, what if useful life is not in terms of years? Maybe useful life in terms of machine hours or production units. They'll tell that they purchased a machinery costing 10 lakhs. Costing 10 lakhs. The cost of the machinery was 10 lakh. Scrap value is 0. They tell you that it can be used for 10,000 machine hours. Alright. The total usage can be 10,000 machine hours. In year 1, when the machinery was purchased, for example, 2,000 hours the machinery was used. How much will be the depreciation? Easy. If 10 lakh is for 10,000 hours, how much is it for 2,000 hours? 2 lakh. Correct? How did you get that? 10 lakh divided by 10,000. If 10 lakh is for 10,000 hours, how much is it for 2,000 hours? Clear? The same concept can be used for production units. It won't be given in hours. It will tell that 10,000 units of a product can be produced. Alright. Depletion method is nothing but extraction of materials. Like for example, coal or gold. They'll take a land on lease and they'll tell that they'll expect that 10,000 tons of coal can be extracted from it. And the land value is some 1 crore, let's say. 1 crore. Well, how we'll do is you'll divide 1 crore by 10,000 tons. And for the year, how many our tons has been extracted? For example, 1,000 tons. So much of the amount will be depreciated for the year. So the formula, the way of calculating depreciation remains the same for all the 3 methods. Just that in one case it is machine hours, one case it is production hours, and one case it is depletion, means extraction. So what will be the formula? Machine hour method, it will be depreciable amount into number of hours in current year divided by total estimated hours. Clear? What will be production units? Depreciable asset into number of hours in number of units, right? Number of units produced in current year divided by total estimated units of production. Here depreciable amount into quantity extracted divided by total estimated extraction. Clear? No doubt till here, right? Now next, what is the accounting treatment? How do we record depreciation? What is the entry for depreciation? Journal entries. Tell me. Journal entries. Apply the same logic. Modern approach. What is depreciation? Depreciation is an expense. Expenses is a debit natured account. So whenever you are recording depreciation, it should be debited. So depreciation account debit, right? To the asset value is reducing. Asset is a, so fixed asset is an asset. Asset value is reducing, dropping. Asset is a debit natured account. When asset value is reducing, you should credit it to asset account. The amount of depreciation should be recorded. Asset value will be reduced. Depreciation should be passed to P&L account. Profit and loss account debit to depreciation account. This is the method of depreciation. If the question is silent, you can use this method. This is a method 1. One more method is there, where something called provision for depreciation is used. Alright. So what happens in balance sheet? In the first thing, depreciation goes to P&L. In balance sheet, asset value will be reduced by depreciation, right? And net amount will be shown here. Reduced amount will be shown here. In case of provision for depreciation, what happens is asset value won't change. Asset value will be the gross value, the total cost minus provision for depreciation will be shown as a reduction from asset. Provision for depreciation, this will be the depreciation, total depreciation amount. This is a liability. This is a like provision. It's like a liability account. So every year it will be adding up. The asset value will not change. So what happens to provision for depreciation? Same entry. Depreciation should be debited because it's an expense. Something has to go to P&L. So depreciation account should be debited. That is fine. 2. Asset value will not be touched. Asset will be shown at cost only. So 2. Provision for depreciation account. Clear? Now depreciation will be passed to P&L. So P&L entry will be same. P&L account debit to depreciation. Right? So in year 2 what will happen? Again this entry will be passed. The provision for depreciation amount will increase every year and it will be shown as a reduction from asset and balance sheet. Clear? So this is the accounting treatment that can be followed. There are few more concepts in depreciation. We'll discuss that and go to a sum. So you saw how is depreciation calculated in various methods, 6 methods, and we saw what are accounting entries. Now there are few more concepts. What if there is a sale of asset? Purchase of asset, what will be the entry? Asset account debit to bank account. Clear. When there is a sale of asset, there can be gain or loss. Gain or loss. How will that be calculated and how what entry will be passed? What will be the treatment in books is what we have to discuss. So whenever there is sale of asset, sale or disposal, whenever there is sale or disposal of the asset, depreciation should be calculated first. Depreciation should be calculated up to the date of sale. So the first step whenever there is sale or disposal is first charge depreciation up to date of sale. Then you will get the written down value. Written down value as on. You will reduce the depreciation from asset value, right? So you will get written down value as on sale date. Correct? This you will get. This you will compare with sale price. This you will compare it with sale price. If sale price is excess, you have gain. Correct? If sale price is lesser than the written down value, that is loss. And you have to record that loss. One thing you have to remember is whenever there is sale, first record depreciation up to the date of sale. Clear? What will be the entry? First depreciation you will charge depreciation to asset. That will be same entry. Depreciation account debit to asset account. When the asset is sold, what should be the entry that you have to pass? If it is a gain, what will be the entry? You will be receiving some amount, bank account debit. Correct? And you should de-recognize the asset. Asset account to asset account credit. So asset account will be written down value amount. Amount should be written down value. Bank account will be selling price. If selling price is higher, the gain will come on credit side. Gains will be on credit side, right? Gain is income. Income is a credit natured account. So to P&L account, this is the gain. This is the gain amount. Clear? What if it's a loss? Same. Bank account debit. Bank account debit will be selling price only. And asset that you have to recognize is asset account to asset account. You have to credit. It will be written down value only. Right? Loss will be debited. P&L account debit. This will be loss. Yes, clear? Let's go to a question. Question number 7 in the study book of ArivuPro. Question number 7. Read the question. A firm purchased on 1st January 2018 certain machinery for 5,82,000. So they purchased a machinery for 5,82,000. What will be the entry? What will be the entry? Asset account debit to bank account. Yes. And they said and spent on 18,000 on its erection. Alright. This you should add to the cost of the asset, right? So you should recognize 5,82,000 plus 18,000 installation when you are recording the asset value. Next, what is happening? On July 1st, 2018, another machinery for 2 lakh was acquired. So in the same year, in July 1st, they purchased another machinery for 2 lakh. Then on 1st July 2019, this is in the next year, the machinery purchased on 1st January 2018 means the first machinery which was costing 6 lakh to us, 5,82,000 plus 18,000. That machinery having become obsolete, it became obsolete and it was auctioned. It was sold through auction for 3,86,000. And on the same date, fresh machinery was purchased at a cost of 4 lakh. So on that date, which date? 1st July 2019, one machinery, the initial machinery which they purchased, they sold it, and one new machinery they purchased for 4 lakhs. They're telling depreciation was provided for annually on 31st December at the rate of 10% per annum. They have given a percentage and they have told written down value. On written down value, which method it is? Diminishing balance method. Clear? They have given percentage and they have told that it will be charged at 10% per annum on written down value. So it is diminishing balance method. They want machinery account. When they say machinery account, it's nothing but ledger account we have to prepare. Alright. What do they want? Machinery account they want. For what period? For 2 years. 2 years transactions they have given, right? So what will be the format? Date, particulars, ledger folio number and amount. Date, particulars, ledger folio number here and amount. Clear? Credit, debit. Now we'll think of the entries and post it directly. Alright. So first, what is happening on 1st of January? On 1st of January 2018 January 1st. What is happening? They purchased the machinery for 5,82,000 and spent 18,000. So total they spent how much? 6 lakh. One is 5,82,000. When they purchased a machinery for 5,82,000, what will be the entry? Asset they purchased. So asset account debit, which is machinery account debit to bank. Correct? To bank, because bank balance will be reducing because they have purchased the asset. So what will be the posting? We have to debit the machinery account using the bank account. So to bank, we have to debit the machinery account, right? We have to post it on the debit side. So to bank, how much? 5,82,000. And they spent on erection also. Erection you can't record it as revenue expenditure. It's a capital expenditure. It's like installation charges. So on the same date, January 1st itself, again they spent 18,000. Same entry, machinery account debit to bank account. To bank account, how much? 18,000. So this is the purchase of first machinery. Next, what is happening? On July 1st, they purchased another machinery for how much? 2 lakhs. Correct? 2 lakh they purchased, right? What will be the entry? Same entry. July 1st. Asset machinery account debit to bank account. To bank account. This is the second machinery. How much? 2 lakhs. Clear? Next, what is happening? Next year, they have told something else. So first year, what you should do? You should close the ledger first for the year. What is the closing date of the financial year? 31st December, they have told, right? Depreciation is calculated on 31st December. Now let's calculate depreciation. Depreciation calculation. Right? Year 1. Depreciation. 2 machineries was there. First machinery. What is the depreciation? How much is the amount? 6 lakh. 5,82,000 plus 18,000. 6 lakh into 10% is the rate, right? Right? It is 10%. The machinery was purchased on what date? 1st of Jan 2018, and we are calculating depreciation as on 31st December 2018. So the machinery is used for the whole year. So 6 lakh into 10% will be 60,000. So this will be the depreciation for first machinery. There is one more, second machinery. Correct? How much? Second machinery. It was purchased for 2 lakhs. Correct? It was purchased for 2 lakh into 10%. But purchased on what date? 1st of July 2018. So from only your depreciation should start from 1st of July only. So July, August, September, October, November, December. Only 6 months you have to calculate depreciation. How will you do that? Into 6 divided by 12. Correct? 2 lakh into 10% is for 12 months. Calculate it for 6 months. How much? 2 lakh into 10% will be 20,000. Half of that will be 10,000. Clear? So total depreciation for year 1 is 60,000 plus 10,000. What will be written down value at 31st December 2018? First machinery, it will be 6 lakh minus 60,000, 5 lakh 40,000, and second machinery, it will be 2 lakh minus 10,000, 1 lakh 90,000. Clear? Now record depreciation. How will you record on 31st December 2018? We discussed the entry rate. Depreciation account debit to asset account. Depreciation account debit to machinery account here. Correct? So machinery account we have to credit using depreciation. So by depreciation. Clear? By depreciation account, how much? Total is 60,000 plus 10,000. Two machineries, 70,000. And close the ledger. The total here is 8 lakh. Here also it should be 8 lakh. So the balance is by balance carried down 7 lakh 30,000. Here debit balance or credit balance? Debit balance, because debit is excess. Clear till here? What is that 7 lakh 30,000? It's nothing but both these written down values. Now year 2, what is happening? Year 2. Okay. Year 2, 2019, what is happening? First is telling that on July 1st, the machinery purchased on 1st January 2018 became obsolete. And it was auctioned. So it was sold on 1st July. First, what should you do? First, calculate depreciation. Now, calculate depreciation as on 1st of July 2019. Correct? First machinery only. How will you calculate? You won't take the cost of the asset now. You will take written down value, because the method followed is written down value. What is the written down value of the asset? 5 lakh 40,000. 5 lakh 40,000 into 10%. The asset is used for how many months? It is sold on 1st July. Means first 6 months has been used from January till July 2019. So 6 divided by 12, which will be 5 lakh 40,000 into 10% divided by 27,000. So first record this depreciation. What will be the entry? Depreciation account debit to machinery. Same posting 2019. Okay, first get the balance. 2019 January 1st. 2 balance bought down. How much? 7 lakh 30,000. Clear? Can we move this? Okay, never mind. So balance bought down 2019 July 1st, first you should record the depreciation. What will be the depreciation entry? Depreciation account debit to machinery account. So by depreciation account, write on first machinery or on the sold machinery. Sold machinery. How much? How much did we calculate there? 27,000. Yes. So calculate here only. What will be the written down value? Written down value as on 1st July. 5,40,000 minus 27,000. It will be 5,13,000. Correct? Yes. 5,13,000 is the written down value. What will be the gain or loss? For what price is it sold? 3,86,000, right? It's sold for 3 lakhs. It was sold in auction for 3,86,000. So you have loss. Loss on sale of machinery will be 5,13,000 minus 5,13,000 minus 3,86,000. This will be loss 1,27,000. What will be the entry for this? Bank account debit, selling price 3,86,000 to asset account, machinery account. This will be written down value, which is 5,13,000, and the balance should be passed to P&L account, loss 1,27,000. Record this in the ledger. How will you record it? By bank. This is the sale. How much? 3,86,000. Same date. And by P&L, which is loss 1,27,000. Clear till here? Clear? Now this sale is done. They are telling that on the same date a new machinery was purchased. Correct? So on July 1st a new machinery was purchased. What will be the posting? To bank account. How much? 4 lakhs. 4 lakh. Correct? 4 lakh. Now for the year 2, calculate the depreciation. Same way, calculate the depreciation for year 2. What will be the depreciation? Depreciation for year 2. Now first machinery is gone. The second machinery, what is the depreciation? You have to calculate depreciation is equal to written down value. What is written down value last year? It was 1,90,000. If you remember, 1,90,000 into 10%. This machinery has been used for the whole year. Correct? In the second year, it has been used for the whole year. So it will be 10%, 19,000 directly. Clear? For year 2, third machinery was purchased, right? Third machinery was purchased on 1st of July. So it has been used only for 6 months. So depreciation will be 4 lakh into 10% into 6 divided by 12. 40,000, 20,000. So next year depreciation will be 20,000 plus 19,000, 39,000. So by depreciation 39,000. Now balance the asset. 11,30,000. 11,30,000 minus 39,000 minus 1,27,000 minus 3,86,000 minus 27,000. 5,51,000 is the balance. December 31st. Depreciation will also be on December 31st. By balance carried down 5,51,000. Done. So in this way they can ask the question. They'll give you the purchase and sale details. You have to calculate the gain and you have to calculate depreciation calculation. You have to show the workings of the depreciation as well. Clear? Clear? Now this is one gain or loss we discussed. Now what if there is a change in method of depreciation? Change in method of depreciation. For example, we were following SLM. After some 2 years, we decided that now we'll shift it to WDV at 10%. What will happen? Will we change the depreciation for the past 2 years? No. Note that it is considered as a change in accounting estimate. Depreciation is an estimate, right? We are estimating what will be the useful life, etc. Change in accounting estimate. So change in depreciation method is change in accounting estimate, and only prospective effect will be given. Prospective means prospective effect on whatever date. After 2 years they decided, right? After 2 years, whatever written down value is there, on that you charge 10% and continue. And whatever difference you are getting, you have to pass it to P&L. Clear? Change in the method. Remember that it's a change in accounting estimate and only prospective effect is given. No retrospective effect is given. Yes, there's one more concept of revaluation. Revaluation of fixed asset. So the asset normally will do depreciation. Now it can be revalued. For example, a depreciation an asset was being depreciated on SLM basis for 3 years. After 3 years, they thought that the asset value, for example, we'll take a question. 10 lakh one machinery was purchased. 3 years it was used, and depreciation at SLM was 10 years was life. So SLM they used, scrap value is 0. So 1 lakh every year depreciation would have been charged. So 3 years depreciation will be 3 lakh, same amount every year. So return down value was how much? 7 lakh. Right? So after 3 years they decided that the market price is much higher than that. So we'll revalue the asset to some 9 lakh, let's say. Whenever there is gain, means there is increase in the asset value, you will pass it to revaluation reserve. All right, you will pass it to revaluation reserve. It's a reserve account which will record with the capital. What will be the entry whenever it's a gain? So what was the gain here? So let's say revalued amount is 9 lakhs. So 2 lakh is the increase in asset. We have to record the increase in asset. So whenever there is revaluation gain, the asset is recorded as asset account debit, because asset value is increasing, to revaluation reserve. Revaluation reserve. Clear? What if after recording the gain there is subsequent loss, reduction? Subsequent reduction in gain. Whenever there is subsequent reduction in the value of the asset value should be brought down. Correct? So asset value should be credited to asset account. But credited using what? Using revaluation reserve. Revaluation reserve account should be debited to the extent recorded earlier. To the extent recorded earlier. Now for example, it was 9 lakhs here, right? Here you passed 2 lakhs, the first entry. Now later they revalued and it became 5 lakhs. Now what you will do is you have to get the asset to 5 lakhs. So your asset value is 9 lakhs now. 9 lakhs you have to bring it to 5 lakhs. So 4 lakh should be credited asset account. Revaluation account debit you will do only to the extent of amount recorded earlier. What was recorded earlier? Only 2 lakhs. Correct? The remaining debit should be to P&L. Profit and loss account debit 2 lakhs. One concept that we discussed earlier as well, conservatism concept. Here, whenever there is a gain, what are we doing? We are passing it to revaluation reserve. We are not passing it to P&L, because that's not actually realized gain. It's revalued gain. But whenever there is loss, even this is revalued loss only. It's not actual realized loss. But whenever there is estimated loss, you have to pass it to P&L. So 2 lakh, to the extent earlierly recorded, revaluation reserve will reverse it, but the remaining will go to P&L account. Same thing, for example, revaluation done and there is a gain, sorry, there is a loss. Revaluation loss is there. So now you won't touch revaluation reserve. You have to reduce the asset value. So to asset account, you will use it doing P&L account only. Profit and loss account, debit, you will record. Subsequent gain is there. So first it was reduction. If there was subsequent gain, then asset account has to be debited now. Asset account has to be debited. What will you credit? Revaluation reserve. But after you reverse the P&L effect. So it should be to P&L account to the extent of recorded earlier. To the extent recorded earlier, P&L account will be reversed. That effect will be reversed. The balance will go to revaluation reserve. Clear? Just remember this. Whenever there is gain first, go to revaluation reserve. When you are reversing it, to the extent revaluation reserve, close that account. The balance should go to P&L. Whenever there is loss, first pass it to P&L. Whenever there is loss, pass it to P&L. Subsequent gain, reverse the P&L effect which was given earlier. The balance will go to revaluation reserve. We are done with depreciation as well. Now we'll jump to final accounts. Final accounts of sole proprietor. So final accounts is nothing but the financial statements of the company, right? The financial statements of the company. This is in which step of the accounting? Summarizing as well as communicating. We won't communicate all the ledgers to the whoever requires the details of the accounts, right? We have to give them a summary. So that summary, how we'll prepare is, we'll prepare what? Trading account, P&L account and balance sheet. So we'll first, one thing we have to give is, we have to give them financial result details, financial results and financial position, right? So here they have to give income statement and position statement. So normally income statement will be two statements divided into two. One is trading account. Trading account will prepare to find out what? Gross profit or gross loss. So in this we'll record only the purchase, sales and all the direct expenses relating to the trade. And one more is profit and loss account to find out net profit or net loss. In this we'll record all indirect incomes and all indirect expenses. Other than direct expenses, whatever expenses are there will come in P&L. Ultimately we'll get net profit or net loss. Position statement will be balance sheet. Balance sheet will show assets and equity on one side. Sorry, assets on one side, liabilities and equity on another side. Let's go to the formats of the financial statements. One is trading, first is trading account. Trading account in P&L account is nothing but a ledger account. So the format will be similar. It will be trading account of the sole proprietor of Mr. X for the period ending 31st March or December, whatever year. So it is for the period, means it is for an accounting period. Normally it is 1 year. So whenever we prepare trading account and P&L account, it is for a period. It is only for a particular period. Whereas in case of balance sheet, it is as on a particular date, as on the year end date. This is for the particular period. Sorry. The format will be, there won't be date because it's for the whole period we are summarizing the ledgers. What all will come? So it's a ledger, so we have to write it like to opening stock, two purchases. So all the expenses will come on the debit side, all the incomes and closing stock will come on the credit side. Two purchases, there will be some adjustment to here, minus what? Purchase returns. There are few more adjustments, we'll discuss that when we do adjustments. Purchases, all the direct expenses, two direct expenses. What will be the direct expenses? Expenses which are directly relating to the trading of the goods. What will be that? One is carriage inwards. So to get the goods, whatever carriage is paid, that power, fuel, gas, what else? Factory expenses, water, fuel, etc. All these will be direct expenses. Then on the credit side, by sales account minus sales returns. We'll show the net figure here by closing stock. Why do we take closing stock and opening stock? Closing inventory and opening inventory, we discussed that, right? To find out the cost of goods sold. We have the sales here. We can't compare purchase and sales. If we compare and purchase and sales, that will be wrong because some stock is still lying and some stock was already there last year. So to find out cost of goods sold, we do this opening stock plus purchases minus closing stock. So it's nothing but opening stock, we are adding here purchases, minus by crediting we are doing closing stock. In that way, cost of goods sold is getting calculated in trading account and we are getting the profit or loss. How will we calculate profit? It will be, if it is profit, credit side should be excess. If the credit side is excess, it is profit, it will be gross profit carried down. If debit side is excess, that means expenses are more than income, then by gross loss carried down. Clear? If credit side is excess, then it is profit. If debit side is excess, it is loss. This is the format of trading account. Now let's go to profit and loss account. What will be the format of profit and loss account? Similar. Even this will be profit and loss of Mr. X as on, not as on, for the period, for whatever period ending 31st March 2020, it's for an accounting period. It's not as on a particular date. Clear? Now, how will you start with P&L? Here also you will have debit and credit. So you will start, if you had got profit in the earlier, get that by gross profit brought down. You will get that. Otherwise, if you had loss, to gross loss brought down. First you will get that from trading account. P&L account is a continuation of trading account. So you will get that, and then to all indirect expenses on the debit side and all indirect incomes. What can be indirect incomes? It can be interest received, commission received, etc. Indirect incomes on credit side. What are some of the examples? Indirect expenses. Remember this carriage outward. Carriage inward is relating to purchase. It will come in trading account. Carriage outward is relating to sales. It won't come in trading account. In trading account, only the expenses which were incurred to bring the goods to the factory should be recorded. Indirect expenses, carriage outward is not in direct expenditure. It is relating to sale. So it will be recorded there. Whatever else, like depreciation will come in P&L, bad debts will come in P&L, What else? Stationery, office expenses, whatever is not coming in trading account will come in profit and loss account. Indirect incomes can be interest, commission, etc. Clear? So after you record the indirect incomes and expenses here, if income is excess, if the credit side is excess, you will get 2 net profit carried down. Yes, if debit side is excess, you will get by net loss carried down. Either of these will come, both won't come. Hope you know that. One more thing, balance sheet. Balance sheet format will be balance sheet of Mr. X, not for the period. It's not for a particular accounting period. It is as on a particular date. What is the closing date? Whatever it might be, 31st March 2023. It will be as on a particular date. It's a position. As on 31st March, what is my position? Clear? So one side you will record equity and liabilities amount and assets amount. So balance sheet is not a ledger account. Balance sheet is not an account, it's a statement. Clear? So these are the 3 financial statements that will be prepared in case of final accounts of sole proprietor. Correct? So in every step there will be few adjustments. So in exam, how they will ask you question is, they'll give you a trial balance, there will be amounts, particulars, debit balance, credit balance. They'll give you a summary of all the accounts, expenses, losses, liabilities, incomes, etc. They'll give you adjustments in the end. They'll give you 5-6 adjustments telling that these adjustments are there. You should apply those adjustments to those accounts and then prepare the financial statements. We'll discuss the adjustments one by one and then we'll start with 1 or 2 sums. So we'll go through the adjustments one by one. Now take trial balance first. Sorry, take trading account first. See, we are recording closing stock here. Yes. So normally whenever they give you a trial balance, they'll give you debit balance, credit balance, they'll give you list of accounts. Closing inventory is always out of the trial balance. Closing inventory is always out of the trial balance. Why? We did inventory, right? Periodic inventory system. So closing inventory is like they will physically verify at the year end, and closing inventory they'll directly record in the financial statements. They won't prepare a ledger account for that. Hence, in the trial balance, you won't get closing inventory. If there is closing inventory in trial balance, you should understand that then the purchases which is there in, now for example, normally it will be like this. They have given you trial balance, all the balances, it is tallying, and they give you closing stock as an adjustments always. For example, they have not given you the closing stock in adjustments. They have given closing stock here only. Closing stock some 20,000 they have given, and purchases also they have given. Purchases some 2,80,000 they have given. Now here, whenever they give you closing stock in the trial balance, you should understand that purchases is actually adjusted purchase there. Adjusted purchase. What is adjusted purchase? Adjusted purchase is nothing but your cost of goods sold, which is opening stock plus the purchases done during the year, total purchases minus closing stock, and the closing stock whatever they have deducted, that they'll record it here. Clear? So if you have got closing stock in trial balance itself, then you should understand that purchases is actually adjusted purchase. All right. So total purchases during the year will be 2,80,000 plus 20,000. Just that only 2,80,000 has been sold. So it is shown like that, and 20,000 is coming in closing stock. So this one thing you remember, in 99% of the questions, they'll give you closing stock out of the trial balance, and there will be two effects of the closing stock. One is you will record that on credit side, you will record that on credit side of trading account. Also, you will record that in balance sheet on asset side, inventory, closing inventory, whatever amount is there, you will record. So whenever closing stock is given in adjustment, you should record the inventory two places. One is trading account on credit side, and on asset side in balance sheet. Clear? So first is closing inventory. This will be given as adjustment only in most of the questions. Next. Second, outstanding expenses. Outstanding expenses. So closing inventory, what will be the adjustment? In P&L, on credit side, and balance sheet on asset side you should record. Now, if they give outstanding expenses in adjustment, they have given you, for example, we'll come to the trial balance here. They have given you trial balance. They have given salary. Salary will be on the debit balance or credit balance. Salary is an expense, always debit balance. For example, they have given you 1 lakh. 1 lakh on debit side. In adjustment, they gave you outstanding salary at year end is 20,000. 1 lakh in TB it's coming. In adjustment, they have given outstanding salary amounts to, at the year end amounts to 20,000. What is outstanding salary? Outstanding any expense. Let's example we have taken is salary. What is outstanding salary? An expense which is still not paid. Still not paid. For this, we have to follow a concept called accrual concept. Clear? Few points to remember. Just note these points. Few points to remember while preparing financial statements. What are those points? First is accrual concept. Accrual concept. Even this forms a part of your theoretical framework. What is accrual concept is only the expenses and income which relate to the accounting period, the current year, which relating to current year should be recorded. So if something is relating to previous year or next year, it shouldn't come to trading account and P&L. All right. So all the expenses, all the income and expenses relating to the current year should be recorded. It is accrual concept. Second is revenue versus capital. We have already discussed this. Revenue and capital expenditure. Revenue expenditure will go to trading account and P&L depending on the nature, and capital expenses will go to balance sheet. Clear? Third is business expense versus personal expense. This is nothing but whatever business expenses only should be coming in P&L and trading account. If some expenses has happened, like personal expense means of personal expense of whom? Of the owner. We are preparing financial statements of what? Sole proprietor. So if there is some personal expenditure of sole proprietor, it should go where? It should go to drawings. Clear? So remember this 3 points. One is accrual concept, only the current year expenses and income should come. All the current year expenses and income should come. Revenue versus capital we have already discussed, and business expense should be coming in the financial statements. Personal expenses should go to drawings. Clear? Now outstanding expenses we were discussing, right? Outstanding expenses, for example outstanding salary, it means that some salary is yet to be paid, but relating to current year, because they are telling that this salary 20,000 is outstanding at year end, current year end 31st March, whatever financials you're preparing, as on 31st March this salary is outstanding, means it is relating to current year. Whenever they say outstanding as on the end, as at the year end, we should assume that we should understand that it is relating to current year. So it is outstanding expenses is always relating to current year. So you should record it, right? So you should record it. How will you record it? First is salary you should add, because salary is 1 lakh here, but outstanding salary is 20,000. In P&L account, when you record salary, it should be 1 lakh plus 20,000. Clear? And in balance sheet, will it be asset or liability? It's payable. So it will come on liabilities side. Outstanding salary will come in liability side. What is the entry for this? Just look at this and tell me the entry. Salary account, salary expense should be debited, because we have to increase the expense, because outstanding has not been recorded yet. So salary account debit to outstanding salary account. Clear? It can be anything, it can be rent also. If not salary, outstanding rent, last month rent has not been paid, but it is relating to the current year. So outstanding rent. Expense will increase, debit, and outstanding will be on liability side of balance sheet. Clear? So second adjustment is outstanding expense. What will you do? In P&L you will debit it or add it to the expense. Clear? In balance sheet on liability side. Clear? Next, prepaid expenses. So same, salary has been given 1 lakh, but they didn't give outstanding salary. In adjustment. They said prepaid salary at year end is 10,000. What do they mean prepaid? Prepaid means once. Paid in advance, correct? Prepaid. If it is paid in advance, as on year end we are telling that this is paid in advance, that implies that it is not current year expense, correct? If it is paid in advance, it is relating to next year, correct? If it is prepaid at year end, that means it is not relating to current year, it is relating to next year, right? So we should assume that 1 lakh is the salary total paid. Out of that, prepaid is how much? 10,000. So current year expense is how much? Only 90,000 is the current year salary. So what will we do? In P&L, when we put salary, we will reduce prepaid salary. Clear? And one more will be on balance sheet. What will you do? Asset or liability? We had to pay salary, we have already paid, we paid in advance. So on asset side, prepaid expenses. Clear? Prepaid salary will come there. So prepaid expenses, what should you do? In P&L, credit it. Credit means from expense you are reducing, correct? Reduce it from expense. And balance sheet, it's an asset because it's already paid in advance. We don't have to pay further. So it's an asset to us. What's the entry for this? Similar, we have to reverse the expense, correct? And we have to record the asset. So prepaid expense debit to expense account. Clear? Now the same thing, think of the other way. So this is relating to current year, this is relating to next year, right? Now this is adjustment what was given at year end, correct? Now what if they said, for example, TB they gave for as on 31st 3 2020, and adjustment they gave, adjustment both outstanding and prepaid adjustment they gave. So let's say salary 1 lakh they gave, but adjustment they said outstanding salary as on 31st March 2019 was 10,000. Outstanding salary as on 31st March 2019. We are preparing for financials for 31st March 2020. So they are telling previous year there was an outstanding salary which was 10,000. What does it mean? Out of this 1 lakh, so outstanding salary of previous year means what? Last year only it was outstanding. So it was last year expense. Previous year expense it was, right? If it was outstanding on 31st March 2019, means it was previous year. It was relating to the period 31st March 2019. Previous year expense. We have paid 1 lakh and we are telling that outstanding salary as on 31st March is 10,000. Means whatever was outstanding as on 31st March 2019 would have been paid. Correct? This 1 lakh will include this 10,000. Correct? But is it relating to the current year? No, it is relating to the previous year. So you should reduce it. So we'll reduce it from expense and record it as, we won't record it as anything. Why? What will be the entry? Tell me. What will be the entry? P&L, what will you do? P&L, what will we do? Salary, to salary account, we'll put 1 lakh minus opening outstanding. How much? 10,000. Correct? Correct? We'll reduce it because it's not current year. What will be the entry? To salary account. Correct? To salary account, because we have to reduce the salary by 10,000. What will you debit? Will debit outstanding salary account 10,000. So you are reversing a liability, means it should already be there in your trial balance. Outstanding salary, it should have a credit balance of 10,000. So in that case, if it is opening outstanding, we'll close it because it's already paid and your current year salary should only be 90,000. So you are reducing 10,000. Clear? So if they tell outstanding salary as on 31st March or prepaid salary on, if they say prepaid, they said prepaid salary, let's just same adjustment. They didn't say outstanding, they said prepaid salary, and we had an item here. Prepaid salary on asset side 10,000. What does it mean? Prepaid salary as on 31st March 2019 means what? Previous year only it was prepaid. If it was prepaid on 31st March 2019, it is relating to current year. Correct. It was paid in advance in previous year. Paid in advance for which year? Current year. So it is relating to current year. Correct. So you should add. So in P&L to expense, you should add, and what will you do? What will be the entry? You should add means salary account debit. Correct. What will be the entry? Salary account debit to whatever prepaid salary is there in trial balance, will close it. In balance sheet, nothing will come. Clear? So remember, normally they'll ask at the year end, but if they tell at the beginning of the year there is outstanding or prepaid, think from a point of view of like accrual concept, whether it is relating to current year or not. If it was outstanding at the beginning, that means that if it was outstanding for previous year, if it was prepaid at the beginning, means in previous year itself it was paid for current year, so it is a current year expense. So in which year it is paid, it doesn't matter. Whenever it is paid, for which period it relates to the expense is what matters. Clear? So we've done with closing inventory, outstanding expenses and prepaid expenses. Fourth, we'll take personal expenses. I said all the business expenses should come in the financial statements. Personal expenses will always be recorded as drawings. Correct? For example, some expense was made. Insurance is an adjustment that they ask regularly. Now let's take an example. They have given trial balance, right? They have given insurance as an expense in trial balance. Insurance, some 1 lakh insurance premium is paid. It's an expense. You will have debit balance, right? In adjustment they gave that the insurance premium includes life insurance premium payment of 20,000 rupees of sole proprietor, whoever is the owner, relating to his life insurance policy, personal policy. It is paid from the business. What will you do? It's a personal expense. You have to reduce the expense, right? So it will be, we'll credit the expense to reduce to insurance premium. Correct? To insurance premium account, credit you will do. What will you debit? Drawings. Drawings is debit natured account and drawings are increasing, right? That money what is paid is for the owner. So it's like owner is taking the money out of the business. So drawings account debit. Clear? 20,000. So drawings, what will you do? In P&L, credit. So expense, from expense you will reduce, minus. And balance sheet, what will you do? Drawings will increase, right? Drawings will increase and these drawings will be shown as a reduction from capital. Correct? From reduction, from capital it will be shown as reduction. Clear? Balance sheet. Next, relating to incomes, there are two adjustments. Take accrued income. Accrued income. Income is what natured account? Credit. Right? So let's say they gave the trial balance and they gave, for example, interest. They gave interest received from bank. On credit side it will come 20,000. Okay. In adjustment they gave accrued interest at the year end. At year end is rupees 5,000. Accrued interest means the interest has been accrued for the year. Like interest is relating to the current year. Interest should have been received, but it's not received. It will be received in the next year. It is accrued for current year. Whenever they say accrued interest at year end, it means that it is accrued for the current year. What should you do? Income should increase. Income received is 20,000. Correct? So when you in P&L, when you record interest on what side will record? Credit side. By interest 20,000. Correct. You will add accrued interest. Accrued interest of 5,000. Total you will show 25,000 on credit side. Clear? And balance sheet asset or liability, it's receivable. Whatever is accrued, you have to receive it. So on asset side. Clear? What will you do in P&L account? Credit or debit? Credit will increase the income. Yes. And in balance sheet, asset side, it's receivable. Now let's say they say income received in advance. All right. Let's say you have rental income. You have rental income in your business. Rental income, debit balance or credit balance? Always credit balance. It's income. Let's say 2,50,000 is the rental income. In an adjustment they give, out of the rental income, rent received in advance. Received in advance means it is relating to next year, is 50,000. Rent received in advance means what? It is relating to next year. Correct. If it is relating to next year, can we record it in P&L this year? No. So from income you should reduce and record it as asset or liability. You haven't earned that income yet. Correct. You haven't earned that income yet. When will you earn that income? Next year. But you have already received. So it's not an asset. It's a liability. Liability will increase. Clear? What will you do? What will be the entry for this? Income you are reducing. Income is a credit natured account. If you are reducing, income account debit, whatever income it is. Here rent account debit. Correct. Rent account debit to, you have to record a liability. Rent received in advance. Clear? So what will you do in P&L? Debit or credit? You will debit, reduce it from income. And a balance sheet, a liability. Clear? 6 adjustments done. So all these, like these can come in your adjustments list after your trial balance. So all this treatments you should do in P&L and balance sheet, and then you should disclose the, then you should like issue the P&L and balance sheet. You should give a clear picture there. Next, income tax. So this comes in personal expenses itself. For example, what if they say income tax paid, income tax of owner paid. See, normally tax is an expense. Normally, if other financials are prepared of company or anything, it's always an expense because the business is getting charged. But only in case of sole proprietor, we are preparing financials for sole proprietor only, right? If they tell income tax of that person is paid, income tax, we won't take it in P&L. We'll take it as reduction from capital, similar to drawings. Here, we'll reduce it from capital. Clear? So if it is income tax is paid, what will be the entry? Bank is reducing, amount is going out to bank account. What will you debit? Capital account. Debit. Clear? So in P&L will it come? No. If it is already recorded, reduce it from P&L. And balance sheet, it is reduced from capital. Clear? This is income tax. Next adjustments. bad debts. Bad debts. Normally, what is the entry for bad debts? Bad debts. Bad debts is an expense, right? So entry for bad debts will be bad debts account debit, right? Bad debts account debit to debtor account, right? Bad debts account debit to debtor account. Bad debts is an expense. We will debit it, and debtor account is reducing because we are assuming that he is not going to pay us. Bad debt is like the debtor is not going to pay us, so we'll reduce his balance, record the expense. Now bad debts is easy. For example, provision for bad debts is what we have to see here. Provision for bad debts. What is provision? Provision is a liability rate, where like provision is always a charge on profit. It's called charge on profit. So provision, what is meant by provision? Like the bad debt has not happened. Bad debt has not actually taken place. But we are expecting that, for example, debtor balance is some, we have total receivable of 1 lakh, debtor balances 1 lakh. We are expecting a bad debt of 5%. We are expecting, they have not yet become bad debts. We are expecting bad debts of 5%. So we'll create a provision for 5% of 1 lakh. Will be 5% provision has to be created. How will we create it? 5,000 at 5%, 5% of debtors. What will you do? Will you reduce the debtors? No. You will record it something like this: profit and loss account debit to provision for bad debts. Focus on the entries here. So how will you pass the provision entry? This is the provision creating entry. Provision creation. How will you create the provision? P&L account debit to provision for bad debts account 5,000. Clear? Provision for bad debts is comes on the liability side. It's a liability, but how is it disclosed? In balance sheet, debtors still is 1 lakh only, minus provision for bad debts 5,000 is shown, but it's a liability. It's shown as a reduction from debtors, similar to asset and provision for depreciation like we discussed, 95,000. Clear? So it goes to P&L. In P&L will record provision for depreciation created is 5,000. P&L on expense side it will come, and in balance sheet on asset side reduction from debtor. Clear? So whenever provision has been created, P&L here nothing will come, right? Provision for bad debts in P&L expense side we will debit it, debit P&L, expense side we will include, and balance sheet it's a liability, show as reduce from debtors. You have to disclose it. You can't directly write the net figure 95,000 there. You have to show debtors is 1 lakh minus provision that we are creating is 5,000, 95,000. Okay, well and good. First year you created a provision 5,000. Next year, for example, you have the balance of 5,000. Focus here. They have given you trial balance. Let's say it is relating to next year. So provision for bad debts is coming on credit side 5,000. Debtors is also coming. Let's say it's the same amount still, 1 lakh. Okay. Now they say in adjustment, let's say they say that bad debts for current year is 2,000 and provision for depreciation, provision for bad debts should be maintained at 5% of debtors. Now, if they tell you this, what happens? First entry, what will you pass? You will record the bad debts, right? Bad debt entry will be what? Bad debts account debit. Bad debt account debit to debtor account. First you will reduce the debtor balance because that has become bad debt. It's not provision. It has become bad debt. How much? 2000. Yes. So whatever this bad debts is there, you can pass it to P&L, or best way is pass it to provision for bad debts. You have created a provision, what? Expecting that there will be a bad debt, right? So whatever bad debt you have, pass it to provision. How will you pass? You will close this, so you will have to credit bad debts to bad debts account. How much? 2000. Pass it to provision for bad debt. Debit. 2000. Clear? Now, if you create the provision for bad debts account ledger, provision for bad debts. Now, what is happening? It has an opening balance, credit side, by balance, carried down. Sorry, brought down. How much? 5000. It has a balance on credit side, credit balance he has. What is the first entry we are passing? Bad debts to debtors. So debtors balance came down from 1 lakh to 1 lakh minus 2000, 98,000. And one more bad debts, we passed it to provision for bad debts, 2 bad debts. So provision for bad debts has been debited. So 2 bad debts, right? 2 bad debts, how much? 2000. And they are telling provision for bad debts should be maintained at 5% of debtors. 5% of debtors. What is the debtor balance now? What is the debtor balance? 1 lakh it was there, but debtors 2000 actually took place. So 98,000 is the debtors balance. Iska 5% will be 98,000 into 5% is 4,900. So this should be the provision that should be maintained. So provision, so 4,900 should be the closing balance of provision for bad debts. How will you calculate that? To balance carried down. Debit balance or credit balance? It's credit balance. We are assuming that credit should be excess. So debit side, it is a credit balance. Closing balance of provision for bad debts. How much? 4,900 should be there. So whatever balancing figure you get here, so you will tally it 6,900. The balance is 1,900. What should you do to this 1,900? This should be passed to P&L account. Clear? Yes. This you should be careful. Provision for bad debts. This account you remember, or those entries you remember. Whenever they have given you balance and they tell you that this percentage has to be maintained, you should take the closing balance as that percentage. You maintain that. Bad debts, you pass it to provision for bad debts. The balancing figure will go to P&L. Clear? The disclosure will still be the same. On P&L, you will show it as expense. In balance sheet, you will show it as reduction from debtors. Clear? Now, ninth, adjustment to purchases. In trading account, we are calculating purchases rate. In trading account, we are calculating purchases, right? You have trading account. Here you will record 2 purchases. So in this you will reduce purchase returns. There are some more adjustments that can be done in trading account. What are those? First, it can be abnormal loss. What should you do to abnormal loss? So let's say you have done some purchases. Some of the goods have been lost due to abnormal reasons, not normal reasons. Abnormal reasons. What will be the entry? You should reduce the purchase. So to purchase account you will credit. What will you debit? Abnormal expenses account. Where will this abnormal expense account go to ultimately? It will go to P&L. So P&L account debit to abnormal loss account. Clear? So in trading account you will show minus abnormal loss. Yes. Similar way there can be let's say goods taken by the owner for personal use. Let's say some of the goods the owner took for his personal use. It will be drawings, right? It will be drawings, right? How will you record it? How will you record? Drawings account debit to purchase. Purchase you should reduce. Drawings account debit to purchase account. Right? Drawings account, where will it go? It will go to balance sheet as reduction from capital. Goods and for advertisement or free sample. Or donation. Right? It's an expense, but it's not a direct expense. It is an indirect expense. So similar to abnormal loss, what entry you should record? For example, if it is free sample, it's an advertisement expense. So you should record advertisement expense debit, because advertisement expense is increasing. To purchases you should reduce because the goods are going out. Purchases account. Clear? In all these cases, what should you be doing? You should reduce it from purchases. In trading account, reduce from purchases, right? And and only in case of personal use it will go to drawings. In other cases you are recording it in P&L, record expense. Clear with this? You see what adjustment it is. You should, like in all the cases the goods are taken out, so reduce it from purchases. Where will you record it? Depends. For personal use it will go to drawings. All the other cases it's a indirect expenditure, so record it in P&L account. Clear? Next, commission. 10. Commission based on profits. Commission based on profits. Who will be paid commission? Mainly the sales guys or like even the managers. For example, it is agreed that whatever profit they get, they'll create P&L, trading account P&L. They'll get what? Net profit they'll get at the end. Right? If credit is excess, they'll get net profit. Right? Let's say they got 1 lakh. 1 lakh as net profit. It is agreed that commission will be based on profits. Now, it can have two cases. One is commission will be charged on profit before charging commission. Before charging commission. Means what? You will just take the 1 lakh. So 1 lakh, for example, 2% is the commission decided. 1 lakh into 2% will be 2000 will be the commission. So what is the formula for here? If the commission is charged on profit before charging commission, then it is net profit into percentage of commission by 100. Right? Rate of commission divided by 100. Now what if it says commission is charged on profit after charging commission? After charging commission. What do you mean by that? You should take net profit 1 lakh. They're telling that you should charge commission on profit after charging commission. Like this net profit, they are telling that it should be after charging commission. So if it should be after charging commission, 2% is it charged now on this 1 lakh? No. They're telling that it should be after charging commission, means the 2% you should add. Assume that it is 102%. We'll assume that it is 102% and we need 2%. That will be our commission. So it will be net profit. It will be net profit into rate of commission divided by 100 plus rate of commission, which is 102. It will be 1960. Clear? So the formula will be net profit into rate of commission divided by 100 plus rate of commission. Clear? Just remember the formula. If they give this adjustment, just see whether it is before charging commission or after charging commission. Clear? Let me see if any other adjustments are there. No, I think we can try one question. Question number 11 in study book. Question number 11. Let's read the question. The following is the schedule of balances as on 31st March 2020 extracted from the books of Sri Gavaskar, who carries on business under the same name and style of Messrs. Gavaskar. So this is the business name, Messrs. Gavaskar Vishwanath and Co. at Bombay. Is it a trial balance? Yes, it is a trial balance. Correct. He has given debit balance and credit balance and it is tallying. Now go through the trial balance. What have they given? Cash in hand. Where will this go? Balance sheet, assets. Correct. Cash at bank. Again, asset. Sundry debtors, asset. Opening stock. Opening stock, where will it go? Trading account. Right? Trading account on debit side. Furnitures and fixtures. It's an asset. Office equipment. Asset. Buildings, asset. Motor car, asset. Creditors, liability. Loan from Vishwanath. So it's a liability. It's a loan taken. Provision for bad debts. How will we show provision for bad debts? We'll reduce it from assets. Correct? It's a liability, but we'll reduce it from asset. Purchases, trading account, debit side. Purchase returns, trading account, will reduce it from purchases. Sales, trading account, credit side. Sales returns, will reduce it from trading account. So we'll reduce it from sales returns in trading account. Salaries, P&L, right? Indirect expenditure. If it is wages, direct expenditure. Rent for go down, direct or indirect? Indirect. So P&L. Next, interest on loan from Vishwanath. Just a minute. Yeah, sorry. Interest on loan from Vishwanath. We have taken a loan from Vishwanath. Interest debit balance. So it's a expense, P&L account. Rates and taxes, P&L account, expense. Discount allowed to debtors, expense, P&L account. Discount received from creditors, income, P&L account. Freight on purchases, trading account. If it was freight on sales, next, carriage outwards, always P&L account. If it is relating to purchase, trading account. Relating to sales, P&L account. Drawings, balance sheet on liability side, correct? Balance sheet. Printing and stationery, it's an expense in P&L. Electricity charges, P&L. Insurance premium. If they said power, then trading account. Electricity charges, profit and loss account. Insurance premium, We'll see whether it is relating to business or not. Normally, profit and loss account. General office expenses, profit and loss account. Bad debts, profit and loss account. Bank charges. What will you do to bank charges? Profit and loss account. Motor car expenses, profit and loss account. Capital account, balance sheet on liabilities. Right? Next. They have given adjustment. Prepare trading account. They have given the requirement. Prepare trading account, P&L account for the year 31st March 2020 and balance sheet as at that date. Clear? After making provision for the following. Means what? All these are adjustments. Means these are not, effect of this is not given in the trial balance. We have to give it now. What are those? First, depreciation. Depreciation we saw, it didn't come in trial balance. So we have to calculate depreciation and record it in P&L. They have given building used for business by 5%. Okay, this is the rate of depreciation. Furniture and fixtures by 10%. One steel table purchased during the year for 14,000 was sold for same price, but the sale proceeds were wrongly credited to sales account. What is this? Rectification of errors. Even rectification of errors will be tested. They're telling what? One steel table purchased during the year for 14,000 was sold for the same price, but the sale proceeds were wrongly credited to sales account. We'll see. Like once we discuss the adjustments, we'll see. Next, office equipment by 15%. Purchase of a typewriter during the year 40,000 has been wrongly debited to purchase account. Again, rectification of error. Right? Motor car by 20%. They have given the rate of interest for all the rate of depreciation for all the assets, and they have given two rectifications that we have to do in financial statements. Right? Next, value of stock at the close of the year was 4,40,000. What is this? Closing stock. It is out of trial balance. So you need not worry about purchases. You can take purchases directly. 2 months rent for go down is outstanding. Outstanding expenses. We discussed it. Next, interest on loan from Vishwanath is payable at 12% per annum. This loan was taken on 1st May 2019. So interest on loan, they have given interest on loan. Interest on loan from Vishwanath they have given. But here they are giving interest means what? There might be accrued or paid in advance, correct? There might be outstanding interest that is payable or already paid, prepaid interest. So that we have to calculate. Next, provision for bad debt is to be maintained at 5%. They are telling that it should be 5% of debtors. Yes, we have to create the provision for bad debts account and see. Insurance premium, how much was insurance premium? Was 55,000. They are telling insurance premium includes 40,000 paid towards proprietor's life insurance policy. What do we do? Drawings. And the balance of the insurance charges covers the period from 1st April 2019 to 36 2020. Right? Like what period it is? It is for more than 1 year. We are preparing as on 31st March 2020. So 3 months excess they have already paid. Prepaid insurance. Right? So we have to first we'll discuss these adjustments, then we'll move to financial statements. So first let's discuss the adjustments one by one. First, what are they given? Depreciation. Let's working notes. Working note 1. Depreciation. Calculation of depreciation. Depreciation calculation. What are the assets? What are the assets? There is furniture and fixtures. Buildings, there is no adjustment, correct? Building, what is the rate? 5%. Correct? 5% is the rate. So particulars amount. Building is 5%. What is the value of building? Building is 6 lakh. 6 lakh into 5% will be 30,000. 30,000, correct? Right. Next, what is given? Furnitures and fixtures, there's an adjustment. Motor car, there is no adjustment, right? Motor car, 20%. What is the value of motor car? 2 lakh. 2 lakh into 20%, which is 40,000. We are good till here. Now, see the other ones. Furnitures and fixtures, what is the value in balance sheet? Furnitures and fixtures, 2,14,000, correct? 2,14,000. They're telling one furniture and fixtures by 10% we have to do. So furnitures and fixtures, 2,14,000 is the value and 10% is the depreciation. So into 10% is fine. But there's an adjustment. What is the adjustment? One steel table purchased during the year for 14,000 was sold. So purchase is fine. Was sold for the same price. If it is sold for the same price, what will be the entry? What will be the entry? Let's assume there is no loss, no profit, right? Then what is the entry? We are getting bank. We are getting money, right? Bank account debit to steel table is furniture to furniture account 14,000. So this should have been the entry. But what did they do? What is the error? They are telling the sale proceeds were wrongly credited to sales account. Wrongly credited to sales account. What will be the entry then? What was the wrong entry? So this is the right entry. What is the wrong entry that they have passed? They have credited it to sales. So bank account debit to sales account. Right? Correct. We have to pass a rectification entry now. How will you pass a rectification entry? Furniture should have been credited. It's not credited. So you credit it now to furniture account. 14,000. Sales shouldn't have been credited, but that has been credited. You reverse it now. So sales will reduce debited. Sales account debit 14,000. This is the rectification entry you have to pass. So depreciation on what value you will calculate? 2,14,000 is what is in TB. Once you pass the rectification entry, we reduced furnitures by 14,000. Correct? So 2,14,000 minus 14,000 into 10%. 2 lakh into 10%. 20,000. Clear with this? Next. Office equipment also there is one adjustment. They are telling purchase of a typewriter during the year for 40,000 has been wrongly debited to purchase. Similarly, what is the right entry? What is the right entry for this adjustment? It is office equipment purchased. So it should have been office equipment debit. Office equipment account debit to bank account. Right? It is purchased. How much? 20 or 40,000. Right? This should have been the entry. But what was the entry passed? What was the entry passed? It was debited to purchase account, they're saying. Excuse me. So the entry was purchase account debit to bank account. So you have to rectify this entry. What will be the rectification entry? Rectification entry should be office equipment had to be debited. It was not debited, so debited no. Office equipment account debit 40,000. Purchase account should not have been debited. Correct, it's not a purchase, but it was debited. So reverse it now to purchase account. What kind of error is this? Types of error. Error of principle. Correct. The rule of capital versus revenue has not been followed. So this will be the rectification entry. Now, what is the office equipment balance in balance sheet? Office equipment is 1,60,000. So office equipment, what is the rate of depreciation? Office equipment should be 15%. So 1,60,000 is what is there in trial balance. We debited office equipment rate by 40,000 into 15%. So 1,60,000 plus 40, 2 lakh into 15% will be 30,000. So this is the total depreciation. 60, 1 lakh, 1,20,000. 1,20,000 is the total depreciation. Done with the first adjustment, correct? So depreciation we calculated, 2 rectification entries we have passed. So even that you should remember. 1 depreciation we passed. We should give this effect in trading account. We have to reduce from purchase, reduce from sales, and also balance sheet. Balance sheet, what do you have to do? You have to add to the value of the assets and then apply depreciation, correct? So first adjustment done. Second adjustment, what do? We'll record it in balance sheet and trading account, right? Second entry, second adjustment is closing stock, correct? Second adjustment is closing stock, so not a problem. Look at the third adjustment. 2 months rent for go down is outstanding. How much amount they have not given? They have said 2 months rent for go down is outstanding. Now go down rent they have given somewhere, right? Go down rent for go down they have given here. How much they have given? 55,000. So 2 months rent is outstanding means what? 2 months rent is outstanding. So whatever is this rent for go down will be for how many months? Will be for only 10 months, right? Right, working note 2. Working note 2, outstanding go down rent. Outstanding go down rent. They have told that 2 months go down rent is outstanding. So what is the rent paid as per TB? 55,000, right? 2 months is outstanding. So this will be for how many months? This will be for 10 months because 2 months is outstanding out of 12. So it will be for 10 months. So plus outstanding rent. How much? How much? 55,000. If 55,000 is for 10 months, what will be per month rent? 5,500 into 2 months. How much? 11,000. Right? Add it. What will it be? 66,000. So 66,000 should be total expense for the year. Total rent for the year. Clear? They have not given the amount. You should understand that if 2 months rent is outstanding, the rent which is coming in trial balance is for 10 months only. Next, interest on loan from Vishwanath is payable at 12% per annum. This loan was taken on 1/5/2019. For which year we are preparing 31st March 2019. But that is from 1st April 2019 till 31st March 2020. So during the year it was taken, right? So it was taken on 1/5/2019. So during the year, so they are telling that interest on loan from Vishwanath is payable at 12% per annum. So let's calculate the interest here. Working note 3. Interest on loan. Loan from Vishwanath. How much? How much is the loan taken from Vishwanath? You see first. Loan from Vishwanath is given here. It is 3 lakh he has taken. Correct? Total interest is equal to 3 lakh into What is the rate of interest they are telling? 12% per annum into 12%, that is 12 by 100. For how many months? It was taken on 1/5/2019 till 31st March 2020. How many months? From May, June, July, August, September, October, November, December, January, February, March. 11 months. So into 11 by 12. If 12% is for 12 months, what is for 11 months? So 3 lakh into 12% into 11 by 12. 33,000 is the interest for the year. This is total interest for the year. Correct? This should come in P&L. Correct? This is the interest for the year, accrual concept. This should come in P&L. What is coming in TB? Interest on loan from Vishwanath is 27,000. So this should be interest paid. Interest paid is how much? 27,000. The balance is? The balance is what? Outstanding. You still have to pay. Outstanding interest is equal to 33,000 minus 27,000. 6,000. Yes, clear? So, what will you do to this? You will record 33,000 in P&L, 27 plus 6, and 6,000 you will show in balance sheet as what? As a asset or liability? Liability, you have to pay. Clear? Now, what else is there? Adjustment. We are done with 4 adjustments. Correct. Next, provision for bad debts. So, working note 4. Provision for bad debts account. Prepare a ledger only. Provision for bad debts account. Debit. Credit. Now look what's happening. What all have they given? Provision for bad debts is to be maintained at 5% of sundry debtors. One more thing we have to notice is they have given bad debts here. Correct? They have given provision for bad debts here, and they have given debtors here. Everything is relevant, right? So now bad debts is already coming in trial balance. That means bad debts is already recorded during the year. What is the entry for bad debts? Bad debts to debtors. So already bad debts is recorded and debtors has been reduced. So we shouldn't pass that entry again, right? So what is the opening balance for provision for bad debt? 30,000, right? So provision for bad debts by balance, credit balance, right? By balance brought down 30,000, right? I told you whenever bad debts is there along with provision for bad debts, pass it to provision for bad debts. So bad debts has debit balance. To close it, you have to credit. So the entry will be provision for bad debts account debit to bad debts account. Posting will be to bad debts account. How much? 20,000. Correct? So to bad debts 20,000. Clear? Now they are telling maintain provision for bad debts at 5%. So to balance carry down, how much to prepare? They have already given 5% of debtors. What is the debtor value? Debtors value is 8,60,000. So they are telling prepare, like your provision for bad debts closing balance should be how much? 5% of 8,60,000. 8,60,000 into 5% will be 43,000. Right? What will be balancing figure? Balancing figure should go to profit and loss account. How much? 63,000. 33,000 should go to P&L account. Clear? 33,000 should go to P&L account. What is the next adjustment? Done with provision for bad debts. Always prepare a ledger. It will become easier for you to understand. Insurance premium includes 40,000 paid towards proprietor's life and the balance of the insurance cover the period from 1/4/2019 till 36/2020. Now let's calculate that. Working note 5. Insurance premium. What is the total insurance premium paid? Insurance premium paid. Paid is what is coming in trading account, right? How much is it? Insurance premium 55,000, right? 55,000. So this 55,000 is total paid. In this minus personal insurance of owner is how much? 40,000. That shouldn't be recorded, correct? That shouldn't be recorded. So the balance is 15,000 is insurance premium relating to business. So this is business insurance, business related insurance expenses. How much? 15,000. So 15,000. But this they are telling whatever 15,000 is there. What have they said? The balance of the insurance charges cover the period from 1/4/2019 to 36/2019. Our period is this 1/4/2019 to 31/3. So they have paid till 36. So after March, April, May and June, 3 months they paid excess, right? Total how many months they paid? 15 months they paid. So 3 months is prepaid, correct? 3 months is prepaid. No, 12 months is the expense for the year. So reduce minus prepaid insurance. You reduce. How will you calculate prepaid insurance? The balance is 15,000. 15,000 is for how many months? 15 months. And how many months is prepaid? 3 months is prepaid. So 15, 1,000, 3,000. 3,000 is prepaid insurance here. So the balance is expense for the year. Insurance expense for the year is how much? 15,000 minus 3,000. 12,000 is the insurance expense for the year. Clear with this? We are done with all the adjustment. 5 working notes we have prepared. This working notes you apply in the financials, you will get the answer. Now let's go through the solution here. Look here, trading account they have prepared first. Trading account for the year end 31st March 2020. Particulars, details, amount. This is optional, you can do it otherwise also. Details column, it's not mandatory there. Look at the format. To opening stock given in trial balance itself 6,20,000. Purchases 14 lakh. Purchases there were 2 adjustments. One, purchase returns. Purchase returns is given in trial balance itself. One is reduction because typewriter purchase was considered as purchases. We passed the rectification entry, so we are reducing 40,000 here. So net purchases they have recorded, right? Freight on purchase we said is will come in trading account. Freight on sales will go to P&L account. Now look at the credit side. Sales, we have sales returns which is coming in trial balance itself. One is sale of furniture which was considered as sales. We passed the rectification entry, that is reversed. Clear? So the net sale is recorded here. Closing stock is given in adjustment 4,40,000. Yes, 4,40,000 is recorded here. Which side is excess? Credit side is excess. The balance is 7,18,000 recorded as gross profit. Now P&L account, we'll go to P&L account from there. The same balance 7,18,000 is brought forward here. Now next, see what is recorded. We have already discussed where all these accounts will come. Salaries, P&L account. Rent for godown, we prepared working notes where 55,000 was for 10 months. 2 months we calculated 66,000, and this 11,000 will go to liability side of balance sheet. Next, provision for bad debts. We we discussed this, right? In ledger account, the balancing figure came as 33,000. Next, rents and taxes, 21,000 directly from TB. Discount allowed directly from TB. Carriage outwards directly from TB. Printing and stationery TB. Electricity charges in P&L. Insurance premium we discussed. 12,000 is for current year. Insurance premium. 40,000 is like considered as owner's expense. It is considered as drawings, and 3,000 is prepaid insurance. So 12,000 for the current year. Depreciation we calculated 1,20,000. General office expenses directly from TB. Bank charges directly from TB. Interest on loan we discussed. 27,000 is what is paid. 6,000 is outstanding. 33,000 is the interest for the year. We calculated this. Next, motor car expenses directly we have taken in P&L. This is revenue in nature, right? Whenever they tell normal repair or expenses, go to revenue or take it as revenue expense only. If they tell that it improves efficiency or it improves productivity, then we have to capitalize it. Clear? On the credit side, you see only discount received directly from TB we have calculated. The balancing is net profit. What will we do to net profit? Net profit is always transferred to capital account of the owner, right? Balance sheet. Look at balance sheet. On asset side, you see first building 6 lakh given in TB, 30,000 is depreciation. We have calculated in working note. Motor car 2 lakh directly given in TB, depreciation we calculated. Office equipment, they have taken it as 2 lakh. Office equipment was how much? 1,60,000, right? We passed this adjustment, no? 1,60,000 plus 40,000 is 2 lakh. Rectification entry. 2 lakh minus depreciation 30,000. Furnitures and fixtures, it was 2 lakh 14,000 minus 14,000, which is 2 lakh here minus depreciation. Clear? Stock in trade. Which stock is it? It is closing stock, which is coming in adjustments. Opening stock we won't take. Closing stock we'll take here. Sundry debtors 8,60,000 given in TB. Less show the provision that we have calculated 43,000, 5%. Right? Next, cash in hand directly taken. Cash at bank directly taken. Prepaid insurance. This is something we calculated, right? 3,000. We'll record it as asset. Prepaid is asset, right? Because we paid in advance, we don't have to pay later, it's an asset. Now here outstanding rent 11,000, we calculated 2 months rent was outstanding. Sundry creditors directly 4,30,000. Loan from Vishwanath 3 lakhs, this is the loan amount. Outstanding interest is 6,000. So total outstanding is 3,06,000 relating to the loan. It's fine if you show separately also, it's fine if you show adding it to that as well. Capital, you see, one is 16,20,000. What is this shown in trial balance? Add net profit taken from P&L less drawings 1,20,000 less insurance premium of 40,000. Right? Insurance premium, life insurance premium of his account, we reduced it from life insurance expense, right? That they've recorded here, and they've prepared this. These are the working notes that they have prepared, similar to our working notes. Clear? Clear? We are done with final accounts one part. There's one more thing called manufacturing account. Right? Normally, sole proprietors, they'll ask for trading companies, which is trading account, P&L account, and balance sheet. Sometimes they can ask for manufacturing account as well. What is manufacturing account? Now, what are the financial statements that we prepared? Financial statements that we prepared are what? Trading account, P&L account, and balance sheet. This trading account, we'll assume that this is for trading companies, means they are purchasing goods, they are selling goods, that's all. So we record purchase, sale, opening stock, closing stock, and then we move on to P&L and then balance sheet. What if it is a manufacturing company? manufacturing company. If it is a manufacturing company, before preparing trading account, there should be something called manufacturing account. Manufacturing account. There is a specific format for it. If they ask the question, you will have to follow this format, and before it will come before trading account. Trading account will come after manufacturing account. How will we prepare manufacturing account? Similar, it's an account, it's similar to ledger. Particulars, amount, particulars, and amount. Now, how will you calculate? In trading account, what was the format? We'll take opening stock, we will take closing stock, we'll take purchases and sales. Now here what we do is, and in trading account, what do we find out? We find out gross profit. Here we don't do that. What will we find out? We'll see. First we'll take opening stock. Opening stock of what? We'll take opening stock of work in progress. To opening work in progress. Opening work in progress. One more we'll take is to raw material, but raw material will show net figure on debit side itself. How? To raw material consumed. To raw material consumed will put. What is raw material consumed? It's nothing but opening stock of raw material plus purchases during the year. Whenever you are preparing manufacturing account in TB they say purchase. The purchase is not of finished goods. The purchase is of raw material minus closing stock. So this is the raw material consumed during the year. Clear? Next. To direct expenses. Whatever expenses that we have spent for the manufacture, that will record here. Then next to direct wages. Direct wages, and will record something called indirect expenses here. Indirect expenses relating to manufacture. It is relating to manufacture of goods. Like what? For example, a machinery is there. A machinery is used for production of goods only. For like exclusively for production of goods. It is used directly for production of goods, right? So depreciation will normally go to P&L, but if the machinery is used for production of goods, for manufacture of goods, then depreciation will come here under the indirect expenses. Depreciation or repairs to that machinery, or a machinery is hired, then hiring charges of that machinery. All this will come here. Okay, then on credit side what will come? By closing work in progress. Here we took opening work in progress. Here we'll take closing work in progress. Raw material closing stock we won't take. Why? Because here only we have adjusted raw material consumed we have taken. And the balance, if debit balance is excess, debit balance will be excess, right? Because there is no sales here. It's all like everything is what is consumed and what is spent. The balance will go where? The balance will go to trading account. Trading account. It is nothing but cost of production. It's called cost of production. This is what we pass to trading account. Cost of production. The balancing figure will be this. This will be balancing figure. One more thing can come on credit side. By sale of byproduct. Byproduct. When we use the raw material, in some cases, when the raw material is consumed, there will be some byproduct that will be created along with the main product. Like the main product will be there. There will be some byproduct that will be created. That will sell it. So to show that receipt, will enter the amount here. Because that is relating to raw material itself, the byproduct, like whatever byproduct, if it comes, then the sale of that byproduct is also shown on in manufacturing account itself. Clear? Now, what will change in trading account and P&L account? In trading account, what will come? Only opening stock of finished goods and closing stock of finished goods. Purchase of finished goods, if they've specifically given, it will come. Otherwise, purchase is always raw material, right? Cost of production will come there, right? Cost of production will come. Sales will come. Whatever is sales during the year, closing stock, gross profit will get. Clear? What else will be the difference? In balance sheet, when we are showing the inventory, we'll show all three: raw material closing stock of raw material, closing stock of work in progress, and closing stock of finished goods. Clear? Clear? So this is the manufacturing account format. We prepare manufacturing account. We prepare manufacturing account to find out what? Cost of production. Clear? We'll do one question of manufacturing account and we can close final accounts. Come to question number 17 in the study book. In ICA material also similar question will be there. So read the question. Mr. Vimal runs a factory which produces soaps. Following details were available in respect of his manufacturing activities for the year. What is required? They are asking for a manufacturing account of Mr. Vimal for the year end 31st March 2020. So we just have to prepare a manufacturing account. We'll follow the same format that we just discussed. It's a manufacturing account of Mr. Vimal for the year ending 31st March 2020. Right? Particulars. Now, first, opening work in progress will calculate. Okay. They have given units as well, right? Prepare one, we'll prepare one more column. If units is not given, you can directly write amount. If units is given, better put one column for units as well. You don't have to balance it. Still, just for calculation purpose, you can prepare one additional column. Units, amount, particulars, units, amount. Yeah. First, opening stock they have given 2. Opening work in progress. How much? 10,000 units. Amount is 16,000. So 10,000 units. Amount is 16,000. Closing work in progress is given on credit side. We can record that by closing work in progress. How much? 12,000 units. 20,000. 12,000 units. The amount is 20,000. What else? Opening inventory of raw materials they have given, closing inventory of raw materials they have given, and they have given purchases. So we can calculate to raw material consumed, right? To raw material consumed. What is opening stock? Opening inventory of raw material 1,70,000. 1,70,000. Purchases during the year is 8,20,000. Minus closing stock is 1,90,000. Clear? So 1,70,000 plus 8,20,000 minus 1,90,000. 8 lakh is the raw material consumed. Units are not given, so no need to write that. 8 lakhs. Clear? Next, higher charges of machinery they have given. What expense is it? Indirect expense. Indirect expense included in manufacturing account itself. How they have given? To indirect expense, they have told indirect higher purchase of machinery at 0.6 per unit manufactured. They have given how many units have been manufactured. They have given here. Units produced are 5 lakh units. So what is it? Higher purchase or higher charges of machinery. Higher charges of machinery 5 lakh units into 0.6 per unit. What will it be? 3 lakhs, right? 3 lakhs, right? Yes, 3 lakh. Next, higher charges of factory, they have given the amount directly. Indirect expense itself, factory charges 2,20,000. Yes. Next, they've told direct wages. Direct wages we have to calculate, we have to record separately. What is direct charges? 0.8 per unit manufactured and 0.4 per unit of closing work in progress. 0.8 per unit manufactured, so 5 lakh into 0.8 plus 0.4 per unit of closing work in progress. What is closing work in progress? 12,000 units. So 12,000 into 0.4. This is the direct wages. So 12,000 into 0.4 and 5 lakhs into 0.8. 4 lakh 4,800 to direct wages. 4 lakh 4,800. What else? Repairs and maintenance, again indirect expense 1,80,000 they have given. Repairs and maintenance 1,80,000. 4,04,800. That's all right. Anything else that we have to record? No, we can balance it. You no need to balance units. You just have to balance the amount. This 8 lakh, 3 lakh, 2,20,000, 3,000, 4 lakh 4,800. The total is 19,20,800 minus 20,000 is 19,800 should be going to trading account as cost of manufacturing. Yes, 19,20,000. Clear? Just remember the format and follow the same kind of posting. Clear? We are done with final accounts. Final accounts, 100% one question will come, at least of 10 marks, 10 to 15 marks. How they'll ask you question, I told you. They'll give you trial balance. They'll give you trial balance with the balances of assets, liabilities, expenses, income, capital. They'll give you few adjustments. Prepare working notes for adjustments. Whatever adjustments you have prepared, there will be two effects of each and every adjustments. Dual double entry bookkeeping system, right? So whatever adjustments you are doing, there should be two effects. Either both the effects will be in P&L only, or one effect will be in trading account and P&L, or trading account and balance sheet. There should be two effects for sure. So remember that all the adjustments should have two effects, and all the trial balance items should go at one place. They shouldn't be recorded at two places. Either it will go to P&L or balance sheet. Clear? That's all with final accounts. We'll start with NPO now. We'll start with not-for-profit organizations. Not-for-profit organizations. Not-for-profit organizations. Yes. So in final accounts, the previous chapter we discussed was final accounts for sole proprietorship. What is the financial statements we prepared? We prepared trading account, prepared P&L account, we prepared balance sheet. And in case of manufacturing companies, before trading account, we also prepared manufacturing account, right? Now they want so the next topic is we have to prepare financial statements of our not-for-profit organizations. What are not-for-profit organizations? In the previous one we prepared like the business motive is to earn profits, right? We find out gross profit, we find out net profit. The profit motive, so the motive of the business is to earn profits, like to make the sales, to incur less expenses, to maximize profit. Not for profit organization is the profit motive is not sorry, the motive of the business is not profit. What is it then? It's something like betterment of society. It's like charitable organizations, educational institutions, all these are not for profit organizations. So wherever the motive is not to make profit, motive not profits, those organizations are not for profit organizations. Example are charitable institutions, hospitals, clubs, sports clubs or clubs in general, clubs, educational institutions, etc. Institutions, etc. So how financial statements are prepared for these organizations is what is the chapter. So financial statements will be a bit different here. What will be the financial statements that will be prepared here? One is receipts and payments account. Receipts and payments account. One is income and expenditure account. And third is balance sheet. So balance sheet is same. What is receipts and payments and income and expenditure? Receipts and payments is nothing but similar to cash book. In cash book we would have recorded transaction wise. All that will summarize and prepare receipts and payments account, where on the debit side same way will summarize all the receipts. On credit side will summarize all the payments. Opening balance will be there, both cash and bank. Closing balance also, both cash and bank. Income and expenditure is similar to P&L. The difference will be that we won't be finding net profit or net loss. We'll be finding surplus. If the credit side is excess, means the income side is excess, then surplus, or if the debit side, the expenditure side is excess, that will be deficit. The balance will be surplus or deficit. Balance sheet remains the same. We'll calculate the assets and liabilities. The difference will be capital fund. It will be called capital fund. Clear? So one is, what is difference between receipts and payments and income and expenditure account? It is similar to cash book. It is similar to P&L. We already discussed. Here in receipts and payments account, all the receipts and payments irrespective of capital or revenue in nature. All the receipts and payments will come here. Only revenue expenses and receipts should be recorded, right? In receipts and payments, for whatever period, even the previous year receipts or previous year payments or next year receipts and next year payments are recorded. Like all receipts irrespective of which period the receipts or payments relates to, all the transactions are recorded. But here only current year receipts and only current year income and expenditure should be recorded. Clear? Same way, like it is like similar to P&L. So the same way it should be recorded, income and expenditure, and receipts and payments is similar to cash book. So all the receipts and payments, irrespective of whether capital or revenue in nature or whichever period it relates to, we should record it. Now let's go to the formats. Formats, I told you it will be the same. Receipts and payments account, receipts on debit side, receipts amount, and payments amount. Just that there will be some like new words that you will find in not-for-profit organizations. What are those words? Something called subscriptions to subscriptions. Subscriptions is the income in not-for-profit organizations that the members, like in maybe in club, members are subscribing to some membership or some service. So subscription are normally income. You will hear something called entrance fees. Entrance fees, even that is income, but that is capital in nature. Let us discuss that one by one. You will listen to something like donations, then membership fees. Membership fee is similar to subscription fee. Then what else will be there? The assets will be purchased, normal expenses. Payments will be what? Assets will be purchased, to assets, sorry, buy assets, by other expenses, by rent or other expenses, etc. You will have opening balance, to balance brought down, both cash and bank. Both cash and bank will be recorded, and by balance carried down, both cash and bank will be recorded. Clear? Similar to a ledger account, we should balance it. Income and expenditure account, similar to P&L. In expenditure on debit side, expenditure amount, income on credit side amount. So whatever is on the debit side in receipt and payments will come there, obviously, because it is income. So here, by subscriptions, by donations, right, by entrance fee, etc. Right? So here, two expenses. So whatever expense will be there, we'll record. If credit side is excess, we'll get surplus here. What is surplus? Surplus is excess of income over expenditure, and or else we'll get deficit. Deficit, excess of expenditure over income. Got it? Balance sheet will be same format. Balance sheet, on credit side you'll have liabilities and capital. On, sorry, not credit side, on the left side amount. On the right side you'll have assets amount. You will have assets, liabilities, the balance will be called capital fund, and for this you will add what? You will add surplus or deduct deficit, right? The balance will, you will record it as capital. Clear? Now all these new items whatever are there, let's see whether they are capital in nature or revenue in nature. Right? Treatment of certain items. So the formats are simple. It's similar to the other. So cash book you already know. The P&L we have already done. So the formats remain different. The treatment of certain items you should remember. First main one is subscriptions. I told you subscriptions is generally income, and subscription is normally for a period, like from this period to this period. So like subscription should be recorded in, so receipts and payments, all the subscription, all receipts will be recorded irrespective of which period it relates to. All receipts will be recorded. And in income and expenditure only current year related subscriptions to be recorded. Right? So here they will give you, for example, as on year end, there is, for example, there is outstanding subscription. Outstanding subscription. If they say there is outstanding subscription, what does it mean? It's an asset or liability, receivable or payable. Outstanding means it's outstanding for the current year. Correct? It's relating to the current year. At the year end, if it's outstanding for the current year, and it is income. If it was expense, it will be liability, but it is income, so it will be an asset. All right. If they said subscription received in advance, subscription received in advance at the year end. So at the year end, they tell that some subscription is received in advance. Which year is it related to? Next year. Correct? If it is received in advance at the year end in the means current year year end. Current year end, subscription received in advance means it is not relating to this year. It is relating to the coming years. So it will be relating to the next year. So it's not ours. Correct? So this outstanding subscription should be recorded in income and expenditure. So it should be added. But received in advance, it should be deducted. And it will be asset or liability. It will be a liability because this is not earned yet. This is not earned yet. So we'll record this on liabilities side. Similar to what we discussed outstanding. For example, they tell that in previous year year end, there were certain outstanding subscription. When they say previous year end it was outstanding, means it won't be relating to current year. It was relating to previous year itself. Correct? So you should always deduct it. So it means that whatever subscription we have received, it includes the outstanding subscription of previous year as well. So you will always deduct that. And previous year end, if they said subscription were received in advance, what will you do? Previous year end it was received in advance, means it will be relating to the current year. Correct? Previous year it was received in advance. It is relating to the current year. So you will add it. Clear? We'll take an example for this subscription. For example, they have given receipts and payments to you in the question. Receipts and payments they have given. They have shown 2 subscriptions. Means this is the total receipts. Correct? 2 subscription 1 lakh they have shown. Okay? 2 subscription 1 lakh. And they have given some data relating to assets and liabilities of previous year and current year. Let's say this is for 2020, and they have given assets and liabilities balances for 2019 and 2020. So they are telling 2019 and 2020, they are giving the details. They were giving that outstanding subscription or accrued subscription, both are same. Outstanding subscription for 2019 is 1000, 2020 is 2000, and subscription received in advance is 1500 in last year, 500 this year. Now they want you to calculate income and expenditure account. When you prepare income and expenditure account, you should record only current year income and expenditure. Subscription is the income. On credit side, you will record by subscriptions, right? By subscriptions you will receive. You will record, but what amount? What amount will you record? Now subscription received during the year is what? 1 lakh is received during the year. Correct? 1 lakh is received during the year. It's not relating to current year. To this you have to make adjustments. What adjustments will you make? Plus, I'll tell plus I'll tell closing outstanding. Closing means 2020 outstanding. So 2020 outstanding is relating to current year, right? When they are telling that 2020 it is outstanding, which means that it is relating to 2020. So I'll add that 2000. I'll add. Then 2020 they are telling that subscription received in advance is 500. So at the end of the year we are telling that subscription received in advance is 500, which means it will be related to next year. This will be relating to next year. So minus 2020 received in advance. Received in advance. How much is it? 500. I'll reduce. Then opening. Outstanding subscription 1000 is given. 2019 outstanding subscription is what? It's relating to current year or previous year? It is relating to previous year. Previous year only it was outstanding means what? It was relating to 2019. Now 1 lakh whatever we have received, it will include that 1000. Correct? So we'll reduce that. Minus 2019 outstanding. What is it? 1000 rupees. Clear? And subscription received in advance of 2019. So 2019 subscription received in advance were 1500. So it was not relating to 2019. It was received in advance. How much? 1500. What will be that? It is relating to current year. So that 1500 was received previous only. This 1 lakh doesn't include that 1500, but it is relating to the income of the current year. So we should add 2019 received in advance. 1500 you will add. So subscription which you will record in income and expenditure is 1 lakh. You will add 2000 minus 500 minus 1000 plus 1500. 1 lakh 2000 is what you should record in income and expenditure. Clear? Just think from a point of view of which year it relates to. Simple. Now they can ask something like, they'll give the same data that we have prepared here. Same data they'll give. They'll ask you to prepare subscription account. Subscription account. When they ask you to prepare subscription account, it's a simple ledger. Left side debit, right side credit. Now subscription account for 2020 you will be creating. When you're creating for 2020, you have to take opening balances. Opening balance is nothing but this 2019 whatever data is given is opening balance. Both the sides opening balance will come. To balance brought down, by balance brought down. One is outstanding and one is received in advance. Outstanding subscription for 2019 will be what? Asset or liability? It will be asset. It will be something which is receivable. So asset will come on debit side. So it will be outstanding subscriptions. This is how much? 1000. Correct? Correct. Outstanding subscription of previous year. Opening balance 1000. Subscription received in advance of previous year is liability. Correct? So on credit side, liability received in advance in previous year. How much? 1500. Correct? We have received something during the year. What will be the entry? Bank account debit to subscription account. So by bank account will be posting. How much have we received? It has come in receipts and payments account. No, 1 lakh. 1 lakh has been received by bank. You have closing balances. Two sides closing balance will come. To balance carried down and by balance carried down. Debit balance will come on credit side. Correct? Debit balance will come on credit side and credit balance will come on debit side. What is the asset here? The asset is outstanding subscription, receivable. It will come on which side? It's a debit balance. So it will come on credit side. How much? 2000. 2000. Simple ledger preparation. Now this is a liability. correct, received in advance. It has a credit balance, so it will come on debit side. How much? 500. So this will be outstanding subscription of current year, and this is received in advance of current year, right? Now the balancing figure, whatever we have the closing balances, so balancing figure what will come is has to go to income and expenditure account, to income and expenditure account. How much? Balance it 1,02,000, 1,03,500 minus 1,500, 1,02,000. Exactly what we prepared, 1,02,000. Yes, simple. So if they ask you to prepare subscription account, you can prepare it in this way. Just remember the accrual concept. Whatever is relating to current year should come in income and expenditure account. But whatever is received will come in receipts and payments account. Clear till here? So first thing is subscription account, and only relating to current year should go to income and expenditure account. Second is donations. Donations in general is a revenue receipt. Revenue receipt means what? In income and expenditure it will come on the income side. But if donation is received for any specific purpose, for example, for building, a donation is received specifically for building, then we'll create something called building fund and record it in balance sheet on liability side. Then it will become capital receipt. So in general, if they just give donations, revenue receipt, record it in income and expenditure account. Third, entrance fee. Entrance fee is in general a capital receipt. Capital receipt. It will be recorded on the liability side. Liability side. But if any other treatment is suggested in question, if any other treatment is suggested, or if they just give that entrance fee can also be called admission fee. If they give in question that the admission fee or entrance fee is just a nominal account charged to cover the expenses of admission process, then you will take it in income and expenditure. Otherwise, it always goes to balance sheet. It is generally, in general, a capital receipt. Fourth, legacy. Legacy is nothing but a bill. A person will write that, okay, in case of my death, all the funds will go to this charitable institutions. If that is received, it's always a capital receipt. It's always a capital receipt. Lifetime membership fee. The next item is lifetime membership fee. So in general, it is a capital receipt. It's recorded in balance sheet unless any other treatment is specified. Unless any other treatment is specified, it always goes to capital receipts. All right. Okay. What else is there? Let's see. I think that's it. It's a very simple chapter. You have to prepare financial statements. Now, how can they ask the questions? They'll normally give you, they'll give you receipts and payments account. They'll give you receipts and payments account and ask you to prepare income and expenditure account and balance sheet. They'll give receipts and payments account. They'll give some adjustments and they'll ask you to prepare income and expenditure account and balance sheet. Or they can also, what they can do is income and expenditure they'll give. They'll tell you what is surplus, what is the deficit. They'll ask you to prepare receipts and payments account and balance sheet. Clear? So in both the questions, they won't give the opening balance sheet. You will need the opening balance sheet to prepare because they won't be giving trial balance. You won't know what are the values of assets and liabilities. So they won't give you opening balance sheet, but they'll give you details of opening balances. So you have to prepare opening balance sheet as well. opening balance sheet in both the cases. You have to prepare opening balance sheet, tally it, then prepare income and expenditure and balance sheet. We'll do 1 or 2 questions in this and we'll be done with it. Very simple chapter. Come to question number 9 in the study book. Read the question. They're telling the Sport Writers Club give the following receipts and payments. So they have given the receipts and payments, right, of the for the year end 31st March 2020. Receipts and payments account. What have they given? 2 balance brought down and balances opening and closing balance. What balances are this? Cash and bank. This is nothing but cash and bank. Cash and bank. Remember this. Next, they have given subscriptions, income, miscellaneous income. You have to prepare. You have to record that as income in income and expenditure account. Interest on fixed deposit, revenue receipt, income and expenditure account. Look on the payment side. Salaries, expenditure, rent and electricity, revenue, expenditure. Library books, asset or expenditure? Asset. Library books as asset. Magazines and newspapers, revenue, expenditure. Less than 1 year. Library books, more than 1 year. Alright. Sundry expenses, income and expenditure account. Sports equipment, asset. Alright. They have given other details. Figures of other assets and liabilities are furnished below. So they have given as on 31st March 2019 and 31st March 2020. What have they given? Salaries outstanding, outstanding rent and electricity, outstanding for magazines and newspapers, fixed deposit with bank, what is the value, interest accrued thereon, subscription receivable, prepaid expenses, furniture, sports equipment and library books. They are telling the closing values of furniture and sports equipments are to be determined after charging depreciation at 10% and 20% per annum. So current year we have to charge depreciation as well, respectively inclusive of the additions if any during the year. The club's library books are revalued at the year end, at the end of every year. So they follow a revaluation model at the end of every year, and the value at the end of 31st March 2020 was 5250. So whatever difference is there, even that we should pass to income and expenditure. What do they want? Requirement is from the above information you are required to prepare the club's balance sheet as at 31st March 2019, opening balance sheet. The club's income and expenditure account for the year ended 31st March 2020. So current year income and expenditure account and the club's closing balance sheet. Alright, 3 requirements they have given. The club's balance sheet as at 31st March 2019 we can prepare. They have given all the balances, right? Opening balance sheet for 31st March 2019. Prepare liabilities and assets. Alright. Now we have the balances here, right? Record one by one. Salary outstanding, liability or asset? Liability, correct. Salary outstanding, how much? 710. Take the 2019 balances. Outstanding rent and electricity, again liability. Outstanding rent and electricity, 864. Next, outstanding for magazines and newspapers, again a liability. Outstanding for magazines and newspapers, how much? 226. Next, fixed deposit with bank. Fixed deposits is an asset. Fixed deposit with bank is 20,000. Interest accrued thereon. Interest accrued on FD means what? Asset or liability? It's an asset. It's receivable. Interest, how much? 500. What else? Subscription receivable, asset or liability? It's receivable, so asset. How much? 1263. Subscription receivable, 1263. Next, prepaid expenses, asset, how much? 417. Prepaid expenses, asset, 7. What else? Furniture 9600. Furniture 9600. Sports equipment 7200. Library books 5000. Any other balances to be recorded? There is one balance that still has to be recorded. That they won't give you separately. That is the balance bottom, the opening balance of cash and bank. That will be an asset last year, right? Cash and bank. How much? Opening balance 4820. So why you need to prepare opening balance sheet is to figure out the capital fund balancing figure. Capital fund. Take the balances and prepare the and find out what is the balancing figure. Is the balancing figure, right? Find out 9600, 7200, 5000, 20,000, 500, 1263, 417, 4820. 48,800 is the total. Minus 710 minus 864 minus 226. 47,000 is the capital fund as on previous year end. That we'll take as opening balance this year. So the point of preparing this opening balance sheet is to find out the capital fund, which is the balancing figure. In this question, they specifically ask for opening balance sheet. Even if they don't ask, you have to prepare the opening balance sheet to find out the capital fund opening balance. Clear? Clear? Next, we'll prepare the income and expenditure account. Sorry. Income and expenditure account for the current year. For the current year, let's find out all the expenditure on debit side, income on credit side, right? We'll go one by one. So first start with payment side of the receipts and expenditure. That will come as expenditure in income and expenditure account. So receipts and payments, go to the payment side. What is there? By salaries 12,000. So this is the salaries paid during the year. Now if you come in the assets and liabilities here, there is salary outstanding in 2019 as well, 2020 as well. So we have to find out what is the actual salary. So here to salary 12,000 as per receipts and payments account, 12,000, right? But we have to adjust salary outstanding. So salary outstanding as on 2020 is current year salary, correct? Current year salary you have to pay, you haven't paid, it is coming as liability, correct? So it is a liability, but it is relating to current year. So add 2020 outstanding. Outstanding, how much? 170 you will add. Last year 17, whatever was outstanding was related to previous year, but was outstanding. Now when we have paid 12,000, out of the 12,000, even that 710 rupees would have been paid, correct? So we should reduce that 2019 outstanding. We should reduce, how much is that? 710. So you will add 170 outstanding of current year, you will reduce outstanding of previous year. So 12,000 plus 170 minus 710, 11,460. Clear? 11,460. Next, to rent, by rent and electricity payment, we will record here to rent and electricity. Even that outstanding is there. We have outstanding rent and electricity. Similar adjustment. You have to add the outstanding of this year, reduce the outstanding of previous year. So we'll add 973, right? 2020 outstanding minus 2019 outstanding. What is the amount paid? 7,220. 7,220. 2020 outstanding is 973. 2019 outstanding is 864. Clear? So 7,220 plus 973 minus 864. 7,329. Clear? Next, on payment side, what is there? Library books, will it come in the income and expenditure account? No, because it is a asset. Magazines and newspapers, will come to magazines and newspapers. It's an expense only. Revenue expenditure. What is paid? Paid is 2172, but there is outstanding. Outstanding or prepaid? Outstanding. Magazines and newspapers. How much? Current year 340, previous year 226. Same adjustment. 2020 outstanding. 2019 outstanding. How much will you add? 340, 226. 340 you'll add. 226 you'll deduct. So 2172 plus 340 minus 226. 2286. Yes. Next, what is there on payment side? Sundry expenses 10,278. Is there any adjustment? There is, right? Prepaid expenses, right? So, to sundry expenses, how much is paid? Paid is 10,278. We have to adjust prepaid. Now think of prepaid. Prepaid is not similar to outstanding. Prepaid of current year is what? It's relating to the next year. We have paid in advance this year. It's relating to next year. So we should deduct. Prepaid of previous year is what? They have paid in the previous year itself, but it is relating to the current year. So we should add. So we should add 417 and deduct 610. So plus prepaid 2019 minus prepaid 2020. Clear? So 417 and 620. 417, 620. Here 10,278 plus 417 minus 620. 10,075. Next, what is there? Payment side. Nothing. Sports equipment is there, which is an asset. What else? What else? Interest we have to calculate. See the adjustment. Fixed deposit 10% with bank. Interest accrued thereon 500 is there. Now fixed deposit with bank is how much? How much should we calculate in P&L? Current year we can directly calculate, right? By FD interest. How much? We don't have to worry about the accrued. Why? Because current year expense will calculate directly. What is current year expense? Current year income. 10% of 20,000, which will be 2,000. Correct? How much is received? Received also is 2,000 only. Why? Because the accrued opening and closing are same. We don't have to worry about that. Income and expenditure, we can directly take 2,000. Next, miscellaneous income we have to record. By miscellaneous income. How much? 700. Subscriptions we have to buy subscription. How much? So subscription received is how much? 28,600. But there will be adjustments obviously. Look at the adjustment. Subscription receivable. Receivable is what? Asset. Correct? Asset of current year we should add, right? Because it's relating to current year. Receivable. So we should add current year outstanding. Receivable is nothing but outstanding. We should deduct previous year outstanding. So plus 2020 receivable minus 2019 receivable. What are the amounts? 1575 1263. 1575 1263 you will deduct. 28,600 plus 1575 minus 1263, 28,912. Clear? Subscription is done. Any other adjustment that we have missed here? Nothing. We have to calculate depreciation. Correct? How much will you calculate depreciation? Depreciation on what side? Expense side. To depreciation. There are 3-4 assets, right? What are those? One is furniture. Furniture. How much? They've given percentage here. 10%, 20% respectively. Furniture is 10%, sports and equipment 20%. 10% of 9,600 will be 960. Correct? And 20% of sports equipment. Sports equipment is 7,200. Plus there is purchase. Don't forget. 7,200 is opening balance. Plus purchase is there. So 7,200 plus 1,000. 8,200 into 20%. Clear? 1640. Sports equipment is 1,640. One more is library books. Library books, how will you calculate? There is opening balance. Opening balance is what? 5,000 is opening balance is given here. We purchase some books, correct? 1,000. So balance should be 6,000, but they told it is revalued to 5250. The balance will be 750. 750 will be calculated as depreciation. Clear? So 960 plus 1640 plus 750. 3,350 will be your depreciation. Anything else that we are missing here? No, right? All the adjustments are covered. Calculate the surplus or deficit. 11,460 plus 7 329 plus 2286 plus 075 3350 34,500. This side it is 28,912 plus 2,000 plus 700 31. So expense side it is excess. Expense side it is excess. So what will you get? You will get by deficit. In bracket you can write excess of expenditure over income. How much? 34,500 minus 31,622. 2,888. 2,000. Clear? So this is how income and expenditure should be prepared. It's looking too congested because I've done the adjustment here itself. You can do this way, or you can prepare a working note separately to find out what is the actual expense, and you can prepare that way. Clear? So we've got the deficit. They want one more thing. One more requirement is closing balance sheet. Closing balance sheet is also easy to prepare. We have all the assets and liabilities. Balance sheet 2020 31st March. Right? Prepare. What else? What all will come? You have opening capital fund. How much? Opening capital fund is how much? We calculated here 47,000. Correct? Capital fund is 47,000, and you have got deficit. If surplus, you'll add. If deficit minus deficit, how much? 2,888. So 47,000 minus 2,888 will be 44,112. Now record the assets and liabilities. On asset side, what is there? Furniture, how much? Furniture 9,600 minus depreciation is 960. 8,640. Sports equipment, you have opening balance 7,200. You made purchase of 1,000 minus depreciation was how much? Depreciation was 1640. 6,560. Library books, they have given the figure 5,250. Clear? What else is there? You can take all these balances, correct? Salary outstanding, rent outstanding, magazines and newspaper outstanding. All three balances you have 170, 973, 340. 170, 973, 340. All are liabilities, right? Payable. Next, you have FD on asset side, fixed deposit 20,000. On this, accrued interest is 500. What else? You have subscription receivable and prepaid expense, which is asset. Subscription receivable and prepaid expense, how much? 1575 and 620. One more asset that will normally forget is cash and bank. Where will you find that? In the question itself, in closing balance of on payment side. How much? 2450. 2,450. Check if it's tallying. 8,640, 6,560, 5,250, 20,500, 575, 620, 45,595. Done. This is a solution. This is how they'll ask question. They'll give you receipts and payments. They'll they'll ask you to prepare opening balance sheet, then the current year income and expenditure account, and then balance sheet at the year end. Clear? You can see the solution. They have done working notes. In working notes, they have prepared all those like expenses for the year. Outstanding, prepaid, all this they have adjusted here. Column wise they have prepared. You can see. You can prepare this way, or even if you are adjusting properly, just write a bit neatly in your answer paper. The examiner will accept it. All right. Yes, we'll stop with not-for-profit organization. We'll continue with partnership. Partnership accounts, important chapter. Will get at least 10 to 15 marks in your question paper. Yes, partnership. What is a partnership? Partnership is an association of two or more people, two or more persons who agree to take up a business and share profits. So they should share profits, and there should be an agreement, either oral or written. There should be an agreement. They should agree to conduct a business. One is business. Two or more persons agree to conduct a business and share profits among them. Clear? Minimum number of partners 2. Is it right? 2 or more. Maximum, as per the Partnership Act 1932, 50. Maximum partners are 50. Clear? Now this agreement can be, I said, oral or written. Oral or written. If it is written, it is called partnership deed. So they can get the partnership deed registered. All right, a written document where all the terms of the partnership are agreed. What will be the terms that will be agreed? One, what is the business related information, the place where the business will be conducted, the terms of partnership, what will be the profit sharing ratio, right? What will be the profit sharing ratio, the capitals will be invested, how much capital will be invested on that capital, whether any interest will be paid, interest on capital. Then there will be drawings, so interest on drawings. One more thing is salaries, whether any salaries will be paid to partnership, etc. All the terms will be discussed in partnership deed. What if partnership deed is not there? No partnership deed. If they tell there is no partnership deed registered, first we have to see is the profit sharing ratio can't be anything different other than equal. The profit sharing ratio should always be equal when there is no partnership deed. Next, there will be no interest on capital or drawing. No interest on capital or drawings, right? There is like, because there is no agreement between the partners, this is the terms that will apply in general. So no interest on capital on drawings, no salaries will be paid. Even if only one partner is working and one partner is silent partner, even then, like whatever the case may be, if there is no partnership deed, no salary will be paid. What else? The interest on loan, if any loan is provided by the partner, then interest on loan can be paid at a maximum rate of 6% per annum. 6% per annum. So you should be careful about this. If they say there is no partnership deed, you should remember that the profit sharing ratio should be equal. Then there should not be any interest on capital or drawing. There should not be any salary paid to the partners. And if there is any loan provided by the partner, then interest can be paid at 6% per annum max. Clear? Now this is regarding partnership deed. Now next you have something called LLP. So this is partnership firm, right? Partnership firm, what we discussed. There's something called LLP as well, which is limited liability partnership. What is the difference? Both are partnerships only. Both are called partnership firms only. One is, this is under the it is covered under the Indian Partnership Act. India Partnership Act 1932. It's covered under this, the partnership firm. And LLP, it's covered under LLP Act, Limited Liability Partnership Act 2008. All right. Then what are the other differences? This, the registration is optional. Registration is optional. We discussed, right? There can be a deed, there can be oral agreement as well. Even then, the partnership will prevail. In case of LLP, registration is mandatory. Mandatory with Ministry of Corporate Affairs. Like with ROC, they have to get registered. Next, it is created by agreement. Partnership, it's created by agreement. Both two people have to agree. This is created by law. This has to get registered. That's what we said, right? Next, here the partnership is minimum partners 2, max we said 50. In case of LLP, minimum is 2, but max there is no limit. Max there is no limit. What else? Here they are telling limited liability. Means what? The liability of the partners is limited to the amount they have gotten, amount that they have invested. It's limited. Here the liability is unlimited. Clear? Then in case of partnership, it like it can't own any property in its own name. It can't own any property in its own name. But in case of LLP, LLP can own a property in its own name. Alright. LLP will have perpetual existence. Partnership will not have. If all the partners die, the partnership will be dissolved, etc. So these are the differences. The accounting for both the LLP and partnership, there is no difference. The accounting remains the same. This is just one theory concept. Give a reading. All right. Next. Next. Okay. We'll start with capital maintenance. Capital maintenance methods. So in case of partnership, capital will be for more than one person, right? So in balance sheet, when you write capital, in balance sheet, when you write all the partners capitals, you should write A, B, for example. Both the partners will have a certain amount of capital, and their respective capitals, to their respective capitals we should add profits, etc. So that capital maintenance has two methods. One is fixed capital method, one is fluctuating capital method. What is fixed capital and fluctuating capital? In case of fixed capital, whatever initial amount is invested by the partner, that will remain fixed. The initial capital invested will remain fixed. Then whatever changes happens, for example, interest on capital is paid, or salary is paid, or profits or salary, or interest on drawings, or profit, all these things will be there, right? So all these things, even drawings, so all these things will be recorded in something called partners current account. Partners current account. So in case of fixed capital method, there will be two accounts that will be created. One is partners capital and one is partners current account. In case of fluctuating capital, no two accounts are prepared. Only one capital account is there, and that capital will be fluctuating. Clear? If question is silent, follow fluctuating capital method. If they have given specifically that these are the fixed capitals and this is the capital and this is the current account, then you have to follow the fluctuating capital method. Clear? Now there are few more concepts. Now interest on capital. Interest on capital. When we have to calculate interest on capital, you take effective capital into percentage, whatever rate has been agreed, into 1 divided by 12. Why 1 divided by 12? What is the effective capital? Let's discuss that. Effective capital is nothing but, now for example, the opening capital was 10 lakh as on 1st January 2020. The capital of a partner of A, let's say, is 10 lakhs. Now on 1st of March 2020, he bought in some more capital, 2 lakhs. Then for example, on 1st of June, he made drawings of some 5 lakhs out of this. Then that remained towards the end. Now if you see, from 1st January 2020 till 1st March, so for 2 months, what is the capital? 10 lakhs, correct? So for 2 months into 2 by 12, if you do, this is the effective capital for those 2 months. All right. Then next, if you see, from 1st March till 1st June, so March, April, May, 3 months, right? March, April, May. 3 months, what is the effective capital? 10 lakh plus 2 lakh. So 12 lakhs, correct? This is the additional capital. This is the drawings. So 10 lakh plus 2 lakhs, that is 12 lakh, was the effective capital for 3 months. So 3 by 12. Next, 5 lakh was the drawings. So from 12 lakhs, 5 lakh was the drawings. So for the remaining 7 months, from 1st June to 31st December, it was 7 lakh into 7 by 12, right? So this, all these three, if you add this, this and this will be your effective capital. Effective capital. All right. Effective capital. If you are doing by 12 here, you don't have to do this. Or if you are just multiplying into months here, if you are just multiplying into months here, then you have to do 1 by 12. All right. Next. This is interest on capital. This, if they are asking, they'll ask like a different question, or else also you can calculate, or you can calculate the interest here itself. Calculate the interest here itself. For example, they tell 12% is the interest. 12% is the interest on capital. If they tell, calculate here itself. So for 2 months it was 10 lakhs. So 10 lakhs into 12% into 2 by 12, right? Then for the next 3 months it was 12 lakhs. So 12 lakh into 12% into 3 by 12. And for the remaining months it was 7 lakhs. So 7 lakhs into 12% into 7 by 12. So all this, if you add, that will be your interest on capital. Clear? The formula is this. Effective capital means you have to multiply into months. Or if you are taking into month divided by 12, you don't have to do this. Clear? Next, interest on drawings. Interest on drawings. Now see this formula. Annual drawings into rate by 100, whatever rate is agreed, into factor by 12. Now what is this factor? Now if they say that the drawing is done monthly, every month at the beginning of the month, just focus here. Now if they say every month at the beginning, means what? First, let's say calendar year only, 1st of January 20, then 1st of December, 1st of February, then March, then April. So like this till the last will be 1st of December, correct? So every month he is taking out some money. For example, 5,000 per month, every month. So for 12 months. Now if we apply the logic, for this amount, this 5,000, we should charge interest for 12 months. Then next, for this 5,000, how many months? 11, 10, 9, 8, 7, etc. So for this, they have calculated a factor that take annual drawings. What will be annual drawings here? 5,000 every month. So 60,000. So 60,000 into rate whatever is agreed into factor. What is factor? If it is beginning of the month, it will be 6.5. If it is middle of the month, every month 15th. If it is every month 15th. So for this, how many months we should calculate for 15th Feb? 11.5 months. Correct. From January 15th till December 31st. 11.5 months. The next 10.5, 9.5, etc. So the factor will be 6. Or if it is end, then it will be 5.5. Clear? Or if they give quarterly, it is 7.5, 6, 4.5. Clear? Beginning of the quarter means what? 1st of January 20. All right. And the beginning of the quarter will be 1st of April, then April, May, June done, 1st of July, July, August, September, 1st of October. Clear? So in this way you will calculate. So these factors you can remember, or else you apply your logic and calculate the. Now for example, this same example, if you don't know the factor, you have to calculate. I told you, right? If it is, for example, every month on 1st it is being calculated. So for 1st of January, the interest should be calculated for 12 months. Then 1st of February, it should be for 11 months. Then 10, 9, 8, 7, like that it will go till 1. For 1st of December, whatever is withdrawn, 5,000, interest should be for 1 month, right? Only for December. So 12 to 1, for these many months you have to calculate. So you can add these up. So 12 plus 11 plus 10 plus 9, you will get a number. What will be the number? You can do n into n plus 1, right? N into n plus 1. 12 into 12 plus 1 divided by 2. So 12 into 13 will be 144 plus 12. 144 plus 12 will be 156 divided by 2, which will be 75, 78. So how you can calculate is take monthly drawing now, because we want for 78 months we have to calculate the interest. So take interest on drawing will be, how much is the monthly drawing? 5,000 into what is the rate of interest? Let's say it is 10%. Now you have to calculate for how many months? 78 months. So this is, we have taken monthly here, it's not annual. We don't know the factor, let's say. So we want for 78 months divided by 12. So 10% is for 12 months. We want for 78 months. Clear? So either remember the factors here or apply the logic. If it is quarterly also you can do. If it is quarterly, no, like focus here. For this, on 1st of January, whatever is withdrawn, for how many months you should calculate interest? How many months? 12 months. 1st of April, 9. Then 12, 9. Then there will be 6 months. And 1st of October will be 3 months. October, November, December. Add these up. Take the drawings. Calculate. Clear? So this is about interest on capital and interest on drawings. What did we discuss? One is capital maintenance method, interest on capital, and interest on drawings. Now an important topic, goodwill. So what is goodwill? Goodwill is nothing but what is the good name, what is the reputation of the firm. What is the reputation? Or it can also be called the ability to generate more than normal profits. More than normal profits with the good name. Alright, this is goodwill. It's an intangible asset, right? It's an asset for the company, but intangible asset. Right? So goodwill, self-generated goodwill cannot be recorded in books. You can't tell, okay, this is my goodwill, so I'll record it myself. So goodwill will come into picture only in case of like few things. When there is change in profit sharing ratio, or when will goodwill come? Then there is changing profit ratio. When there is admission of partner. Why we'll discuss. So 4 cases where goodwill will come in case of partnership. Third is retirement or death of partner. And sale or dissolution of partnership. Why does it come? If there is change in profit sharing ratio, why will it come? Or when there is admission, why will it come? So whenever there is a change in structure of the partnership, so for example, 2020, A and B started. A and B started the partnership, and they they ran the business successfully for 2020 till 2023. So for 3 years they successfully continued. Towards the end of 2023, they decided that okay, we two were partners till now, we'll admit one more partner, A plus B. Now they decided that C will come into the picture. Now whenever C comes into the picture, right, these 3 years they have ran the business from zero. They have got the business, they have grown the business. Now whatever goodwill will be, what is goodwill? Goodwill is the reputation that they've built, that now people won't think like more before going to them for the goods or services. So now they have the reputation, they have the goodwill. So now when C is getting admitted, they'll tell that for 3 years, whatever hard work we have done, we should be compensated for that. Correct? So for 3 years, we'll decide what is the goodwill. We'll calculate the goodwill. There are various methods that we'll discuss now. So we'll calculate the goodwill, and this goodwill will collect it from C. So because C is getting the share now, right? C is getting the share now in business. We'll tell that okay, we both were partners, A and B were partners for 3 years. We have built the goodwill. So now whatever goodwill is created, our share, you pay it to us. Clear? This is nothing but goodwill. How that will be done in each and every topic. So we'll be discussing all of them. Change in profit sharing ratio, admission, retirement and death. Sale and dissolution is in your CA inter. So that will be done there. So admission, retirement and death will be discussed here. Alright. Now there are, for valuation of goodwill, there are methods. There are methods to value goodwill. Mainly 4 methods. Focus. First, average profits method. Average profits method. The formula will be goodwill is equal to average profits into number of years of purchase. What is this number of years of purchase? This will be discussed in the this will be given in the question itself. Number of years of purchase. It will be just that okay, whatever we have calculated goodwill will be like, we'll take it for how many years. We'll decide for how many years that goodwill will remain. So that is nothing but number of years of purchase. This will be given in the question itself, number of years of purchase. Average profits we have to calculate. How will we calculate? So average means what? You have to consider average, right? For example, year 1, year 2, year 3. So past 3 years, they have given profits, let's say 20,000, 30,000, 20,000. What will be average? What will be average? You will calculate all 20,000 plus 30,000 plus 20,000, 40, 70,000. You will take average 70,000 divided by 3. Whatever figures comes is the average profit. You will do average profit into number of years of purchase. That is very simple. Now, this is simple average. Correct? This is simple average. Now, in few cases, we'll have to calculate weighted average. That is when there is a trend of profits. Alright, if there is trend in profits, there is like increasing profits, etc. Now here, what is the trend? 20, 30, 40. So there is a trend in profit. Then you will have to calculate something called weighted average profit. How will you calculate? So this is the profit. Year 1, 2, 3. We'll allot weights to it. Weighted average profit, right? Will allot weights. How will you allot weights? Whatever is the recent year. For example, this is 2020, 2021 and 2022. Whatever is the recent year should get higher weights. So 2022 will be, so 3 years, right? 3, 2021 will be 2 and 2020 will be 1. Alright. So allot the weights in this way. Take the product. You have to multiply profit into weights. So 20,000 into 1 is 20,000. 30,000 into 2 is 60,000. And 40,000 into 3 is 1,20,000. Now if you take total 80,000, 2 lakh, right? This is the product. This is the sum of product. You have to take sum of weights. 1 plus 2 plus 3, 6. So you will do average profit is equal to sum of products divided by sum of weights. It will be 2 lakhs by 6. So whatever figure you get, that you will have to calculate. So average profit can be simple average or weighted average. If it is weighted average, you have to allot weights in a way that the recent years will get higher weight and the last years will get lower weight. Clear? And in case of weighted, the formula will be sum of products by sum of weights. Simple average is simple. Total profit divided by sum of profit divided by number of years. Alright, clear with average profits method. Second is super profit method. What is the formula here? Formula is super profit into number of years of purchase. Even here the number of years of purchase will be given in the question itself. What is super profit? Super profit is actual profit. So what is the actual profit that you have calculated minus normal profit? Super profit formula is actual profit minus normal profit. What is actual profit? Actual profit is average profit. In the previous method, whatever we calculated, same way, if it is trend, take weighted average. If there is no trend, take average profit. So whatever past profits they have given, if they have given past profits, you calculate the average. If they have given actual profit directly, take actual profit. What is normal profit? Normal profit is capital employed into, so this is the formula, capital employed into normal rate of return. Normal rate of return they'll give in the question. Capital employed also they'll give in the question. You have to multiply the capital, what is the capital employed, into what is the normal rate of return. It will be industry standard. So once you calculate that, you will get normal profit. Actual profit you have to take averages. Now for example, here we'll do in the same example, they have given profits, right? Now let's change it a bit. Example, let's say the profits were 20,000, 30,000 and 10,000. No trend, so you will calculate average profit. Actual profit, for actual profit you have to calculate average profit, which will be this 60,000. 60,000 divided by 3, average profit is 20,000. All right, so actual profit you have got, correct? Actual profit you got. Now we have to calculate normal profit. Now for example, in the question they give that capital employed is 1 lakhs. Capital employed is 1 lakh and normal rate of return is 12%. Capital employed is 1 lakh, normal rate of return is 12 lakhs. So what will be normal profit? So actual profit we got at 20,000. Normal profit will be 1 lakh into 12%, which will be 12,000. What will be super profit? 20,000 minus 12,000. Actual profit minus normal profit, which will be 8,000. 8,000 is the super profit. Over and above normal profit, whatever you have earned is the super profit. This you will multiply by number of years of purchase. Let's say they gave in the question number of years of purchase is 3 years. So goodwill is equal to 8,000 into 3 years. So total goodwill will be 24,000. Clear? This is super profit method. Third, we have something called annuity method. Annuity method, we apply discounting. What will be the goodwill formula? Goodwill will be super profit into annuity factor. Annuity factor. What is annuity factor? They'll sometime given the question, but how to calculate it, we'll see. For example, they given the question 3 point something, then we can take it directly. But otherwise, how to calculate is annuity factor? In annuity method, you do nothing but discounting. Now, same example, if we take goodwill in the previous example, what did we do? We got super profit. We multiplied it by 3 years directly. Correct. This 3 years is the next 3 years. We are assuming that next 3 years this goodwill effect will have. So we are multiplying it by 3. Now, if we apply discounting, what is discounting? Discounting means that the rupee today is worth more than a rupee tomorrow. So after 1 year, whatever it is, so it's worth more now. So it will assume that, so discounting topic assumes that the value of a rupee is worth more today than after 1 year. So we will apply discounting. So we are assuming that it is for 3 years, right? So 3 years we are thinking that 8,000 goodwill effect will be there. So we are multiplying it by 3. Total 24,000 we are taking. So this is normally done in super profit method. If annuity method we are following, we have to discount it. Correct? How will you discount it? For example, in the question they gave discounting is done at 10%. You have to find out what is the discounting factor. How do you do discounting factor? Take your calculator and do 1 divided by 1 plus 10%. 10% is nothing but 0.1. Correct? So do 1 divided by 1.1. You will get the figure 0.909 something, I think. Then what will you do? This is for first year. You will take this factor. The next, it will be 1 divided by 1.1 2 times whole square. This you will get 826 something. Third year, you will do 1 divided by 1.1 whole cube. You will get some figure 0.729 etc. something. Now this 8,000 you have to multiply by this. You will get some figure. This 8,000 by this and this 8,000 by this. You will get the discounted figure. This will be goodwill. Clear? So the annuity factor that we said is nothing but the sum of all these factors. The sum of all these factors you can take multiplied by 8,000. Then you will get the answer. This is discounting. So in your calculating, what you should do is, if it is 10%, 1.1. If it is 12%, 1 divided by 1.12. Clear? So for second year, you have to do it twice. Is equal to you will get the figure. Third year something. Add all that. This is annuity factor. Annuity factor. Sometimes they'll give in the question itself. Sometimes you have to calculate it yourself. Multiply it by the number. You will get the goodwill. Clear? Fourth one is capitalization method. Capitalization method. The formula is goodwill is equal to normal capital employed minus actual capital. Actual capital employed. So we'll calculate the capital amounts and then we'll compare what is the normal and what is the actual. So how will you calculate normal capital employed? You will take average profit or actual profit. The same way you will calculate divided by NRR. What is NRR? Normal rate of return. So you will do average profit divided by NRR. You will get normal capital employed minus actual capital employed. They would have given in the question itself. This difference is goodwill. All right. Clear? This is normal capital employed is nothing but average actual profit, which can be average profit divided by normal rate of return. So the four methods are these. One is average profit method. So if trend is there, you have to calculate weighted average. If there is no trend, simple average. Then you have to multiply it by number of years of purchase. Super profit, calculate super profit. What is super profit? Actual profit minus normal profit. Normal profit is, actual profit is, you have to calculate average, and normal profit is capital employed into normal rate of return. Calculate the super profit multiplied by number of years of purchase. Annuity method, same super profit, but you have to apply annuity factor. What is annuity factor? Nothing but discounting. Next, capitalization method, normal capital employed minus actual capital employed. Normal capital employed is nothing but your actual profits you should calculate, average profits divided by normal rate of return. You will get normal capital minus actual capital, you will get the goodwill. Goodwill will be calculated in this four methods. Once goodwill is calculated, why did we say goodwill should come in what all cases? When there is change in profit sharing ratio, admission of partner, death or retirement of partner, and fourth is dissolution or sale of firm. Now, in those cases, what will happen? So, for example, A and B are partners. They had their profit sharing ratio, old ratio was, let's say, 2:1. They were sharing profits in the ratio 2:1. Now they decided that they'll change the ratio. After some 2 years, they decided, okay, now we'll change the ratio, and the new ratio will be 3:2. Okay, there is change in profit sharing ratio, correct? So we'll calculate goodwill, because previously the goodwill share was what, like A had 2/3 share, correct, and B had 1/3 share. In the new agreement, what is decided, that the share will be 3/5 and 2/5 whenever there is a change. So previously whatever was owned, someone will be losing some share, someone will be gaining some share. So in that ratio, goodwill should be compensated. How will we do that? Let's calculate, like, whether they are gaining or losing. So this is the old, this is the new. Now take the difference. In case of A, what is happening? His share was what? 2/3 old, minus now new share is 3/5. Is he gaining or losing? We'll see. So old minus new you are doing. Take 15, 10 minus 9. So 1/15. And B, 1/3 was his share earlier, now it is 2/5. So 15, 5 minus 6, minus 1/15. Who is gaining, who is losing here? You can't say, because -1 is there, he is losing. Now whenever you calculate old minus new, and you get a positive figure, whenever you calculate old minus new and you get a positive figure, which it means that it is sacrificing ratio. And whenever you do, you can do this new minus old, you will get positive figure. You are getting negative figure when you are doing old minus new. So this will be gaining ratio. So B is gaining, A is sacrificing. You don't even have to think so much. Just look at the ratios. A had how much? 2/3. Take it in percentages. How much? 66.66%, 67%. And B had 33%. Right? Now in the new ratio, calculate the percentages. 3/5. So 60%. Correct? And B, how much? 40%. So B is actually gaining, right? B is gaining and A is losing the share. Now goodwill, what will we do? So this 1/15th whatever is there, A is losing the share in that firm, right? Who should compensate that? B should compensate. What will be the value? Now let's say goodwill amount calculated is, let's say goodwill is 90,000. Goodwill we have calculated. Some method in the question they gave, we calculated that goodwill is 90,000. Now A is sacrificing some of his goodwill and B is gaining that goodwill. So B should give it to A. Clear? How much? It will be into 1 by 15. So goodwill, whenever they give, it will be goodwill of the firm. Right? Goodwill of the whole firm. Now A is losing 1/15 of his share. So 90,000 divided by 15 will be 6,000. Correct? So 6,000 should be given by B to A. Clear? B should compensate that to A. How will that be compensated? Normally when the question is silent, adjust the capital accounts. If they're telling that B will pay physical cash to A, we don't have to record anything in partnership accounts. But if adjustment has to be done in the books itself, then the capital account will be adjusted. What will be the entry? Capital is what account? What natured account? Credit natured account. So whosever capital is increasing will be credited. Whose capital is decreasing should be debited. Whose capital is increasing now? Now A should be compensated. So A's capital should be credited. So A's capital account. So to A's capital account, how much? 6,000. What should be debited? B should be reduced because B has to compensate to A, no? So B's capital account debit to A's capital account 6,000. Clear? So this is the way to calculate. This is in case of change in profit sharing ratio. Now the same logic will be applied in admission, retirement and death as well. Whenever, when for example admission is happening, a new person is coming in, right? When new person comes in, he'll get one share. So this one, whatever share he gets should be compensated by some of the other partner, right? Like for example here only A and B. Now they decided that they'll admit C. Now if C gets some share, that share should be given by A or B or both A and B. Correct. So who is gaining here? C will be gaining. And who will be losing? A and B will be losing. So depending on the circumstances, all you have to do is, what is the old ratio? What is the new ratio? In that, we'll get to know what is the sacrificing ratio, what is the gaining ratio. So in case of admission, the new partner will always have gaining ratio. Correct? He's coming in as a new partner. He's getting whatever share he's getting is his gain only, right? So he'll have gain, and the old partners will have sacrificing ratio. Correct? In case of retirement or death, there won't be any new partner. There will be retiring or deceased partner. So his share will be becoming 0. So he'll have always sacrificing ratio. Sacrificing part will be his and the old partners will be gaining. The old partners in the sense, it can be only one partner, it can be two partners. That will depend on ratios. For everything what you have to do is take old ratio, take new ratio, compare it, you will get the figure. Clear? So if you're confused, then sacrificing ratio, whenever you are calculating, you do it old minus new. So old minus new, if you are getting positive ratio, that is sacrificing ratio. And gaining ratio, whenever you are calculating, you do new minus old ratio. Here you will get positive. Clear? Clear? Don't think too much about it. If you are confused, just calculate the percentages. If it is 1/5, it is 20%. 1 divided by 5 into 100. Calculate the percentage, you will get to know whether it is sacrificing or gaining. But if you want to follow this method. Old minus new, if you are getting positive, it is sacrificing. New minus old, if you are getting positive, it is gain. Clear? So the entry will remain same. Alright, entry will be whoever's capital is increasing, that will be credited. Whose capital is decreasing should be debited. This is about the goodwill accounting. Now goodwill accounting is done. Next we'll move on to the Topic of admission of partner. Admission of partner. So whenever there is admission of partner, one is goodwill adjustment. Correct? That is for sure. Goodwill adjustment you have to do. How will you do it? The same logic you have to use. We'll take an example. A and B are partners. C is admitted. A and B had the profit sharing ratio of 1:2. All right. Here they had what was the old ratio? 1:2. C didn't have any share, so 1/3 and 2/3 was the old ratio. New ratio they decided it will be 1:1:1. Let's say 1:1:1. So 1/3, 1/3, and 1/3. Correct. Now you have to calculate who is gaining, who is losing. Right. Now if you calculate who is gaining, we are getting to know directly, right? Gaining, who is gaining? C is gaining how much? 1/3. Who is losing? A is not losing anything. Correct? His share was 1/3 in the partnership firm. Even now it is 1/3. But B's was, it was 2/3. Now it is becoming 1/3. So B's sacrificing ratio will be 2/3 minus 1/3, which will be 1/3. Now if they say goodwill of the firm is 60,000. Now what should be done? Now C should compensate that, right? C should compensate that. How much? 1/3 C should compensate. So goodwill of the firm is 60,000. C's share of goodwill will be 60,000 into 1/3, which will be 20,000. This 20,000 should be given to whom? Should be given to B. Correct? Because B is giving that share to C. What will be the entry? If in the question they tell that C is getting the goodwill in cash. If they tell specifically that C is getting the goodwill in cash, then cash is coming in. So bank account debit to what capital? To B's capital, because this has to go to B, right? This is goodwill, B's capital account. In narration you can write goodwill brought in by C passed to B's capital account. If they tell that if the question is silent, or they tell that it will be adjusted with the capital accounts, how will you adjust the capital accounts? You will reduce the C's capital account. Correct? You will reduce the C's capital account. You will increase the B's capital account. How much? 20,000. Right? Same logic you have to use as what we did in change in profit sharing ratio. Calculate old minus new you do. See who is sacrificing the share, who is gaining the share. Whoever is gaining the share should compensate for the goodwill. Whoever is sacrificing the share should receive the goodwill. So first, whenever there is admission of partner, first thing you have to take care of is goodwill. Second one is something called revaluation account. Revaluation or P&L adjustment account. Revaluation account or P&L adjustment. What is it? The same example, A and B and C were there, right? So A and B were the old partners. They continued the business for these many years. Now whenever the admission is happening, on the date of admission, they'll revalue all the assets and liabilities. And whatever gain, revalue means what is the value of the asset and liability as of today, right? Whenever they revalue, they'll get some gain or loss. Revaluation gain or loss they give. Whatever gain or loss they get, it will belong to whom? It will belong to them only. Who are they? Old partners. The revaluation gain or loss, whatever they get, belongs to the old partners, because these many years they managed. If the asset value, if they purchased the land before 2 years, now it has gone up, let's say it gone up by 1 lakh, that 1 lakh gain belongs to A and B only. So whatever gain will be done, whatever assets will be revalued and gain will come, that gain should go to the old partners. Correct? So that is the concept. How will you prepare revaluation account? So revaluation account, it's a ledger. Correct? Particulars, amounts. How will you calculate? Now, for example, there are assets and liabilities. There can be increase in assets, decrease in assets, or increase in liabilities, decrease in liabilities. For example, there is increase in assets. How will you record? If there is increase in assets, asset is a debit nature account. So asset account debit to revaluation account. Clear? What will be posting? Buy assets account. Buy assets account in case of increase in assets value. Correct? Buy assets account. If there is decrease in assets account, what will be the entry? Revaluation account debit to assets account. Revaluation account should be debited. So to assets account. In case of decrease. What about liabilities? What about liabilities? If there is increase in liabilities, you should credit the liabilities. So revaluation account debit to liabilities. So posting will be to liabilities account in case of increase, and the opposite by liabilities account in case of decrease. In case of decrease. So they'll give you in the question what was the old value, what is the new value, like how much you have to revalue. Once you put all these figures, whatever increase, decrease in assets and liabilities, after you do that, you will get a gain or loss. Gain, how will you get? If credit side is excess, you will get gain. If credit side is excess, the total is excess compared to debit side, you will get a gain. So to what? The gain belongs to whom? Partners capital. Partners, right? Which partners? Old partners. To old partners capital account. To partners capital account, whoever are the old partners, you should write. For example, A and B are old partners. How much will go to them? In the profit sharing ratio. Which profit sharing ratio? Old profit sharing ratio. Correct? Because these many years old profit sharing ratio was there. So whatever gain or loss is accumulated over the past years will be given to them in the old profit sharing ratio itself. Clear? So this will be gain if credit side is excess. If debit side is excess, it will be loss. So by partners capital account, you will have old partners, you will allocate in old profit sharing ratio. This is in case of revaluation loss. Clear? Revaluation account is nothing but there will be increase in assets or liabilities as on the date of admission. You have to revalue all the assets. After revaluation is done, you will get gain or loss. That gain or loss should go to old partners only. Old partners in old profit sharing ratio. So you will transfer that to partners capital account. Next. Now in revaluation account, there is one more concept called memorandum revaluation account. Memorandum revaluation account. We'll do this when we do the questions, the revaluation account. Now, revaluation account you understood, right? Whatever change in assets and liabilities will be there, you have to revalue it, and the gain or loss should be transferred to the partners, old partners in the old profit sharing ratio. Now, whenever they do the revaluation, assets amount is increased, liabilities amount is decreased here, liabilities amount is increased, and assets amount decreased. So the amount of assets and liabilities have changed. So even in the balance sheet, new amounts will come, revalued amounts. So sometimes what they'll tell is they don't want to change the value of assets. Like they tell that there should not be any change in value of assets or liabilities. That's when memorandum revaluation account is prepared. What will be the steps in like in this method? So first you will prepare. So the first step will be prepare revaluation account. Revaluation account in the same way you prepare. What will you do? You will increase the assets, you will increase the liabilities, you will decrease the assets, decrease the liabilities, gain or loss, you will transfer. Right? Done. You will do the revaluation. After that, what they want to do is reverse all the entries. Reverse. What are the entries? Now here, what was the entry passed for this? For this assets account debit to revaluation. They are telling it reverse it. Reverse it how? Revaluation to assets. But this time you won't use revaluation, you will use memorandum revaluation account. So reverse the effect on reverse the effect, whatever increase or decrease, effect is increase or decrease on assets and liabilities using memorandum revaluation account. Memorandum revaluation account. Clear? So whatever increase was done, now decrease it. So the assets value will go back to its normal figures, but you will have a balance of memorandum revaluation. Correct? So this memorandum revaluation, you will transfer it to all the partners. All the partner means even including new partners. So the third step will be memorandum revaluation account to be closed. So if it had a debit balance, close it by using credit balance and pass it to partners capital, all the partners, to be closed using capital accounts of all the partners. All the partners is including new partner. Correct? Including new partner. In what ratio? In new ratio. In new profit sharing ratio. Clear? So this is the steps to prepare memorandum revaluation account. Normally they'll ask you to prepare revaluation account only. Prepare revaluation account. Whatever effects you want to give the effects and pass the gain, and assets will be valued at the revalued amount in the balance sheet. If they tell specifically memorandum revaluation account, then you have to follow this process. Clear? So this is memorandum revaluation account. All right. So first adjustment we said is goodwill. Second one is revaluation. Third one is whatever reserves are there. Reserves. What is reserves? Reserves is an appropriation of profit. So whatever reserves are there in your uh, balance sheet, when they give you balance sheet, the old balance sheet, they will give you A and B had these reserves. After capital, they'll have reserves. So whatever reserves are there, pass it to partners capital account. Which partners? Old partners. So transfer all the reserves, close the reserves, transfer the reserves to old partners. Old partners in what ratio? In old profit sharing ratio. Clear? Because those reserves belong to them. Now if the new partner is admitted, he doesn't owe any share in that, right? So close those reserves and transfer the reserves to old partners. What will be the entry? Reserves will have a credit balance. It will be on the liabilities side below the capital. So to close it, reserves account debit to partners capital account. Capital account will increase, right? To partners capital account. Which partners? Old partners in old profit sharing ratio. Clear? So what all you have to be careful about? One is goodwill, one is revaluation, and third is reserves. All right, we'll do one question in admission. Question number 22. Question number 22 in the study book. Read the question. Is it Dalal, Banerjee and Malik are partners in a firm sharing profits in the ratio 2:2:1? Their balance sheet as on 31st March 2020 as below. They have given the old balance sheet. The old ratio is given here 2:2:1. Now liabilities and assets they have given. Next, read the adjustments. The partners have agreed to take Mr. Mistry as a partner. So this is the new admission of partner. Correct? Admission of partner. New partner is Mr. Mistry as a partner with effect from 1st April 2020 on the following terms. What are the terms? Mr. Mistry shall bring 5,000 towards his capital. Okay. The value of inventory should be increased by 2,500 and furniture should be depreciated by 10%. Reserve for bad and doubtful debts should be provided at 10% of trade receivables. Okay. The value of land and building should be enhanced, means increased by 20%. Then next they are telling the value of goodwill of the firm. So whenever there's a value of goodwill, it is for the firm is 15,000. You don't have to calculate goodwill, they have given you directly. General reserve will be transferred to the partner's capital account. Even if they don't give this specifically, whatever general reserve is there, we have to close it to the old partners. Next, the new profit sharing ratio shall be Dalal 5 by 15, Banerjee 5 by 15, Malik 3 by 15 and Mistry 2 by 15. So Mistry is getting 2 by 15 share. The outstanding liabilities include 1000 due to Mr. Sen which has been paid by Mr. Dalal. Necessary entries were not made in the books. Okay. The outstanding liabilities include 1000 due to Mr. Sen which has been paid by Mr. Dalal. We have to adjust this entry. The next necessary entries were not made in the books. Prepare revaluation account, partners capital account and balance sheet of the firm after admission. Yes, let's start with the solution. First, we'll calculate the change in profit sharing ratio first. So working note 1, change in profit sharing ratio. Now calculate partners old ratio, new ratio and difference. Now who are the partners? Dalal, Banerjee, Malik. Dalal, Banerjee, Malik. New partner is Mistry. What is the old ratio? 2 is to 2 is to 1. 2 by 5. 2 by 5. 1 by 5. Mistry doesn't have any share in old profit sharing ratio. What is the new ratio? 5 is to 5 is to 3 is to 2. Right? 5 by 15. 5 by 15. 3 by 15. 2 by 15. Now you have to calculate the difference and decide whether it is gaining or sacrificing. Mistry is clear. 2 by 15 he is gaining. Correct. This is not a doubt. He is gaining 2 by 15. His gaining ratio. What is Dalal? 2 by 5 minus 5 by 15. 15 if you do, then 3 6 minus 5. Correct. 1 by 15. So this is sacrificing. Correct. Sacrificing ratio. In case of Banerjee, will you calculate? Same. 2 by 5 minus 5 by 15. It will be 1 by 15. This will be sacrifice. Right. Next, you can calculate in percentage as well. They had 2 by 5 means 40%. Now he is getting 5 by 15 which is 1/3, 33%. So they are losing some share which is 1 by 15. In case of Malik, it was 1 by 5. Now 3 by 15. 3 by 15 is nothing but 1 by 5. Correct. So nil. No gain. No gain, no loss. Right. So who's sacrificing? Dalal and Banerjee in the ratio 1 is to 1. Now goodwill you calculate here itself. Now goodwill of the firm is 15,000 they have given in the question, right? Right? Goodwill of the firm to be fixed at 15,000. Now if goodwill is 15,000, who is gaining? Mistry is gaining. So Mistry has to compensate. So Mistry's share will be how much? Mistry's share will be how much? 15,000 into 2 by 15, which will be 2,000. Right? This 2,000 should be compensated to whom? To Dalal and Malik in the sacrificing ratio. Correct? What is sacrificing ratio? 1 is to 1. 1/2 to Dalal and 1/2 to Banerjee. So this should be given to Dalal and Banerjee. What will be journal entry? What will be the journal entry? Who has to get it? Mistri's capital account. Debit. His capital is decreasing because he has to compensate that to whom? Dalal's capital account. Dalal's capital account and Banerjee's capital account. So 2000 he has to pay, 1000 each to Dalal and Banerjee. Clear? So this is the first working note, which is change in profit sharing ratio and goodwill accounting. Clear with this? So that is done. Now let's start with the solution. What do they want first? They want revaluation. Revaluation account. For revaluation, see what all have they given. First point, this is shall bring 5,000 towards his capital. That will come in capital account. What will be the entry? Amount is coming in. So bank account debit to Mistri's capital account. Correct? So this will come in capital account. Next, the value of inventory should be increased by 2,500 and furniture should be depreciated by 10%. This is changed. Correct? So what will you do? The value of inventory should be increased by 2,500. What will be the entry? Increased. Correct? So inventory account debit to revaluation account. Posting will be buy inventory. Right? You can see the solution here. Buy inventory 2,500. Next they are telling furniture should be depreciated by 10%. What is the furniture value? 6,500 into 10%. 650 depreciate. So asset value should decrease. So revaluation account debit to asset account. Posting will be to asset, which will be to furniture account. To furniture account they put 650. Next, see what is happening. Reserve for bad and doubtful debts should be provided at 10%. Correct? 10% of the trade receivables. How will you create the reserve? Normally, what is the provision for bad debts entry? Provision for bad debts is a liability. So P&L account debit to provision for bad debts. But here you have to pass it to revaluation account. So revaluation account debit to provision for bad debts. How much? 10% of trade receivables. So 5,500 into 10%, 550. So to provision for bad and doubtful debts, 550. This is increase in liability. Correct? Increase in liability. This is done. Next, the value of land and building should be enhanced by 20%. Enhanced means increase. So enhanced by 20%. What is land and building value? 25,000. 20% will be 5,000. Correct? What will be the entry? Land account debit, because we have to increase land and building account debit to revaluation. Posting will be buy land and building account. Correct? 5,000. Anything else that they have given? No. Regarding assets and liabilities, they have given those 3 points. Now whatever is gain, so here 7,500, here is only 1,200. Correct? 7,500 minus 1,200, 6,300 should be transferred to old partners. In what ratio? Old ratio, which is 2:2:1. That's what they have done, right? 2:2:1. They have transferred 6,300 to revaluation account. Clear? Easy. Second requirement, what is it? Capital accounts. Now capital accounts, because these 4 partners, you can write the capital account separately as well. For example, Dalal's capital account 1 ledger, Banerjee's capital account 1 ledger. You can prepare it like that as well, not a problem. But if you can manage space, then 3 partners, it's normally fine. If 4 partners, you are not able to manage the space, prepare it separately, it's not a problem. Otherwise, prepare it together in this way. Now check the entries first. First, partners capital account. What will you start with? We'll start with opening balances. What are the opening balances? These 12,000, 12,000, 5,000. On which side? Credit side, capital, right? So buy balance, bought down 12,000, 12,000, 5,000. It's given in your balance sheet as well. Now start your admission process. What's happening first? Now go one by one. Mistry shall bring 5,000 towards his capital. What will be the entry? Bank account debit to Mistry account. What will be posting? By bank. Correct? By bank. By cash they have assumed. How much? 5,000 in Mistry's column. Clear? Next. What is happening? We revalued certain figures. Correct? We revalued and passed it to capital accounts. What was the entry here? Revaluation account debit to capital accounts. So in capital account, what will be the posting? By revaluation account. Here it's on debit side, there it will be on credit side. By revaluation account, right? By revaluation account, how much? 2,520. In what ratio? Old ratio. 2,520, 2,520, 1,260. This is old ratio. Next, see what is happening. So this is revalued, this is done, this is done, this is done. Next, the value of goodwill should be fixed at 15,000. We passed the entry for goodwill, right? What was the entry? Mistry's capital account debit 2,000 to Dalal's capital account to Banerjee's capital account. So Mistry's capital account should be debited. Should be debited with these two accounts. Correct? See what I've done? To Dalal 1,000 to Banerjee 1,000. And Dalal's and Banerjee's account should be credited. So even this should come in capital account itself, credited with Mistry's capital account. So credited by Mistry 1,000 and 1,000. This is goodwill. This is goodwill. We pass the entry of that in sacrificing ratio, right? Next, see what is happening here. General reserve should be transferred, they told. What is general reserve? 6,500. In what ratio will it go? Old ratio, 2:2:1. Correct? Check this. By general reserve, 2:2:1. They have done. What else have they given? The outstanding liabilities include 1,000 due to Mr. Sen. Who's Mr. Sen? Maybe some creditor, right? The outstanding liabilities include 1,000 due to Mr. Sen, which has been paid by whom? Mr. Dalal. If it is paid by Mr. Dalal, his capital account should increase. He has paid from his own pocket. When he has paid from his own pocket, it's like he has got the money into the business, right? Right? His capital account should increase. So what will be the entry? There is outstanding liabilities is there. Correct? His outstanding liabilities out of 1,500, 1,000 is paid by Mr. Dalal. So entry will be reduce the liability, which will be outstanding liability account debit. Correct? We are reducing the liability and increasing Dalal's capital account. Because it's like he invested that amount, because from his own pocket he has paid 1,000. In partner's capital account, Dalal's capital account should be credited using outstanding liabilities. Check this. By outstanding liabilities, 1,000 rupees. Clear? So now balance all the ledgers. You will get the closing balance of partner's capital. Clear? Next, balance sheet is easy. So whatever revalued figures are there, we'll continue at revalued figures. We are not preparing memorandum revaluation account here. They didn't tell anything. So land and building was enhanced by 20%. Furniture depreciated by 10%. Inventory increased by how much? 2,500 inventory. Trade receivables 5,500, but provision we created 5,500. You have to disclose the same way as we discussed in final accounts. Cash in hand and cash at bank are they remaining same? No, because cash in hand was 140, cash at bank was 960, but they got 5,000, right? The 5,000, assume that it is cash, so that will increase. They put it bank here, so the mistake here you can correct here, correct it here itself. By bank, you can assume always bank. So bank balance they have increased by 5,000, 960 it was, plus 5,000. 5,000 was bought by whom? By Mistry, new partner. Credit side trade payables remain the same. Outstanding liabilities, it was 1,500, correct? Minus 1,000 Dalal paid, so 500. The partner's capital will take directly from partner's capital account. Clear? We'll record that. The balance sheet will tally. Clear? Easy. Always remember 3 adjustment. One is goodwill. For calculate goodwill, you have to find out sacrificing ratio and gaining ratio. Correct? First, goodwill. Second, revaluation account. Third, reserves. So this you should always remember these 3 points. In addition to this, if any adjustments are given in the question, you should do that as well. Clear? Now let's get back. Next topic will be retirement of the partner. So we discussed admission. Let's discuss retirement. Same points you have to remember. One, goodwill. Goodwill, what will you do now? Whoever is retiring is sacrificing rate. Whoever is retiring, his share is becoming 0. So retiring partner will have what? Sacrificing ratio, and the and the remaining partners, whoever will remain in the firm, will have gaining. Correct? So we have to calculate who is gaining and who is sacrificing, and then we have to pass the goodwill. Whoever is sacrificing should be compensated, his capital account will increase. Whoever is gaining, his capital account will decrease, because he has to pay that, right? He has to pay that to the ones who are sacrificing. Second, revaluation. Revaluation of assets and liabilities should also be done, but this revaluation gain or loss will go to all partners, right? All partners, because here it's not admission, it's retirement. So all the existing partners who were there, to all those partners, that revaluation gain or loss will go in the old ratio. Correct? Third is reserves. Same thing, the reserves should be passed to all the partners in old ratio. Clear? What else will be there? So goodwill you will give, revaluation you will give, reserves you will give. So after doing all this, whatever is the capital balance in capital account, after passing all these, capital balance of retiring partner will be there. Correct? So this capital balance of retiring partner should be settled, should be paid by the firm. Should be paid by whom? Firm. Correct? This is the steps in these are the steps in retirement of partner. The calculation of goodwill will remain same, revaluation will prepare in the same way, will pass the reserves also, just that here there is no admission. So here whatever capital balance of the retiring partner will be there, that should be paid by the firm. Clear? Now we have a concept here called joint life policy. Joint life policy. So we discuss it, if it is personal life insurance policy of the partner, that will be considered as drawings. Joint life policy is taken by all the partners. Taken by all the partners. All the partners. One premium will be paid every year. One premium every year will be paid. This is a single policy, joint life policy. So single policy, premium amount will be paid every year, and in case of death of any partner, the maturity amount or policy value will be received from insurance company. Correct? Insurance company. Now for example, A, B and C are there. C died, they received the policy amount. What will happen in that case? The whatever policy amount is received will belong to all the partners. It's joint life policy, right? It will belong to all partners. This is in case of death, they'll receive maturity amount. In case of retirement, In case of retirement, it's a joint life policy, right? Correct. When one person goes out, the joint life policy won't last after that. So in case of retirement, they'll get something called surrender value. So surrender value is something they would have decided in advance that in case we stop the policy, we'll get the surrender value. So whatever surrender value they receive also goes to all the partners in the old profit sharing ratio. So whenever they give retirement and they sell joint life policy, they are getting this much surrender value. We have to pass it to all the partners. Clear? Now, what is the accounting treatment for this joint life policy? There are three accounting methods. First is premium expense method. How will you account for it is what we are discussing. In expense method, what will you do? Whenever you are making the premium, you are paying the premium every year, right? What will be the entry? What will be the entry? Bank account, premium account debit to joint life policy premium account debit to bank account, right? This will be passed to P&L. So P&L account debit to premium, the joint life policy premium account. So it will be recorded as expense. And when maturity amount or surrender value is received, whenever this policy amount or surrender value is received, then it will be bank account debit to partners capital account. Which partners? All the partners capital account in profit sharing, old profit sharing ratio. This is expense method. Second one is asset method. What is asset method? It means whatever premium is paid, it will be recorded as an asset. How will it be recorded? Joint life policy account debit to bank. So whenever premium is paid, it will be paid joint life policy account debit to bank. But at the year end, the joint life policy asset can be maintained only up to a level of surrender value. Now, for example, the joint life policy premium paid is 1000, and it is given that at year end, at the end of first year 1, the surrender value is only 500. In that case, we have recorded as an asset of 1000, but the surrender value is 500 only. Then we'll reverse the asset to the extent it is not covered by surrender value. Then what will you do? P&L account debit. So whatever is not received, which is 500, can't be received, to joint life policy account. 500. Clear? Asset method, they tell that the asset can be maintained only to the extent of surrender value. Over and above that, we should pass it to P&L as an expense. This is the asset method. Third is reserve method. JLP reserve method. Joint life policy reserve method. Here what will you do? Here you will record the asset in the same way. You will record the asset in the same way. Asset in same way as above. So to the extent of surrender value, you will record the asset. Also, you will create a reserve of the same amount. Create JLP reserve of the same amount. Using capital accounts, but you will pass P&L appropriation account. What is P&L appropriation account? We'll discuss in the end. P&L appropriation account. Okay, P&L appropriation is a small concept. We didn't discuss that. P&L appropriation means that you will record P&L rate. So in P&L, what is the result you will get? You will get net profit or net loss, right? So this net profit or net loss in P&L, what all expenses you will record? All the indirect expense and indirect incomes of the business. Now whatever are the expense relating to partners won't come in P&L. So after you get net profit, for example, you get net profit, you will get the balance here by net profit account. My net profit, whatever amount, right? Once you get the amount here, then you will record the expenses and incomes relating to partners. What are those? Interest on capital, expense for the firm, right? Then what else? Salary to partners, interest on drawings, right? All these expenses and income will be recorded in P&L appropriation. The balance, whatever will be there, will be passed to partners capital account. Clear? So P&L appropriation. So here you will create the JLP reserve using P&L appropriation account. How will you do that? Reserve is a like similar to liability, right? So you have to credit it to JLP reserve, and debit you will do P&L appropriation account. Clear? Clear. So you will record the asset as well as the reserve in the books. So these are the three methods that can be followed. One thing that you have to remember is, in case of retirement, they'll receive only surrender value, which should be transferred to all the partners. So this is it about the retirement. Let's do one question relating to retirement. Question number 46 in the study book. Let's read the question. Mr. X is a partnership firm with partners A, B, and C sharing profits and losses in the ratio of 3:2:5. The balance sheet of the firm as on 30th June was as under. The balance sheet is this. So A's capital account, B's capital account, C's capital account, loan. There is a overdraft, trade payables. On asset side, land, building, plant and machinery, investments, inventory, trade receivables. They're telling it is mutually agreed that B will retire from partnership. Okay, B will retire and in his place D will be admitted. So there is both retirement and admission as a partner with effect from 1st July 2020. For this purpose, the following adjustments are to be made. First, goodwill of the firm is to valued at 2 lakh rupees. Goodwill of the firm to be valued at 2 lakh rupees due to the firm's locational advantage, but the same will not appear in the assets as the books. Means it will be adjusted to partner's capital account. Okay, of the reconstituted firm. Next, building and plant and machinery are to be valued at 90% and 85% of the respective balance sheet. Means there is decrease in the value of balance sheet buildings and plant and machinery. Investments are to be taken over by retiring partners at 25,000. So investment is going to be taken over by retiring partner. What is the investment value? 22,000, but it is taken over by 25,000. Means there is increase in the value of the asset. We have to record that as well in revaluation account. Next, trade receivables are considered good only up to 90% of the balance sheet figure. Balance will be considered bad. Bad debts should be recorded in revaluation account. So means debtors should be reduced. Next, in the reconstituted firm, the total capital will be 3 lakhs. They have given how much capital should be, which will be contributed by A, C and D. Now D is admitted. In the new profit sharing ratio, 3:4:3. They have given old profit sharing ratio. They have given new profit sharing ratio. The amount due to retiring partner shall be transferred to his loan account. So whatever is payable to the retiring partner is transferred to his loan account, which will be paid later. If they don't tell anything, it will be bank. Now, first thing, let's calculate goodwill adjustment. Right? Working note 1. Change in profit sharing ratio and goodwill. Ratio and goodwill. Now, calculate what is the change. Partners A, B, C, D. Old ratio, new ratio. What is the difference? What is the old ratio? 3:2:5. So 3/10, 2/10, 5/10. D will have nil. Now who is retiring? B is retiring and new ratio is 3:4:3. So new ratio 3/10 nil. 3/10, 3:3:4, 3:4:3. 4/10, 3/10. This is the new ratio. We have to find out what is the gaining, what is the sacrificing ratio. D is gaining ratio. Directly we can calculate how much. 3/10 gaining. Correct. is he gaining or losing? No, nil, no gain, no loss. B is gaining or losing? He is losing everything, so sacrificing. 2 by 10 is sacrificing ratio, sacrificing 2 by 10. This 5 by 10 is becoming 2 by 10 for C. So he is gaining or sacrificing? He is sacrificing. How much? 1/10 of his share is sacrificing. So D is gaining 3 by 10. That whatever goodwill amount should be compensated in the ratio of 2:1. Correct? In the sacrificing ratio. How will that be done? What is the goodwill of firm that they have given in the question? Goodwill of the firm is 2 lakh rupees. Correct? So who has to get the goodwill? D has to get the goodwill. D is the new admitted partner. D's share in goodwill, how much? 3 by 10, 2 lakh into 3 by 10, which will be 60,000. Correct? This will be contributed to whom? B and C. What will be the journal entry? This will be given to B and C in what ratio? 2:1. How will you do it? Whose capital should increase? B and C. Whose capital should decrease? D's. D's capital account. Is he telling that goodwill he'll get in cash? No, they're not telling anything, so we won't assume it. All right. D's capital account, how much? 60,000 debit to B's capital account to C's capital account. In what ratio? 2:1. So 40,000, 20,000. Clear? Next. So we are done with goodwill. Next, let's prepare. They want revalue. They are asking for only revaluation and partners capital account. Revaluation account is easy. We have to revalue all the assets and liabilities. See how they've done it. Revaluation account. What is the first point? In the buildings and plant and machinery to be valued at 90% and 85% of the respective balance sheet figures. So buildings should be at 90%. Correct? They're telling 2 lakh is a figure now. It should be 90%, means it should be 1,80,000. So 20,000 should go to revaluation account. Profit or loss? It's loss, right? Decrease in the value of asset. So revaluation account debit to building account. A posting will be to building. Decrease in the value of assets, debit side, 20,000. Next, plant and machinery, 85%. So 15% we have to reduce. Plant and machinery amount is 3,80,000 into 15%, 38,000 plus 19,000, 57,000. 57,000 to plant and machinery. Decrease in assets. Next, they're telling investments are to taken over by the retiring partner at 25,000. Think of what will be the entry. What is the investment value now? 22,000. First, we have to increase the value. How will you increase the value? Investments account debit to revaluation account. Then it will be transferred to partners capital. So, buy investments 3,000. Correct? First, we'll revalue the assets, then we'll sell it to partner. Next, trade receivables are considered good only up to 90% of balance sheet. So, the reduction in value of assets, 2 bad debts. How much? 13,900. Or you can record 2 debtors as well. Alright, 13,900, which is 10% of 1,39,000. Clear? So, revaluation account is done. It will be transferred to which partners? The old partners. Who are old partners? A, B and C in old profit sharing ratio. A, B and C in old profit sharing ratio. The revaluation gain. It is gain or loss? It is the debit side is excess. So, it is a loss on revaluation. Clear? Next, they want partners capital account. Now, they have not given how much D will bring exactly. They have told that in the reconstituted firm, the total capital should be 3 lakhs. So the closing capital should be 3 lakhs, which will be contributed by A, C and D in their new profit sharing ratio. So after we calculate the closing balance, we have to decide how much should be brought by D. See how they have done. Partners capital account. 1. Goodwill. What is the entry? B's and C's capital account is credited 40,000 and 20,000, and D's capital account is credited, sorry, debited, correct, reduction. Next, what is happening? Revaluation. So these will be transferred, correct. So it's a loss. So 26,000, 17,580 and 43,950. After this, they have told that investments will be taken over by the retiring partner. Who is the retiring partner? B. If he's taking over investments, investment is going out of the books. So we have to reduce investment. So to investment account, what will you debit? Partner's capital. Because he's taking, his capital balance will reduce, right? So B's capital account debit to investments account. Posting will be to investments account. To investments account, 25,000. Done. Clear? Now B settlement is done. Now B has an opening capital. He got goodwill, revaluation loss he has to bear. He got some investment. The balance should be settled. The balance should be settled using B's loan account. Alright, clear? Now, other than that, they've told that the remaining capital should be 3 lakhs. So this whole capital should be how much? 3 lakhs in the ratio of 3 is to 4 is to 3. So 3 lakh into is divided into 3 is to 4 is to 3, which is 90,000, 1 lakh 20,000 and 90,000. They have entered the figures here, which should be the closing balance, and the balance whatever is there, this is balancing figure. This we are assuming that will be brought by the partners into the business. So the difference are 12,370, 3,950 and 1,50,000. Clear? Easy question. All right. So that's all about retirement. Now think of this same question and assume that okay, on 1st of July B died. B retired in this question. Let's assume B died. What will be the treatment? The treatment will remain same. Correct? Revalue the goodwill whatever is sacrificing we should go to him, to his partner's capital account. Then revaluation gain or loss whatever is bearing, that should go to him. Any other adjustment should be made to him. But whatever is closing, whatever has to be settled, how much has to be settled? 73,420. This settlement amount won't be paid to him because he is not existing anymore. It will be paid to his legal representative. So it will be to legal representative account or executor account. Executor's account. It will be passed to this and it will be settled. What else? Anything else that will come? Yes. So in case of death of partner, same points will come. One is his goodwill. So whatever is the sacrificing ratio, goodwill should be compensated. Next is what? Revaluation gain or loss. Next is reserves. Right? Along with this, there can be something called share in profits. Share in profits. The death can't be planned, right? On random day he died. For example, financial year is from 1st January to 31st December. On July 3rd, he died. So till July 3rd, he is entitled to get the profits. So the share of profits will be from the beginning of the year, beginning of financial year, up to the date of death. Clear? So this share in profits should be calculated. How can that share in profits be calculated? How that share in profit? Depending on the period, it can be calculated. Time. So if we know that, okay, for example, here, for example, July 1st only he passed away. Means 6 months he was there as partner. 6 months he won't be there. So for 6 months the profit can be calculated, or it can be calculated on the basis of sales. On basis of sales. How will you do that? For example, last year you earned a profit of 20% average. All right, this year for 6 months you have made a sales of 1 lakh. So your share of profit for that period will be how much? For that period, the total profit of the firm will be 1 lakh into 20,000. So 20%. 20,000 is the profit of the firm will assume. In that, share of the deceased partner will be given. Alright. The treatment will remain same as retiring partner. Clear. Now there are two more concepts in death of the partner. We'll discuss that and close. One, if the settlement is not done, settlement should be done to whom? Settlement to legal representative. If settlement to legal representative is not done on time, if the settlement is not done, for example, he passed away on July 1st, for 6 months also they have not done settlement, then the legal representative will be entitled to one is share in profits for that period, for the delay period, whatever profit has been earned in that shares, or interest on capital, interest on the settlement amount, not capital, interest on settlement amount at 6%. So the legal representative will be entitled to either share in profits or settlement amount, whichever is higher. Why whichever is higher? Because legal representative will have the option. Obviously, the legal representative will choose whichever is higher. So the legal representative can choose either share in profit for the delay, or whatever settlement amount is there, interest on that at 6% per annum. One more concept in this is insurance. We already discussed JLP, correct? Joint life policy. Now in this case, death, in this case it is death of partner, right? So whenever death happens, the insurance company will give maturity amount or policy amount, correct? Maturity amount or policy amount. This amount should be transferred to all the partners. Yes, in case of retirement, you will be receiving surrender value. In case of death, you will receive maturity amount or policy value, which should be transferred to all the partners. So rather than joint life policy, there can be cases where where individual policies have been taken. Individual policies have been taken by all the partners. So individual policies have been taken by all the partners. So it is not personal life insurance. It is relating to the firm. So premium will be paid by the firm. Premium will be paid by the firm. Clear? Premium will be paid by the firm, and whatever value received, whatever receipts will be there, it will, everyone will be entitled. Means all the partners will be entitled to the amount in the profit sharing ratio. Now in case of death, what will happen? For example, A, B and C were there. C, right? So for C's policy, they'll receive policy amount, correct? They'll receive the whole policy amount. This will be transferred to all partners, correct? For A and B's policy, they'll get surrender amount, surrender value. This will also be transferred to all the partners. Clear? Similar, just that remember that this individual policy is not personal expense. Don't take it as drawings. So they'll take it and premium will be paid by the firm. So all the partners are bearing. So whatever benefits they are getting, all the partners should get those benefits. Clear? That's all in the partnership chapter. Alright, that's all. We have covered almost all topics of partnership. Now we'll move to company accounts. Company accounts. Company accounts is basically, the chapter name is issue of shares and debentures. There's some theory regarding the company accounts. We'll first discuss the theory and then we'll move to issue of shares and issue of debentures. Now first, what is a company? Company, again, association of people, etc. It's a company is something like an entity registered. It should be registered similar to LLP. Should be registered under the Companies Act. There's an act called the Companies Act 2013. So should be registered under 2013. Who are the owners of the company? Owners of the company are shareholders. Shareholders, or in the act it is called members, or the shareholders are called members. The owners are the shareholders. Who's the management? The management is board of directors. Board of directors. Owners can also be board of directors, but they don't become board of directors in default. There can be a case where owners are totally separate and board of directors are totally separate. So owner gives the board of directors the right to act in behalf of the company. All right. It should be registered. It will be a separate legal entity. It is separate from the owners. It is separate from the owners. It will run on its own. In the company's name, they can buy property, they can enter into transactions. It will have perpetual existence. Means a death of the member or a member selling the shares, like getting out of the company, doesn't change the existence, doesn't matter to the existence of the company, because the company is separate from its members or shareholders. So it will have perpetual existence. It runs under a common seal. I told you, right, the company can run on its own. It can authorize the board of directors to run the company, but all of them will act under a common seal of the company. The company is in the company, it always has limited liability. So whatever amount is invested by the shareholders when the shares are issued, their liability is limited to only that amount. Clear? And the shares can be transferred. Transferability of shares. Clear? So these are the features of the company. These are the features of the company. It should be registered. The owners are shareholders. Board of directors is the management. It is a separate legal entity. Thus, it will have perpetual existence. It's run under a common seal. The members have limited liability. The members have limited liability, and transferability of shares is possible in company. These are the features. There are types of companies. Types of companies. We'll quickly discuss the types of companies. First, private company. Private company. In private company, the minimum number of members can be 2 and the maximum can be 200. Minimum and maximum 200. It's called private company. Second, public company. Public company. More than 200 members, it automatically becomes public company. Third, listed company. Listed company. So the public company can be listed company or need not be listed company. Listed company is something which is listed on stock exchange. Stock exchange. Clear? Government company. Government company is something where more than 50% of the company is owned by central or state government. Central or state government or combined. Both. If the government holds more than 50%, then it is called government company. Foreign company, where the company is incorporated outside India. Incorporated outside India, but has a place of business in India. Place of business in India. Then it is called Foreign company. What else is there? One person company. One person company. One person company. In this, only one person can be a member. Only one member will be there. Clear? So in private company, minimum two should be there. In one person company, one one person is enough. Company limited by shares. Limited by shares means the members liability will be limited to the amount they have invested in shares. Liability to the extent of amount invested for shares. Invested in shares, right? Then next, company limited by guarantee. So in this, the liability of members will be limited to the amount of guarantee given by them. Amount of guarantee given by them. Then next, holding company and subsidiary company. So when a company, for example A Private Limited, owns 50% or more than 50% of another company B Limited, when he owns that, A becomes holding company. Means A Limited owns more than 50%, so A Limited becomes a member there. Clear? And B Limited becomes subsidiary company. This becomes when A Limited owns more than 50% of the share capital of B Limited. Clear? So these are the types of companies. Next, similar for like how we prepared financials for sole proprietor, NPO and partnership, financial statements should be prepared for companies. It's prepared under Schedule 3. There's something called Schedule 3 in Companies Act 2013. It's prepared under this. What all do you have to prepare? Similar to the others: balance sheet, profit and loss account. The profit and loss account means in that only the elements of trading accounts will also come. Then there's something called cash flow statement, which you will be learning in your inter. Cash flow statement. What else should you prepare? Changes in equity, statement of changes in equity. In your share capital, what are the changes that have happened during the year? You should prepare a statement for it. And fifth one is notes to accounts. So relating to whatever financial information you have given in the financial statements, we should give notes which will contain details regarding to those. These are the financial statements that should be prepared according to Schedule 3 of the Companies Act. Clear? Next. Now, what are the now let's come to shares. Shares. What is shares? The chapter's name is what? The topic's name is issue of share. Issue of shares. What is shares? The capital, the company's capital. Capital is what? Owner's capital is called company's share capital. And the share capital is divided into small units. Let's say we started a company, we decided that 10 lakhs is required to start the company, to run the company now. So we'll divide it into small units. Let's say 10,000 units, will divide it. So 10,000 units when we divide, per unit will it be how much? Will be 100. So per share value will be 100 rupees. Clear? So these shares will be issued to the owner. Clear? And the liability of the member will be limited to the amount invested in that share. Clear? So share capital can be of two types. Yes, what is that? Equity share capital and preference share capital. Right? What is preference share capital? Preference share capital means that they'll get preference over equity shareholders. In what? One, in payment of dividends. They'll get the preference over. So before equity shares, before dividend is paid to equity shareholders, dividend should be paid to preference shareholders. What is dividend? Dividend is nothing but whenever profits are earned, a part of it is distributed to the shareholders. Second is repayment of capital. So whenever the capital has to be repaid, first preference shareholders will be paid, then the equity shareholders will be paid. What else will be there? Generally, no voting rights will be given. No voting rights will be given to the preference shareholders. What is equity share capital? Equity share capital is nothing but these are the original owners of the company. Like after everyone takes everything, whatever is left in the company is of equity share. Equity share capital means equity shareholders will own that equity share capital. Equity share capital will be divided into small shares. Correct? Right? So this share capital has types again. Say categories, let's say. Share capital categories. First is authorized share capital. Authorized share capital. What is authorized share capital? When the company is registered, they'll prepare something called a MOA, Memorandum of Association. It will contain like few clauses of the company. Okay, what should be the name, what is the location, etc. They'll decide what is the authorized share capital in MOA. What is authorized? This is the maximum share capital that a company can raise. This is the maximum share capital that the company can raise. So this authorized share capital will be in memorandum of association. In balance sheet, it should be disclosed. It won't be in your balance sheet. It won't be the original share capital, because share capital will be what is actually issued to the shareholders. But the authorized share capital should be disclosed. Clear? Next. Second is issued share capital. So once you started the company, you have the authorized share capital as per MOA. A part of it you will decide, like maximum is authorized share capital. Let's say you decided to issue a part of shares. So how will you issue is, you will first invite applications. We'll tell that, okay, we are issuing these many shares. Let's say out of 10,000 shares, we are issuing 5,000 shares now. Whoever wants to buy can come and apply. So first we'll invite applications. We'll receive applications. Correct? We'll receive applications. When we receive applications, if the applications were received for only 5,000 shares, then well and good, we'll allot the 5,000 shares. If, for example, 4,000 shares, only for 4,000 shares we received the applications, there is some rule which says that 90%, at least 90% of the applications should be received for the share issue. Otherwise, we have to cancel the issue. This won't be tested in your exam, but there is a minimum amount set by the SEBI, the Securities Exchange Board of India. Not that important. Now, for example, not 4,000, we received 6,000 applications. We received applications for 6,000 shares. We cannot issue 6,000 shares only because we received applications. We'll issue only 5,000 shares. In what way? In pro rata allotment. Clear? So pro rata, it will be like whoever that will be given in your question. but here 6,000 applications we received. So we'll tell that whoever for every 6 applications that we received will issue 5 shares. In that way, 6,000 for 6,000 applications we can issue 5 shares. So how many are actually allotted? That will be given in your. So this is called allotment, that will allot these shares, right? So when we invite application and we receive applications, we receive something called application money, and then we allot the shares. After the allotment, after only once they tell that allotment is done, that's when we record the equity share capital. This will discuss in entry, but understand the flow. Clear? Allotment. So application money will be received. When allotment is done, allotment money is received. So how much will this be? For example, if the share per share price is 10 rupees, maybe 2 rupees will be invited in application money. 2 rupees per share. Then maybe allotment 3 rupees. So total 5 rupees is collected up to the allotment stage. Then there can be calls. Calls means like for maybe some 2 months they managed with allotment money. After 2 months they'll tell, okay, now capital is reducing, so we are calling capital more. Maybe this is first call, they'll invite another 3 rupees. So this is called called up capital, right? They'll call 3 rupees. That 3 rupees should be paid by each and every shareholder per share. Then maybe after a few months again they'll do second and final call. It can be any number of calls. Let's say assume that for here we received 2 rupees on application, 3 rupees on allotment, 3 rupees on final call. So 8 rupees we have already received. So final call will be for 2 rupees. Clear? So as and when we receive the amount, will increase the share capital of the company. Clear? So issued share capital is the share capital that you are inviting from the shareholders. Then subscribed share capital. Subscribed share capital is nothing but whatever is allotted. So public send the applications, whatever is allotted becomes subscribed share capital. For these many shares, it is subscribed. Then you have something called called up share capital, right? We made these calls, right? 3 rupees and 2 rupees. When we made these calls, it will be called called up share capital. But once it is paid by the shareholders, it will become paid up share capital. Paid up share capital. This is the share capital. This paid up share capital is the share capital which we will record in balance sheet. This will be our capital amount. Clear? So paid up share capital is what will record in the balance sheet. So all these authorized share capital issued, how much is issued, how much was subscribed, how much is paid up, how much is called up, how much was paid up, everything should be disclosed in your financial statements. Clear? Everything should be disclosed. So all the information should be given to shareholders telling that, okay, this much we issued, this much was allotted, this much was called up, and this much is paid up. Clear? So these are the types of share capital. Now this preference share capital, what we discussed, this preference shares. So preference share capital are divided into preference shares, right? Small units are divided into small units, and those are called preference shares. So these preference shares has certain types, all right, that we'll discuss. One, cumulative preference shares and non-cumulative preference shares. Cumulative and non-cumulative depends on how the dividends are paid. Cumulative means irrespective of the company earns the profits or not. Even if company doesn't earn profit, the dividend has to be paid to the cumulative preference shares. It will be accumulated. So this year some 10,000 dividend had to be paid. There was a loss, we couldn't pay. next year this 10,000 and next year 10,000, 20,000 will be accumulated and that should be paid. Non-cumulative is like only if profits are made by the company, then the dividend will be paid. Clear? Then we have convertible preference shares and non-convertible preference shares. So whenever preference shares are issued, you can tell that okay, 3 years it will be preference shares. After that you will have an option to convert. In this convertible, we'll give an option to convert it into equity share capital. In this, there will be no such option. Non-convertible. Clear? Next, redeemable preference shares and irredeemable preference shares. This will have a time period that after 3 years the shares can be redeemed, will repay the capital. In this case, not redeemable, so it can't be redeemed. It will forever stay in the books. Clear? Next, participating preference shares and non-participating preference shares. It means that whatever profits are left after the dividends to both preference shares and equity shares are paid, whatever leftover profits are there, the preference shareholders will have share in that. Clear? Whatever after paying all the dividends, preference share dividend and equity dividend, whatever profits are left, if they have a share in those profits, then it will be participating preference shares. In case of non-participating preference shares, no such share will be there. Means the amount they'll receive will be only dividend of preference shares. No participation in the profits of the firm. Clear? These are the types of preference shares. There won't be sums for all these topics that we discussed now. There won't be sums. This is theory. Give it a reading. Clear? Now we'll start with accounting. Issue of shares. Clear? So this was the theory. Now we'll start with accounting. Accounting. For what we are accounting? For issue of shares. So first we'll discuss what will be the entries. We'll go with the flow. Then we'll solve one or two things. Clear? The very first entry will be, we'll invite the applications. For inviting the applications, there is no entry. We'll just tell that okay, we are issuing capital. Whoever wants to send application, send. With application, they should send application money. Correct? Whenever we receive application, we'll receive application money. What will be the entry? So we are getting money. So bank account debit to share application account. So if equity, if in the question they have given equity shares, write equity share application account. If they have given preference shares, then write preference share capital account. So here we are just writing share application account. Your ledger name should depend on, your account name should depend on what shares are those. If they in the question they have given equity shares, then you also write equity shares. What will be the entry? Bank account debit to share application. This will be amount of all the applications received. All the applications. So it can be excess, right? So whatever money is received, it will be bank account debit to share application account. What will be the next entry? We have received share application. Once we received share application, we'll see how many applications are received. Depending on that, we will allot shares. When we allot shares, the share application account, what is there? We have to close that and pass it to equity share. I told, right, only on allotment. This is on application. This entry is on application. Clear? Next, on allotment of shares, there will be certain entries should be passed. First is share application, we have to close. So entry will be share application account debit. This will be amount of allotted shares, amount related to allotted shares. Correct? We might receive excess applications also, that we have to return. Clear? So to equity share capital. So this will also be amount of allotted shares. And to bank account will be, this will be in case of excess applications. Excess application amount refunded. So whatever application money was received in excess, it should be refunded to those people. So the entry will be share application account debit to equity share capital account to bank account. And once share allotment is done, they'll invite allotment money as well. For that you have to record the entry. It will be like the amount will be called first. It won't be received directly. First they'll call. When they call, they will record the entry. Share allotment account debit. This will be allotment money receivable. Clear? To equity share capital account. Clear? So share allotment account debit, it will be receivable to equity share capital account. There's one more thing that can come here, which is securities premium account. When will securities premium account, let's say, discuss? When shares are issued, for example, share is 10 per share. This is called, it is called that it is of 10 per share, it is the face value of the share. Now what is the value of share? 10 rupees. But they can tell that okay, 10 rupees is per share, 10 rupees is the face value, but we want 12 rupees from you to issue that share. Oh, all right, then issue price will become 12 rupees. So face value is only 10 rupees, issue price will become 12 rupees. This case is called issue at premium. Issue at premium means what, like in excess of face value we are recording. Otherwise, if it was issued at 10 rupees only, if the issue price was 10 rupees only, it is called issue at par. Clear? If it was 8 rupees, it is called issue at discount. Right? Whatever is the discount value, we are issuing at less than that price. But it is not allowed now. It is not allowed under Companies Act. So this won't be tested. You don't have to worry. So it will be either issue at par or premium. Whenever it is at premium, we should always remember that whenever we record equity share capital, this should always be recorded at face value only. What's the face value? 10 per share. So this 2 rupees excess whatever is received will be recorded as securities premium, the premium amount that is received for the issue of shares. So securities premium, will record the premium amount. What is premium amount? Issue price minus face value. Equity share capital will always record at face value. Clear? Sometimes what they'll tell is this equity share application money, if it is received in excess, they'll tell that you can adjust it to. So for example, a person applied for 5,000 shares, but he has been allotted only 4,000 shares. So 1,000 shares application money we have to return. Correct? But later he has to pay share allotment money for the 4,000 shares. So I'll tell that like the 1,000 shares application money what you are refunding, you adjust it to the allotment money, the balance amount will pay. In that case, we have to adjust it respectively. How will you adjust? So the share application money won't go to bank account. It will go to share allotment. The next entry will pass it is here bank account will not come. This bank account will not come. We'll pass an entry called share application account debit to share allotment account. Clear? So whatever receivable is there, receivable amount whatever is there will decrease because we are adjusting share application account. There are few questions to it. We can do that. Now, share allotment is invited here, correct? That will receive after that. So receiving is called bank account debit to share allotment account. Clear? Bank account debit to share allotment account. You can write being share allotment money received at like maybe this rupees 3 per share for these many shares. Will write the amount. Clear? This will be the amount received. Then we'll invite calls, right? Calls will call up the capital, called up capital that we discussed. Whenever we make calls, we'll call share call account. If it is first call, you will record it as share first call account. Correct? If it is equity share, then equity share first call account debit to equity share capital. Same. Equity share capital should always be face value of the share only. This will be the total amount receivable. Clear? So when it is received, same entry like allotment, bank account debit to share call account. So if it is first call, equity share first call will record. Then if there is second call, will record again. Whenever his call is made, then share or call account debit to equity share capital, and then bank account debit to share second call account, second call or final call, etc. Clear? Clear till here? Now in this stage, so this is the equity share capital flow whenever issue is made. Now there can be some cases where whenever calls are made, the amount is not received. Clear? It can be at allotment stage or call stage. At allotment stage, oh sorry, just a minute. Right. So at allotment stage or the call stage, this is call stage, right? This is call. On call, what we record the entry are these. Oh sorry, not this. On call we record these entries. So at this stage, this is receivable, correct? The share call account total amount is receivable. If it is received, we'll pass this entry. Sometimes it won't be received. Then what will be the entry will pass? Bank account debit. So whatever amount received, correct? Whatever amount received, we'll record something called, okay, we'll write it separately. So if some of the amount of call or allotment is not received, we'll record this entry, bank account debit, whatever money received, only partial will be received because we are telling that some of the amount is not received. Then calls in arrears, means we made the call but has not been paid. We'll debit it because it is still receivable. Calls in arrears account debit, this will be whatever not paid. Calls in arrears account debit to share call account. We'll close the share call account and record whatever, for whatever received we'll record bank account, for whatever not received we'll record calls in arrears account. So for this calls in arrears account, there can be interest can be charged because they are paying late, right? The shareholders had to pay on a certain date but they didn't pay, so interest can be charged to them at the rate of 10%. Interest interest maximum can be 10% can be charged to shareholders as per the Companies Act. So whenever so it's charged for the period of delay. They had to pay by this date, they didn't pay, they paid after 2 months. So for 2 months they'll charge the interest. So they'll calculate the interest at whatever rate. What will be the entry? What will be the entry? Who has to pay this? Now you need not go to shares. It's not relating to shares. Correct. Who has to pay this? Shareholder has to pay. So the shareholders account. This is not relating to share capital. This is personal account. Shareholders account debit to interest is income, right? Interest on calls in arrears. Arrears account. Whatever amount is there. This is the receivable entry. We'll debit the shareholders account because it is receivable from shareholders. When it is received, the entry will be bank account debit to shareholders account. Clear? This is one concept. There is one more concept called calls in advance. Clear? So for example, after the allotment stage itself, before the call itself, someone paid off the call amount. Someone came forward and paid the call amount. So it is received in advance. It's not called up yet. It is received in advance. What will be the entry for that? One is bank account debit. There is no share call. It's not, share call is not yet done. So we'll record something called to calls in advance account. It's a liability. It's a liability. Why? Because we have not called up yet. We have already received. Correct? So it's a liability. How will that be adjusted? So when the call is made, when the call is made, what will be the entry? Share call account debit to equity share capital account. That share capital should be received from bank account, right? So when bank account is received, bank account debit, they'll receive only partial amount, right? Then because some amount is already received, whatever is already received will be recorded here. Calls in advance, close that. Calls in advance account debit to bank account. Clear? So even for calls in advance, interest can be paid to the shareholders. Here interest will be charged in case of arrears. In case of advance, in case of calls in advance, interest can be paid to the shareholders. Then what will be the entry? As per Companies Act, the maximum interest that can be paid is 12%. Clear? So if they are not giving in the question, you should assume that it is 12% for calls in advance. What will be the entry? Interest on calls in advance, it's an expense for us. So interest on calls in advance account debit, the interest will be calculated for the period. Like if they had to pay on a certain date, they paid some 2 months in advance. For 2 months, we'll calculate the interest on calls in advance debit to shareholders. Now we have to pay to shareholders account, right? We have to pay to the shareholders, so we'll credit it. When it is paid, shareholders account debit to bank account. The amount will be recorded. Clear with these entries. So this is in case of arrears or advance. If there is arrears or advance, this entry will be recorded. Correct? So will be like issue is done till here. So what will be the stages of issue? First, applications will be received. After applications is received, allotment will be done. After allotment, calls will be made and call money will be received. Allotment money will be received, then calls will be made, call money will be received. If money is not received, we'll record arrears. If money is received in advance, we'll record calls in advance and later will adjust. Clear? So interest will be paid to the shareholders in case of advance, will be charged to the shareholders in case of arrears. These are the entries for issue. There can be something called forfeiture of shares. Forfeiture of shares. What is forfeiture? Calls in arrears we recorded, but even after 6 months, the shareholder didn't pay the amount. Okay, it's 6 months. Like for example, the shares we have We have allotted the shares. We invited some money, but the person didn't pay only. The shareholder didn't pay the amount. In that case, we'll forfeit the shares. Forfeit is nothing but cancellation of shares. Cancellation of shares. We'll cancel the shares whatever are relating to that particular person. How will you cancel the shares? Those entries, journal entries, will discuss. What will be the journal entries in case of forfeiture? First is whatever share capital that we have recorded, that will reverse it. Equity share capital is credited, right? So to reverse it, we'll debit it. Equity share capital account debit. This will be only face value, correct? Correct. Face value, whatever is recorded till now. For example, up to the stage of allotment, 5 rupees was received. 5 rupees was recorded. So reverse that. Equity share capital account at face value will record. Then securities premium we might have recorded if it was issued on premium. Correct. That will reverse, but that will reverse only in case it is not received. Not received means what? For example, for allotment we recorded one entry. What will be the allotment entry? Share allotment account debit sum 2,20,000 to equity share capital 2 lakh to securities premium 20,000. We recorded this entry, but this allotment money was not received in some case. That's why we are forfeiting the shares. So if this securities premium is not received, then we'll reverse it. For example, this was received, allotment money was received, then bank account to allotment we received. To allotment we received this. Then the call was pending, that's why we forfeited shares. Now securities premium, whatever we recorded, it's already realized here. In that case, we won't reverse securities premium. Clear? Securities premium we won't reverse in case it is received. So only if not received. Only if not received. Then to forfeited shares. Forfeited shares. Whatever is already recorded. Also, whatever call is pending. Now, for example, we have recorded that as calls in arrears. Because calls in arrears we didn't receive only, we were forfeiting shares, right? So that will reverse to calls in arrears, or it is still, the amount is still pending in share allotment account or share call account. So all these are pending amounts. Whichever ledger it's like recorded in, if it is still outstanding, we'll reverse those. The balance will go to forfeited shares. Clear? So forfeited shares will be the amount paid up. The forfeited shares, the amount will always be paid up, which the amount which has already been received. Clear? Which has not been received, it will be sitting in any of these accounts, right, as a receivable. So that will reverse accordingly. Clear? So this is the entry when we forfeit the shares. We reverse the share capital, we close the share capital, we reverse securities premium only if it is not received. We pass it to forfeited shares, but only paid up amount, means whatever is already received in cash will be going in forfeited shares. Then to calls in arrears or to calls share allotment to, or to share call, this is receivable. Whatever is not received will credit it here. Clear? This is the forfeiture entry. After forfeiture is done, forfeiture is cancellation, there can be reissue of shares. Reissue of shares. What is reissue? We cancel the shares, but later he is ready to pay the amount, we'll reissue the shares. How will we reissue the shares? One is bank account, will be receiving the amount. Bank account debit will receive the amount from the shareholders. Whatever forfeited share is there, we'll close that. Forfeited share account is there, we'll reverse that to equity share capital account. So equity share capital account will record at face value. Bank account will be amount received. Correct? This will be the balance which will pass it to forfeited shares. So some of the amount will be reversed here. The balance of forfeited shares, whatever is there, the balance of forfeited shares should be passed to something called capital reserve. Capital reserve account. Clear? So this will be the balance closed. So balance should be closed to capital reserve account. Clear? These are the entries for issue. First, issue of shares. Then if forfeiture is there, what will be the entry? The next is if it is reissued. If the forfeited shares are reissued, what will be the entry? We'll go to sums for issue of shares and then we'll come to debentures. Question number 7. Question number 7 in the study book. Read the question. Rashmi Limited issues at par 1 lakh equity shares. 1 lakh at equity shares it is issued at 10 rupees each, payable rupees 2.5 on application. So first 2.5 application, 2.5 on application, 3 rupees on allotment, then 2 rupees on first call, and balance on final call. So final call will be how much? Is it issued at premium? No, they are not telling anything. So it is, we'll assume that it is issued at par. So 2.5, 7.5. So 2.5 will be final call. All the shares were fully subscribed. Mr. Nair, who held 10,000 shares, fully paid remaining amount on first call itself. So what's happening here? Mr. Nair, who is Mr. Nair? Who is one of the shareholders. Telling all the shares were fully subscribed. So 1 lakh shares were subscribed. Then what is happening? Mr. Nair, who held 10,000 shares, paid off full remaining amount on first call itself. So when first call amount was invited, how much was first call? 2 rupees. 2 rupees. So Mr. Nair, what he did? He paid the remaining amount, means he paid 2.5 as well. Means calls in advance. Correct? Then what happened? The final call which was made after 3 months, the final call was made after 3 months from first call was fully paid except a shareholder having 1000 shares. A shareholder having 1000 shares did not pay. Will record calls in arrears. Who paid his due amount after 2 months along with interest. So 2 months will charge interest. Calls in arrears. Company also paid interest on calls in advance. Calls in advance, how much interest should be paid? 3 months. Here it's given that after first call, after 3 months they called for the final call. So for 3 months interest should be paid for calls in advance to Mr. Nair. Now they are asking for journal entries to record these transactions. Clear? Now what will be the first entry? First entry, let's look at that. How many shares? 1 lakh equity shares. 1 lakh equity shares. They have not told how much is received. They have told it was fully subscribed. So we'll assume that for 1 lakh applications were received. How much into 2.5? Correct. 2,50,000 was first received. What will be the entry? Share application. First bank account debit to equity share application account. They have told that it is equity shares. So bank account debit to equity share application account. Right? Bank account debit to equity share application account. 2,50,000. Clear? Equity share application account. And they are telling that all the shares were fully subscribed. What will they do? Equity share application will close. So equity share application account debit to equity share capital. Will record the equity share capital once they are allotted. Correct? So all the applications were accepted. So equity share application will close and will record equity share capital 2,50,000. Next, allotment. Only on the first call something is happening. Till then nothing. So on allotment money is how much? 3 rupees. So 3 into 1 lakh, 3 lakhs. What will be the first entry? You will record receivable, equity share allotment account debit to equity share capital account. Then bank account debit to equity share allotment account. Look what's happening. Equity share allotment account 3 lakh receivable. They have passed it to equity share capital account. Securities premium is not there in this case, right? Then bank account debit to equity share allotment. Whatever was receivable here was received here, 3 lakhs, right? Allotment stage is done. Then they have told Mr. Nair, who held 10,000 shares, paid fully remaining amount on first call itself. Correct? So when he paid full amount. First, what is like when the call was made, what will be the entry? Equity share first call account debit to equity share capital account. First pass that entry. Equity share first call account debit 2 lakhs. How much? 2 rupees per share. Right? 2 rupees on first call and balance on final call. Balance is 2.5. So 2 rupees on first call. 2 into 1 lakh, 2 lakh. So equity share call account 2 lakh to equity share capital. Right? When the amount was called, we recorded this entry. How much amount was received? Now this is interesting, right? How much amount is received? First of all, 2 lakhs should have been received. Correct? 2 lakhs should have been received, which was receivable. In addition to that, they said Mr. Nair, who held how many shares? 10,000 shares, paid full remaining amount. What will be the remaining amount after first call? The final call amount. What is that? 2.5. 2.5 into 10,000. It will be 25,000. So how much amount was received? 2,25,000 was received, correct? So when the first call was made, the call was made for 2 lakh. How much was received? 2,25,000. What will be the entry? Bank account debit is 2,25,000. Correct? Bank account debit is 2,25,000. But share call is how much for share first call? To equity share first call is 2 lakh only. The balance 25,000 is calls in advance. 2 calls in advance. How much? 25,000. Check the answer. Bank account debit 2,25,000 to equity share first call account 2 lakh to calls in advance 25,000. Clear? Clear till here? Next. I have told the final call was made after 3 months. When the final call was made, what will be the entry? When the final call is made, what will be the entry? Equity share final call account debit to equity share capital account. How much? 2.5 into 10,000, 2,50,000. Equity share final call account debit to equity share capital account. Simple entry. Next, they're telling the final call made was fully paid. They're telling was fully paid except a shareholder having 1,000 shares. Now when they say fully paid, how much was receivable? 2,50,000 was the final call. Correct? How much, like they're telling, except a shareholder having 10,000 shares who paid his due amount after 2 months. So for 1,000 shares he didn't pay. So 1,000 into 2.5 will be 2,500. He did not pay. So this was not received. Also, calls in advance whichever we received earlier, that wouldn't be received, right? Mr. Nair won't pay again. So that 25,000 was received in advance. Even that won't be received here. How much will be received here in net? 27,500 won't be received. So 2,22,500 if I'm not wrong. 2,22,500. What will be the entry? Bank account debit is 2,22,500. Calls in advance we have to reverse. We have liability, we have to reverse. So calls in advance account debit. How much? 25,000. Correct? Calls in arrears we have to record. It's receivable debit. Calls in arrears account. How much? 2,500. Right? To equity share final call account. The whole amount can be credited. How much? 2,50,000. Clear? Check the entry. Bank account debit 2,25,000. Calls in advance were met. How much? 25,000. We are reversing it. Calls in arrears 2,500. We are reversing to equity share final call account 2,50,000. Clear? Clear? So that is the entry. Next, we have to pay interest rate. First, we'll pay to, like, immediately after this entry is passed, calls in advance, we have to pay interest to the shareholder who paid in advance. Who is that? Mr. Nair. What will be the entry? What will be the entry? We have to pay. So interest expense. So interest on calls in advance. Interest on calls in advance account debit to shareholder account, which is Mr. Nair. Interest on calls in advance account debit to Mr. Nair. How much? How much? What will be the amount? 25,000. Have they given interest rate? No. Then we should take it as per Companies Act. For calls in advance, it is 12% into, for 3 months in advance he was paid, correct? This amount will calculate. This will be interest on calls in advance. Check the entry. Interest on calls in advance account debit 750 to shareholders account at the rate of 12% per annum. Clear? Next, after 2 months, this calls in arrears would have been received. What will be the entry? First entry will be receipt of that amount. Bank account debit to calls in arrears. How much? 2,500. But along with that, he has to pay interest as well. How much? How much? 2,500 into 10% for calls in arrears into how many months? 2 by 12. This will be interest on calls in arrears. Check the entries. First, calls in arrears entry is not passed. Okay, here bank account debit to calls in arrears account 2,500 to shareholder account. So receipt entry they have recorded at once. Check here. Show shareholders account debit to calls in interest on calls in arrears. This is income, correct? This is income to the company. Think from company's point of view. This is income and this is receivable. So total amount is received here. Total interest plus arrears. Right? So this is the question. We covered all the entries of issue, arrears, advance, interest, etc. Now let's do one question for forfeiture. Let's do one question. Which one will do? Okay, in this forfeiture and reissue is there. Let's do this. Okay. Read the question. A holds 2,000 shares of rupees 10 each, on which he has paid 2 rupees as application money. B holds 4,000 shares. So they're giving shareholder information. B holds 4,000 shares of 10 each, which he has paid 2 rupees per share as application money. So both have paid 2 rupees per share as application money. And okay, A has paid only application money. B has paid application money and 3 rupees allotment money. C holds 3,000 shares of 10 each and has paid 2 rupees on application, 3 rupees on allotment and 3 rupees on first call. They all failed to pay their arrears on the second and final call. They failed to pay their arrears on second and final call. And the directors therefore forfeited their shares. So all the shares are forfeited. The shares are reissued subsequently at 12 rupees per share, fully paid up. Now let's go step by step. So there are 3 shareholders information they have given. A, let's take some space here. A, B and C. So A holds how many shares? A 2,000, B 4,000, C 3,000. 3,000. 2,000 shares, 4,000 shares, 3,000 shares. So number of shares is this. how much is paid. So A has paid how much? Only 2 rupees as application money. He has paid 2 rupees as application money. 2 into 2000 will be 4000. He has paid. B has also paid 4000. For 4000, 2 rupees application money. So 4 into 2, 8000. He has paid. C has paid. Right, C holds 3000 shares and he has paid 2 rupees on application, 3 rupees on allotment, and 3 rupees on first call. So he also paid how much? 3 rupees. 3 into 3000. 3 into 3000. Sorry, 2 into 3000. 6000. So application money is fully paid. We don't have to worry. Allotment money. Allotment money. Who did not pay? A did not pay. So pending allotment money is pending allotment money. A. How much? How much is allotment money? 3 rupees per share allotment money. So 3 into 2000, 6000 is pending. Correct? He has not paid. B has paid 3 rupees. 3 rupees into 4, 12,000 he has paid. So it's not pending. C has also paid how much? 3 rupees into 3, 9,000 he has paid. Nothing pending. First call. First call and pending first call. So who paid first call? C has paid first call. Only C has paid first call. How much? 3 rupees for first call he has paid. So 3 into 9,000. So sorry, 3 into 3,000, 9,000 he paid. The others two did not pay. So it will be pending. How much? 3 into 2000, 6,000 pending. 3 into 4,000, 12,000 pending. Correct? For C, this won't be pending. And all failed to pay second and final call. How much is second and final call? 10 rupees is per share. 2 rupees application money, 3 rupees allotment money, and 3 rupees first call. 2 plus 3 plus 3, 8. So 2 rupees is final call. So all of them it is pending. Pending second and final call. How much? 2 rupees per share. So 2 into 2000, 4000. 2 into 4000, 8000. 2 into 3000, 6000. Now check what is pending. What is pending? Allotment money is pending for only A. First call is pending in case of both A and B. Second call is pending in case of both A, B and C. These amounts will be pending. How much? 6,000 total here. Here 18,000 and here 10, 18,000. Clear? This will be pending. So because they didn't pay second and final call, what did they do? They forfeited the shares. Correct? What will be the entry? Forfeited what will be the entry? First, equity share capital, you will reverse. Equity share capital account debit, you will reverse. 2. Is there securities premium? There is no securities premium. 2. Forfeited shares. Forfeited shares. Forfeited shares should be what? Forfeited shares and equity share capital should be the paid up amount. Correct? Just a minute. Right? Equity share capital account debit to forfeited shares. Forfeited shares should be what amount? Whatever amount is already paid up. What is paid up? What is paid in relating to these shares? This is paid. Correct? This is paid. Let me highlight with a different color. This is paid. This is paid. And this is paid. How much total? This is 18,000 plus 21,000 plus 9,000, 30 and 48,000. Two forfeited shares account, 48,000. Two, all these pending. First is equity share allotment account. Allotment account. How much is pending? 6,000. To equity share first call account. How much is pending? 18,000. And 2 equity share second and final call account. How much? 18,000. This total amount should be passed to equity share capital. How much? 18, 36. 36 plus 6, 42. 42 plus 48, 90,000. Right? Clear? So equity share capital, which was recorded earlier in relating to these shares, will be reversed. Few forfeited shares should be the paid up amount. Paid up amount, we calculated that all the green highlighted amounts are paid up and all the red are pending. Whatever is pending, we reversed. Whatever was receivable, we reversed it. We cancelled the shares. So this is the entry for forfeiture of shares. Clear? Next, the question says, they forfeited the shares. We are done till here. Then the shares are reissued subsequently for 12 rupees per share. Means the share value was how much? Only 10 rupees. They have issued now what? 12 rupees. So issuing at premium, journalize the transaction. So when reissue is happening, they would have received some amount. Bank account debit. Correct? To equity share capital. Equity share capital account to securities premium account. Correct? If it was loss, then it will be passed to forfeited shares, but they have issued at a premium. Correct? So 12 rupees per share. How many shares in total? 2000 plus 4000 plus 3000, 9000 shares. So 9000 into 10 will be 90,000 face value. Correct? 90,000. And 9,000 into 2 will be 18,000 securities premium. Total 1,08,000 would be received. Correct? So we recorded equity share capital again. Whatever forfeited were there were reissued, so we recorded. This balance is still remaining in books. Forfeited shares account. This should be closed. How will you close it? How will you close it? The credit balance is there, so forfeited shares account debit to capital reserve account. The total amount, how much was it? 48,000 will be reversed. Clear? So this is the issue of forfeiture, and in case of reissue, these two entries have to be recorded. Clear? So we are done with issue of shares. Now we'll start with issue of debentures. Issue of debentures. What is issue of debentures? Even debentures is a way of raising money for the company, but these are debt instruments. Debt instruments means what will do, the company will give you a document telling that okay, we are taking a small loan from you. So it's a acknowledgement of debt. Company will tell that okay, this much amount we are taking a loan from you and we'll pay you a interest of that amount. So it is a loan taken by the company. Correct? Debentures. Right? Then what else? Interest will be paid. Fixed interest amount will be there. Interest amount will be paid when? At fixed times. At fixed time period. Maybe every 6 months or yearly once or every month. The interest will be paid on whatever debentures are issued. Now, one theory concept they discuss is the difference between debentures and shares. What is the difference? The debenture holders are, what are they? They are creditors of the company. They are giving us loans. It's a liability. What are shares? They are owners of the company. Correct? Shareholders are owners of the company. They have voting rights. Correct? The shares get voting rights. Creditors, in case of creditors, there will be no voting rights. They'll get fixed interest. Debenture holders will get fixed interest. But in case of shares, dividends depend on profit. So only if profit is there, dividends will be paid, otherwise not. Debenture holders should be paid interest irrespective. Then what else is there? Debentures are redeemable, correct? Debentures can be redeemed, shares cannot be redeemed. Shares can be forfeited, debentures can't be forfeited. Clear? So debentures will be for a fixed period of time. They are telling that okay, three years you will be the debenture holders. After that, we'll give you back the amount. Shares is not like that. They own the company. Clear? So that's the these are the few differences between debentures and shares. Then similar to preference shares types, there are types of debentures as well. Types of debentures. What are those? Similar to preference shares, convertible debentures, and non-convertible debentures. That they will have an option to convert this debentures amount into shares. But in case of non-convertible, they won't have that option. Then redeemable debentures and irredeemable debentures. That redeemable debentures will have fixed time telling that after 3 years will give you back the amount. In case of irredeemable amount, that amount won't be there. What else is there? There is convertible, non-convertible. There is something called registered debentures and bearer debentures. So registered debentures means that the debenture will be registered in the books in a particular name. If it is issued to Ram, it will be registered as it is issued to Ram. That is registered debentures. Bearer debentures is what the debenture document, whatever is there, whoever is holding that document owns the share. Clear? Then there is something called first mortgage debentures and second mortgage debentures. So first mortgage debentures means they will have a benefit of repayment. So they will have benefit of repayment. They will have a security telling that in case of failure of repayment, they will have a security. First mortgage. Second mortgage means that already that security will have a liability. Over and above that, whatever amount is left after giving that security, that will be repaid using that will be used for repayment of your debentures. So that is called first mortgage debentures and second mortgage debentures. First mortgage debentures gets priority over other debentures. Clear? These are the types of debentures. Now this is the like some theory concepts discussed. Now let's come to accounting of debentures. There are entries first. So in case of debentures, similar to shares, debentures can be issued at par, right? It can be issued at premium. It can also be issued at discount. The shares can't be issued at discount. The debentures can be issued at discount. What do you mean? Issued at par means face value is equal to issue price, correct? What is premium? Issue price is greater than face value. What is issued at discount? Issue price is less than the face value, right? If the face value is 10 rupees, issue price issued at 12 rupees, issued at 10 rupees, then it is issued at par. If the issue price is 12, the face value is 10, then it is premium. If issue price is 8, face value is 10, then it is issued at discount. Clear? So this is about the issue. Whenever debentures are issued, the terms will be discussed at the beginning only, right? What will it be redeemed at? Redemption of debentures will also be decided. For example, there are debentures. When we always tell the debentures name along with interest. For example, it was some 9% debentures. When we say 9% debentures, it means that the debentures bear 9% interest rate. Clear? And let's say the period of debentures is 3 years. After 3 years, it will be redeemable. when we issue itself, we decide that what price it will be redeemed at. Correct? It can be redeemed at par, means if the face value is par, it will be redeemed at par. 10 rupees only will be given back to the customer. It can be redeemed at premium. What do you mean by redeemed at premium? Means that the face value is 10 rupees, but you are redeeming at 12 rupees. You are giving 2 rupees extra to the debenture holder at the time of redemption. Whenever we are telling that it is redeemed at premium, it is an expense to the company. When we issue at premium, the company is getting extra, but when it is redeemed at premium, the company is losing money. And it can be redeemed at discount. Redeemed at discount means what? Means the face value is 10, but we are redeeming at only 8 rupees. We took 10 rupees from him, but we are redeeming at only 8 rupees. So that's a profit for the company. Correct? It's a profit for the company. So whenever redemption is happening at par or premium, we don't have to worry about it. Because why? At the end, whatever will be redeemed will be at par, means whatever we have taken only will give, like it won't be excess, or sorry, not premium, discount, sorry, or discount. If the redemption is happening at par or discount, we don't have to worry. If it is discount, it is benefit to the company. We are telling that today we are telling that after 3 years it is a benefit to the company. In that case, we shouldn't record it. Why? Conservatism concept, right? Losses should be estimated, but profit should not be estimated. But whenever it is redemption is happening at premium, means after 3 years we might bear a loss, so that we'll have to record it. Clear? How will be the entries? See, we can divide the entries into 3 types. One, sorry. So whenever it is issued at par, for example, if it is issued at par and redeemable at par, or discount, we don't have to worry about the redemption when we are redeeming at par or discount. In that case, what will be the entry? It will be similar to debenture, how we receive applications. How will we receive? Bank account debit to debenture application account, and debenture application account debit to debentures account, whatever percentage debentures account. It's a liability. We'll credit debenture application. Whatever we recorded, we close it. So this is the entry. If it is issued at par and redeemable at par or discount. What if it is redeemable at premium? Whenever we say it is redeemable at premium, it means that after 3 years we'll have to pay extra. Correct? We will have to pay extra over and above that amount. In that case, what we do is this allotment entry will change a little. We'll close the debenture application account. It is issued at par, so same amount will be to debentures account. So debentures account will not change. So it is issued at par. The debenture application money received and debentures account will remain same. The extra what we'll have to record is, we'll have to create a reserve called debentures redemption premium account. Clear? What? This is a reserve that we are creating, which we are crediting. So this amount, whatever will be there, this will be the amount of premium on redemption. The net amount will be calculated and recorded here, and the same amount will be recorded on the debit as loss on issue of debentures. Loss on issue of debentures account. Clear? So whenever we are issuing any debentures which are redeemable at premium, we have to record the debentures redemption premium account, and that amount should be recorded as loss on issue of debentures. This loss on issue of debentures, whatever will be there, this will be written off to P&L over the life of debentures, over life of debentures. Clear? So these are the entries. Now the other two categories also similar, a little bit difference will be there. Let's discuss. Now if now par we discussed. Now let's say we issued at premium. Issued at premium means what? Issue price is more than the face value. Issued at premium. Whenever we issue at premium, it's a benefit for the company. What is the entry? Bank account debit to share application. Then share application account debit. Share application account debit. Share application account debit to debentures account. Debentures account should be at face value only, correct? The balance will be securities premium account. Clear? So this will be the case if it is issued at premium and redemption is at par or discount, correct? Redemption is at par or discount, this will be the entry, because you don't have to care about redemption if it is at par or discount. What if the redemption is at premium? Redemption is at premium. What is the change? Same thing as we discussed earlier. You have to record something called to debenture redemption premium account. To debentures redemption premium account, this will be a reserve. You will credit it. What will you debit? Loss on issue of debentures. Clear? Simple. Now this is done. What if it is issued at discount? The application will be same, bank account debit to whatever is received, we'll record it as share application. But if in discount, when it is issued at discount, we receive less money than the face value, right? Correct? So when we pass the allotment entry, it will be share application account debit. This will be lesser than the face value. Two debentures. Debentures will record at face value. So this will be less than face value. The difference, where will it pass? We'll record some same as when we record debenture redemption reserve, which will be loss on issue of debentures account. This will be written off over the life of the asset. This is the entry when debentures are issued at discount. But issued at discount and redemption at par or premium, this entry is fine. Par or discount. If the redemption is happening at par or discount, we don't have to worry. But if the redemption is happening on premium, the same thing should be recorded again. To debenture redemption premium account, which is reserve. The reserve amount will be recorded here, and this amount will be recorded on debit side as loss on issue of debentures. So this will be two things. One is, so what we are debiting here is two things. One is discount on issue plus premium on redemption. The whole amount will be written off over the life of the asset. Clear? This is total loss for the company because already you are issuing at discount, you are issuing at lesser price, and you are paying extra at the time of redemption. These are the entries. Just remember that issue is easy. Issue, if it is at par, simple entry. If it is at premium, record securities premium. If it is at discount, loss on issue of debentures. But redemption, if redemption is at par or discount, you don't have to worry. You don't have to worry about redemption. Only when redemption is at premium, you have to record something called debenture redemption premium account, which is a reserve, and the debit effect you will give it to loss on issue of debentures. Clear? Now let's do one question. Come to question number 21. Yes, question number 21 of study book. Modern Equipments Limited issued 4 lakh 12% debentures of 100. 100 is face value. This is the number of debentures issued. Interest rate is 12%. Clear? Payable as follows. How will it be paid? On application 30, on allotment 70. So it is issued at par, correct? Because it is issued at 100 rupees. 100 rupees is the face value. The debentures were fully subscribed and all the money was duly received. All the money was duly received. Then, just a minute. Then, as per the terms of issue, debentures were redeemable at 110. Redeemable at 110 means they are paying more than the face value, which is redeemable at discount. Correct? Record necessary entries regarding issue of debentures. What will be the entry? First, application money will be received. How much? 30 rupees into 4 lakh debentures. So 30 into 4 lakh is how much? 120 lakh. Right? 30 into 4. 120 lakhs will be received. What will be the entry? Bank account debit to 12% debenture application account. There it was share application. Now it will be 12% debenture application account, 120 lakhs. The amount is in lakhs. Next, then once it is received, it will be allotted. How will it be allotted? 12% debenture application account, you should reverse it and record 12% debentures account. So this will be the instrument. So you reverse the application money, same amount, and record the debentures. Next, when allotment money is recorded, you will record the debenture redemption premium. How will you record that? First, debenture allotment account. How much? 70 into 4 lakh, which is 280 lakhs. Correct? 280 lakhs you will record. Let us write the entry. 12% debenture allotment account debit. How much? 280 lakhs, right? And you'll record 12% debentures account 280 lakhs. This is done, but it is redeemable at premium. So we have to record debenture redemption premium account. So to debenture redemption premium account. How much? How much is the premium? 10 rupees, right? 10 rupees per debenture. So 10 into 4 lakh, it will be 40 lakh. The same amount is recorded as loss on issue of debentures account, 40. That's all is the entry. See, 12% debentures account, 12% debenture allotment account, 12% debentures account 280, and create the debenture redemption premium account of 40. Pass it to loss on issue of debentures. Next entry will be the allotment money will be received. So bank account debit to 12%, debentures account 280. Clear? Easy. Next, little Agrotech Limited issued 150 lakh 9% debentures. Agrotech Limited, 150 lakh is the quantity. 9% debentures is the debentures name. Then of 100 each. 100 is the face value, each at discount of 6%. So they are issuing at a discount, correct? Redeemable at a premium of 5%. So issuing at discount, it's a loss, and redemption at premium, which is also a loss. 5% means 5% of face value. So redemption price is 105. After 3 years, payable as 50 on application, 44 on allotment, and record the necessary journal entries. What will be the first entry? Bank account debit to share application account. How much? 50 rupees into 50 into 150 lakhs. Correct. 50 into 150 lakh will be 7,500 lakhs. Bank account debit to share application 7,500. Then application money will be recorded as debentures. Application money account debit to debentures, same account. Till then we are clear. Allotment, what will be the entry passed? Allotment, what will be the entry passed? One is what percentage is it? 9%. So 9% debenture application allotment account, debenture allotment account debit to 9% debentures account, right? I'll record. How will I record? 44 rupees, 6 rupees is discount, 6% is discount, right? So 6 rupees is discount. How will I record? So 44 into 150. 150 into 44 will be 6,600. 6,600, which is 150 into 44, will be debenture allotment. This will be receivable. But how much will be 9% debentures? 7,500. Correct? Why? Because we have to record at face value. 6 rupees is discount. Discount, how will we receive? Loss on issue of debentures. How much? Debit. Difference is 900. Right? 900. But also it is redeemable at premium. That you record to debenture redemption premium account. How much? Redeemable at 5 rupees per share, right? So 750. 150 lakhs into 5. So 750 lakhs. This you should add to loss on issue of debentures. So plus 750. So 1,650 will be the total loss on issue of debentures that you will record. Right? Correct? So this will be the entry. Check here. Debenture allotment account 6,600. Loss on issue of debentures 1,650 to 9% debentures to debenture redemption premium account. Next entry will be the allotment money will be received. Bank account debit to debenture redemption 6,600. Clear? So simple. Just be careful when the debentures are redeemable at premium. That's when you have to record that reserve. Otherwise, it's a easy topic, right? There are 2 more topics in debentures. We'll record that. One is interest on debentures. How will you record interest? Sorry. Interest on debentures. How will you record? How will you record interest on debentures? Interest on debentures for the company is what? Expense or income? It is an expense. So what will be the entry? Interest account debit. Expense will be debited to whom we have to pay that interest? To debenture holders. To debenture holders account. So whatever will be the interest amount, that will record it as expense and payable. So interest account debit to debenture holders account. We have to pay that amount. When paying that amount, debenture holders account debit, we'll pay that amount. But when we pay, we hold back something. To bank account, we'll pay a partial amount. What happened to this? We pay a partial amount. Why? There is something called TDS. What is TDS? Tax deducted at source. So it comes in your income tax. For here, just understand that whenever interest has to be paid, we have to deduct some amount which will be paid to the government. The company will have to deduct that amount we have to pay to the government. So whenever we are settling debenture holders, bank account will be partial amount. How much? Depends on the TDS payable rate. If they tell TDS payable is 10%, so 10% you will record it as TDS payable, the balance you will pay to bank. TDS payable you will have to pay. So the next entry will be TDS payable to payable account debit to bank. This company is paying to the government. Company paying to government. Just that this is not your expense. This is a tax, but it's not your expense. Why? You are deducting it from debenture holders. Whatever you have to pay to debenture holders, you are paying it to the bank, paying it to the government. Clear? Next entry. So debenture holders we settled, TDS we settled, interest will go to P&L. P&L account debit to interest account. The expense will be recorded in P&L. That's all. Clear with the topic of issue of debentures. One, only remember that whenever we are redeemable at whenever the debentures are redeemable at premium, we have to record a reserve called debenture redemption premium account, and it has to pass to loss on issue of debentures account. The remaining entries are fairly simple. Clear? They won't complicate it more than this. We did 2 questions. They won't complicate it more than this. So we are done with company accounts. We are left with special transactions and theoretical framework. Right? Right. The first topic in the special transaction is bill of exchange. Bill of exchange and promissory note. Right. So what is bill of exchange? First let's understand that. For example, A and B. A sold goods to B. B has to make payment to A. So rather than so if B doesn't have the money now, he wants to pay later. One option is by bill of exchange. How that bill of exchange works? One, so what is a bill of exchange? Bill of exchange is a document telling that this person, so B person, accepts to pay this amount to whoever holds this bill of exchange on this date, or after this time, after maybe 3 months, etc. And B will sign on this. Alright, it's just like a document where B is taking the commitment that he will pay on a certain date or after certain time. So how does this work? So this document, who draws this document is A. So A will be the maker of this document and he will be called drawer. So whoever has to receive that amount, whoever has to receive that amount draws the bill of exchange, and B, whoever has to pay, will have to accept that document. So he will be called acceptor. Alright. So how does this work? When B has to make a payment to A will draw a bill of exchange and ask B to accept that bill of exchange, accept the commitment. So B will sign the document and send it telling that, okay, I accept to pay this amount after maybe 2 months or on a particular date. Alright. So what can be done with this document? There are 3 options that can be done with the document. A can hold it till maturity. For example, this bill of exchange, particular bill of exchange for 3 months. Alright, so it says that after 3 months you can receive the amount from B. Now what A can do is, A can hold the bill, hold the bill of exchange. If he holds the bill of exchange, he will receive the amount after 3 months. Alright, after 3 months, B will make the payment, A will get the amount. That is one option. Other option is, he can discount it at bank. What do you mean by discounting? So the process of discounting means that, so whatever bill of exchange is there, A will go to bank. A will go to bank and say that, okay, I have this document, which is due after 3 months. You can receive after 2 months, but I need the money today. So he will ask the bank to pay him amount. How much will they pay? They will pay some amount. They, whatever bill amount is there, bill of exchange amount is there, they'll deduct some discount as their charges. So bank is paying today, but you will be bank is paying you today, but bank will receive after 3 months. So for that 3 months, bank will charge something called discount for that 3 months period, and the balance amount will be paid to A. All right. So this can be done if A wants the amount today itself. So this is one thing which is called discounting process. All right. So one more option is there. So one is hold till maturity. Second is discounting. That's third option, which is called endorsement. Endorsement. What does this endorsement means? For example, A has a creditor. All right. A made some purchases. A has a creditor, and A owes him some amount. Let's say same amount. B owes 10,000 to A. B gave a bill of exchange. A owes 10,000 to the creditor. Rather than accepting one more bill of exchange here, what he can do is he can give this bill itself to creditor, telling that, okay, I have to pay you 10,000 after 3 months. He has to pay me, B has to pay me 10,000 to me after 3 months. So better, like, also better take this bill of exchange, he will pay you after 3 months. So it can be, this is called that the bill is endorsed. Bill is endorsed. So after 3 months, what will happen? After 3 months, the creditor will get the amount. Clear? So what is A doing? A is just setting off his receivable and payable. So these three things can be done. So whoever holds the document, all right, whoever, it's called bearer instrument. Whoever bears the document, whoever holds the document will receive the amount. So whoever receives the amount is called payee. If he holds the bill, if A holds the bill, A will be payee. If bank is receiving, bank will be payee. And if the creditor is receiving, creditor will be called payee. So the three parties in the bill of exchange is maker, who draws the bill, he's called drawer. Then acceptor, whoever has to pay that amount will accept the bill of exchange, he is called acceptor. And whoever gets the amount ultimately is payee. So drawer can be payee, may not be payee. Clear? So this is how bill of exchange works. So the features are, it's an instrument in writing. It should be in writing. It should be in writing. It is an unconditional order to pay. It's an unconditional order. It has to be paid after a certain date. The three parties are drawer, acceptor, and payee. All right. What else is there? And drawer and payee can be same person, but like not necessarily, may not be the same person. All right. This is the bill of exchange concept. What is a promissory note? Promissory note. We are covering both, right? So bill of exchange, this is the process I told. What is a promissory note? It's a promise. So A and B, same example if we take. A sold goods to B, correct? A made sales. B has to pay, correct? So if B can't pay today, he will give a promissory note. He will give a promissory note. B will be the maker here. All right. B will be the maker here. He will give a promissory note to A, telling that B will make the payment after a certain amount of time. After some time, whatever is decided, after 3 months or on a particular date, etc. So this is an unconditional promise. Unconditional. That was unconditional order. This is unconditional promise to pay. And even this should be in writing. Clear? So here only two parties. Here there is no concept of endorsement or discounting. He will be the maker and A will be the payee. Clear? So the sums will be, the accounting will be like same for both. They'll give you as a bill of exchange itself, and you have to account for bill of exchange itself. So you don't have to worry much about promissory note. Just understand the concept. There is one more small theory concept called foreign bill of exchange. Foreign bill of exchange. So what is it? First is when it is drawn in India on a person outside India. When it is drawn in India on a person outside India and it is payable outside India. Alright. Second one is drawn outside India on a person outside India. And payable in India or outside India. These two cases is called foreign bill of exchange. When it is drawn in India on a person outside India and it is payable outside India. If it is payable in India, if it is drawn in India on a person outside India which is payable in India, that will not be foreign bill of exchange. And the second one is drawn outside India on a person outside India, and whether it's payable in India or outside India, it will be called a foreign bill of exchange. It's just a theory concept, might be asked in true or false. All right, next. So here I told you, right, in the concept. So B can agree to pay after a certain amount of time, correct? So if he says, for example, on 1st of January 2020, he says 1st of January 2020 he accepts the bill, let's say, and the bill says that the amount will be payable after 3 months. So how will you calculate after 3 months is the challenge. Now you have to see what wordings they give. If they give in months, from 1st of January 2020, 3 months, then 3 months in months if they give, then it will be 1st of April 2020, correct? For example, they don't give 3 months, they give 90 days. So in days if they give, you have to calculate. How will you calculate? Exclude the accepted bill. After that you calculate. How will you calculate? In January, how many days left? 30. February, be careful. Whenever they give a leap year, consider 29. Otherwise, consider 28. So 29 plus how many days do I want? 90 days. How many days more? 31 days I want. March is 31 days. Correct? So January 30, February 29, March 31st. So 31/3/2020 will be the due date. Clear? So if they give in months, you can just add the month here. So from 1st, 2nd, 3rd, 4th. So 1st of April. If they give in days, you have to count in terms of days. In both the cases, you have to add 3 grace days. In both the cases, you have to add 3 grace days. Then what will be the due date? In first case, it will be 4th of April 2020. Right? And in the second case, it will be 3rd of April 2020. Alright. So this is one. And one more is, if the due date falls on a public holiday. So if the due date is on public holiday, then take the previous day. What is a public holiday? For example, October 2nd, they say that it's a public holiday. If the due date falls after considering the grace days, if the due date falls on that date, take October 1st as due date. But if any other date, you can take the due date itself. If the due date is a sudden holiday or emergency holiday due to some strike or band, etc., in that case, what will you do? You will take the next day, because that you can't plan. So if any particular day it is a emergency holiday, then you have to consider the next day as due date. So this is the due date. You have to calculate the due date. All right, now let's come to journal entries. Journal entries. How will you calculate the journal entries? So journal entries depends on three things: whether it is held till maturity. If the drawer holds till maturity, what will be the entries in his books? So it's in the books of drawer, I'm telling right now. Held till maturity, or what are the two other options? Discounting, discounted with bank, or endorsed to a third party. Third party. It need not be a creditor only. It can be anyone. Endorsed to a third party. Then what will be the entries? Sale entry will remain the same. Whenever sale is done, sales remain the same. That doesn't change in all the cases. Next, when bill is received, when bill is accepted, when it is drawn, we don't pass any entry. Only when it is accepted, it becomes a bill of exchange. Correct? Only after acceptance, it becomes a bill of exchange. What will be the entry for this? So what will be the sales entry? First entry, same in all the cases. Debtor, trade receivable account debit to sales account. Correct? We are recording a receivable, we are recording the sales. Next, what will be the entry? Now bill is accepted. Now the debtor will pay you in form of bill of exchange after a certain amount of time. What will be the entry now? You will reverse the debtor account. Whatever receivable you have recorded here, you will reverse it. So to debtor account, and whatever bill has been accepted, that you will record as an asset. What will you record? You will record it as bills receivable. Bills receivable account debit to debtor account. Clear? All right. So in all the cases, it will be the same. All right. Whenever bill is accepted, we'll reverse the debtor account and record an asset which is bills receivable. Next. Now after the bill is accepted, he can hold till maturity. Correct? Or he can discount it, or he can endorse it. Right? Before maturity, he can discount it. So let's say he discounts it with bank. Discounts with bank. When he discounts, what will happen? We discussed the concept. The bank will pay you the amount today itself. So on the day of discounting, he'll record bank account debit. Correct? Bank account debit. He's getting the amount now. Right? He's getting the amount today itself. Is he receiving the total amount of bills receivable? No, he is not receiving the total amount of bills receivable. He is paying some discount. So the discount will be deducted by the bank and the balance amount will be paid to the drawer. So bank account debit, you have to close the bills receivable because you are discounting it. Correct? It won't be an asset for you anymore. Two bills receivable, but this will be total amount. Correct? Total amount of bill, but bank account will be partial amount because the bank will be deducting some nominal discount. Then discount is an expense for you, so you will record discount account here. Discount account debit. Expense should be debited, right? So bank account debit, discount account debit to bills receivable. Discount, how will they give you? They'll give you a percentage. For example, 10,000 is the amount. They might give you percentage or they might give you an amount. If they give you percentage, it will be on like per annum basis. You have to calculate it for so whatever bill period is there, you have to calculate it for that period and calculate the discount. Sorry, this will come where? So this entry won't come here. It's held till maturity, right? If it is held till maturity, this won't be the case. In case discounted, what will be the entry? Bank account debit, discount account debit to bills receivable account. Clear? Next, what if it is endorsed before maturity date? Endorsed to third party. What will be the entry? In case of held till maturity, there will be no entry. Here, no entry. In case endorsed to third party, what will happen? You have a creditor in books, that is getting reduced, and whatever bills receivable is there, that is closed. Correct? You are settling both creditor and receivable. So creditor or any third party account debit to bills receivable account. Clear? So in these two cases, discounting and third party, bills receivable is closed. So it's closed. Now on maturity, two things can happen. On maturity, two things can happen. The acceptor, whoever has to pay the bill, he pays, he settles the bill. What will happen? If it is held till maturity, he will receive the amount. Bank account debit to bills receivable, he'll close here in case he has held till maturity. If it is discounted with the bank will receive the amount, not us. So no entry in our books, right? And if it is endorsed to a third party, the third party will receive the amount. No entry in our books. Clear? But what if he doesn't pay? If he doesn't pay, it's called dishonor of bill. So if he pays, it is called honors the bill. What if he dishonors the bill, does not pay? If the acceptor does not pay on maturity, what will happen? If it is held till maturity, what will happen? Now bills receivable has expired, correct? It was for 3 months. Now it has expired. So we'll reverse it either ways. Correct? You will reverse it. But what will you debit? You will get the debtor back into the books. Debtor account debit to bills receivable. Correct? This is if you held till maturity. Now if you have discounted in bank, what will you do? If you have discounted in bank, will the bank go to the acceptor and tell that you have to pay? No. The bank will come back to the drawer itself. He'll tell that you gave me this bills receivable. He has not paid. Now give me my amount back. Alright. What will be done there? You have to pay the bank. How much you have to pay the bank? Will the discount be considered now? No. The total bills receivable amount will be paid to bank. So to bank, what will come as debit? Now bills receivable won't come because bills receivable has already expired. So debtor account. So debtor account will come back into your books and you will pay it to the bank. Now same, in case endorsed to third party and the acceptor doesn't pay to the creditor, the creditor won't go to the acceptor telling that okay, you have to pay me now. Correct? If he doesn't pay, he'll come back to the drawer telling that you gave me this bills receivable, you endorsed it, but he is not paying, so you pay me back. What will be the entry? So the debtors will come back into your books in the same way. Correct? Even the creditor will come back. You will again owe that creditor account. Now here you had settled. Correct? You had settled creditor, you had closed bills receivable. Now bills receivable is expired. So debtor will come back into your books and creditor will also come back into your books. Clear? Now this is in case of maturity. Clear? So these are the journal entries that will be there. Few other concepts will be there. One is renewal of bill of exchange. If the bill of exchange, if the acceptor doesn't pay on maturity and he wants to renew a bill, extend the period. Renew means extension of the credit period. He wants to renew the bill. What will happen? If he wants to renew the bill, for example, 3 months was original bill. After 3 months he comes back. And he says renew it for 2 months, means extend the bill for 2 months. What will you do? First you will close this original bill. All right, how will you close it? Same entry, debtors account debit to bills receivable. This bill you will close, and the new bill you will record. So, but when you record the new bill, you will charge some interest to him. For that particular period you will charge him interest, and the new bill will be recorded with an amount of sales amount, the original bill amount plus interest. So the new bill amount will be the amount of bill that was not honored on date for which you are extending, plus whatever interest is payable for 2 months. You have to calculate that and do it. But this can be avoided if he pays the interest on due date itself. So interest, when the renewal date, if interest paid by the acceptor in cash, on the renewal date he pays the interest. You know the interest, what will be the interest for 2 months. He pays the interest in cash. Then the new bill will be only for the sales amount, the original bill amount. Clear? So this should be the way of recording a renewal of bill. One more bill is there, retirement of bill. One more concept is retirement of bill. What happens in retirement of bill? So for example, original bill was for 3 months and he wants to settle in 2 months itself. Original bill was for 3 months, but the acceptor is ready to pay in 2 months itself. So in 2 months itself he is settling. What will be the entry? You will receive bank account debit, correct? But you will give him some rebate now, telling that okay, you are paying 2 months in advance. They'll give you the rebate percentage in the question. So you have to calculate rebate for how many months in this case? 1 month, because 1 month early he is paying, right? So you will record the rebate or discount account debit to, you will close the bills receivable. Clear? This is very easy. If you are receiving in, like if the bill is retiring soon, you will give some discount to the acceptor, and the partial amount whatever is received will be bank account debit. Discount you will record debit. Discount is a expense to you, so debit it, close the bills receivable account. Clear? One more concept is, what if there is insolvency? Insolvency means what? There is a bills receivable which the acceptor has to pay, correct? Acceptor has to pay. Acceptor is nothing but your debtor. Acceptor has to pay, but the acceptor becomes insolvent. What is insolvent? Means that he can't pay now. His liabilities exceeds the assets, so he cannot settle the bill right now. Insolvent means that he doesn't have money right now to pay. What will happen? The bills receivable will be closed and it will be passed to bad debts. Clear? So whenever insolvency happens, whatever bills receivable amount will be there will be passed to bad debts. There is one more question called accommodation bill. First let's do one question in bill of exchange. Question number 7 of the study book. Read the question. Mr. David draws 2 bills of exchange. Draws means Draws means Mr. David is what? Seller or drawer of the bill. Correct? He has to receive the amount. So he draws two bills of exchange on 1st of January for 6,000 and 10,000. So two bills is drawing on 1st of January 2020. The bills of exchange for 6,000 is for 2 months. So 6,000 is for 2 months, while the bill of exchange for 10,000 is for 3 months. So they have given the period in months. Tell me what will be the due date? For the first bill, what will be the due date? We have to calculate 2 months from 1st of January. So January, February, March, 1st of March plus 3 grace days. So 4th of March. So the due date for the first bill will be 4th of March. And there he is telling that while the bill of exchange of 10,000 is for 3 months. So what will be the due date? From January, February, March, April 1st plus 3 grace days. So 4th of April 2020. So these are the due dates for the two bills. Next, what is happening? These bills are accepted, right? Only when acceptance happens, will record the bill of exchange. Next, on 4th of March, 4th of March is what? The due date of the first bill. What is happening? Mr. Thomas requests Mr. David to renew the first bill. He is asking for renewal of the first bill with interest at 18% per annum for a period of 2 months. He is asking us to renew the bill and he is given the interest percentage also. Mr. David agrees to this proposal. On 20th March 2020, Mr. Thomas retires the acceptance for 10,000. So the first bill, what is he doing? He is extending it. He wants renewal. And the second bill, he is retiring. The interest rebate, that is discount, being 100 rupees. So here discount is given in 100 rupees and the balance amount will be received. Clear? Before the due date of the renewed bill, Mr. Thomas becomes insolvent. So before the due date of the renewed bill, the renewed bill is for 6,000. So 10,000 is honored. So 6,000 was renewed. So before that maturity, Mr. Thomas becomes insolvent. So Thomas cannot pay. And only 50 paise in a rupee could be recovered. He can pay, but only 50 paise in a rupee. What do you mean by 50 paise in a rupee? Half. Correct? 50 paise in a rupee. In 1 rupee means 50% of the amount can be recovered from him. Alright. You are to give the journal entries in the books of Mr. David. Mr. David is the drawer here. He wants you to give the entries. What will be the entry? So the first entry, he has to record two bills on what date? So the 1st of January it was drawn, and let's say the same day only it was accepted. So on 1st of January he'll record. What will be the entry? You have to close the debtor. Correct? Who's the debtor? On whom is he drawing? Mr. Thomas, right? Mr. Thomas. You have to close his account and record two bills of exchange. Correct? Two bills of exchange. What will be the entry? Bills receivable account debit number 1. You can combine and write, or better is to write it separately, because bill of exchanges are like two different treatments is happening for two different bills, right? So bills receivable account debit, two bills to Thomas account, right? See the narration, being drawing of bills receivable number 1 due for maturity on 4th of March, and bills receivable number 2 due for maturity on 4th of April. This will be the first entry. What's the next entry? On the due date of the first bill, which is 4th of March, Thomas requests Mr. David to renew the first bill. What will happen first? First, close the bill. Whatever original bill was there, that is not honored. So first, reverse that entry. What will be the entry? Mr. Thomas account will come back into books and you will close the bills receivable number 1 for the amount, original amount. Next, he wants to renew the first bill with 18% per annum for a period of 2 months. So what will be the interest? Interest will be 6,000 into 18% into 2 divided by 12. Correct. So this will be the interest amount that we'll have to record. Will he pay the interest now? It's not told. When it's not told, you you draw a new bill for the amount of original, which is 6,000. Correct. Original bill was 6,000 for this amount plus interest whatever comes for that amount as well. Clear? See the entry on 4th of March itself, the new bill is accepted. So bills receivable number 3, this is the different bill. Correct. Bills receivable number 3 to interest account to Mr. Thomas account. Interest is income for you here. Correct. You are renewing the bill. Interest who is paying? The acceptor is paying you the interest. So to interest account record the income, to Thomas account close. To Thomas account will be 6,000. Right. Interest comes to 180. Our calculation whatever is there, it comes to 180, and then 6,180 will be the amount of new bill. Clear? Next, they are telling the second bill of 10,000 which was there, the bills receivable number 2, is settled on what date? Is settled on 20th March itself with a discount of 100 rupees. If discount is 100 rupees, how much is received? 9,900 is received. So 20th of March, bank account debit 9,900. Discount is an expense for you. Correct. 100 to bills receivable number 2. Easy. Now, before maturity of the third bill, what is happening? Mr. Thomas become insolvent and only 50% is recoverable. 50% of 6,180. Correct. 50% of 6,180. So, first the bill will be dishonored because he is not paying, he is not settling the bill. So record Mr. Thomas account to bills receivable 6,180. Right. Then Thomas account you have to close. How much? So this one entry also you can pass. Thomas account 3,090 will be received and 3,090 will be bad debts. Clear? So this one entry also you can pass. Bank account debit, bad debts account debit to Mr. Thomas account. Clear? Clear with the entries? Clear with the entries? In exams they will be asking you journal entries itself. Just take care of the due date, when it is due, calculate the interest rebate properly. In case if it is discounted also, you will get discount, calculate that and pass the necessary entries. Clear? Now there's one more concept of accommodation bills. We will discuss the concept. Accommodation bills. We'll discuss the concept. There are questions. Practice. Alright. Accommodation bills. What is accommodation bill? So the situation we discussed earlier was when sale is happening. A is making a sale to B and B has to pay. Rather than paying, he'll issue a bill of exchange. Correct? Now, what if sale is not there, but they want the amount? So A and B are in need of credit. They are in need of amount. They want a loan, but they are not getting the loan from bank. Then they can think of something called accommodation bill. What happens in accommodation bill? For example, two parties are there. These two people want a loan. For example, they want 5,000 each. Those two people want 5,000 each. Then what will happen is one of them, any one of them, will draw a bill of 10,000. 5,000 plus 5,000. 10,000 is required, right? So A will draw a bill for 10,000. He will draw and send it to B. B will accept. Drawer. He will accept it for 10,000. Right? So A will tell that, A will draw a bill of exchange telling that B has to pay A a certain amount after 3 months, let's say. After 3 months. Now A will have a bills receivable. He will go to bank with it. He will go to bank and get it discounted. Let's say out of 10,000, some 500 was discount. Okay. 10,000 was the bill amount. 500 bank charge discount. So 9,500 they get. Who will get 9,500? A will get 9,500 from bank. 9,500. They both are in need of loan. So what will A do is half of this. Why half of this? Because the discount expense whatever is there, 250 will belong to A, correct? And 250 should be borne by B. So half of it, which will be 4,750. 4,750 will be sent to B. 4,750. And A will have the remaining 4,750. Correct? So A will also record in the discount here. A will also record. B will also record the discount here. Alright. Then on maturity, what should happen? On maturity, B has to pay to bank. Correct? B has to pay to bank. How much? 10,000. Correct? B has to pay him. B has to pay to the bank 10,000. He will collect the amount from A 5,000. He will put his amount 5,000 and he'll pay it to bank. Clear? This is the concept of accommodation bill. So if they want a amount for 3 months and they're not getting the loan, they can enter it to a transaction like this where a bill is drawn but there is no sale. Bill is drawn, it is discounted, amount is shared between them, even the expense is shared. Even the discount of 500 whatever is there, A records 500 as an expense, 250 as an expense and B records 250 as an expense. Alright, clear? We are done with bill of exchange. The entries for acceptor, what will be the entries for acceptor? We discussed the entries for drawer. What will be the entries for acceptor? When bill is accepted, what will be the entry? It is bills payable for him, correct? For acceptor, it is bills payable and he'll have a creditor in books, correct? So creditor he'll reverse, creditor account debit to he'll record bills payable. Correct? This is the entry. Now, for if the drawer endorses it or discounts it, it doesn't matter to the acceptor because like it's not concerning him, right? He has to pay after 3 months. 3 months he is not bothered. So after 3 months, so after whatever period at maturity, on maturity, what will be the entry? He'll have to pay. So he'll close bills payable account debit to bank account. Clear? So if he's paying, he'll record this. If he dishonors, means he is not able to pay now, he'll record an entry which is he'll close the bills payable account debit. The creditor will come back into the books. Clear? So this is the entries in case of acceptor. The entries will be these. We are done with bill of exchange, guys. Done. Next chapter, sale of goods on approval. Very simple topic, simple and small topic. So the concept is something like the seller, for example, A sends goods to B. For example, he is purchaser. A sends goods. So the possession will be given to the purchaser. Possession will be given, but it won't be considered as sales because A will give an option that you can either accept it or reject it. For example, seller tells that I give you 1 month time. Either accept it or reject it. So B can either accept it or reject it. Clear? When he accepts, it will become a sale. Clear? Or after 3 months, expiry of this period, it will become a sale. Alright? Clear? So if he rejects, obviously it's not a sale. How the accounting will happen for this is, whenever goods are sent to purchaser, So for example, A is sending to B, right? So the entry will be normal sales entry. Entry will be sales entry. What is the sales entry? Debtor account debit to sales account. Now let's take this example only. We'll pass the entries. Now example, he sends goods of 10,000. Sends goods worth 10,000 to B. So the first entry will be, you will record the sales in your books when the goods are sent. This is when goods are sent. Clear? Now he can either accept or reject. For example, he accepted 5,000 worth of goods. When he accepted, when the goods are accepted, what entry will you pass? You won't pass any entry. No entry. Because you already recorded the sales. You already recorded debtors. So you won't pass any entry. If goods are rejected, you have to reverse the entry. Correct. If goods are accepted, there will be no entry because sale you have already recorded when the goods were sent. When rejected, what will be the entry? You have to reverse it. So sales account debit to debtors account. Now let's say 5,000 were rejected. So 5,000 were rejected. So what is your net sale? Only 5,000 because you recorded a sales of 10,000. You reversed 5,000. Your net sale is 5,000. Which is the amount of goods accepted. Clear? Now it can happen that goods are accepted at a higher or lower price. Means when the goods were sent, we told that the goods are worth 10,000. Now let's say they are ready to accept the whole lot. They are ready to accept 10,000, but they want it at different price. Now what if they want it at 9,500 and what if they want it at 10,500? What will be the entry? If it is 9,500, you have to reduce the sale amount, correct? So you will pass sales account debit to debtor. You will reverse the sale to that extent. Clear? What if it is extra? You record the extra sales, which will be debtor account debit to sales. Clear? These are the entries. Next, so this is when goods are accepted or rejected at year end. Now let's say in the same example, let's say this 10,000 goods, whatever is there, the 10,000 goods are it's not neither accepted or rejected at year end. So for example, we sent the goods on 29th March. We sent the goods on 31st March. We have to close the books, but neither the goods are accepted nor rejected. What will be the entries? You can't record that as sales now, right? When you sent the goods, you would have recorded this entry, right? When you send the goods, you would have recorded this entry, debtor account to sales account, but you can't record that as sales at the year end when you are issuing financials in your P&L. That shouldn't come as your sale because the sale is not completed. When will the sale be completed? When the goods are accepted. When the sale is not completed, you have to reverse the entry, right? So you will reverse the entry first. So the first entry will be reversal of sales. Sales account debit to debtor account. Clear? So this will be one. Second one is on 31st March closing inventory will be calculated. But will that closing inventory have the goods which are sent on sale? No, right? Because those are not approved, but those are still with the customer. Those are like pending approval. Those are still with the customer. So when you are calculating your inventory, closing inventory, it's not coming. So that you have to record separately. How will you record that? Inventory is an asset. So inventory with customer. Inventory with customer, you will debit inventory. But inventory should be recorded at what price? Inventory, basis of valuation, cost or NRV, whichever is less. Now the sales was, now sales which was 10,000, correct, 10,000 was the amount. 10,000 was what? 10,000 was the sale price, correct. But the inventory should be recorded at cost, correct. So from 10,000 you should remove the profit element. Remove the profit from the sales, calculate inventory and record the cost. Now for example, they gave that the profit percentage is normally 20% on selling price. So 10,000 minus 20%, 8,000. 8,000 inventory, you will pass it to trading account. Clear? To trading account. So in trading account, you will get a closing stock by inventory with customer. 8,000 you will get, right? And inventory with customer, whatever debit balance remains will go to balance sheet. So this will go to balance sheet and this will go to trading account. Clear? So these are the entries on for sale on approval basis. That sale is done, but the customer can either choose to keep it, which will be accepted, which will be acceptance, or rejected, in which case we will have to reverse the sales. So this is one. So normally this is the question that will be asked. There are few other concepts that can come. One, so this is when, like, so for example, it is done in case of one customer, one or two times, you can record this entries like this individually. But if it is done frequently, if goods are sent on approval basis frequently, then there are some other records that we have to prepare. What are those records? One is sale or return day book. Sale or return day book. So it's similar to like subsidiary books, where whatever goods you are sending, because it is frequent, it will become difficult to keep a track. So for that, you will prepare something like this, and the format will be something like this. You will have date on which the goods are sent, the customer name, the customer details. So who is the customer to whom you are sending the goods, ledger folio number of the customer, then what is the amount of goods sent, amount of goods sent. Then you will have what is the accepted goods, what are the rejected goods. For example, on day 1, 1st of January, to Mr. X, you send some 10,000. So out of which how many are accepted, how many are rejected, and you will have date of acceptance or rejection. Clear? On what date, what has been accepted, what has been rejected. So this is the format of sale or return day book. Clear? Next, sale or return account. So this is like a ledger which will have to record. The entries will be something like this. So this is to manage the inventory. All right. So whenever goods are sent, you will record it as on credit side by goods sent on approval basis. All right. What will be the entry? Goods sent on approval basis to sale or return account. Correct? It will be like an asset. So this will be the total amount of goods sent. Entry will be goods sent on approval basis to sale or return basis. Next, whenever sale or rejection happens, both will come here to sales account. What will be the entry? When sale is happening, acceptance, the entry will be sales account, sale or return account debit to sales account. So this will be the amount of accepted goods and to returns. So this will be the amount of rejected goods. So you have goods sent on approval basis, you have what is accepted, what is rejected, whatever balance is comes here, balance carried down. What will be this? This will be pending approval. Clear? These will be the goods which are neither rejected nor accepted and which are still lying with the customer. Clear? There are 1 or 2 questions in the study material. Practice it. It's like fairly simple. You will understand. And what will happen to the individual customer account? Individual customer account, what will happen? Individual customer account, for example, X is the customer. What will happen? Whenever the goods are sent, it will become receivable from the customer. Correct? Whenever goods are sent, it will become receivable from the customer. So we have to debit the ledger. So to sale or return account. To sale or return account. This is when goods are sent. Right? The amount. And whenever accepted or rejected, his balance will close. Right? By sale or return account. This will be the amount of goods which are accepted or returned. Both will be recorded here. So here balance whichever is comes is your pending approval. The goods which are still lying with the customer. Right? So these ledgers are prepared to manage the inventory. That from whatever we have sent, how much are still pending. So this will be the total goods, like this will be for the total inventory which is sent on approval basis, and individual customer wise this will be the ledger. There are 1 or 2 questions in the study material. You can practice it, but mostly they'll ask these entries. They'll mostly ask it's not that important. Rarely they ask a question. If they ask, they'll ask this, which is fairly simple. When the goods are sent itself, you record the sale. If they are accepted, there will be no entry. If they are rejected, then you have to reverse the entry. And at the year end, you have to reverse the sales because you can't record the sales in the books, and you have to record the inventory at cost. That is important. You have to record the inventory at cost only. Clear? You have to remove the profit element and you have to pass this entry, inventory account debit to trading account. Clear? So this is that with sale on return. Next, consignment. Next topic, consignment. So what does consignment mean? So consignment is not a transaction between seller and buyer. It's a transaction between seller and agent. It's an arrangement where the seller, like if seller cannot reach to customers in large, he will hire agents. And he'll send the goods to them, who will ultimately sell it to the customer. So the seller is called consignor, and agent is called consignee. So what happens is seller will send the goods to agent. All right, the sale is not happening there. Sale has not come into the picture when the goods are sent. Who bears the risk of the goods? The seller itself bears the risks. The possession will be given to agent to make the sale to the customers. But who will bear the risk of the goods? The seller itself. What will agent do? Agent will sell the goods to Agent will sell the goods to customer. That's when sale happens. Clear? Agent will sell the goods and agent will give the amount then. Agent will give the amount, whatever amount of like consignment is there, the agent will give it back to the seller. And this is the basic arrangement. Now few more things will come into the picture. Now when seller sends the goods to the agent, he'll give something called, he won't give an invoice because it's not a sale. He will give the invoice only to the customer. The seller will give the agent something called pro forma invoice. Pro forma invoice. It will have the details of all the goods which are sent. And the agent when he's sending the amount, whatever he has collected from customers, he'll send it to the seller. When he's sending the amount, he'll send something called account sales. Account sales. So account sales is a document. In this account sales, what all will be there? One is the amount of sales, correct? The amount of sales which happened, right? The basic arrangement is to make the sale. So amount of sales. He might have incurred any expenses, correct? So agent might have incurred some expenses. He might have rented a go down. He will be paying rent, electricity, etc., etc. So whatever expenses are there, those details will be there. Commission should be paid to the agent, right? To the consignee, commission should be paid because he is making those sales. So those commission has types. Commission has 3 different types. One is ordinary commission. Commission has 3 types. One is ordinary commission. Ordinary commission means it is a percentage on sales. If the agent made a sale of 1 lakh and the commission percentage is 2%, ordinary commission is like percentage of 2% of 1 lakh, which is 2000 will be his commission. One will be del creditor commission. Del creditor commission. So del creditor commission, when del creditor commission is paid, even this will be a percentage only, but it will be generally a higher percentage. Why? So when del creditor commission, normally when agent sells to the customer, if he makes a credit sale, if he makes the sale to customer credit on credit and the customer doesn't pay to agent, right? The customer doesn't pay to agent. Will agent bear that expense? No, it's bad debt, but bad debt of the seller. It's a bad debt of seller, not the agent, when the customer doesn't pay. But whenever del creditor commission is paid, the bad debt will be of it will be a bad debt of agent. So if the customer doesn't pay, the agent should bear the expense. So whatever sale he is making, he should pay that amount to the consignor. If he is not receiving any amount from customer, it doesn't matter. The seller should get that amount. The consignor should get the total amount of sales. The bad debts will not be, the bad debts should be borne by consignee itself. That's del creditor commission. The third is overriding commission. Overriding commission. Overriding commission is like if the goods are sold at a higher price. If the goods are sold at a higher price, then so whatever excess will be there. So for whatever excess price he has sold, on that some percentage will be given. So this so what is the overriding commission? They'll give you clearly in the question. All right. So the commission is of 3 types. Account sales, it will include sale details, expense details, and commission. What else? Bad debts, etc. So whatever is relating to the arrangement, whatever arrangement is there, sale, expenses, bad debts, etc. all those details will be sent to the consignor. All right. This is how consignment works basically. All right. So for accounting in the consignment approach, we follow we prepare a ledger, consignment account. when we're preparing this, we are preparing this ledger. So it is similar to like P&L account. So all the goods sent, sales, closing stock, everything is decided here, and ultimately the net profit from consignment is sent to the P&L account from consignment account. All right. So consignment account is it's not like P&L account. It's similar to P&L account, where the profit from consignment is decided in this ledger itself, and then it is passed to P&L account. Now what will be the entries? What will be the entries in consignment account? We'll discuss the entries and post it here. Then we'll do one question. So whenever goods are sent to the consignee, whenever goods are sent to the consignee, we'll pass an entry consignment account debit to goods sent on consignment account. So it starts with goods. So whenever goods are sent to the consignee on consignment basis, the entry will be what? Consignment account debit to goods sent on consignment account. So to goods sent on consignment account. Correct? Whatever value of consignment you have sent, you will record that. That is first step. So the goods are sent to the consignor. Whenever the goods are sent to the consignor, the consignor itself will pay some amount. For example, for sending the goods, he paid some freight himself. So consignor, whatever he pays, so it will be paid by him. So bank will reduce. So to bank, right? Debit, what will you do? You won't do expense. So if it is freight paid by consignor on the goods sent on consignment, the entry won't be freight account debit to bank account. To bank account, yes, because bank account is reducing. You will debit consignment account only, because all the expenses and income will be recorded in consignment account itself. So to bank account, this will be the expenses paid by consignor. Clear? So goods are sent on consignment. Expenses are paid by consignor. Whatever paid by consignor will be recorded in consignment account itself. Now after the goods are sent, the agent will make the sales. Once the goods are sent, and he bears the expense and sends the goods. So now consignor's part is done. Now consignee, what he does, he starts selling the goods. After some maybe monthly or annually, he'll send a report called account sales. Correct? Account sales will contain details of the sales, expenses, etc. When he sends, for example, he sends the account sales, it says that, okay, this is the amount of sale made. If he says that this is the amount of sale made, what will be the entry? Whatever sales he has made, that amount he has to send it to us. Correct? He has to send it to the consignor. So his account will be debited. Correct? Consignment account is different from consignee account. Alright. This is consignment account. For example, Mr. X is the consignor. Then the ledger will be called consignment to Mr. X account. The ledger will be called consignor to Mr. X account. Now Mr. X, for whatever sales he has made, he has to pay us the amount. Correct? So to record the entry, if it is receivable from Mr. X, we'll debit his account. Correct? So Mr. X account debit to consignment account. Mr. X account debit to consignment to Mr. X account. Clear? Mr. X is like a debtor here, that he has to pay us the amount. The customer won't pay. He has to collect it from customer, and Mr. X has to pay. So Mr. X account debit to consignment to Mr. X account. So by consignee account. Here it is Mr. X will record. What is this? This is the amount of sales made. Clear? What else will be there in the account sales? There will be expense details. Correct? So expenses, what should we do? Expenses we have to pay to consignee, right? So his account should be credited because we owe him, we have to pay him. So his account will be credited and will debit consignment account. So consignment to Mr. X account, debit to Mr. X account. Clear? So to consignee account, to consignee account, this will be the expenses paid by whom? Expenses paid by consignee. Clear? So the expenses will include bad debts itself. Bad debts won't be included if del creditor commission is paid. Clear? Now expenses will be sent. What else will be there in account sales? Commission details. We have on whatever sales is made, we have to pay commission. Correct? What will be the entry? It won't be commission account debit. It will be consignment to Mr. X account, debit to Mr. X account, because it is payable to Mr. X and will debit consignment account, because all the expenses and income of consignment should be recorded in consignment itself. So entry will be again to consignee account. This will be commission. Clear? So account sales is sent. So we sent some goods, Mr. X sold those goods, he'll send whatever are the expenses, the balance will be profit. Correct? But before recording balance as profit, we'll have to record the closing stock. If all the goods are sent, then well and good. Goods are sent on the what are goods? These are the goods sent on consumer. This is the sales made, and the difference is profit. But if there are some goods left, you have to record that as inventory. Correct? Matching concept, similar to trading account. Yes. So you have to record inventory. How will you record that? Sale or return basis we passed, right? Similar way. What will you record? Inventories on consignment account. Inventories on consignment account debit to, you won't pass it to trading account, no, because I said all the incomes and expenses will be recorded in consignment account itself. So the entry will be inventories on consignment account debit to consignment to Mr. X account, to consignment to consignee account, whatever it is. So buy inventory on consignment. Consignment account. Clear? So when inventory is recorded, then you have whatever are the goods sent, you have sales, you have all the expenses, the difference will be profit. The profit will be sent to P&L account, to profit and loss account. This will be profit on consignment. So if credit is excess, it will be profit on consignment. Otherwise, by P&L, loss on consignment. Clear? Clear with the accounting? Yes. Yes. So this is when the goods are sent, if they are sent at cost price only. For example, let's say the goods sent on consignment are sent on cost. For example, 10,000 is cost. All right, 10,000 is cost. Is sent at cost. So in the pro forma invoice, when he sent it at cost only. Then this approach is fine. All right. Sometimes it won't be sent on cost. What will it be sent on? It will be sent on something called invoice price. Invoice price is nothing but they'll add some profit element. Is this profit realized? No, this profit is not realized. This profit will be realized only if the goods are sold. But the profit will be added so that maybe sometimes they don't want to disclose the cost to the consignee. So to the agent, they don't want to tell how much is the cost. So what will they do? They will add the profit, which is called loading. Because it is not realized, we call it loading. So we add some loading. Let's say 20% on cost. Let's say loading is 20% on cost. The invoice price will be 20,000. Clear? Normally, if it is sent on cost, no, goods sent on cost will be the cost only 10,000, and inventory will also, the closing inventory will also be cost only. Now let's say 50% of goods are sold. All right. So goods sent will be 10,000. 10,000. Let's say 50% of goods are sold at 20% profit. So 20% profit is, now for example we are doing this, 20% profit is 50% of goods are sold. So 5,000 worth of cost of goods are sold for 6,000 and the closing inventory is 5,000. Right? If the goods are sent on cost, this is great. But when the goods are sent at loading, you have to record, the invoice price will be how much? 12,000. Correct? The invoice price will be 12,000, which is 10,000 plus 20%. So when the goods are sent at loading price, then it will be goods sent on consignment 12,000. Sales will be 6,000. The inventory on consignment will also be 6,000. All right. So how you are recording it is, you are recording the loading. But is it right? Why? There's a concept called conservatism concept. What does it say? The estimated profits should never be recorded. The estimated loss can be recorded. Estimated profits should not be recorded. Now we send the goods on consignment. Half of them are sold. 6,000. That is fine. But the closing inventory is how much? 6,000. Correct? Can we show that as 6,000? No, because our asset value is how much? 5,000 only. So we have to reverse the asset. So in case the goods are sent on loading, the loading should be removed from two places. All right. So for whatever goods are sent on consignment, the total for the total goods, the loading should be reversed. All right. So the how will be reversed? Same entry you have to reverse it. So what was the entry when goods were sent? Consignment account debit to goods sent on consignment. To reverse the loading at the year end, you will pass goods sent on consignment account debit to consignment account. So by goods sent on consignment account. How much? This is the loading. It will be 2,000. Correct? 12,000. The loading is 2,000. One more thing is, on inventory it is 6,000 here. You have to remove the loading. So on debit side you will record to something called inventory reserve. This will come in your reserves. This will go to balance sheet. Inventory reserve. This will be the amount of loading on closing stock. So on closing stock, how much is the loading? 20% of 6,000. 20% on cost. No, it is. So 6,000 is 120%. How much will be 20%? It will be 1,000. So inventory reserves 1,000. Now if you see, when we do this, the net effect will be same as before. Correct? Here you are recording 12,000. Here you are reducing 2,000. Your net amount is 10,000 only. And here inventory you are recording 6,000. Here you are reducing 1,000. So the net effect is 5,000 only. Clear? So whenever the goods are sent on loading, if in question, how will they say this? They will tell invoice are sent on invoice price or including profit, etc. So whenever that happens, you have to record it at invoice price. You have to give two effects. One is loading on credit side. You have to remove loading of the whole goods, total goods, and debit side you have to remove the loading of closing stock. Clear? So this is one concept. There are a couple more concepts. So commission we already discussed. It will be ordinary commission, del creditor commission, and overriding commission. There are one more concept, which is loss of goods. Loss of goods. Now when the consignor is sending the goods to consignee, there are chances where the goods might be lost or damaged, etc. If that loss is, the loss can be two types: normal loss, abnormal loss. So normal loss is avoidable. Normal loss is avoidable. How is it avoidable? So for example, you buy a box of mangoes. You bought. It has 12 mangoes, a dozen mangoes, 12 mangoes. But the seller says that when you buy the goods, the seller says that there's a chance that 2 mangoes will be damaged. Normally in cases, 2 mangoes will be damaged, 10 will be good. Now, for example, let's say you bought this box for 120 rupees. 120 rupees you bought the mangoes. How much should be cost per mango? It should be 10 rupees. Correct? For 12 mangoes you are paying 120. So the cost per mango, cost per unit should be 10 rupees. But he's telling that the normal loss, there is a high chance that 2 mangoes will be damaged, will be spoiled. So you can't eat that. So that is like waste. So when you buy itself, you know that unavoidable is 2 units. So 2 units you might not get. You might not enjoy the 2 mangoes. Then what will happen when you can't enjoy that benefit? You have to assume that you will get only 10 units. Correct? 12 units, 2 is normal loss. So 2 mangoes you are not getting. You are getting only 10 mangoes. When you are getting 10 mangoes, the cost per unit will become 12 rupees. So if the cost doesn't, if the damage doesn't happen, ultimately you get 12 mangoes only. The cost will still remain 10 rupees. But if up to 2 mangoes, the damage has been done, it's not your loss because you won't record that loss because it's normal. It's unavoidable. So the cost per unit will increase. The cost per unit will increase because the normal, what is normal realizable units? 10 only. So if you get 10, it will be normal loss. So in this case, no entry has to be passed. If it is a normal loss, like it is unavoidable, you don't have to pass any entry. What is abnormal loss? It is avoidable. Could have been avoidable. Some like unfortunate events happened and there was loss of goods. In this case, we should pass an entry. What if the question is silent whether the loss of goods is normal or not abnormal? Assume it is abnormal only. Correct? If they have normal loss, they'll give you loss. Correct? If they have not given anything as normal loss, consider it as abnormal loss only. So for abnormal loss, we should record. Correct? So consignment account, if you see, we have sent some goods worth 12,000. He has sold some. We have closing stock. Now, what if some goods are lost, which is abnormal loss? You will pass an entry. So the journal entries will be abnormal loss account debit to consignment account. Now, I said that any expenses that you bear, you shouldn't record an expense in P&L, but you are recording abnormal loss account debit here. Why? Because it's not related to consignment arrangement. Correct? If you record the abnormal loss also in the consignment as an expense, it will be wrong because like it's abnormal, because the consignment profit will have abnormal loss also. It won't be your correct profit. Correct? Because of some, for example, some flood, some goods were lost. It's not the consignment arrangements loss. Correct? Even in trading account and P&L account, if you see, any abnormal loss should be recorded in P&L, not trading account. Correct? Even here, it should go to P&L and not consignment account. Consignment is similar to trading account, where you are calculating what is the profit from the consignment arrangement, from the consignment business. Clear? So journal entry will be abnormal loss account debit to consignment account. Why are we crediting consignment account? Because we have recorded some goods sent here. Correct? But out of that, some are damaged. To give that effect, we will record. So the posting here will be by abnormal loss account, and this should always be at cost. So even if the goods are sent with loading, it should always be at cost, because loading you are removing here, no? So this should always be at cost. Clear? So the journal entry will be abnormal loss account debit to consignment account. Then abnormal loss will be passed to P&L account. P&L account debit to consignment account. Clear? Clear? So in some cases, this can be the abnormal loss, whatever has happened, this can be claimed from insurance company as well. So abnormal loss has happened, general insurance we had taken, okay, that can be claimed from insurance company. If it can be claimed, what will you do? You won't pass it to P&L because it's not a loss. It's not a loss right now because we are getting that amount. When we are getting that amount, it's receivable from insurance company. So insurance company account debit to, not consignment. Sorry, this was not consignment, abnormal loss. Sorry about that. So you will pass abnormal loss account debit, abnormal loss to P&L. And here it will be insurance company account debit to abnormal loss. Clear? So this will be the entry. What if partial amount will be reimbursed by insurance company? Then it will be insurance company account debit, whatever can be recovered. P&L account debit, whatever cannot be recovered is your loss, to abnormal loss account. Clear? This is the accounting for abnormal loss. Now we are done with almost all the concepts. Let's do one question in consignment. Question number 4 in the study book. Yeah, read the question. Nike Sports Company of New Delhi consigned 100 shoes to Adidas Co. Who's the consigner? Nike Sports is the consigner. Correct? Consigner. And who's the consignee? Adidas Co is the consignee. So they consigned 100 shoes to Adidas Co. Then of Ahmedabad costing 1500. Invoiced at 2000 each. Means it is sent with loading. Correct? Sent at 2000 each. Invoiced at 2000 each means they have sent at invoice price. So 2000 into 100 will be the goods sent on consignment. Next, the consignor paid freight 10,000. The consignor paid freight 10,000. Insurance in transit 1500. Who is paying? Consignor is paying. We have discussed how the entry will be. During transit, 10 shoes were totally damaged. Normal or abnormal? They have not told anything. So abnormal. The next, Adidas Co took delivery of remaining shoes and paid 1530 for octroi duty. Then Adidas Co, for how many goods he paid that 1530? For the remaining shoes. What were the remaining shoes? 100 were sent, out of this 10 were lost. So for 90 shoes he paid 1530. Clear? Adidas Co sent a bank draft to Nike Sports Company for 50,000 as advance. So when they received the consignment itself, Adidas sent a bank draft. By bank he sent 50,000 as advance, and later on sent an account sales showing 80 shoes had been sold at 2,200 each. So he sold over and above the invoice price. The cost was 1500. The invoice price was 2000. He sold at 2,200 each. Expenses incurred by Adidas Co on go down rent 2000. Adidas Co is entitled to a commission of 5% on invoice price. What is invoice price? 5% of 2000 each. Invoice price of 2000. 25% of any surplus of sale price over invoice price. Invoice price is 2000. 25% of surplus of sale price they are telling. What is surplus? 2200 minus 2000. 200 is surplus. Clear? No? 200 is surplus. On that 25%. What else? Insurance claim was settled at 14,000. So how many shoes were lost? 10 shoes were lost. Out of that, so 10 shoes were, cost was how much? 1500 into 10. 15,000 was the abnormal loss. How much was settled? 14,000 was settled. So net P&L how much will go? 1000 rupees. So they want us to prepare consignment account, consignees account, and related working notes in the books of Nike Sports. So consignors books they want. Clear? Now let's go point by point. First, they want us to prepare consignment account. Prepare consignment account. So consignment account, will tell it as consignment to Adidas account. Correct? Consignment to Adidas account. So first, they sent how many shoes? They sent how many shoes? 100 shoes of 1500 is that, but 2,000 each was the invoice. So they sent with loading. What will be the entry? Consignment account debit to goods sent on consignment account. Consignment account debit to goods sent on consignment account. What will be the entry? 2 goods sent on consignment account, 2,000 into 10. Correct? 2,000 invoice price into 10. 2 lakh rupees was the goods sent on consignment. Next, they sent the consignor paid freight of 10,000 and insurance of 1,500. The consignor sent what? Freight of 10,000 and insurance of 1,500. What will be the entry? What will be the entry? Consignment to Adidas account debit to bank account. So to bank. What is it? Freight and insurance. 10,000, 1,500. Clear? 11,500. Next, what is happening? Next, during transit, 10 shoes were totally damaged. Clear? So let's calculate what will be the abnormal loss. What will be the abnormal loss? How much was the cost? Abnormal loss calculation. Listen carefully. So what will be the cost? Cost of 10 shoes. 1,500. Correct? 1,500 into 10 shoes. 15,000 is the cost. Is 15,000 is the cost? That's all? No. Because the consignor paid freight and insurance as well. Freight and insurance and in transit he paid how much? 10,000 and 1,500. 11,500 he paid. Correct? Which are expenses? Expenses, freight and insurance. 11,500 he paid for how many goods? For 100 goods. But how many were lost? 10 were lost. So that expenses, even that will be considered as cost of inventory. What all comprised of cost of inventory? Cost of purchase, cost of conversion and other costs. What are other costs? Any other costs incurred to bring the goods to present condition and location. Correct? So for consignment, whenever they have sent, even that has to be the cost incurred on inventory. Correct? So what will be this? 1,150. Correct? This will be the cost of abnormal loss. 16,150. Clear? What will be the entry? What will be the entry? We discussed abnormal loss account debit to consignment account. So by abnormal loss account. By abnormal loss account 16,150. Clear? We recorded abnormal loss. We are done. Next, what is happening? Adidas Co took delivery of remaining shoes and paid 1,530 for octroi duty. That will consider when we record the sales. Correct? When he spent, we won't record. Once he sends account sales, then we'll record. Adidas Co sent a bank draft to Nike Sports for 50,000. So Adidas Co has a bank draft. What will be the entry? The consignment account won't be bothered by this entry. What will be the entry? So Adidas Co has sent, we have received. So bank account debit to Adidas Co account. We have to prepare that as well, right? Consignee account. Correct? We have to prepare consignee account. So Adidas Co account, we have received a bank 50,000. Clear? We have received by bank 50,000. That is done. Next, what is happening? As an advance and later sent an account sales showing 80 shoes has been sold at 2,200 each. Sales. How will you record sales? Consignee account debit to goods sent on consignment. Sorry. Consignee account debit to consignment account. Correct? So what will be the posting? By consignee. Who is the consignee here? By Adidas Co. So by Adidas Co. Correct? By Adidas Co. How much? 2,200 into 80. Clear? 1,76,000. He sent 80 shoes at 2,200. So that will be sales. Next, what has he given? Expenses incurred by Adidas Co on go down rent were 2,000. So two expenses are there, 2,000 and 1,530 for octroi duty. What will be the entry? What will be the entry? The entry will be, we have to pay to the consignee. So Adidas Co you will credit debit you'll do consignment. So consignment to Adidas Co account, debit to Adidas Co account. So to Adidas Co account, you have recorded octroi duty 1530, go down rent 2000. Now one more is commission you have to pay. Next, see what has it given. Adidas Co is entitled to a commission of 5% of invoice price and 25% of any surplus over sale price over invoice price. Correct? So how many goods did he sell? Calculation of commission. Commission will be on sales rate. So they have given there is ordinary commission. Correct? And there is overriding commission. Correct? What will be the ordinary commission? He has sold 80 goods. They are telling that on invoice price 5% commission will be paid. On invoice price, what is invoice price? 2000 into 5%. Clear? And overriding commission will be whatever surplus is there. What is surplus? 2200 is what he sold at. Invoice price is 2000 into 25% that type. So whatever 200 excess is earned, on that 25% commission should be paid. Look at the solution here. Computation of abnormal loss, closing stock, computation of commission. Commission or overriding commission. Sale at invoice price is 1,60,000. So 5% on 1,60,000, 8,000. And surplus over invoice price is 200. Commission on 25% of that is 4,000. So the total commission is normal plus surplus commission 12,000. Clear? So even commission same posting 12,000. Clear till here? Yes. Next. Next, read the question. Insurance claim was settled at 14,000. An insurance claim is settled at 14,000. What will be the entry? You've already recorded the abnormal loss. You have to reverse the abnormal loss. How much was the abnormal loss? 16,150. The entry for insurance claim will be abnormal loss. Already you debited, right? So insurance company is receivable. Correct? Insurance company account debit 14,000. You have to close abnormal loss. Abnormal loss is 15,160. So out of 16,150. Out of 16,150, 14,000 has been claimed. So the remaining is your loss. So P&L account debit 2,150. Clear? So we don't have to pass anything in consignment account or consignee's account. Next, what is happening? Prepare consignment account, consignee's account. Okay, done. These are the transactions that have happened. Now we have to record closing stock. How much will be closing stock? Record closing stock. So closing stock will record with loading, right? So it will be 2,000 rupees per shoe into how much is closing stock? Total 100 were sent, 10 were lost in transit, 80 were sold. So 10 shoes are there. So 20,000 closing stock. What else? Plus expenses spent by consignor. How much? How much was spent? 11,500. So 11,500 were spent for 100 goods. What is it for 10 goods? For closing stock. How much? 1,150. Yes. One more thing is some expense was spent by consignee also on inventory. Correct. Go down rent we won't consider because that is storage cost exclusion. But octroi duty we have to consider. So that duty, octroi duty is how much? 1,530. So this 5,530 was paid for how many goods? It was paid only for 90 goods. So if for 90 goods it was that, what is for 10 goods? Calculate this amount, you will get the answer. Let's see, in calculation they would have given invoice price 20,000, then the expenses spent by consignor and octroi duty 1,530 divided by 90 into 10, 170 rupees. So the total is 21,320. You will record inventory. So you will record by inventory on consignment 21,320. Now because loading is there, two things you have to do at year end. Remove loading from both the sides. On goods sent on consignment, whatever loading was there, total loading should be credited by goods sent on consignment. How much? 500 per shoe into 100, 50,000. Total loading, will remove it here. And on whatever closing stock loading is there, how much loading is there? The loading is how much? 500 per shoe into 10, 5,000 only. Don't consider the expenses here. The loading is 500 per shoe into 10. So that will pass it to inventory reserve. It's inventory reserve, you can say 5,000. Clear? If you balance it, you will get 31,440. It is the profit on consignment. Now consignee account, if you see, whatever we passed in consignment account will come here. Consignment to Adidas Co. These three, correct? And whatever sale has been happened will be posting. This is just simple posting, whatever we posted in consignment account. The balance will be, if in question they say the balance is remitted, then write by bank account. If they have not told anything, you can just write balance, carry it down, whatever is the balance. If they say bank, write it as bank. Clear? This is consignment account. Be careful with the inventory. What all you should be careful about? One is abnormal loss. Abnormal loss is one. One is closing stock and removal of loading. Clear? Now just see what will happen to all the accounts. Now whatever Adidas account we opened, this will go to P&L, the balance will go to P&L. Okay, good enough. The goods sent on consignment account, we debited 2 lakh here, we credited 50,000 here. So balance is 1,50,000. It has balance, credit balance. What will happen to that? It will go to trading account. Why? Because in trading account you would have recorded purchases. You have to reduce this from purchases because this is not sold. This is not coming in closing stock. You have to reduce whatever sent from consignment. So goods sent on consignment will be closed using trading account. What else? Anything else that we open? Abnormal loss will go to P&L or claim. Correct? Inventories on consignment will go to balance sheet along with the closing stock. Reserve will go to balance sheet under reserves. That's all, right? Clear? Adidas account also will have a balance. This is the consignment arrangement, guys. Clear? Clear? Consignment arrangement. Next. So these were the entries in consignor's books. In consignee's books, what will be the entry? This is very easy. Consignee's books. So what will be the entries? He is not concerned with the inventory. Clear? No matter what, he is not concerned with the inventory because it's not his property, it's not his risk. So whenever goods sent on consignment, he'll get a pro forma invoice. He won't record anything. When will he record? Only when the account current is sent. When the account current is sent, before the account current is sent, he'll have to make the sales, right? Make the sales. When he makes the sales, what will be the entry? If cash sales he is making, what will be the entry? He'll get cash or bank account debit. To this, he has to pay it to someone. Who is that? Consignor account. Consignor account. So in his books, whatever sales he is making, pass it to consignor account. What if it is credit sales? He'll record debtor also. Debtor account debit to consignor account. Clear? When he makes the sales, he won't pass it to P&L. Why? It's because it's not his sales. So he'll pass it to consignor account. For whatever expenses spent, it will be consignor account debit to bank. Whatever expenses spent. Correct? This will be the entry. Next. Next. If he has paid to consignor, obviously that entry is fine. If we are sending some amount to consignor, the entry will be consignor account debit to bank. Next, when commission is receivable, he has to record commission. Commission he will record in P&L, correct? So you can record commission income. How will you record? Commission is his income, right? Correct. So consignor account debit. Consignor has to pay it, so it's receivable from consignor to commission account. Clear? This will be for commission because it is his income. Now, what if normal commission was paid, then it is fine. This will be the entry. If del creditor commission was paid, whatever bad debts will be there. So debtors, if it is not received, what will be the entry? Now debtor is in his books. Now something becomes bad debt. What will be his entry? He'll have to reverse the debtor to debtor account. So normally he'll pass it to consignor account because it's not his expense. The bad debts, normally he'll pass it to consignor account because it's not his expense. But what if del creditor commission is paid? Whatever commission paid is del creditor commission. Then you have to. Then what will you do? You will record bad debts. You won't pass it to debit to debtor account. This will go to P&L. P&L this will go. Commission normally goes to P&L as income. Bad debts, only if del creditor commission is paid, you will record bad debts. Otherwise, you have to pass it to consignor account. Clear? That's all. We are done with consignment as well. Next concept. Next topic is average due date. A simple topic. What is average due date? And it will come for, like, generally continuously it's coming for 4 marks. So don't leave it. So average due date. What is average? It is averages of due date. For example, we have a debtor. We have someone, Mr. X. Mr. X is a debtor. He has to pay us 2 amounts, 10,000 each. One he has to pay on 1st of April. This is the due date I'm talking. And second one is of 10th of April, let's say. 10,000 he has to pay on, like, one is, this is due date 1st of April, the other is 10th of April. He says that, okay, 1st of April is not possible for me, it's too soon, I'll pay late. How late? For example, he says 5 days I'll pay late. 5 days I'll pay late. We'll be like, no, you have to, like, pay it on the due date, or you pay me interest for 5 days. Or one more thing you can do is, if 5 days late you are paying here, right? 5 days late you are paying. This amount, whatever 10,000 is there, you pay 5 days early. Correct? So total 20,000 amount, you pay it on 5th of April. Done. So if you are paying early, I'll have to give you like a discount. If you are paying late, you have to pay me interest. So better pay the total amount 20,000 on 5th of April, and we can avoid the interest and discount, etc. This is the concept of average due date. But here the amounts are same. So average we calculated just like that. But amount need not be the same. Correct? So we have to do weighted average. Correct? For due dates, we have to weighted average. So so average due date is nothing but finding out a date on which neither party, so whoever receivable is there and payable is there, neither party is losing on any interest. Clear? So this is the topic of average due date. How will we calculate the average due date? We'll take an example, solve it, and close average due date. Now let's take an example. Same, Mr. X has to pay the following amounts on different due dates. Now before we go there, how will you find out due dates? Same concept. Correct? If they tell it is bills receivable or bills payable, if they tell bills receivable or bills payable, your due date calculation should be in the same way. Correct? If they tell from 1st of January 2020, we did this, right? 3 months. Then it will be 1st of April 2020 plus 3 grace days. So 4th of April 2020. If they say from 1st of April 2020, 90 days, then we calculated 1st of April you leave. How many days remaining in January? 30 days. February 29 because it's leap year. Plus how many days do we require for 90 days? 31. So March 31st will be our due date. Correct. Plus 3 grace days. So 3rd of April 2020 will be our due date. Correct. Calculate due date in this way only. If they don't tell bills, if it is not bills receivable or bills payable, then don't add grace days. Calculate the number of days in the same way, but don't add grace days. Clear? If it is not bills receivable or bills payable. Next, if it is a public holiday, previous day will be the due date. If the due date turned out to be on a emergency holiday, then the due date will be next date. Clear? So this due date calculation you should know, because every time they won't give the due date directly. Sometimes they'll give bills receivable date is this, like the period is this much. So you have to calculate the due date. Once you get the due date, now for example they have given you due date. Now due date is, one is 1st of April 2020, then next 5th of May 2020 and 20th of May 2020. So these amounts are receivable, let's say, and on these date different amounts are receivable. First is 10,000, next 5,000, then let's say 10,000 again. Now on different dates different amounts are receivable. Now let's change the amount here. Let's say 20,000. So 10,000, 5,000, 20,000. Total how much? 25, 35,000 is receivable from Mr. X. Now they say calculate average due date. They say calculate average due date. We have to calculate. How will you calculate? The formula for average due date formula is base date plus sum of product divided by sum of amount. Clear? This is the formula. Now what is base date, what is sum of product, we'll find out. Base date, always take the earliest date as base date. Okay, so base date, for in every question what is the earliest due date you take. What is the earliest due date? 1st of April. So 1st of April 2020 is our base date for this. Clear? So the formula 1st of April 2020 plus something. What is sum of product? Sum of amount we have 35,000. Sum of product we have to find out. Calculate number of days from base date. Base date is what here? 1st of April. Calculate the number of days in each case. From 1st of April to 1st of April is 0. Clear? In case of base date to base date it is 0. From base date to 5th of May, how will you calculate number of days? Exclude the 1st of April. How many remaining in April? 29 days plus 5 days in May. 5. So 34. Clear? 34. Next, in case of 20th May, how many days from base date? Don't take from 5th of April. From base date. 29 days in April plus 20 days in May. 49. Clear? So now you find out product. Product is nothing but amount into number of days. So this will be 0, this will be certain amount, and this will be certain amount. Clear? Let's say you get that amount. Just a minute. You calculate these amounts. 5,000 into 34, 1,70,000 and 20,000 into 49, 9,80,000. Total will be 11,50,000. So this is the sum of product. So we'll do sum of product divided by sum of days. This will be in terms of days, correct? Here we are taking number of days. So whatever you get result, this result whatever you get will be in terms of days. So solve this. From 1st of April 2020, you have to add how many days? 11,50,000 divided by 35,000. 32.86. So round it to 33. 32.86.8. So round it to 33 days. 33 days from 1st of April. Add how many days in April remaining? 29, correct? So 33 minus 29 is 4, correct? So 4th of May 2020 will be the average due date. Clear? Now they'll give you in the question that okay, Mr. X wants to settle the amount on 30th May 2020. So he wants to settle on 30th May and the interest is 12%. Then what will you do? The total amount 35,000 should have been paid on what date? On what date? Average due date 4th of May. But when did he pay? When is he paying? 30th May. So how many days delay? From 4th, exclude 4. 30 minus 4, 26 days delay. So into 12%, 12 by 100 into how many days? 26 days delay. 26 out of 366 or 365? 366, because it's 2020. You should always have that in the back of your mind, whether it's a leap year or not. So 35,000 into 12% into 26 divided by 365. 299 rupees will be interest. So total amount payable will be what? 35,299. Clear? This will be the type of question that they'll ask you in average due date. What is the formula? Average due date formula is base date. Base date is your earliest date plus sum of product divided by sum of amount. Easy. Next, this is the one type of question that they'll ask. What is the other type of question? Now, for example, we told that from Mr. X, this is receivable, correct? From Mr. X, 35,000 was receivable. Now, if we are preparing, now for example, we are Mr. Y. So, in books of Mr. Y, Mr. X has to pay this amount. What if Mr. Y also has to pay to Mr. X? This is receivable, right? Correct? This we said is receivable. What if there is payable also? Payable to Mr. X. Payable to Mr. X. How much? Let's say some two amounts are there, which is due on 20th April 2020. Some 15,000 is due, and 5th of May 2020 some 10,000 is due. So total 25,000 is payable to Mr. X. Receivable from Mr. X is 35,000. Payable to Mr. X is 25,000. In this case, how will you solve the problem? The formula will be average due date is equal to base date plus difference in sum of products divided by difference in sum of amounts. Clear? How will you do it? The base date will be what? It will be the same. Base date will be only one date. It can be either this or that. The earliest is 1st April. So let it be 1st April only. 1st April. Then you prepare this table. So whatever this table we prepared here, this table, you prepare it for both the parties. So one we have prepared here 35,000 and 11,50,000. You do it here as well. Total amount is this. Number of days from base date is number of days from base date from 1st of April to 20th of April, 19 days. From 1st of April to 5th of April, 29 plus 5, 29 plus 5, 34 days. Calculate the product. 34 into 10,000, 3,40,000, 2,85,000. Take the sum. 6,25,000 is the sum of product. How will you calculate average due date? Base date remains same, 1st of April 2020 plus difference in sum of products. What is the difference? Take the higher amount, 11,50,000 minus 11,50,000 minus 6,25,000 divided by difference in sum of amounts. What are the amounts? 35,000 minus 25,000. Clear? What will it be? 1st of April plus 5,25,000 divided by 10,000. Correct? So 1st of April plus 52.5 days. So 53 days will take. 53 days from 1st of April. How much it will be? From 1st of April, 53 days. 29 days will be 53 minus 29 will be in April. 24th of May 2020 is the average due date. On this date, who will pay to whom how much? The excess is receivable. So receivable from X on 24/5/2020, which is average due date is 10,000 rupees. 35,000 minus 25,000. 10,000 he is paying on 30th May, right? Now calculate interest. 30th May. How many days delay? 6 days. So on 10,000 you have to calculate interest. 12 by 100 into 6 by 366. 10,000 into 12% by 366 into 6. 19.67. 20 rupees he'll have to pay interest. Total payable will be 10,020. Clear? This is the case when both the parties have receivable and payable. Alright. What will be the formula? Average due date. Average due date is equal to base date plus difference in sum of product divided by difference in sum of amounts. Clear? This is the entry. Next, what if there are installments? So there can be loan transactions. Correct? There can be loan transactions when, for example, on 1st of April 2020 1st of January 2020 a loan is taken for 5 lakhs, which is repayable with 10% interest. Which is repayable with 10% interest in 5 installments. 5 installments. What will happen? Then next every year 5 annual installments. 5 annual installments. Understand? Now 1st of January we have taken 5 equal annual installments. So what will be the payment terms? On 1st of January 2021, 2022, 2023, 2024 and 2025. 1st of January in all the cases you will pay 1 lakh principal correct, and you will pay interest. Interest will be how much? 5 lakh into 10% for first year. For this period you will pay interest here, correct, on from 1st of January 2020 to 1st of January 2021 you will pay on 5 lakhs, correct. 5 lakh into 10% will be 50,000, Next, when you pay from 2021 to 2022, you will pay interest on only 4 lakh because here you already paid one installment. So your principal decreases. So 4 lakh into 10%, 40,000. Next, 30,000. Next, 20,000. And next, 10,000. Clear? Now, this is the interest paid. Correct? Now we have to find out an average due date where a fixed amount of interest can be paid by the company and neither of the party loses any interest. Alright, so the due dates we have are 5, right? The due dates we have are 5. We want to find out a average due date where neither of the party loses any interest. So the formula for this is average due date is equal to some base date, but base date here won't be the earliest due date. What is the earliest due date? 1st of April. This won't be your due date. Your due date will be date of loan. So base date plus sum of days or months or years. Here it is years. So sum of years from date of loan to date of repayment of each year divided by number of installments. What do they mean by this? Sum of years from date of loan to date of repayment. So date of loan to date of repayment. So what is the first date of repayment? 2020 to 2021. How many years? 1 year. Next 2 years. Next 3 years. Next 4. Next 5. Sum of years from date of loan to date of repayment of each year. It is 1, 2, 3, 4, 5. 1 plus 2 plus 3 plus 4 plus 5 is 15. Correct? What is the date of loan? 1st of April, 1st of January 2020 plus sum of years is 15. Correct? This sum is 15. Total how many installments? 5 installments. So this will be in terms of years. So in the previous question we did in terms of days because we took days. Here we are taking number of years. You can take days as well. It will become complicated. That's all. So from 1st of April 2020, you will add 15 by 5 is 3 years. Then from 1st of April 2020, 2021, 2022, 2023. So 1st of April 2023, if the amount is settled, then no loss to interest. This will be average due date. Clear? Clear? That's all with average due date. We did the questions here itself. We have done examples. Next, account current. Account current is nothing but a ledger. Account current is nothing but ledger between two parties. For example, Mr. X is preparing his books. He wants to prepare account current of Mr. Y. Let's say there are transactions between Mr. X and Y, both purchase and sales, and for that they have due dates. For a particular purchase, what will be due date? For particular sale, what will be the due date? And for the amounts will be paid on different dates. For interest calculation, for the total interest calculation, this account current is prepared. All right, let's see the format. We'll do an example and we'll understand how it works. So the format is a little bigger. So the columns you'll have is some 6 columns on each side. The columns will be six columns on each side. Extra? No. So similar to ledger account. Date, particulars, amount, due date. So for the transaction, what is the due date? What is the number of days? How to calculate number of days? We'll discuss. What is the interest? Next, same thing on credit side. Particulars, amount, due date, then number of days and interest. How does this work? For example, there is one opening balance of Mr. Y. Let's say it's receivable. Receivable means you'll have debit balance. So for on 1st of January, you have an opening balance to balance brought down. You have an opening balance of, let's say, 1000. We'll take small amounts. On opening balance, you don't have a due date, a particular due date. So due date you'll put same from 1st of January itself. Number of days will be the date on which the account current is being prepared. Now let's say this account current is being prepared on 31st January. The same month we have to close. So from 1st of January to 31st January, how many days? You have to include 1 day. So 30 days. Clear? Next. Now for example, one sale was made. What? Sale was made to Mr. Y. What will be the entry? Mr. Y account debit to sales. Correct? What will be the posting? To sales. Let's say on 5th of January to sales account. Some 2000 rupees. And we said you can pay it in 15 days. 15 days from 5th. So 20th January he has to pay. So for this 20th January, number of days will be from 20th January till the date of closing, which is 31st. So 11 days. Correct? Let's say one purchase was done some 2 days later from Mr. Y. What will be the entry? Purchase account debit to Y. Some 7th of January to, so by purchases, let's say the amount was some 500 and he gave you due date that you can pay it on 20th. He said you can pay it on 20th. So due date is 21. How many days? From 21 till the closing. Again 11 days. Let's say you received some amount. You received some amount from Mr. Y. What will be the entry? Bank account debit to Mr. Y. So by bank on 10th of January you received by bank. How much did you receive? Let's say 2000 you received on that date. Whenever bank transaction is there are no due date. So take the date of transaction itself. 10 of 1. Number of days will be from 10 to 31st. 21. Correct? Let's say you paid some amount. On what date? On 25th you paid. 25th you paid to bank. Correct? Mr. Y account debit to bank account. You paid some 1000. No, you paid some 500. Let's say you paid some 500 on 25th. So due date column also you'll put 25th. And from these till 31st, how many days? 6 days. Correct? Now let's say that's all. Your transactions are done. Now you have to close the ledger. How will you do it is, first you will calculate interest for each and every row. On each side. What will be the interest for opening balance? 1000. Let's say interest rate they have given is 10% per annum. Alright. So first 1000 into 10% into 30 days divided by, let's say, 365 days in a year. 8.22. You will record it here. Similar way you will calculate interest on both the sides. 2000 into 10% into 11 divided by 365. 6.03. 500 into 10% into 6 by 365. 0.82. On credit side, 500 into 10% into 11 divided by 365, 1.51, and 2000 into 10% into 21 days. 21 days, yeah, 21 days into divided by 365. So 11.51. On both the sides, you calculated the interest. Balance the interest column. Balance the interest column. Which side is higher? Debit side is higher. 8.22 plus 6.03 plus 0.82. 15.07. 15.07 minus 1.51. 2.05. 2.05. This is by balance of interest on 31st March. On what date? 31st January, you balance the interest. Whatever you get on credit side, bring it to debit side in amount column. Okay, on 31st March, you got the balance on credit side, bring it on debit side to interest. Interest, how much? 2.05 is the interest receivable, net interest receivable. Now balance the amount column. Balance the amount column. How will you do it? Which side is excess? Debit side is excess, right? 1000 plus 2000 plus 500 plus 2.05 minus 500 minus 2000. 1002.05. 0.05 by balance carried out. Clear? This is simple. This is nothing but a ledger account. Just that you have to calculate interest for each and every transaction, including the opening balance. Alright, how will you calculate this? Days will be the due date, from the due date up to the date of preparation of account current. Clear? This is the way account current is prepared. So there are three methods which are followed for account current. One is interest method, which is what we did now. Interest method will be this, what we did. There is one more thing called product method. Whenever we follow product method, what we do is, here number of days will remain same thing. So this will remain same, this will remain same, this will remain same, this will remain same, this will remain same. Here you won't calculate interest, you will calculate product. Here you will calculate product. Product of what? Product of what? Amount into number of days. Amount into number of days. You will get the product here in this column. Here also you will get the product. You will have a balance of sum of product. For that you will calculate interest. How will you calculate? Balance of product you will get. Clear? Balance of product, not the sum. Take the sum, balance it, balance of product into rate of interest into 1 by 365. Clear? So you are multiplying it not by number of days. So for one day, how much will it be? You will calculate interest. You will record it the same way here. By interest, balance of product into rate into 1 by 365. This is the product method. One more thing is there called product of balances method. Product of balances method. Balances method. This is generally done in case of banks. This is used by bank. This is used by bank. Now focus. What will be the format for this? Date, particulars, debit, credit, or you can just put amount, debit or credit. Then okay, let's do debit, credit, balance, then days, debit product, credit product. Okay, what is this? Now it is used by bank, we said, right? It is used by bank. How will it be used? Now for example, Mr. X has an account in one bank, let's say SBI. SBI is preparing account current of Mr. X. Now Mr. X has some opening balance. 1st of January, there he has some opening balance. So balance is, now balance in bank will be what? Will be always be credit, correct? So by balance, how much? Credit. Say 10,000. 10,000 he has balance. So sorry. So it won't be coming here. 10,000 he has credit. All right. Next, let's say on 5th of January, he made a deposit. When Mr. X makes a deposit in bank, what will be the entry? In bank, what will be the entry? They are getting the amount. So bank account debit to Mr. X. Correct? They have to record deposit, right? They have to record deposit. So by deposit account. Now let's say they are receiving, cash has been deposited by Mr. X. Sorry, not bank. Cash has been deposited by Mr. Bank, right? So bank is receiving cash. So cash account debit to Mr. X account. So by cash, let's say 5,000 has been deposited. Debit or credit? Always credit. In bank books, it is being credited. So his balance will become 15,000 credit, right? Now let's say on 10th of January, he deposited the amount. He deposited some amount. What is the amount? He deposited some 20,000, let's say. Out of 15,000, 20,000 means what? Overdraft. So let's say what will be the entry? It's reducing X account. So Mr. X account debit to what? To bank. Bank is nothing but self. Correct? To self. How much? 20,000 debit. Correct. He's withdrawing. So his bank balance will increase. How much will be his balance? His balance will be 5,000 debit now. Correct. Now let's say 20th of January, he again deposited cash. So by cash, how much he deposited? Some 10,000. His balance will become 5,000 debit now. On 31st January, you have to find out balance. To balance, how much is it? You have to find out. All right. How much is it? You have to find out. Now, how will you prepare account current is, number of days will be from the date in the row till the next transaction. So from 1st to 5th will be here. So 4 days. From 5th to 10th, 5 days. From 10th to 20th, 10 days. From 28th to 31st, 11 days. All right. Now debit product, credit product is like, if you have debit balance, do debit product. If you have credit balance, do credit product. Now here what is happening? 10,000 credit. So credit product 10,000 into 4 is 40,000. Next, again credit 15,000 into 5, 75,000. Next, 20,000 debit. Sorry. 5,000 debit into 10 days. So 50,000 in debit product. Next, here 5,000 credit, right? 5,000 credit into 11, 55,000, right? 55,000 credit product. Clear? Now you will get sum of debit product and sum of credit product, 50,000, and here 75, 55, 40, 1,70,000. Now let's say they tell that on all the credit transactions, the credit balances, they'll give you 4% interest, and on all the debit you have to pay 6% interest. Now how will you calculate interest? Is interest on debit balances is equal to 50,000, which is product, into what is the interest? 6% into 1 by 365, because we are taking number of days, and interest on credit will be 1,70,000 into 4% into 1 by 365. Calculate how much is it amount into 4% divided by 365, 18.63, and 50,000 into 6% divided by 365, 8.22. Correct? So debit balances is that, credit is that. On credit transactions, bank will have to pay, and in case of debit, customer will have to pay. So net interest payable by bank, no? Payable by bank, because credit transactions are something that the customer owns. Debit is overdraft. So 18.63 minus 8.22, 10.41, the bank will have to pay. What will be the entry if bank has to pay? For bank, it's an expense. So expense account debit to X account. So on 31st January, before finding out balance, by interest, you will debit it or credit it? You have to credit it. How much? 10.41. Your balance will become 5,010.41 credit. Clear? So your balance is 5,010.41 credit balance. This is product of balances method, which is used by bank. We are done with the special transactions, which were bill of exchange and promissory note. We started with that. Then sale on approval or return basis. Then next we went to consignment, then average due date, and then account current. Now we have left is our theoretical framework. Clear? So in theoretical framework, there are some 6 to 7 units in your study material. How important is it? Some at least maybe some 5 to 10 marks maximum will come from the total of theory, and they might ask more in maybe true or false. Right? We'll quickly go through what all is there in theoretical framework. First is accounting meaning. We discuss this. What is the accounting meaning? Accounting is the process of recording, classifying, summarizing the events and transactions, right? Events and transactions, and analyzing, interpreting, and communicating the results. Whatever results came out of recording, classifying, and summarizing, that will analyze, interpret, and communicate to the users of financial statements. Now accounting process we all discussed. We saw how to record, how to classify, how to summarize, how to prepare financials, etc. Now communication will be financial statements. Who are the users of financial statements? One will be owners, which is investors. Correct? Next, employees, just to see how well it's doing. Government with, for sure, to see whether you are complying with all the laws and whether you are paying enough taxes. Then your creditors, maybe to see how trustworthy you are. Then your lenders, your banks, whether you are trustworthy enough to, and like the company is strong enough to give the loan, etc. Like these are the users of the financial statements. Correct. What is the benefits of accounting? Benefits or objectives of accounting. One, we can find out what are the financial results. Profit or loss will be ascertained. Financial results. Next, you can find out what is the financial position on a certain date, correct, which is balance sheet, right? Financial results, financial position. We can maintain systematic records, means whatever transactions have happened, we have what is the journal, what are the transactions have happened, how we have classified is, we can maintain systematic records, and it will be helpful in what? Decision making of owners of government or banks, etc. It will be helpful in decision making, correct? So these are the benefits of accounting. What are the limitations of accounting? There are certain limitations as well. What is that? First, it is complicated. How it's complicated? We have to make some estimates, different calculations, dual aspect, many concepts have to be followed, etc. One is complicated. Second, it only gives historical information. So in decision making it is helpful, but it gives only historical information. What happens in future, it won't tell. The financial statements won't tell. Third, ignores inflation. The financial statements are prepared at what is recorded, what is the value of your currency, etc. All that we are not bothered. Fourth, ignores non-monetary items. What are non-monetary items? We record assets, but for example, a company has, for example, Tata, they have thousands of employees, loyal employees, correct? Isn't that a strength of Tata? Correct? They have so many employees, they are a strong company. So shouldn't that be an asset of Tata? Correct? Tata Group has lots of employees. Shouldn't be that an asset? It is an asset, but can we, in general terms, we can tell yes, they are assets of the company, but do we record that in accounting? No, because that's non-monetary. So limitations are, one is complicated, it only gives historical information, what happens in future we have no idea. Next, it ignores inflation, and it ignores non-monetary items. Clear? Then there are some subfields of accounting. Even accounting is evolving every day. Some or the other new things are coming up. What are those subfields of accounting? One is financial accounting, what we are doing, correct? Financial statements are prepared, we are communicating. There is something called management accounting. This is internal accounting of the management. Maybe they'll manage inventory and see how well they are doing in managing everything, etc. That is management accounting. This is not for external use, this will be normally for internal use. Cost accounting, inventory management. Again, it's difficult, right? Because inventory chapter says we have to find out the cost particular way. All that maintenance is called cost accounting. You have social responsibility accounting. What is this? To the environment, how harmful are you or how well are you? That is accounted. This you'll learn later, like in final or after final. Human resource accounting. This will be like finding out the value of employees, right? In financial accounting it's not done, right? Finding out value of the value of employees. So that is done in human resource accounting. Clear? Then they have given something called role of accountant. What is the role of accountant? What is the role of accountant? You will know in articleship. What is the role of accounting? One is Books of accounts should be maintained every day. Journal should be prepared at the end of every month or end of every year. Ledgers have to be prepared, trial balance, etc. Then audits, whatever audits, statutory audit, internal audit, tax audit, there are different audits. Stat audit under Companies Act, internal audit is mandatory in some cases, tax audit under income tax. All this taxation accountant have to do. Then consultancy services, advisory services on various topics. It need not be only accounting, it will be investments, insurance, etc., etc. So all those, even advisory services, the role of accountant is important. Clear? So these are some general theory topics that they have given. Just give it a reading, not that important. Next, accounting concepts. Important, a little from exam perspective, but more for accounting purpose. The more you understand these concepts, the better it will be for your the overall accounting knowledge. What are those accounting concepts? We will discuss one by one. Some we have already discussed. Let's finish that. What is that? One is accrual concept. We discussed this in the chapters, right? What is the accrual concept? That irrespective of when the payments are done or when the receipts are there, the income and expenditure of the current year should be recorded in the current year itself, irrespective of whether it is paid or not. Yes, that's why we learned topics of outstanding, prepaid, accrued, paid in, received in advance, etc. Right? One is accrual concept. Next, we learned conservatism concept. Right? Where did we learn that? Cost or NRV, whichever is less. Correct? We tell that estimates of expenses always have to be recorded, but estimated income should not be recorded. Should be recorded only when it is realized. We learnt matching concept. What is matching concept? Says that whatever revenue has been recorded, relating to that revenue only expenses should be recorded. So expenses relating to that inventory should be matched. That's when you'll get the correct profit. Yes, we did that. Some other concepts are there, we'll learn. One is entity concept, which means that owner is separate from the business. That's why we owner's money, whatever is there, we show it on the liability side as capital, that the business owes to the owner. Correct? So entity concept is nothing but the business is separate from its owner. Money measurement concept. That whatever transactions we account, we measure it in terms of money. Correct? Only monetary transactions will record. Next, periodicity concept. Means we prepare financial statements for a period. Correct? Normally a year. In case of India, the financial year is from 1st of April to 31st of March. Next, going concern concept. Says that you are expecting that the business will continue its operations for a foreseeable future. Means the future that you can see today. As of today, the foreseeable future, to the extent that you can see, you can tell that, okay, this company will continue its operations and there is no chance of liquidation as of today. Clear? On the basis of that, you prepare accounts that it's a going concern. Means the company will continue in foreseeable future. Cost concept. That your assets should be recorded at cost, historical cost. Realization concept. Any changes in the assets or even income should be recorded only when it is realized. It can't be recorded when it is estimated. Dual aspect. This we know in double entry bookkeeping system as itself, that every transaction has two aspects. One is debit, one is credit. Next, conservatism concept we already did. Materiality concept. Materiality is like only significant transactions are recorded. Any insignificant amount, if it's there, we ignore it. And even in financial statements, significant information is disclosed in the balance sheet and P&L. That's why we do grouping, correct? For example, you have a table, you have a chair, you have everything, but what will you do? You will show everything as furniture in the balance sheet. That is nothing but materiality, that the significant effect is shown, correct? Next, these are the accounting concepts. There are some fundamental accounting assumptions. Fundamental accounting assumptions. These are the accounting concepts itself, but these are considered more important. Why? One is going concern, that the business will continue in the foreseeable future. One is accrual, that the, what is accrual? Accrual means only current year profits and expenses should be recorded in profit and loss, irrespective of whether it is paid or received or not. Next is consistency. Whatever policies we use, we have to apply it consistently over the years. So these are the three fundamental accounting assumptions. And this one thing important to note is, if not followed, if followed, you don't have to disclose in financial statement, because it is fundamental accounting assumption. It's assumed that it is ongoing concern, it is accrual, and it is consistency. These are the assumptions. If not followed, then you should disclose in financial statements. Clear? Fundamental accounting assumptions. So it says that you are assuming, like it's an assumption that these three are followed. If not followed, you present it in financial statements. They have given one more concept called quantitative characteristics of financial statements. What should be the characteristics? One is understandability. These are very general. Understandability, that it should be understandable to a normal person, not to the accountant. Accountant can make it as complicated as possible, but it should be understandable to a normal person. Relevant information should be given. Only relevant information should be given, what is required in the decision making. It should be reliable. Errors should be avoided. And fourth is, it should be comparable, that the financial information should be comparable with previous years as well as comparable with other entities. So these are the characteristics of financial statements that they have given. Next topic in theoretical framework is capital and revenue expenditure. We have already discussed this, correct? If the benefits last beyond 1 year, then capital expenditure. If it is within 1 year, less than 1 year, then revenue expenditure. Few things you have to consider is, what is the nature of business, whether it is recurring or non-recurring, then what is the purpose of expense, and what is the materiality. And revenue earning capacity, we have already discussed. The benefit, if it is for more than 1 year, capital, less than 1 year, revenue, right? There's a concept called contingent asset and contingent liability. What do you mean contingent? Contingent means that it depends. It depends on some factors, correct? So they're telling that some assets can be contingent, some liabilities can be considered contingent. So what are the definition? Contingent asset is like, it's a possible asset. Contingent asset is a possible asset, arises from past events. So because of what has happened in past, arises because of past events, but so it's a possible event. It's not there. It's a possible asset which has happened because of past events, but existence, whether that asset is there or not, the existence will be confirmed by happening or non-happening of an uncertain future event. Uncertain future event. Right? It is a possible asset which is arising out of past events. So because of what has happened in past, it's a possible asset. But it might be there, might not be there. But the existence will be confirmed by by happening of an uncertain future event. What is contingent liability? On similar lines, it's a possible obligation arising out of past events and existence will be confirmed by uncertain future event. Example for this can be court cases, that something has happened, we might have to pay a fine, or we might not have to pay a fine, but that depends on whether the uncertain future happens, in which favor the decision goes to or not. Now what has to be done for contingent asset and contingent liability in our financial statements? Contingent asset we will not record, we will not disclose in financial statements. Why? Again, conservatism concept. Estimated profits cannot be shown, not disclosed in financial statements. It can be, however, disclosed in board report. Whatever report is given to the board of directors. Who are the board of directors? Management of the company. To them, it can be disclosed. It cannot be disclosed in financial statements. Next, contingent liability. What is a contingent liability? What do we have to do to this? It should be disclosed in financial statements, not recorded. We won't record it as liability in books. It should just be disclosed in financial statements. It should not be recorded. Not to be recorded as liability. Right? What else? Provisions we have already done. The definition is given here. Provisions means it is a present obligation. It's not possible. It's a present obligation of uncertain amount. You don't know what amount is it. That's why you make a provision. What's the example? Provision for bad and doubtful debts. You don't know exactly how much is it, but some percentage of it you will create in the financial statements. Uncertain amount which can be measured reliably using estimates, accounting estimates. Clear? And provisions should be recorded. Provisions should be recorded in balance sheet. Correct? Clear? Next, there are some accounting policies. What is we'll learn something called what is accounting policy and accounting estimate. Accounting policy and accounting estimate. What is the accounting policy? Accounting policy is nothing but principles and method of applying the principles. In case of recording of any financial items in financial statements. So what is the principle and how to apply that principle is what is accounting policy. Example for this in what you have already done is the methods to value inventory valuation. What are the methods? FIFO, LIFO, simple average, weighted average. These are accounting policies, and accounting policies should be chosen, one among them. So these are the accounting policies of inventory valuation, and one has to be chosen. And they have given some criteria of how to select. Selection of accounting policy. What should you consider? One is materiality. Like what kind of effect it gives on the financial statements, is it material or not? Second, substance over form. For inventory valuation, with which method is suitable, you have to see how it affects your business rather than the form of the asset. Like on paper how it is, you should ignore. You have to see how it impacts your books and like what fits your financial statement better. Substance over form. And prudence. Prudence is nothing but cautiousness, conservatism, correct? Cautiousness you should apply when selection of accounting policy is given. Now once accounting policy is taken, if you want to change in accounting policy, when can you do it? They have given change in accounting policy if possible, if it is required by law, or required by accounting standard. Accounting standard is also a law. We'll discuss what it is, the next topic. The next, better presentation. If you think that change in accounting policy will be a better presentation, it will give a better view of the financial statements, then you can change accounting policy. So this is the theory regarding accounting policy. What's an accounting estimate? In depreciation, you estimated some 2-3 things. What is that? Useful life. What is the estimated useful life? Or what is the estimated residual value at the end of some 5 or 10 years? You are making the estimates today, correct? So what is accounting estimates? Accounting estimates is finding some value of a component today using your judgment, correct? Accounting estimate is finding value of some component of financial statement today using your judgment, correct? Example is again useful life of the asset or residual value of the asset. When you find out, those are accounting estimates, right? Accounting estimates should depending on the circumstance, should be depending on circumstance today. So today what is the circumstance? Depending on that, you will find out a value of a component. Now in depreciation we figured, no, for example asset, if there is a change in useful life of the asset, if after some 2 years, so initially you thought 10 years is the useful life, after some 2 years you see that the asset is still in good condition and it can come for 10 years from then, the total useful life will become 12 years. So as on the date, as on present day, you should consider your estimates, correct? So it won't remain the same throughout the period. Clear? So that is the theory about accounting estimate. Next, valuation process. So how will the financial components will be valued? They have given something like that. What is valuation? Valuation is nothing but measurement, correct? Measurement of financial items, right? So it should be valued in the currency in which you are preparing your financial statements, or the currency which is relevant in your country, correct? The valuation principles, in what all ways can you value it? One is cost, what we follow for inventory cost or NRV, whichever is less. One is realization, what can be realized. Cost or NRV, we discussed this in inventory itself. Even for depreciation it is cost, current cost. An example for this will be revaluation method that we followed in depreciation, that whatever is the current market cost, can we find out that will be the value of the asset. And one is present value. Present value is nothing but if you know that after 10 years it will be 10 lakhs. After 10 years it will be 10 lakh. If you know that today what is the value of it? That is nothing but present value. Clear? So these are the accounting policies. We discussed accounting policy. What is it? say how should we select accounting policy? Then if there is change in accounting policy, when is it allowed? When is it allowed? Permissible when these things happen. Next, accounting estimate, depending on the circumstance. Today you should find out the value of component of financial statement and you should use the estimate. And valuation process, there are 4 principles: cost, realization, current cost and present value. Clear? So cost we mean historical cost. Correct. Historical cost. Then next we have the topic of accounting standards. Accounting standards. You will be reading these accounting standards in your CA Inter. Now just know what it is. Accounting standard is nothing but these are like written policies written. Like policies written by whom? Our institute itself. They have written policies that okay, for every particular area of financial statements, this is the for fixed asset, for example, how to record it, how to record depreciation. They have given a standard. They have given a standard that this should be followed. That is accounting standard. You learn this in detail. All the accounting standards you learn in your CA Inter. Now you have to just learn what is it. These are written policies prepared by ICI but issued by government. How they have issued, we'll discuss. Issued by government. So these are prepared by ICI. So what does AS cover? AS cover recognition, measurement, presentation and disclosures. So all the accounting standards have this. What is recognition? Every item, whether it is asset, liability, income or expense, how should you recognize it? Should you recognize it or not? If you recognize, how to recognize it? They have given here. Then measurement, at what value should you measure? They have given that. Presentation, how should you present that in the financial statements? And what are the relevant disclosures you should give? So all these of what? Of all the transactions and events. Accounting, we learned, right? Definition of all the accounting transactions and events. They have given that this is the recognition, measurement, presentation and disclosure of all the transactions and events. They have given in those policy documents and that you have to follow. Clear? Now what are the advantages and disadvantages? Advantages is in the name itself. Standard means there will be standardization. There will be standardization. There will be more disclosures. And obviously, if everyone is following the standards, the financial statement will become comparable. Like comparable financial statements. So these are the advantages. What are the disadvantages? Why do we have to learn so much? So complexity. Clear? So what are the disadvantages? Complexity. They have given how they'll set the accounting standards. What is the method of like preparing those accounting standards? So first, ICAI here, our Institute of Chartered Accountants of India has set up a committee called Accounting Standards Board. Okay, they have Accounting Standard Board. In that, various committees will be there. There will be a chairman. There will be many members who will work on the accounting standards. So, Accounting Standard Board will get a draft. For example, there is some standards. For example, AS1. They will get a draft of AS1. Means they'll prepare. Okay, this is the draft of AS1 that we are thinking of. The draft will be sent to various parties. Who are the various parties? ICI council members, the management of ICI basically, ICI council members, the various government agencies like SEBI, RBI, whether they are fine with it. They'll send it to the government as well, whether they are fine with it. They also invite suggestions from members. So once you qualify, they will post it in our website that this is the draft. If you recommend any suggestions, you can give those suggestions as well. So even to the members of ICI, they give the opportunity that even they can give the recommendations. After taking recommendations, and if the accounting standard boards thinks it is good, then they will apply all those recommendations, and the final draft for accounting standard will be given to whom? To ICI. Who will give? Accounting standard board we will give, and ICI and ICI will issue it for non-corporates. Who are non-corporates? Individuals, partnership firms, etc. All this ICI will issue those accounting standards, and government will issue in case of corporates. This is the method how AS comes into place in our country. Clear? There is one more thing, the last topic, Ind AS. This beast you will meet in your CA finals. Alright, what is Ind AS? Ind AS is called Indian Accounting Standards. One is Accounting Standards, which is general. One is Indian Accounting Standards. This currently is being followed only by companies. Is being followed by companies of large companies, basically large companies with net worth of 500 crore or more, etc. There are criteria. So only large companies are following this because government has asked them to. What does Ind AS do? Ind AS is a complicated version of AS. That's all. All right. How did it come into place? So the rest of the world. So we were using accounting standard till 2016-17. We were following only accounting standards. In 2016, but the rest of the world was following something called IFRS. They are still following. Majority of the countries follow something called IFRS, which is International Financial Reporting Standards. Okay. India was behind with accounting standards. Accounting standards is like very simple compared to IFRS, so it can't be compared. So comparability becomes an issue. So India, what they did, they said we will also take IFRS, but we will change it a little bit. According to our requirements. So they didn't implement IFRS itself. What did they do? They converged the standards of IFRS into some standards called Ind AS. Clear? So who did this? Again, the same process was followed. ICAI made the drafts, took the approvals, got the Ind AS, and Ind AS was issued by the central government for all the companies of a certain net worth. Clear? So Ind AS is similar. So these two are similar, like more than 95% it's similar. But few things we have changed according to our requirements. Those are called carve-outs and carve-ins. Means whatever was removed from IFRS was carve-outs, and whatever was implemented by us new was carve-ins. Clear? So few changes were made to IFRS. The language was changed a bit, and we got Indian accounting standards. What is the point of these accounting standards? What is the benefit? Comparability, which comparability becomes easy. Comparability of financial statements of rest of the world becomes possible because of Ind AS. And obviously because it's more complicated, it gives a more clear and more informed financial statements. Like more and more details are given. All the, like, for example, discounting is done in many cases, etc. You learn this in accounting standard. Just that one is more aspects are covered, that it, like, the financial statements are better. Second is, most important is, comparability with the financial statements of the rest of the world who are following IFRS became possible because of Ind AS. Learn this much. Clear? So we are done with our marathon revision. We have taken around 15 hours, 15 to 16 hours roughly, I suppose. So that's all done, guys. We have covered almost every concept of the chapter. I apologize if anything is missed. So please go through the video, practice enough questions, and write the exam well. All right. Thank you so much. All the best for your exams.